Let's begin the CA Inter Auditing and Ethics Marathon, which is applicable from September examination onward. September, January 26, or even if you're a May 26 student, absolutely you can watch this and rely upon this. And what are we going to cover in this marathon? I straight away tell you, very simple, 80 marks coverage. 80 marks coverage. Remember, in CA Inter, we totally have 11 chapters. In CA Inter Audit, we have totally 11 chapters. We are going to cover all the chapters except 3. Different types of entities, risk assessment, items of financials. These 3 topics, I am going to take a separate video through my newly developed chart notes. Yes guys, I have developed complete audit chart notes, which is just 130 pages. And for your information, I think many of you know, like your seniors or your friends would have told, GOAT notes, which is exactly 260 pages, entire CA Inter Audit in 260 pages. Trust me guys, this is the only book that you need to study. You don't have to touch any other book. And I challenge, I bet, study this book thoroughly. You listen to this marathon and get clarity on this marathon, this entire subject, and get a command on this book. Go and write the exam. Mark my word, not even a single question you will miss. Every question you will understand, every question answer you will be able to write. Such a kind of clarity that I will give you through this marathon and through this book. And along with this book, if you are reading this 130 pages chart notes, exactly 130 pages. Generally, I hate the concept of chart notes. I personally hate the concept of chart notes. But many students, for a mind mapping purpose, they are continuously asking me, sir, where is the chart notes? Where is the chart notes? We want chart notes also for a easy memory mapping, mind mapping, all that. That is why the GOAT notes, we even further simplified and then developed this chart notes where not even a single point from the GOAT notes, not even a single point from the ICS study material will be missed. Everything is covered 100%. Even if you read this chart notes, ignoring the GOAT notes, you still get decent amount of clarity on the subject. But never, chart book is never a substitute. That's why at the beginning itself I mentioned this point, read along with GOAT notes. This is never a substitute for GOAT notes. This is for a quick revision, for multiple revisions. Since it is in just 130 pages, you can easily do well. Now, so that's about the GOAT notes and chart notes, and these are the resources I'm going to use. The next 12 hours which you're going to watch, right? 8 chapters marathon. What are the 8 chapters marathon that I am going to cover in this particular 12 hours video? You know, almost everything. First, you will have fundamentals discussion, then nature, objective and scope, ethics and terms of engagement. In this itself, quality control related discussion is there. SQC and 220 standard. They will be at the last of this video if you see the timestamp. Audit report, entire 700 series, 570, 299. So many. Completion and review chapter, okay, and documentation, audit evidence, different types of entities, audit evidence and audit strategy and planning, audit of banks. These are the topics I'm covering, whereas these 3 chapters I will give a separate chart revision. In August month probably, or maybe by July end itself, I will upload chart revision marathon as well on CA Inter Audit, where chart revision marathon will be less than 5 hours, entire subject will be less than 5 hours. 100% coverage. So that revision also I'll be uploading. You will feel fantastic guys, trust me. The clarity that you get even on the chart notes is amazing. But remember, the chart note marathon you should watch after finishing this particular marathon. And now further, sir, I want to order this particular book hard copy. Where can I get? First of all, if some of you want to take a print directly, you don't want to order the book and want to take a print directly from PDF, go to Sept for CACMA website, septforcacma.com. Free resources, you go here. Here you see P5 GOAT notes. Okay, here you can download the notes, you can download the question bank. Here itself I will upload chart material as well. Further, you want a colored notes hard copy. You know, you just come to books, select CA Inter, and you know, scroll down. Here you will find the books. Only notes you want, you can order, or a question bank set also you can order. I will show you the highlight of question bank also. Question bank is also colored one, yeah, where keywords are highlighted. Even the keywords are highlighted in the question bank. Colored question bank, keywords are highlighted. Fantastic, and one of the best question bank you ever see in CA Inter Audit. Everything we are giving you. We are working so hard, putting our complete heart and soul. It is now your turn to study sincerely, use these resources and get me exemption in CA inter audit. Further, some students often ask me, sir, can I get exemption just by watching this marathon? I can promise you, you will get a very good amount of clarity. Wherever you have taken coaching, I don't bother. But I'm telling you, the kind of clarity that you get in audit after watching this marathon is something different. The clarity that you will have is amazing. You will only thank me in the video below. By the way, subscribe and like the video if you really love the marathon. Okay, so because many students are watching this, they're using the marathon like anything, but they're not subscribing or liking the video. But if you like and subscribe, it will be recommended to most students. It will be helpful for many. Okay, fine. Now some students ask me this question, sir, can I get exemption in CA inter audit just by watching this marathon and reading from the good notes? It depends upon level of command you have already. See, this is a revision class, this is a marathon. 100% discussion we can't do. 100% in the sense in-depth discussion, how in exam, how in-depth the questions will be asked, that entire in-depth knowledge, in-depth discussion may not be possible in the marathon, right? So if at all you want to get Pakka exemption, sir, I will watch the marathon, I will watch chart marathon, but I want to score at any cost exemption. Forget about exemption. Target 75 plus 80 plus in audit. You know, if you want to, you can directly enroll into our EVO Smart. Okay, you can enroll into full group, or you can also enroll subject wise. Okay, there is an audit pro course. You can see here, there is an audit pro course. Inside this, I will give you 85 hours of content approximately, where the GOAT notes is completely thoroughly explained. Question bank, 600 plus questions we solve in the classroom. MCQ discussions, case study discussions we do. 4 tests will also be given. 4 test papers will be given. Answers will be given. Scheme of evaluation will be given. Now tell me, will marathon give you a guarantee exemption, or will this course give you a guarantee exemption? That is your choice. Definitely this course is 5 to not even 5, 10x powerful than the marathon, no doubt about it. This course is 10x powerful. But having said that, you might have already invested in with some other faculty, you might have already listened to the previous some audit classes, like you don't want to enroll again. It's okay, no problem. You watch the marathon, 99% I'm sure you will love the subject, you will start loving the subject. You watch the marathon, use the GOAT notes, use the chart notes, use the question bank, go and write the September exam, work hard, get exemption, reward me with your thanks message. That's enough for me. That's it. So clear? I think I explained regarding what I'm going to cover, what chat book, GOAT notes, question bank, everything. I'm going to very soon, I'm going to publish these 3 put together, one combo, deadly combo, we are naming it as. That's it. Have a nice time. All the very best. Continue watching the marathon. Fundamentals, then nature objective, then ethics and terms of engagement, then audit report, then documentation, then completion and review, then audit evidence, then strategy, then SQC, then bank audit. I think that's the order. Look at the timestamps below, you will find it. Okay, have a great day. Continue watching. All the very best. I will see you soon with exemption. Bye bye. Let's begin the first topic, that is fundamentals of auditing. Just 1 minute. I'll store this file as a separate file. Yes, let's begin fundamental topics, first revision. Very simple. What is definition of audit? We all know definition of audit means audit is an independent examination of financial information of any entity, whether or not profit oriented, irrespective of size or legal form, when such an examination is conducted with a view to express an opinion thereon. Correct? Now, very simple. Why audit? The question is simple. Today we are all investing cross-border, like across offshore entities. We are buying at offshore entities shares, like foreign company shares. Foreigners are buying our Indian company shares. We are buying, just opening stock market, some angel broking, Zero the app, and we are blindly buying shares of various companies. The behind the logic is very simple. They are all audited, they are all certified by chartered accountants, saying that they are all genuine, the numbers are genuine. So if Reliance company published something called we made a profit of 20,000 crore for this quarter, without any doubt we are believing that, because auditors are there who certified that these profits are genuine. So by believing these audit reports, all that, we are blindly investing in those companies crores of money. Entire public is investing crores of money. Yes or no? So what auditors are actually doing indirectly? Auditors are giving confidence to public. Yes or no? People like you and me, without knowing anything about what is happening inside the company, doctrine of indoor management, we don't know nothing. We don't know anything about the company. Yes or no? We are still investing in those companies just by believing their numbers in the balance sheet, numbers in the P&L, which are certified by chartered accountants. Yes or no? So what is that particular certification? What is that process? That process itself is called as auditing. Audit. Yes or no? What happens in audit? Ultimately, the auditors, they verify this balance sheet, because we don't go anywhere into the company. We don't know anything about the company. We don't know anything about their books of accounts, how they're doing business. We know nothing. But we appointed auditor. He will go on behalf of us, and he will verify each and everything in depth in the company, whether balance sheet, whether P&L, the numbers, 9 lakh crore, 10 lakh crore, 5 lakh crore, 3 lakh crore, Tata Motors 3 lakh crore turnover, Reliance close to 9 to 10 lakh crore turnover, whether these numbers, whether these profits, are they reliable or not? These auditors will visit the company, verify those numbers, and finally give us a report called audit report. And now how to give that audit report, how to do this audit is what we are going to learn in this subject. Now look at the definition. The same is what highlighted here. Audit is an independent examination. What is independent examination? You might have already seen in the ethics chapter. Independence has two perspectives. One, independence of mind. Another one, independence of appearance. Here they said independent examination. What do you mean by independent examination? They're mainly talking about mind. Yes or no? Auditor must examine. What you need to examine? Financial information of an entity. So what you need to examine? Financial information. Why you are examining? With a view to express opinion thereon. What is the objective? With a view to express an opinion thereon. So opinion giving is what ultimate. Remember, this opinion is two types. Like you might have seen in audit report chapter called unmodified opinion, modified opinion. Simply positive opinion, negative opinion. Yes or no? Very simple. Auditor went to the company. He saw balance sheet P&L. He saw background accounting data. Real or transactions are real or not. Balance sheet items, numbers, are they real or not? Assets, are they physically there or not? He will go and see. If at all they are not in reality, what is shown on the paper, what is there in the reality, both are not matching. Auditor will directly give negative opinion. Suppose what is shown in the company balance sheet and what is there in the reality, if both are matching, then auditor will come and give positive opinion. Tell me, will this objective, nothing but simply tell me, what is the objective of the auditor? To give opinion. What is the objective of auditor? To give opinion based on evidence obtained by him. Based on evidence obtained by him. How he will get evidence? He will go and verify financial statements. He will go and verify balance sheet. He will do something called verification, and that verification is called as what? Examination. And that verification is called as audit procedure. In our syllabus, everywhere in the upcoming chapter, there are so many places where you will hear the word, where you will see the word audit procedure. Audit procedure is nothing but examination. Audit procedure is nothing but verification. Why are you doing? Why are you verifying? Because I have to give opinion to the shareholders. They all send me to check whether the balance sheet and P&L is correct or not. So I have to give an opinion to them. So if I have to give them opinion, first I should get the opinion. If I have to get the opinion, I should verify. If I have to verify, I should go and physically meet them, check the records, all that. This process is called as audit procedure, and whatever information I am getting, right, when I am verifying, I will get information from company, I will get information from records. That information which I am getting is called as audit evidence. Are you getting it? Now, so audit is an independent examination of any entity. Okay, whether or not profit oriented. Tell me, is audit necessary only for profit entities? For example, many religious trusts, religious temples, religious mosques and all were there. Charitable institutions were there. Non-profit entities were there. They are also dealing with money. There is also a possibility that what they show in income and expenditure, what is there in the reality, there is a possibility of mismatch. So audit is necessary for every entity. It may be profit oriented, non-profit oriented. Why are we doing audit at the end of the day? Whether the balance sheet, whether the P&L, are they right, are they wrong? We are doing audit at the end of the day only for one thing, whether the balance sheet and P&L, are they right or are they wrong? Are they correctly showing the real picture? Are they window dressing? What is it called as? Window dressing. So are they manipulating? Are they showing a manipulated picture? So at the end of the day, auditor want to check whether balance sheet and P&L, whether balance sheet and income and expenditure, whether you call it as income and expenditure account, whether you call it as profit and loss account, whether it's a profit oriented company, whether it's a non-profit oriented company, whether it is a small company, whether it is a partnership firm, whether it's an AOP, whether it's a society, it doesn't matter. Legal form doesn't matter. Size doesn't matter. Your business objective doesn't matter. At the end of the day, as an auditor, I will verify your financial information and I will tell to people whether that information is reliable or not, correct or not, I mean right or wrong. That's only my duty. My duty will not change. My objective will not change because of your objective, because of the size, because of the form. My objective remains same. Now, what do I examine? Financial information. This financial information is two types. Just a minute. This financial information is two types. What are they? Books of accounts and financial statements. Correct? Just a minute. So the financial information is broadly divided into books of accounts and financial statements. Now, books of accounts means, we know, remember, we have to give opinion on what? We have to give opinion on financial statements, correct? Financial statements are what? Balance sheet, P&L, notes, and cash flow statement and statement of changes in equity. These are the financial statements, and on this we should give opinion, and our opinion is two types, either positive or negative, unmodified opinion or modified opinion, correct? Now, you know, these financial statements are multiple types. These financial statements are two types: general purpose financial statement, special purpose financial statements. Special purpose financial statements are those which are prepared using special purpose framework. General purpose financial statements are those which are prepared using general purpose framework. Our entire subject is from the context of general purpose financial statements audit. The entire CA Inter, what we are learning audit is audit of general purpose financial statements. That is what we are actually learning. We do not have in our syllabus audit of special purpose financial statements. For that, we have something called 800 series standards. Standard SA 800, 805, 810, like that some series is there. So that is there only in CA final. We have in our syllabus standards on auditing from 200 to 720. Sorry, 710 only. 720 also we don't have in our syllabus. We have in our syllabus standards from 200 to 700 series. And remember, we totally have 35 standards on auditing. We totally have 35 standards on auditing. I'm talking about auditing standards. There are 3 more auditing standards which are 800 series, which are dealing with special purpose framework related standards. Okay, so main standards 200 series to 700 series, we have only 35 standards in our syllabus, and the following standards we don't have in our syllabus: 240, 250. In 200 series, these two standards we do not have. Then in a 400 series, 402 we do not have. 402 we don't have. In 500 series, 540 we do not have. In 600 series, 600 and 620 we do not have. In 700 series, 720 we do not have. Totally 2, 3, 4, 5, 6 and 7. Totally 7 standards we do not have in our syllabus at all. But if you see audit report chapter, 600 related, one content is there. 600 standard has so many. But one point is covered in audit report chapter. Only to that extent 600 standard we have in our syllabus. Rest of the standards, remaining 29 standards we have in our syllabus. Now, often students ask me this question: how many marks standards weightage? Literally speaking, 80 plus marks standards only we have. All the chapters are nothing but standards. Only these chapters, what are they? Bank audit. What is it? Bank audit. Items of financial statements, different types of entities, only these 3 chapters are not called as standards. Out of 11 chapters, only these 3: bank audit weightage 5 to 7 marks, different types of entities 12 marks, this one 12 marks, hardly 12 plus 2, 24 plus 7, maximum 30 to 35 marks only remaining syllabus. Entire syllabus of 80, minimum 80 marks to 85 marks is standards only. Minimum 80 to 85 marks of the syllabus that we have is standards only. from these 29 standards. For example, if you see the first chapter, nature, objective and scope of audit, it deals with 200 standard. Ethics and terms of engagement, it deals with SA 210, SQC 220. Audit documentation, one chapter is there, SA 230. Audit evidence chapter, 8 standards. Completion review, 6 standards. Audit report, some 7 standards we have. So every chapter that we are discussing, for example, there is a chapter called strategy, which is nothing but 300. Risk assessment, internal control chapter is there, 315, 320, 330. 3 standards are covered in risk assessment and internal control chapter. So literally speaking, what we are discussing is standards only predominantly. Able to understand. Now, so look at, so financial statements are 2 types. What are they? General purpose financial statements, special purpose financial statements. Special purpose financial statements are those financial statements which are prepared as per special purpose framework. You know, whether it's a general purpose framework, whether it is a special purpose framework, they are dealing with financial reporting frameworks. They are talking about what? Financial reporting framework. You might have heard this word, applicable financial reporting framework. What do you mean by applicable financial reporting framework? Remember, a bank, for example, you take a bank, they have to prepare financials. Insurance company has to prepare financials. Electricity company has to prepare financials. But all of them, they don't prepare financials in the same format. A normal manufacturing, trading company, service industry, software company, they also prepare financials. Why to that extent? Schedule 3 itself, you see, it has 3 divisions. Division 1 deals with those entities who are following accounting standards. Division 2 format deals with those entities who are following Ind AS. Division 3 deals with NBFCs. So Schedule 3 itself has 3 frameworks. Schedule 3 itself has Division 1 framework, Division 2 framework, Division 3 framework. So an entity has to prepare financial statements as per respective framework applicable to it. For example, NBFC will prepare financial statements as per Schedule 3, Division 3. Yes or no? Whereas a normal company, manufacturing company, listed company has to prepare financial statements as per Division 2. A bank has to prepare financial statements as per Banking Regulation Act. So depending upon nature of the entity, and objective of the financial statements. Who will prepare financial statements in any organization? Management. Who will prepare? Management will prepare financial statements. Is it auditor's responsibility to prepare financials? Never. It's always the management responsibility to prepare the financial statements. Depending on the nature of entity, objective of the financial statements, whatever financial reporting framework, depending upon nature of entity, objective of financial statements, depending upon this, whatever financial reporting framework management is adopting, whatever financial reporting framework they are following, that financial reporting framework is called as applicable financial reporting framework. Are you getting it? Now, what do you mean by financial reporting framework? Financial reporting, another word is framework. Framework refers to guidelines, rules and regulations, policies and procedures, any way you can call. Framework refers to guidelines. Yes or no? Financial reporting means what? These guidelines for what? These guidelines are for preparation and presentation of financial statements. These guidelines are for preparation and presentation of financial statements. So rules and regulations for preparation and presentation of financial statements is called as financial reporting framework. What is a special purpose framework? Special purpose framework is a financial reporting framework where financial statements are prepared in accordance with requirement of a specific user. For a specific user purpose, if at all I am preparing balance sheet P&L, we call them as special purpose financial statements. Look at any company, in reality, whatever the financial statements, balance sheet P&L you in a day-to-day life you see, they are not prepared for any one particular person objective. They are not prepared for any specific group of users or specific user purpose. These financials are prepared generally. Every year, 31st March, they prepare financial statements in India by every company. For what purpose they prepare? There is no specific purpose. Generally, they prepare. And those financial statements are called as general purpose financial statements. General purpose financial statements are those which are prepared using general purpose framework. What is general purpose framework? You know, you can see here. General purpose framework means what? General purpose framework is a financial reporting framework. Remember, in entire auditing, whenever the word framework comes, we are only discussing about financial reporting frameworks. Yes or no? General purpose framework is what framework? That is dealing with financial statements only. It's a financial reporting framework. How that framework is designed? It is designed to meet common needs of common financial information needs of wide range of users. Common financial information needs of wide range of users. Very simple. You see schedule 3. Schedule 3 balance sheet format, P&L format, accounting standards, are they drafted? Is schedule 3 balance sheet, P&L, accounting standards, are they drafted for keeping in mind any particular section of the people? No. Whether you are a banker, whether you are a shareholder, whether you are an insurance company, whether you are a tax authority, whether you are a government, whether you are an employee, most of you, every one of you want to know how much turnover I am making, how much what expenses I am incurring, how much profit I am making, how much capital I invested in the business, where I invested in the business, what liabilities I entered into. This information is what everybody want to know from my business. Yes or no? This information is what everybody want to know from my business. Getting it? So I am giving that information, like how much I invested in the business, capital, how much savings I have, reserves, where and all I invested, assets, what all obligations I have, liabilities, how much income I generated, turnover, what expenses I incurred, how much profit ultimately made, how much each shareholder is getting per share. Common information which everybody is looking for. I am keeping in one set of financial statements, and that financial statements are called as general purpose financial statements, and that framework is called as general purpose framework. Are you clear? You know, general purpose framework has these characteristics: fundamental assumptions, gap, accounting standards. They are the one which is prepared actually every year. So our entire audit subject, we are discussing what audit? We are discussing audit of financial statements. Which financial statements? General purpose financial statements. We are not discussing special purpose financial statements. We are only discussing general purpose financial statements. Clear all of you? Next, now this financial reporting framework, no, again two types: compliance framework, fair presentation framework. This framework is again two types: compliance framework, fair presentation framework. Don't worry, I will slowly enter into the subject. Already these are all important questions. MCQ purpose, these are all will come. Getting it? General purpose framework means what? Special purpose framework means what? Compliance framework means what? Fair presentation. Actually, this entire discussion is there in the audit report 700 chapter. In SA 700, this entire discussion is there at the introduction. But without discussing this, we can't start the subject. Getting it? Now, compliance and fair presentation. What is a compliance and fair presentation? Remember, across the world, general purpose financial statements follow fair presentation framework approach. They don't follow compliance framework approach. Compliance framework means what? You know, suppose there are some rules which are talking about preparation of financial statements. If the rules are drafted like this, like you should prepare financial statements strictly as per the rules, no deviation at all, then that rules nature is called as what? Compliance framework. Fair presentation and compliance, this is talking about the framework nature. This is talking about the nature of the framework. If the rules and regulations are such that you cannot deviate from them, you should blindly follow them, then that rules are called as compliance. Suppose if the framework nature is like, you can deviate. You can deviate for achieving fair presentation. To achieve fair presentation, for better presentation, if at all rules are permitting you to deviate, then those frameworks are called as fair presentation framework. For example, hypothetical scenario, let us assume accounting standard says you can only follow SLM method or WDV method. Hypothetical assumption. It's not reality. Accounting standard is very good. It is permitting deviations and all. But for a scenario, for the purpose of example sake, let us assume accounting standard is saying either you can follow WDV method or you can follow SLM. But I bought a machine which depreciates based on how it is used. Based on number of units produced only, it will depreciate. First year I produced 10,000 units. Second year I am producing 5,000 units. Third year I am producing 20,000 units. Fourth year I am producing 40,000 units. Fifth year again I am producing 10,000 units. So my machinery useful life is directly decided by units produced. In such case, what method is suitable for me? Units method, production unit method is suitable to me. But when I am calculating depreciation, my accounting standard is saying I should either follow SLM or WDV, but not units method. If at all accounting standard says like this, yes or no? Now, I am a company incorporated under Companies Act. My Companies Act is also saying you should prepare financials as per accounting standard only. They are saying like that only. For example, then the framework is compliance. Tell me, in this case, if I follow SLM or WTV, will it reflect truly depreciation, matching concept and all? Will it truly reflect the substance over form? No. Unfair. Equal depreciation is unfair because my machinery is not used equally every year. Unfair that method is. Are you getting it? Suppose if my accounting standard or Companies Act, if at all they are saying you can achieve true and fair view. What is important is true and fair view is important. If at all Companies Act is saying true and fair view is important. Luckily 129 subsection 1 Companies Act says true and fair view. What Companies Act says, you should prepare financials as per schedule 3, as per accounting standard, and they should give true and fair view. Originally they are saying follow accounting standard. Originally they are saying follow schedule 3, but true and fair view is also important. Suppose if at all accounting standard, what rule accounting standard is there? No, what rule accounting standard says, if at all that rule is not correct for you, you can deviate. Follow what is right according to you, so that financial statements ultimately reflect true and fair position. What is the difference between true and fair? True means it's only fact. Fairness means genuinity. Able to understand? Very simple. I sold goods to a customer for 100 crore. I sold. Credit basis I sold. In my balance sheet, 100 crore I showed in the first year. Second year and third year, customer became insolvent. I can only recover 50% from him. I can only recover how much? 50% from him. 100 crore is the sale value. 100 crore is a liability. How much I can recover? Only 50 crore I can recover. But I am showing to the balance sheet. I am showing to the public, everybody, I have 100 crore worth of asset. Tell me, you have 100 crore worth of asset. It is true. But can you show to the public that you are really having 100 crore worth of asset? Tell me how much you can recover. Only 50 you can get. 100 crore you can't get. Only 50 you can get. 50 crore if you show, that's fair presentation. Are you getting it? Financial statements, no. They should not only show true number, they should also show fair number. Getting it? Fairly tell me, logically tell me, reasonably tell me how much you can recover, and that is called as fair. Able to understand? So true and fair. Now in a fair presentation framework, fairness will be given major importance than the trueness. Able to understand? Now what is a fair presentation framework? It is a framework where financial statements are prepared according to the framework. You follow the framework guidelines only, but you can deviate from the requirement of the framework if at all fair presentation is to be achieved. If you want to achieve fair presentation, you can deviate from the framework. Getting it? You can also include disclosures beyond the framework. Suppose, with respect to plant and machinery, schedule 3 is saying disclose 5 points: useful life, residual value, expert related, who estimated this, registered value, revaluation, some information. If at all you felt there is one more important data relating to plant and machinery, suppose some plant and machinery damage happened. But schedule 3 is not asking you to disclose that. But plant and machinery got damaged. Yes or no? Without showing the damage, people might misunderstand company has so much of valuable plant and machinery. So disclose the damage related information also, because that is what fair, that is what genuine. Able to understand? Can I disclose additionally like this? This is a question. Suppose you want to disclose additionally. Can I disclose additionally? Framework is silent on that. Framework is not prohibiting you. If at all framework is silent on additional disclosure, you can happily disclose. If that is the kind of framework that you are following, then that framework is called as what? Fair presentation. So when do we say a framework is a fair presentation? Point number 1, it will give you permission to disclose additionally whatever you want. 2, it will give you flexibility to not to follow that rule. Follow some other rule. At the end of the day, ultimately fair presentation should come. Ultimately what you are showing must be true and fair. So the words true and fair view in the auditor's opinion, right? You might have seen the word opinion. Auditor has to give opinion whether financial statements are showing true and fair view or not. That you should give opinion, right? Whether true and fair view word, that true and fair view word will appear only in this type of framework. In a compliance framework, no. In a compliance framework, no, we straight away give opinion that financials are prepared as per the law. That's it. Are they prepared as per the law or not? That's it in a compliance framework. Luckily, we don't have in India compliance framework at all. Not only in India, across the world, the frameworks are fair presentation frameworks. That's it. Next, what is the objective of the auditor? Now let's enter into objective of the auditor. In your first chapter, nature, objective and scope of audit. For example, you see nature, objective and scope of audit. This is in the first chapter. Yeah, I think fourth concept. Objective of the auditor is what? The auditor should obtain reasonable assurance that the financial statements are free from material misstatement, whether due to fraud or error. You must obtain reasonable assurance whether the financial statements are free from material misstatements. I am appointed as an auditor of Tata Consultancy. I am appointed as an auditor of Tata Motors. I am appointed as an auditor of Reliance Industries Limited. My objective is very simple. Whether this balance sheet and P&L, is it free from material misstatement or not? Like, free from means what? Is it containing mistakes or not containing mistakes? If at all they are not containing any mistakes, we say that free from material misstatement. Suppose if they are containing mistakes, then I will say that they are not free from material misstatements. So my objective is to obtain reasonable assurance whether the balance sheet is free from material misstatements. Okay, once you got the assurance, what you have to do? The auditor has to report on the financial statements and communicate findings. You finally have to report on that. Fine. Now, before I discuss about objective, so misstatement. What do you mean by misstatement? One topic. Once this misstatement definition discussion is over, fundamentals topic will be over. Now, what do you mean by misstatement? Observe the definition carefully. Only highlighted part you see. What is a misstatement? It's a difference between reported financial statement item and that is required under applicable financial reporting framework. Difference between what is reported and what is required under framework. Getting it? Suppose a company prepared balance sheet, company showed some fixed asset value. What is shown in the framework? What is required as per the framework? That value. As per accounting standard, that value, how much you showed in the balance sheet value, both are same, then no misstatement. If there is a difference, then there is a misstatement. And you know, the definition says misstatements in financial statements can happen in 4 ways. It may be in the form of amount, it may be in the form of classification, it may be in the form of presentation, it may be in the form of disclosure. Now you see definition of misstatement. A misstatement is a difference between amount, classification, presentation, disclosure of a reported financial statement item and the amount, classification, presentation, disclosure which is required under applicable financial reporting framework. Amount, classification, presentation, disclosure required under framework what? What amount, classification, presentation, disclosure you showed? If there is a difference, then that's a mistake. Because what is there in the framework only you should follow. Able to understand? Whatever is there in the applicable framework only you should follow. If you're not following applicable framework, then that is called as a misstatement. Now, how a misstatement can happen in amount? Very simple. Inventory example you take. Lower of cost or NRV? Yes or no? That is a valuation principle, right? For example, company cost of inventory 100 crore. NRV value is 70 crore only. But company showed in the balance sheet 100 crore only. Yes or no? What the framework says? Framework says amount to 70 crore. But company showed what price? 100 crore. Now what you showed, what you reported, what is required to be reported, both are different. Then this is called as a misstatement. Tell me the misstatement. No, auditor will react on this mistake only when it is material. Only when it is material. That's why the objective standard says what? Whether misstatements are free from, whether the auditor has to obtain a reasonable assurance whether financial statements are free from not simple misstatements, material misstatements. Yes or no? Then second mistake, classification. Classification. Very simple. You know, if you classify fixed assets as a current asset wrongly. See, balance sheet total is same. Balance sheet total assets value is always correct. But what company did you know? Fixed assets they classified as current assets. Just they shifted from non-current to current, that asset. Because of this, what happened, you know? Company working capital position came positive. Company working capital position came positive. In reality, company working capital was negative. It is a adverse situation. Company financial position, liquidity position is adverse. As per liquidity analysis, company position is worst. But to show, in order to, but to hide this picture, what company did, they misclassified one big plant and machinery to current asset. They simply classified work in progress is there, capital work in progress. What they did, they treated it as revenue, inventory work in progress. They classified by misclassifying, a non-current item to current item. What company is indirectly showing, company has a very sound financial position, liquidity position is very strong, like that company showcasing. So through classification they can do mistake. Through classification they can do mistake. Another misstatement they can do is presentation. Another mistake they can do is presentation. How presentation mistake can be done? Debtors example you can take. Remember, debtors minus provision is equal to net debtors you must show in the asset side, correct? So when you are showing debtors, you must always show provision liability side, trade receivable left side, like asset side. This is not the right way of presentation. What is the right way of presentation? Trade receivable how much? Provision. Here itself you should adjust, and balance only you must show. This is the right way of presentation, correct? That's it. So misstatement can be done even in presentation. Fourth mistake, misstatement can be in disclosure. Financial statement, balance sheet, people only think mistake means amount. No, mistake can be in the way amount, or it can be in the form of classification, it can be in the form of presentation, it can be in the form of disclosure. Disclosure mistakes are two types. Partial disclosure is one way of misleading people. Non-disclosure, like you are not at all disclosing, that is also another way of misstatement. Again, these disclosures, we can do mistake in narrative disclosures, or we can do mistakes in quantitative disclosures. Quantitative disclosures means what? Very simple. If you see schedule 3, the employee benefit expenses is there, total amount in the P&L. Now breakup you should give. Employee benefit expenses, salary and wages how much, welfare expenses how much, provident fund, retirement benefit how much. Breakup you should give. That is just a disclosure requirement in the notes to accounts, and that is called as quantitative disclosure. Are you getting it? Same way, companies will also make some narrative disclosures. Narrative disclosures means what? I will show you in audit report chapter, notes to accounts. In notes to accounts, they will make some statements. We follow accrual method, we follow percentage completion method, we are recognizing liabilities like this, we are recognizing assets like this. Some narrative disclosure they give. If that is wrongly stated, if statements are wrongly made in the notes to accounts, then that's a misstatement in narrative disclosure. Able to understand? Now why we should understand misstatement these many types? Because our opinion wordings, our audit report wordings will vary. Our audit report wordings will change depending upon the type of mistake. In the recent January exam also, this is what tested. Able to understand? So with this, misstatement term is also over. So now this mistake will arise because of two reasons. Intentionally these mistakes might happen in the balance sheet, or unintentionally it might happen. If it is intentionally happen, we call them as fraud. If it is unintentionally happen, we call them as error. What is fraud, what is error? Not required for you. Are you clear? That's it. So with this, fundamentals on auditing is completed. Able to understand? Now the next topic is nature, objective and scope of audit. That's it. 2 minutes. Okay, we'll start the next topic. What clarity? Reasonably, yes or no? Yes. Let's begin the first chapter, nature, objective and scope of audit. In this, first I will directly discuss with respect to what is an engagement. There is a topic called what is an engagement. What are the benefits of external audit engagement? Many a times in exam from this segment only they will ask. This is one segment. In the first initial chapter, this nature, objective and scope. There is another segment, principal aspects to be covered in audit. Scope of audit includes what? Scope of audit excludes what? And inherent limitations. In this chapter, these are generally important topics. Scope of audit, aspects to be covered in audit, inherent limitations in audit, and from 7th concept, whatever I'm showing here, completely important. Getting it? Now, what is the subject that we are learning? Audit. Actual subject name is auditing and ethics. Though we don't have ethics related syllabus much, we only have little bit in ethics chapter. Ethical principles only we have in our syllabus. So technically what we are learning is audit. But we as a chartered accountant can provide various types of services. We as a CA can provide various types of service. In that, one service is audit. We are not only doing audit. One of the service that we render, we call it as audit. Typically, whatever works that we provide, we call them as what? Whatever works we do, it is called as engagement. In a business, no, it is called as a contract. In profession, no, that too in our CA profession, no, we call them as what? Engagement. Engagement means what? Here they have given a meaning. Engagement refers to a formal agreement between the auditor and client. See, at many places the word auditor is used. Just because the word auditor is used, the work you are doing may not be audit. You are simply called as, generally your popular name is what? Auditor. We are called as auditors. That does it mean we are doing auditor? The moment you are a CA, you are generally referred as what? Auditor. But right now I am doing teaching here. Getting it? Activity name is different. The person referred as is different. So in many standards, no, at many places the word auditor will be used. Actually there you are not actually doing audit service. You are doing some other work. But you are referred as what? Auditor. Just why I am discussing this, you will get it. So whatever work we do, we simply call them as what? Engagement. Engagement is what? A formal agreement between auditor and client. What are all works we provide? What are all works that we do, no? They are broadly divided into two types. They are broadly divided into two types. Assurance engagement. What is it? Assurance engagement. Another one is what? Non-assurance engagement. Assurance engagement and non-assurance engagement. Whatever work you do, these are the two ways. Getting it? For example, now tell me what we thought in our fundamentals, or what you know about audit, definition of audit. Audit means opinion we will give. Audit means what? Opinion. Opinion, why? Why are we giving opinion? So that our report, our opinion will be used by some third party and he will take some financial decision. Correct? So indirectly, we are giving confidence to third parties. Yes or no? People, shareholders, they invested thousands of crore money in the company and they are not allowed inside the company. They don't know what is happening inside the company. They are all tensed what is happening inside the company about their money. So we, on behalf of them, we went to the company, verified everything, top to bottom, 100% we verified, totally we verified, and then we are coming back and giving them opinion. Don't worry, everything is good, your money is safe. Indirectly we are giving that confidence to the users. Yes or no? That confidence that we are giving, right? And that confidence is called as assurance. That confidence is called as assurance. So if at all you are appointing me for giving you an assurance, that work is called as assurance engagement. Suppose if I am taking some work, for example, no, we know, right, auditors do IT returns filing, GST returns filing and all. Suppose, a client came to me, he just wanted me to file IT return, nothing else. He will give the data, he will give his income details and all. I will have to compute income tax as per income tax provisions, tax computation, and I will tell him how to pay the tax. He will pay the tax, then I will file the IT return. Is there any confidence I am giving to anybody here? Nothing. Yes or no? This is a non-assurance engagement. What is this called as a non-assurance? Example I'm just telling you. Getting it? Now again, you can give assurance on historical financial information other than historical financial information. The auditor can give assurance on historical financial information other than historical financial. For example, other than historical financial means what? Other than historical financial means nothing but prospective financial information. In the recent JAN exam, this was only asked, what is a prospective financial information, where the focus is on. In a prospective financial information, where the focus is on, what level of assurance generally will be there in the prospective financial information. This question is what asked in JAN 25 exam. Getting it? Fine. Anyhow, so we give assurance on historical financials other than historical financial. Now again, historical financial information, no, we give two levels of assurance. We can give two levels of assurance. One assurance is called limited assurance. Another assurance is called reasonable assurance. Another assurance is called reasonable assurance. If you recollect, just we have seen objective of audit. In the objective of audit, what we understood, the auditor obtains reasonable assurance whether the financial statements are free from material misstatement. Yes or no? Reasonable assurance engagement. What is it called as? Reasonable assurance. What is a reasonable assurance? High level of assurance. Reasonable assurance is a high level of assurance, but not absolute assurance. Reasonable assurance is a high level, but not absolute. You know, what is the reasonable assurance engagement? Audit. This is what we are learning in our subject. We are only learning one type of engagement. In our syllabus, we only have one type of engagement, that is audit, which is a reasonable assurance engagement, where we are giving assurance on historical financial statements. Tell me, we are giving audit report, right? We will give audit opinion, right? Are we giving opinion and report on future data, na past data, na? Past already past completed transactions, events, policies, balances, yes or no? On that we are giving report. Yes, that is reliable. No, they are not reliable. We are giving confidence to the people on the past financial data, and that is called as historical financial information. Now, on the historical, you can not only give audit, you also give review. You also give some, not only reasonable, sometimes you may give only limited assurance. Limited assurance example is what you know? Review. Limited assurance example is review. Review engagement. We call it as, what is it called as? Review engagement. Now, example, suppose I am appointed as an auditor for a listed company. Listed companies, every quarter, they need to file financial information with SEBI. Quarterly financial results, we call them as. But I have not yet started the audit. How we know? They're asking my report. Sir, we want your audit report on the quarterly financials. Sir, I am recently appointed. Just 1 month ago I am appointed. I have not yet started the audit. How can I give audit? Reasonable assurance and all, not possible. Then company told me, sir, no. Don't give that level of assurance. Just tell that nothing you found bad. You know, reasonable assurance is saying whether the financial statements are good or bad. Whereas review, no, I will simply say they are not bad. In a review, what I will say? They are not bad. Getting it? Because I don't know whether they are good or not. But I will briefly verify. I will logically see whether the balance sheet numbers, P&L numbers and all logically correct or not. You know, in a review, we perform two types of procedures. In a review, we perform two types of procedures: inquiry and analytical procedure. I hope you have heard of this inquiry and analytical procedure. You know it in audit evidence topic, you might have seen already. Now, whereas in audit, no, we do so many procedures: inquiry, inspection, observation, recalculation, reperformance, external confirmation, analytical procedure. So many we do in audit. So many types we will verify the data. Whereas in a review, we only inquire whether the data is correct or not. We only logically see whether the data is correct or not. When I logically see the numbers, no. When I logically see our company compared to last year, turnover increased, expense increased, profit also increased, everything is logical. I did not find anything suspicious. I will not go inside deep. I will briefly see analytically, is it correct or not. If everything seems correct, no, I will give opinion. No, sorry. I will give conclusion. What is it called as? I will express a conclusion. Nothing has come to my attention. How I will give? Nothing has come to my attention to say that the quarterly results are incorrect. Are they incorrect? To say they are incorrect, I did not have any evidence. I did not have any evidence to say that they are incorrect. Remember, on audit you must obtain sufficient appropriate evidence. Even in review also you must obtain sufficient. In audit, you must obtain sufficient appropriate for reasonable level. Whereas in review, you shall get sufficient appropriate level for a basic confidence, limited level of assurance. It is like something is better than nothing. Review is like something is better than nothing. Suppose if I saw a movie, it is fantastic, then I will say it is good to others. Suppose if it is not good, suppose it's okay, one time watch, then I will say it is not bad. Able to understand? Limited assurance is like not bad. Able to understand. So that is called as what? Review. Now, for audit, we have something called standards on auditing. For review, we have something called standards on review engagement. Then there is another assurance that I can provide. What assurance? Other than historical financial information, I can also provide assurance on Not only historical, other than historical. For example, I can provide assurance on PFI, prospective financial information, or I can also give assurance on controls at the entity. Controls at the entity. If you recollect in 501, there is a service auditor report. There is a wordings used called service auditor report when the inventory is with third party. Yes or no? Obtain a service auditor report on internal control system implemented at third party relating to inventory. That is nothing but assurance audit report. That is nothing but assurance audit report. Don't worry, if at all you're not aware of it, we'll discuss in the SA 501 standard. Clear? So I can give assurance on PFI, prospective, or I can give assurance on control. Now let's talk about prospective financial information. What is a prospective financial information? Prospective financial information is financial information which is prospective, which is future oriented. In future, how much is my sale? In future, how much is my expense? In future, how much is my profit? About future. How can I calculate future accurately? We can't. Future data is calculated based on assumptions. In a PFI, what auditor will give assurance? You know, he will not give assurance on the information. He will give assurance on the assumptions. In a prospective financial information engagement, the auditor will give assurance on assumptions used to prepare PFI, whether these assumptions are reasonable or unreasonable. Whether these assumptions are reasonable. Company prepared future estimated financial statements. We call them as projections. We call them as forecast. The prospective financial information is called as a projection. It is either called as a forecast. The auditor will give assurance on assumptions used behind the forecast. Assumptions used behind the projection, whether these assumptions are reasonable or not, whether these assumptions are unreasonable. But tell me, they're at the end of the day assumptions only. Can I give high level of assurance on that? I cannot give high level of assurance. High level of assurance means what? Reasonable assurance. I cannot give high level of assurance on future financial information. So, but I am giving assurance, right? Sorry, but I am giving assurance, right, at the end of the day. Yes or no? On PFI only I am giving assurance, right? But I know that it is not a high level, right? So what level of assurance it is? Moderate level. Moderate level. MCQ, it is important. The level of assurance that we give on prospective financial information is moderate. The level of assurance that we give on in case of review, limited assurance. The level of assurance that I give in audit is reasonable, which is a high level. But can I give 100% assurance in audit? Impossible. It is not at all possible because we are having so many inherent limitations. Yes or no? There are so many inherent limitations. We'll come back to it later. Now, look at. So, you know, simply whatever work that we are doing, we call them as what? Assurance engagements. Yes or no? So, assurance engagements are various types. Yes or no? Assurance engagements are various types. What is an assurance engagement? In an assurance engagement, practitioner, nothing but we auditors. Yes or no? We provide conclusion. Why are we giving conclusion or something like that? To enhance confidence of users. Yes or no? We are giving them confidence. How are we giving them the confidence? By giving some report. We are giving some conclusion. Conclusion includes opinion. So how we will give? Through a report. Through a report. About what? About what we give conclusion? About evaluation of subject matter against criteria. Some subject matter is there. Some criteria is there. As per the criteria, subject matter prepared correctly or not, I will check and I will give my conclusion. Suppose in audit, no. In audit, no. Auditor is there. Client is there. Financial statements are there. Whether these financial statements are true and fair or not, I should give opinion. Correct? I should give opinion on whether the financial statements are true and fair. Financial statements is subject matter. How do I know whether financial statements are correctly prepared or not? Applicable financial reporting framework. I will check that. Whether the financial statements are prepared in accordance with applicable financial. Look at the objective. Auditor has to obtain reasonable assurance whether the financial statements are free from material misstatements and are prepared in accordance with applicable financial. You should check financial statements, are they prepared in accordance with applicable framework. Means this is called as criteria. What you have to verify? Financials. That is called as subject matter. So in an audit, in an assurance, simply in an assurance, auditor will express a conclusion. Auditor will express a, practitioner will express a conclusion or opinion to enhance the confidence of the user by evaluating subject matter against criteria. Accordingly, in an assurance engagement, what elements are there? Totally 5 elements are there. One, ultimately report we will give. Yes or no? Whatever we are giving confidence to the user, how do we give confidence to the user? By a report. That report will contains what? That report will contains the assurance, nothing but conclusion. In case of audit, we give opinion. In case of review, we give conclusion. In case of assurance on PFI, we give conclusion. Able to understand? So the report will contain assurance, yes or no? Ultimately, the written report is there, right? That is the outcome of the assurance engagement. Okay, in that report, what I will, how I will give this report? Based on my evidence. Based on my evidence, I verified no subject matter against criteria. I verified balance sheet, P&L, books of accounts, background data, all that. I spoke to the company management, all that. Finally, only I gave an opinion. So I gathered something called evidence, and that evidence is called as sufficient appropriate evidence. In order to give assurance to third party, first you must have that assurance. First you must get that confidence. How will I get the confidence? Only when I have evidence in my hand, I can give opinion on that. Only when I have evidence in my hand, I can talk about whether they are right or wrong. Yes or no? The practitioner will obtain sufficient appropriate evidence to form conclusion, to form opinion. Sufficiency is a quantity, appropriateness is a quality. We have a chapter called audit evidence. There we will discuss about quantity, quality, all that. Getting it? Next, how do, next, in assurance engagement, 3 parties will be there. Who are they? Practitioner. First, I am there. Now tell me, I will do what? Audit of financials. In case of audit, what I will do? Audit of financials. I'll verify financials. Who will prepare the financials? Management. They are responsible, right? We call them as a responsible party. Now I prepare now management will prepare financials. I will do the audit. I will verify the financial statements. Then finally I will give a written report. That report is used by users. They are the third party, intended users. They are called as what? Intended users. They are nothing but they use this assurance report to make the decisions. And remember, audit relates to historical financial information, while practitioner can also offer assurance on non-historical. Tell me, as I already told you, we can give assurance not only on historical, we can also give assurance on other than historical. In audit, we give assurance on historical. In other than audit, we can give, we can also give assurance on other than. So as a practitioner, as an auditor, as a CA, you can provide assurance on historical financials, you can provide assurance on other than. On historical financials, you can provide reasonable assurance, limited assurance. Reasonable assurance is called as audit, limited assurance is called as review. Yes or no? Subject matter means what? Information which is examined by practitioner, that information which auditor verified ultimately. Yes or no? That is called as subject matter. Now when you verify, no, you gather some evidences and all, that is called as sufficient appropriate evidence. What you will verify? You will verify financial statements. Yes or no? For example, in audit you verify financial information, books, accounts, all that you verify. With what? What you will compare? You will compare these financial statements with something called rules and regulations, benchmarks. You will compare with benchmarks. You will compare the balance sheet with accounting standard. You will compare the balance sheet with schedule 3, whether they are prepared as per schedule 3, they are prepared as per accounting standard. Benchmark. So benchmarks are nothing but suitable criteria. Benchmarks are nothing but criteria which is used to evaluate the subject matter. 5 more minutes. Okay, then now I told you audit, now assurance. Now what is assurance engagement? What is element of assurance engagement? It is over. So what is the purpose of assurance engagement? You will give an opinion. Yes or no? Where users and all will make confident decisions based on your opinion, because they know very well the chance of incorrect information in the financials is reduced because you verified them. So in the balance sheet, P&L, is there any incorrect information? The chance is reduced a lot. Yes or no? Now I told, right, again, assurance can be on historical financial, other than historical. On historical, you can give two level of assurance: reasonable, limited. Reasonable assurance is called as audit. Limited assurance is called as review. Audit provides reasonable. Review provides limited, which is a lower level. Review means what? Audit means what? In audit, no. In review, no. First of all, only few procedures I will perform to obtain evidence. Few procedures means what? Inquiry, analytical procedure only I will perform. I will not perform anything else. Very briefly I will check. Whereas in audit, I will do detailed audit procedures. Detailed procedures I will perform. Like in audit, no, we perform in audit inquiry, inspection, external confirmation, recalculation, reperformance, analytical procedure, observation, physical verification. So many I will do in audit. Now, what is review? 2400 series is the standard we have in CA final. We don't have in CA inter. In CA inter, we only have a discussion on meaning of review. Now, what is the relationship? Both are dealing with historical only, but audit provides reasonable assurance, review provides limited assurance. Like, what is the difference between reasonable and limited? Reasonable is a high level of assurance. Limited assurance is a lower level of assurance. Now, whereas in audit, we do elaborate and extensive procedure: inquiry, inspection, analytical, recalculation, reperformance, observation, all that. Whereas in review, we perform few procedures when compared to reasonable assurance. Like inquiry, analytical only we perform. These examples not there in ISA that I gave you to make you understand clearly. Then, in audit, we draw reasonable conclusion, which is a high level clarity. Whereas in review, we draw limited conclusions. We also don't know in depth about balance sheet, but based on whatever I saw, nothing I found wrong. That's what I simply tell to the people also. Example, audit is an example of reasonable assurance engagement. Review is an example of limited assurance engagement. That's it. We completed PFI, we completed audit, we completed review. You see how quick we are going. Able to understand that too without compromising any part of the explanation. Understood or not? That's it. We'll continue in the next session the rest of the topic. Yeah, we'll continue the pending discussion in the nature, objective and scope of audit. Fundamentals is completed. NOS major part is also completed. Now we are going to discuss about prospective financial information, right? So I already told engagements are various types. Review engagement, review is a limited assurance engagement, audit is a reasonable assurance engagement, and the differences we already seen. Yes or no? Now let's look at PFI, prospective financial information. Prospective means what? It refers to financial information about future events and actions. Financial information about future events and actions based on assumptions. Based on assumptions, and that is called PFI, prospective financial information, which is two types. Either it can be a forecast or it can be a projection or a combination of both. Like 1 year forecast, future upcoming prospective information, 1 year forecast, 4 years projection, like that companies do. Generally, forecast is a best estimate assumption. Forecast is based on best estimate assumption. Projection, we call it as hypothetical assumption. Projection is based on hypothetical assumption. Forecast is a best estimate. Forecast is more reliable than projection. Simple. But remember, both are at the end of the day regarding future. Since at the end of the day both are regarding future, can auditor give reasonable assurance on that? We can't. We can only give a moderate level of assurance. That too, I can give assurance on what? About the information, about the assumption. Assumption. I can only give my opinion. Sorry. I can only give my conclusion. I can only give my conclusion on the assumptions used by the management. Are they not unreasonable? Are they not unreasonable? Negative form of basic level of assurance, limited assurance. Able to understand? Instead of calling it as limited assurance, we are calling here it as moderate assurance. The technical term for prospective financial information is moderate. Now, what is the difference between historical? Historical reflects past events and circumstances, whereas prospective is about future events and circumstances, conditions based on assumptions. Historical is rooted in past. Prospective focuses on future. In prospective, the practitioner ensures that management assumptions are not unreasonable. Nothing but we need to ensure management assumptions are reasonable. Information is properly presented based on assumptions. Whatever the information they showed, forecast, projection, whatever, is it based on assumptions correctly calculated or not? We just check that. We never check on the information, whether the information is right or not, whether sales target achievable or not. That and all we are not bothered. Yes or no? All material assumptions used by the management must be disclosed in the prospective financial information. And remember, future oriented. So that itself is a biggest limitation. Correct? So evidence may be there on the assumptions now. Assumptions reasonable, unreasonable, you may have an evidence, but the assumption itself is future oriented. Correct? Therefore, you cannot confirm whether results will be actually achieved or not. So that's why, how do we give opinion? How do we give conclusion? We express a conclusion. Nothing has come to my attention to say that assumptions are not unreasonable. Are they unreasonable? I am not saying they are reasonable. I am saying nothing has come to my attention to say that they are unreasonable. Are they wrong? To say that they are wrong, I don't have anything in my hand. Are you getting it? I did not see any data to say they are wrong. I am not saying they are right. I am not saying they are good. I am not saying they are reasonable. I am saying to say they are unreasonable, I don't have any information. So, absence of evidence against to it. Getting it? I am not saying that they are wrong. Able to understand? That's why it's a negative form of assurance. It's a negative form of assurance. It's a limited assurance. But the technical word for prospective is moderate assurance. Technically, if someone asks you, sir, what is the difference between moderate assurance and limited assurance? They both are same. Honestly speaking, they both are same. Even you see in review, nothing has come to my attention that causes us to believe that the financial statements are not true and fair. That's how the wordings in a review. So there the same phrasing, here also same phrasing. Both are limited assurance only, or both are moderate only. But to differentiate, in review we use the word limited assurance. In prospective we use the word moderate assurance. That's it. Then there are something called qualities of auditor. Auditor must have certain qualities: tact, firmness, discretion, reliability. Auditor must have a high level of culture, high integrity. All the basic human qualities are required for the auditor. You must having an expert knowledge on accounting, technique, all that. Yes or no? That's it. Then remember, the whatever types of works we do, we simply call them as what? Engagement. The engagements that we do are broadly two types: assurance and non-assurance. Assurance is again two types: historical financial information, other than historical. On historical financial information, what you give is reasonable and limited, whereas other than historical, prospective, moderate level. Remaining services are called as non-assurance services, non-assurance engagement. Non-assurance engagement, one of the standard applicable is SRS, standards on related services. Totally 4 standards we have: standards on auditing, historical; standards on review, that is also historical. Both are historical financial. Assurance engagement on other than audit and review of historical. This is nothing but what? It's an assurance engagement, but not audit, but not review. Then what is it? It is about PFI, yes or no? Or agreed upon procedures, compilation, related services engagement. The auditor can even take up agreed upon compilation. What is agreed upon? Company will call us, sir, can you just do physical counting and then tell us, reconcile with our record and then go? Nothing. Your duties, please come, do physical verification, say records and books, records, physical stock matching or not, just to give a report and then go. That's it. We don't want any assurance, sir. By the way, we are not going to use your report for any third party purpose. Nothing. Please come. We don't have employees. Okay, we are tight in employees. We have a go down in so and so location. You go there, do physical counting, give a report on the physical count. That's it. We are not going to use it for any third party purpose. 2, sir, please come us. Talk to all our debtors, talk to all our creditors, get a confirmation from them. Just agreed upon procedure. You and me agree upon some procedure, and that's called agreed upon. 2, compilation. What is a compilation services? Sir, we don't know how to prepare financial statements. Our auditor is saying we are the responsible person to prepare financial statements as per applicable financial reporting framework, but we don't know how to prepare. Please, you come and prepare financial statements for us. Please, you come, compile balance sheet, P&L for us. We will give this balance sheet P&L to our auditor, statutory auditor. Are you getting it? Can the same person do compilation and audit? No, prohibited. You should not involve in preparation of books of accounts. You should not involve in preparation of financials. That's responsibility of management. They may take help of another chartered accountant. Yes or no? But he should not be the auditor of the company. That's compilation engagement. Both agreed upon procedure, compilation engagement, both are called as what? Related service engagement. Are you clear? Next, what is the purpose of engagement quality control standard? Why all these standards are very simple? High quality standards, they provide guidance on audits, review, assurance, related services. Yes or no? What are standards on auditing? They apply to audit of financial statements. They set high quality benchmarks for audit. Like these standards talks about so many issues. Remember, we have already seen documentation standard is there, audit strategy planning standard is there, 500 evidence standard is there. So many standards. They talk about objectives, they talk about documentation, they talk about planning, they talk about risk assessment, sampling, evidence, so many examples of standards on auditing. 4 examples. You rate any whatever the examples you like. Then standards on review. They apply to review of financial statements. Yes or no? They provide limited assurance, which is lower than audit. In review, we only do few procedures. Although it's a limited assurance, auditor still has to obtain sufficient appropriate. We have 2 standards, 2400, 2410. Only 2 standards we have. One, engagements to review historical financial information. Another one, review of interim financial information performed by independent. The second standard is applicable for listed entities mainly, where listed company auditor along with annual audit report, he should also give a review report on quarterly financial results. You see, review of interim, which is quarterly, half yearly, whatever. By whom? Independent auditor. Same auditor only performing review also. Able to understand. Next, both standards on auditing and standards on review, they only apply to historical financial information. Then we have another set of standards called standards on assurance. This is applicable for what? This is dealing with subject matter other than historical information. They do not include audit and review. You know, in PF we give assurance on non-financial matters such as internal controls also. That is also there. In assurance other than historical. In assurance other than historical, we give assurance on one is prospective financial information. We can also give assurance on other than financial information. Example for other than financial controls. For example, there is a standard called 3400, examination of PFI. 3420, examination of pro forma financial information included in prospectus. 3420. There is another standard called 3402. Engage assurance report on controls at service organization. Assurance report on controls at service organization. Service auditor. Remember in 501 at one place we have seen service auditor. Yes or no? Assurance report. That is 3402. We have a parallel auditing standard called 402. Responsibilities of the auditor of an entity using service organization. Okay, we don't have both in our syllabus entirely. We don't have just example. It is there. Are you clear? Then related. What is related service? Related services, they apply to engagements which involve agreed upon procedures. They also apply to compilation. What is agreed upon procedure? It is an engagement. Some specific procedure will be performed by the practitioner. Yes or no? Accounts payable, receivable, purchase, related party, something which management will request you, you do that work. Compilation. Compilation means what? Preparation and presentation of historical information. For that, what are you doing? You are assisting the management. You are helping the management in preparing and presenting financial statements without providing assurance. Remember, it's a non-assurance engagement. You don't provide any type of assurance. The practitioner issues a report stating that no opinion is expressed. Easy or not? Yes or no? What are the examples? 4400, one standard. 4410, 2 standards. We have only 2. One is engagement to perform agreed upon procedure regarding financial information. Then compilation engagement. Apart from that, we have one more standard called quality control standard. Remember, I told you in one of our regular class also we spoke 46 standards we have. Totally we have 46 standards. Okay, one is quality control standard, remaining 45 are engagement standards. Yes or no? In that engagement, quality control, this standard is applicable for audit firms. Standard on quality control is applicable for firms. Guidance on a firm's responsibilities for quality control system. Quality control where? Any work you do. What works I do? I do audit, I do review, or I provide some assurance, or I provide related service. Quality control for firms that are performing audit, review of historical information, other assurance and related services. Simple. Yes or no? What SQC 1 says? Firms has to establish quality control system. Remember I told quality control system also. Pizza, Domino's Pizza, they need to establish policies and procedures. You must have a standard operating practices on how do you work all that. Anyhow, once we start quality control revision, that time I will discuss. SQC revision we have. So that time I will discuss. Getting it? What is the objective? Objective is very simple. Ensure quality control system within firm, no, whatever the firm we are running, audit firm, no, quality control system guarantees compliance with the standards, issuing our reports appropriate. At the end of the day, whatever work you do, it must be as per law. Whatever report you are issuing, it must be appropriate. Engagement risk must be low. What is it? Engagement risk must be low. What is engagement risk? I am giving a report, no, my report should not go wrong. My report should not go wrong because I give report based on sampling. My report should not be abruptly go wrong. So what is engagement risk? What is audit risk? That and all we will discuss in risk assessment topic later. Clear? That's it. Then this SQC apply for all services which are covered by engagement. So whatever 45 standards you are doing, right? In addition to that, SQC is applicable. They ensure proper quality of services. Why standards? Okay, understood. You know, whatever works we do, we call it as engagement. The types of works we do is assurance, non-assurance. Assurance again historical, other than historical. Review, audit, other assurance related, all that we understood. Corresponding standards also we understood. What is the need of these standards? What is the need? Very simple. What is the need of this standard? They ensure audits are conducted against benchmarks along with the global practices. Quality of financial reporting, improve quality. This is accounting standard objective. Quality of financial reporting. Here the question is normally standards benefit is what? Then they equip professional accountants with necessary, because I am just a CA, I don't know what to do in audit exactly. Yes or no? Standards will guide me what to do exactly, how to do exactly. They ensure audit quality. So what is the duties of professional accountants like you and me with respect to these standards? What is our duty? We have to comply. Professional accountants must follow standards in their engagement. Suppose no, sometimes no, some standard, some procedure is there that may not be suitable for you. At that time, what you should do? They must document how alternative procedure you performed. No, that helped, that achieved the standard objective. See, at the end of the day, standards are saying you must obtain sufficient appropriate evidence. Whatever you do, you must obtain evidence. Standard tells you some procedures also sometimes how to get the evidence. If you feel that procedure is not suitable, no, you might have followed some other procedure, right? You should document how other procedure you followed that is not recommended in the standard, how that achieved objective of the standard, you must document. Clear? Reason for the departure also you must document. Remember, just because you are giving disclosure in the audit report that I didn't follow so and so rule, so and so procedure I didn't follow, you are giving a disclosure, does it mean the standard is exempt for you? Standard is still applicable. Exceptionally rare scenario. Sometimes whatever the procedure given in the standard may not be usable for you. Clear? Next, we have few more topics in this chapter. Scope of audit, principal aspects to be covered in audit, inherent limitations in the audit. Once we complete this, it will be over. Correct? Next, who appoints the auditor? By the way, for companies, no, auditor is appointed by members at AGM. For government companies, no, C&AG will appoint the auditor. For partnership firms, LLPs, partners will appoint. For government authorities, the respective law or regulation will take care. To whom the audit report is to be submitted? Companies, no, shareholders, firms, no. Part report revision will be discussing in depth of how to prepare the audit report, to whom the audit report has to be addressed, all that. Next, is audit mandatory? Always? No, it's not mandatory for everybody. Only for a company, LLP, respective act says audit is mandatory. LLP also, small LLP audit is not mandatory. LLP whose turnover is less than 40 lakh, whose capital contribution total is less than 25 lakh. If both of them are satisfied, audit is not mandatory. If any one of them are failed, audit becomes mandatory for the LLP. We call them as small LLP. We call them as small. Actually in LLP they didn't define, they didn't use the word small and all. We simply call them as what? Small. I mean, we are, for the sake of convenience, we call them as small LLP. They're exempted. But 40 lakhs turnover across, mandatory. Company, every company, 1% company, small company, private limited, public company, every company audit is mandatory. What about a sole proprietor? There is no law. What about partnership firm? The law is silent on audit. Society tax, Societies Act says audit is compulsory. Multi-state corporate society, the act says audit is compulsory. State Bank of India, SBI Act says audit is compulsory. Yes or no? Not every type of organization audit is compulsory. But some entities, no, Even though audit is not applicable to them, they voluntarily go for audit, and that audit is called as voluntary audit. And remember 44AB in the income tax, 44 section 44AB, 35AD, 35D, 80JJAA, 80QQB, 80RRB. In all these sections, audit is compulsory. In all these sections, audit is compulsory. If audit is compulsory under a law, for that reason you are appointing auditor. That is called statutory audit, mandatory audit. You are voluntarily appointing even though there is no legal requirement. That is called voluntary audit. Yes or no? That's it. Easy. You take care of this. Then benefits of audit, you read on your own. Nothing is there inside that. So what is an engagement? Engagement is nothing but a formal agreement between the auditor and client. It contains list of services to be provided. Now the famous engagement is what? External audit engagement. What is external audit engagement purpose? To increase confidence of the users. Yes or no? For example, in India, companies are required to get audited by external auditor. Non-corporate entities may choose auditor for their own advantages. That's it. Next, we have limitations in audit. We have something called limitations. Remember, objective. What is the objective of the auditor? The objective of the auditor is to obtain reasonable assurance whether financial statements are free from material misstatements. Reasonable assurance. Why reasonable? Why can't you get absolute assurance? Look, balance sheet P&L. The financial statements are so big. Transactions are so big. Imagine a company like Reliance Industries Limited. 10 lakh crore is the consolidated turnover. The consolidated turnover of the company is close to 8 to 10 lakh crore. Coming from multiple businesses, coming from multiple stores, retail stores, petroleum, so many is there. Revenue itself, 100% if you want to verify, it may take 20 years. 100% of the revenue if you want to verify 20. When you will verify expenditure, when you will verify payroll, when you will verify in audit, we don't do audit 100%. We only do sampling basis. That's why we cannot get absolute assurance. Sir, if absolute assurance is not there, then why audit? Very simple. Something is better than nothing. Are you getting it? But we do audit very scientifically by using sampling, scientific statistical technique. We randomly pick the sample in such a way, if any frauds and errors are also there, can be easily detected. In such a way we do audit. But in spite of we do audit so scientifically, in spite you do whatever the way, there are still limitations. You can't discover each and every fraud. You can't discover each and every error. The opinion you are giving, right? Everything is true and fair. Suppose I'm giving on a company, everything is true and fair. I told everything is true and fair. That may not be in reality. Yes or no? Your opinion might go wrong. Yes or no? But at the end of the day, we have seen in documentation chapter, in the upcoming revision, I will tell you, with my documentation, with my evidence which I collected, if I am able to prove to the people that I did my audit genuinely, even though you did audit genuinely, if still some frauds were not discovered, you will not be punishable. Yes or no? Fine. Why we can only give reasonable? Why can't we give absolute assurance? Inherent limitations. So the audit process has some limitations. Correct? Now, what are the limitations? First limitation, financial reporting itself is limitation. See, I have to give opinion on the balance sheet P&L, right? That itself has a limitation. That itself is not 100% true. Why? Management will prepare financial statements. Yes or no? They make so many judgments which are subjective, which are having some degree of uncertainty. Uncertainty is that they're not accurate. Yes or no? For example, companies know some purchase bills, controls and all, they might not follow properly. Yes or no? So these are all limitations. So management is responsible for financials. Management is responsible for internal controls, and these controls itself might have some limitations. Company top management told people be careful in everything, but they are doing frauds. What to do? Yes or no? They are doing frauds. They are hiding the frauds. Yes or no? So books of accounts, balance sheet, P&L itself has a limitation. They themselves are not 100% correct because they involve some judgments, assumptions, estimates which are subjective in nature. Able to understand? Financial reporting itself is a limitation. Obviously for audit also it is a limitation for the auditor also. Second limitation, nature of audit procedure. The way we do audit, that itself have a limitation. In audit, the auditor, what we do, the auditor obtains evidence by audit procedures. Yes or no? We give opinion based on sample, but that's a practical limitation for us. Sampling itself is a practical. We cannot verify 100%. We can only give We can only verify financial statements based on sample, and we will give our opinion based on sample. Why sample? Why can't you verify 100? Practically not possible. That's a practical limitation. In exam they will ask you what is a practical limit. Nature of audit procedure is suffering from certain limitations. What are the 2 types of limitations? Give example for each. Practical limitation, legal limitation. Another limitation is what? Management. No, they don't provide complete information to me. I cannot force them. If not provided, I can only report it to people. I can't force them. That's a legal limitation. Yes or no? Sometimes management might be dishonest. Frauds might be conducted by sophisticated schemes, fabricated documents. I may not discover that. Yes or no? Related party transactions. One more thing is what? Related. Company can enter into paper transactions, dummy, fictitious transactions. Yes or no? The relationships and all. The company relationships, related party transactions, we can't discover. We will discuss 550. There is a standard called 550 on related party. We will discuss that. And remember, what we are doing is audit. We are not doing investigation. So we can only obtain reasonable assurance. We cannot obtain absolute. In investigation, we get evidence conclusive in nature. Remember, there are totally 3 types of evidences based on the satisfaction level. Getting it? 1, prima facie evidence. Persuasive. What is it? Persuasive evidence. Conclusive evidence. In audit, we get only persuasive in nature. Persuasive means what? Convincing. By looking at purchase document, I will convince that purchase is true. By looking at a sale invoice, delivery challan, e-way bill, I convince that sale is there. But in reality, they are all fabricated documents. Who knows? I convince based on the document. If the document is fabricated for, completely fictitious, it is impossible for me to discover. Able to understand. Next, timeliness of information. The relevance of information decreases over time. Auditor cannot verify every matter in detail. Yes or no? So you must always you must always strike balance between reliability of information and cost of obtaining. For example, sometimes we may take last year data itself for the purpose of audit. Future events. Remember, company prepared financial statements using going concern assumption. Going concern means what? About near future. 1 year the company don't have any problem, like that they said. But I don't know. In reality, in the next month only company might shut down if something went wrong against the company. Yes or no? So future events may adversely affect the entity's ability to continue. Some new business model, unforeseen event, all this causes the company business to cease operations. These are all inherent limitations. Nature of financial reporting, nature of audit procedure. Audit is not an investigation. Relevance of information over time, future events. Able to understand? That's it. Then, what are various aspects to be covered in audit? First we will see what is the scope of audit. Scope of audit means what? Scope means, okay, you see, scope refers to range or reach of something. The purpose of audit is ultimately to increase the confidence of user. How we can increase the confidence of user? By expressing opinion. What we check? Whether financial reporting framework followed by the management, is it acceptable or not? I will check. Yes or no? Scope includes. First I will discuss scope excludes. What we are not supposed to do. Remember, something that requires competence beyond our capability. Something that requires competence beyond our capability, we are not responsible to do. Remember, auditor is not expected to perform tasks outside their competence. For example, machinery physically there or not, I went and saw. Condition of the machinery, I don't know. For that, I need to call expert only. Yes or no? Whether impairment happened or not in a machinery, whether impairment happened or not in a building, the value, recoverable value, realizable value, I may not be the right person to decide. I have to call expert. I am not an expert in authentication of documents. I don't know whether a document is genuinely original or duplicate. You know what? Carbon testing they will do. Carbon dating something. Carbon dating or carbon testing something they do. By doing a carbon testing, they can tell you which year it was actually manufactured approximately. By just suppose you give this pen to them, for example, okay, they do a carbon testing on this and they will tell you when this was manufactured approximately, almost with 90% accuracy. Getting it? Like many stones and all, they will be discovering some stones, so archaeological, they say 2000 years old, 5000 years old. How? That's called carbon testing. Able to understand? That's it. Okay. Now, audit is not an official. Tell me, can auditor tell that? Can auditor? Suppose no company, no, they purchased some machinery, some archaeological collection, painting they purchased, okay, to display in their particular art gallery. The company is running some art galleries. So in the art gallery, they purchased one painting. They purchased that painting by paying 5 crore. When I saw, it was like a spitting on wall. So that's how the painting looks like. General, most of the paintings like that only. Yes or no? It was a very abstract painting, something they told, for example. So they sticked it to the wall, okay, and they're saying 5 crore is the paint cost. And when I asked the management, what is this? Who painted this? It was painted by so and so popular painter, sir. Who died 500 years ago. Who died 500 years ago? Okay, for example. So whether that painting is 500 years back or not, how do I know? Able to understand? Management might do fraud, no, in the name of this. Who knows? So audit and investigation are different. Investigation involves what? Detailed examination. Yes or no? So objective of audit is very simple. Reasonable assurance whether financial statements are free from MMS. Many a times they will ask this question. Scope of audit. Write about scope of audit and what is not included in scope of audit. They will ask you meaning and they will ask you exclusions. Activities beyond competence of the auditor. Auditor cannot do authentication of documents. Audit is not an official investigation. Objective is to obtain reasonable assurance. Then what is included in scope of audit? We have to cover all aspects of the entity. What do you mean by all aspects of the entity? We will discuss in the previous question. What are the principal aspects to be covered in audit? You see, aspects to be covered. What do you mean by aspects? You should cover all aspects, right? What do you mean by aspects to be covered in audit? We should check whether financials are matching with books of accounts. Books of accounts means what? They are supported by journal entries. No, whether journal entries are supported by bills, vouchers, proper evidence. See that no omissions are there. No duplications are there, no fictitious entries. You must ensure that there are no omissions, no duplications. Information presented must be clear and unambiguous. You must ensure that amounts, classification, presentation, disclosure are as per applicable financial reporting framework, and financial statements are presenting true and fair view. So what you will do in audit, if somebody asks you, I do all these aspects. I cover all these aspects. I will ensure books of accounts are matching. I mean, books of accounts and financials are agreeing. I ensure books of accounts are having supporting documents. I ensure there are no duplications, omissions and all. I ensure information present is clear. I ensure accounting standards are complied. I ensure financial statements are true and fair. All aspects I should cover. Yes or no? Next. You see, all aspects. Another one. I get information, right, about books, documents, bills and all. I need to ensure that they are reliable, and I need to obtain sufficient evidence before I give opinion. So scope of audit include obtaining reliability of information, obtaining sufficient information. Sir, what is reliability? What is sufficiency? We will discuss in 500 revision. We have a chapter called 6th chapter audit evidence. Inside that first topic is 500, which talks about audit evidence. Inside that there is a in-depth discussion on reliability, relevance, sufficiency, appropriateness. So much is there. Clear? All of you. Proper disclosure of financial. By the way, you know what? Yesterday results came. Jan 25. Okay. Many students failed in group 2 only because of audit. Many students failed in group 2 only because of audit. Getting it? In costing, FM and all, people got 70, 80 easily. Getting it? But audit is the paper where many got, failed. Getting it? Generally, every attempt we get 80 plus so many marks. This time 1 or 2 only. 68 only we got one of the student. 60 plus only we got this time many. Because the paper was extreme tough, I told you. In fact, in our regular class, we solved the entire paper. It was not so tough. Technically, it is not tough. It is there. Every point is there in the ICA book only. No question will be asked in the exam beyond ICA book. You will not find a single question beyond ICA book. So, whatever the book you are following, you should ensure it is 100% ICA coverage or not. And our book, that what we are reading here, is 100% ICA coverage. If you understand entire this conceptually 100%, you can do really well. And I even posted a video on the result. Like many students, close to 150 students messaged. Getting it? Still, there are so many 100. I need to just open and then see. Okay. So, I made a video. Almost 70 to 80% of the students told about 3/4 strategy. 3/4 strategy. Audit, again, they all qualified in audit, I'm telling you. 3/4 strategy is number 1 strategy, I'm telling you. What is 3/4 strategy? Come on, you're attempting 80, 90 marks of the paper. Obviously, you'll qualify. Yes or no? 3/4 syllabus means, is it small? 3/4 means what again? We have in CA Inter 11 chapters. Any 2 to 3 chapters pick up. keep aside. What I told you to pick up and keep it aside: 520 standard, 530 standard, risk assessment and internal control, items of financial statements. Don't touch them. First finish rest of the chapters 100%. Become 100% confident. Any question comes from that, you can answer well. Then in such a case, whether paper is tough or difficult or easy, that doesn't matter for you. See, by default you are having 14 marks choice. Items of financial statements 14 marks. That will never come in the compulsory question. For classes purpose you listen everything. Yes or no? For MCQ purpose you listen everything. But for revision purpose you can take items of financial choice. Yes or no? 14, remaining 100 are there. So these two topics, 530, 520, risk assessment, put together how many you'll get? Maximum 15 versus against 20. 80 marks of the paper is in your hand, right? Yesterday one student messaged, he wrote for 65, got 44 in audit. He qualified. Perfection is important. Perfection is important. It's not, there are many students who wrote 105, 110 also, got 11, 12 marks. How many marks you are attempting is not the matter. Perfectly how many marks you are attempting is what important. In every chapter, C category questions will be there. Never do that analysis. That's a dangerous approach. In every chapter, C category topic, ignore. A category, B category, I will cover. Never do that. You will fail pakka. Getting it? Success rate is very, very low in that. Because what if an exam, D category, C category is what majorly tested. What will happen? If at all that is tested in every chapter, you are gone. Instead of that, see, C category, how much syllabus they occupy, 25%. C category syllabus occupies how much, 25% out of 100. I am also asking you want to reduce you want to avoid C category questions because you can't cover 100% syllabus. For example, I am also telling you 25% syllabus, keep it aside, but not in each and every chapter itself. Will ICA ask you on items of financials 40 marks, 50 marks? Huh? They can't. These three topics, small topics, yes or no? These three topics hardly 25 to 30 marks. You keep them aside. First become perfect in all other topics. Believe me, you can score exemptions. That's it. Clear all of you? Fine. And one more point that I need to cover in audit is what scope of audit also includes what I need to verify whether financial statements are disclosing properly, whether disclosure of information is properly, whether transactions are summarized properly, transactions, events and management judgments are they summarized properly, whether management judgments are appropriate, accounting policies are appropriate, whether these selected accounting policies are applied consistently, yes or no. And the auditor has to understand that financials are based on historical, nothing but based on past economics and events. So scope of audit includes what? Scope of audit, you must cover all aspects. You must verify reliability and sufficiency. You must verify proper disclosure. Sometimes in exam only this itself can be asked as a 4 marks or 5 marks question. One of the important aspects the auditor is covering is disclosure. The directors of the company are opposing that it is not the auditor duty to verify disclosure. You should write disclosure point and you should link with the question which they are asking. Are you clear? That's it. So principal aspects to be covered in audit, everything is over, right? What is reasonable assurance? Reasonable assurance is a high level of assurance, but not a complete guarantee. Yes or no? Audit of financial statements is conducted by auditor. The auditor only gives reasonable assurance. We remember misstatements can arise from fraud or error. Ultimately, what auditor do is he will give opinion. As per standards on auditing, he will do the audit and give opinion based on findings. That's it. This is objective of the auditor. Remember, this entire chapter is nothing but first standard 200. This entire chapter is developed based on what? 200 standard and preface to standards. There is a pronouncement book in ICI. Okay, pronouncement. You don't have in the syllabus, don't worry, which talks about standards. Before starting the first standard, there is something called preface. That preface and 200 standard. Based on these two, this entire chapter is developed. So, what is nature of auditing? Audit process contains independence. Yes or no? What is the nature of financial information? Nature of financial information may be profit oriented, non-profit oriented, bigger or smaller, doesn't matter. The purpose of objective of audit is what? To express opinion. Purpose is what? To enhance the confidence of the users. This is what we are already discussed, yes or no? That's it. Nature, objective and scope of audit is over. What is the relationship between audit and other disciplines? You please read later. Advantages of audit, you read later on your own. So some 2 or 3 small topics only I kept pending. Rest all other I completed in the revision. You see, hardly 1.5 hours. Fundamentals we completed. Nature, objective and scope of audit we completed with explanation. This weightage is 10 marks. 8 to 10 marks we completed within just 1.5 hours. Can't you read this later? One more time in-depth preparation and revision. Later, day before exam, 45 minutes enough for you to read this. Because you don't have responsibility to explain, no. You just have to read it. 45 minutes is what it takes, this chapter. Day before exam, you have 20 hours time, which is solid. So much time. Sufficient for you to watch my marathon once again and then do a revision also. Are you clear? That's it. So, first chapter is completed. Just 5 minutes, we'll begin ethics and terms of engagement. Are you clear, everybody? Able to recollect everything? So let's continue the discussion of the second chapter revision, ethics and terms of engagement. Actually in the ICA book, this is 11th chapter, but ethics part and terms of engagement part we can discuss here right now. In this chapter, total 3 parts were there. Part 1 is dealing with ethics. Part 2 is dealing with the terms of engagement, 210 standard, SA 210. Part 3 is dealing with quality control, 2 SQC, SA 220. 2 standards are there in part 3. Getting it? Part 3 we will discuss at last. Now, part 1, ethics. So, what is the need of the professional ethics? In the recent JAN exam also, they asked some principles, fundamental principles. They gave one of the example and asked you to figure out. And also they asked you to give meaning of it. 5 marks question they gave. So simple it is. Okay. Like, what is this ethics is all about? You know, ethics means what? Moral principles. Yes or no? It is a branch of knowledge that deals with moral principles. What is the nature of ethics? It comes from an individual. Yes or no? Which is inculcated into habit. So resist selfish motives. Getting it? What is right? What is dharma? We must do that. That is what ethics is all about. You must not do something that favors you and unfavoring others or society. Next. Ethics is a state of mind, moral principle, science of morals in human conduct. Getting it? One point, I always tell this. Remember, if you are ethical and moral, you can grow in your life like anything. Don't listen to people around you who says, honesty, this is not the days. Nothing. That's wrong. What is important for success in life is competence. People, lack of competence, they fail. Not lack of ethics. Getting it? Competence is what ultimately required for being successful. If you use that competence in good dimension, you will grow, or bad dimension. What dimension you do that? It doesn't matter. You grow. Competence is what important. For the competence, if morality and ethics is added, your satisfaction and peace of mind is different level altogether. You will be happy, peaceful if you are earning well with ethics and morals, rather than you are earning with dishonesty, all that. Getting it? Yes. So, need for professional ethics. Remember, what we provide is assurance engagements. Yes or no? Where we are giving confidence to the users. We are dealing with public interest. Literally speaking, we are dealing with public interest. Getting it? So, professional ethics, no, they are mainly focused on what? Morality. Getting it? Next, adherence, the respect and confidence on any profession. People respect on that, people confidence increases when they follow ethical standards and they are self-disciplined. And remember, accountancy profession is one where we deal with the public interest. We deal with listed companies, we audit them, we give them opinion, which is relied upon by so many, and they're honestly, confidently investing in those companies, thinking everything is true and fair. Yes or no? So ICI has issued some ethical standards. Ethical compliance is the core philosophy of our profession, chartered accountancy. Further, we chartered accountants were given by the institute something called Code of Ethics. What is Code of Ethics? In depth, we are going to have a discussion in CA Final. In CA Final, we have 19 chapters. 19th chapter is dealing with ethics. Almost that chapter, no, in ICA book is 170 pages. Getting it? But we made our book, which is 45 pages. Completely. Everything is covered. Literally. Next, if at all any member who is not complying with Code of Ethics, he is liable for disciplinary action. You know, if any CA with whom you are dealing with tomorrow, if at all you have really a trouble, if at all you feel they did something dishonest, they are troubling you like anything, you can file a complaint in ICA. Getting it? You can simply type ICAI space DISC. You will get disciplinary site website. You just open that. There is a e-form, e-application can be made. On whom you want to make a complaint, give your details. What is the complaint to describe? 2,500 plus GST, some amount they will charge. And if at all you win the case, you will get the refund along with damages. Able to understand? So next, so that is regarding the fundamentals. Remember, ethics is something that can be enforced on an individual through rules. We can enforce ethics on a particular individual through rules, but rules alone cannot be exhaustive. You must always understand the intention. Whatever service you are doing, for that, no, some rules were there. For example, in Companies Act, we have something called disqualifications of auditor. Body corporate is disqualified, relative of the auditor disqualified. Relative definition, you see, grandparents are not covered, grandchildren are not covered, for example. Now that means, if at all my grandfather is a managing director in a company, since relative definition he is not covered, can I accept the audit of the company? Literally, if you interpret based on rules, no, you can be, but understand the intention of the law, principles of the ethics. Why disqualification is given? To make sure you are independent. If a grandfather is working there, just because you show Companies Act as a reason, relative definition does not include grandparent, you show that reason and then you accepted the appointment of auditor. Where is your morality? So ethics must be seen in both principles as well as rules. Principle based approach, where you need to observe spirit of the ethics, intention of the law. Yes or no? Professional judgment is required. Your knowledge, skill, expertise is required to evaluate and reach conclusions. Rules based is what? In a rules based approach, well established rules are there. For example, Companies Act says auditor must be independent. How? Disqualification should not apply. If at all you are not covered under disqualification, you are independent. But rules cannot be exhaustive. Rules cannot cover each and every scenario. Yes or no? This can be a narrow outlook and overlook spirit of the ethics. It is rigid, not suitable in every practical scenario that we handle. Yes or no? Disqualifications only says if your relative is a managing director or key manager, you should not be auditor. Relative definition does not include grandfather. So can I accept the auditor of a company? If you ask, understand the spirit of the ethics, spirit of the law. Yes or no? Next, always you must observe spirit of the code. It is essential to follow spirit of the code rather just a letter of the rules to apply. This itself can be asked as a question straight away in exam, 4 marks question. Are you clear? All of you? Next, that's why ICA has given something called fundamental principles. There are 5 fundamental principles: integrity, objectivity, professional competence and due care, confidentiality, professional behavior. Integrity. The chartered accountant, when you are performing the work, you must be straightforward. Chartered accountant must be straightforward, honest in all professional dealings and all. Integrity means weight. Integrity means what? Fair dealing. Morality. Yes or no? Accountants, you should never associate your name with something, a false or misleading statement, negligently provided data, or if something you are signing a report which is containing omissions, which is misleading. Some financial statements you are signing, it is silent on contingent liability. You are saying everything is true and fair. You are at risk. Yes or no? So you should not associate. But remember, if at all in all these cases, if you are giving modified opinion, suppose when the financial statements are misleading or they are negligently prepared or omissions are there, and there you are giving a modified opinion, qualified adverse, something you are giving, then not an issue. If you give a positive opinion on the misleading items and all, if at all the law understood, if at all the reviewer, quality control reviewer, tomorrow NFRA will do quality review of your audit. If they found out that you did audit carelessly, they will punish you. Able to understand? Next, very recently, yesterday or day before or maybe 2 days ago, NFRA has released, they are going to increase the audit quality reviews. NFRA going to increase audit quality reviews. I will show you. NFRA recent news. Yes, you see NFRA inspected so and so. This is on March. They put a deadline. Okay. So very recently an article came, they are aggressively going to increase the extent of review for more listed companies. Already listed companies are under the purview of NFRA. That's it. So that is integrity. What is the second fundamental principle? Objectivity. Objectivity means what? Unbiased. You should not compromise your decision making power. Professional judgment means what? Decision making. Due to bias, conflict of interest, undue influence. You should never take activities where you are having some relationships with the client or some circumstances are there in that client that affect your judgment making process. If my grandfather is a director in a company, even though he is not a relative as per Companies Act, if I accept the audit of the company, he can forcefully influence me not to discover. Even if any frauds I discover, I will not report. He will influence me in such a way. If at all any such influence is there where you can't be independent, you can't do your work completely as per the law, even though as per the letter of the law you don't have any restriction, you should not accept that work. That is what we call them as what? Objectivity. Next, professional competence and due care. You are having a moral responsibility to make yourself ultimately competent. Getting it? It is a moral responsibility. See, fundamental principles of code of ethics. Code of ethics says it's morality. Code of ethics means what? Morality. Being professionally competent is a moral responsibility. So don't see important questions. Getting it? You must study properly at least 80% of the syllabus in such a way. Getting it? If 20%, one or two topics, if you do not study, also not an issue. Able to understand. Imagine a doctor who has not studied some surgery or some anesthesia related basics. Yes or no? He start directly operating the patient without giving anesthesia. Yes or no? You see, the doctor, can they have important questions? Suppose I am only dealing with heart, I only learn that heart, that heart nearby radius of 10 centimeters, only that I will learn. Rest of the body part unnecessary for me. You need to understand, no, there are so many nerves which are connected. So doctors cannot have that choice. Literally, no, in doctors, no, medicine, no, they don't have important questions. They literally have to study everything. And their books are, for example, our CA and audit book is 260 pages. In medicine, there is something called anatomy or some subject is there. That itself is 1400 pages. One subject, I'm telling you. They study fully. But they never complain that we are working hard. Yes or no? We complain so much. With this book only we complain so much that we are studying hard. Basically, our students, many narrow-minded. They don't have exposure on other courses. Fine. So 1400 pages, one subject there. Total 3 or 4 subjects are there mainly, where 1500, 4000 to 6000 pages are there. Our entire CA book is itself put together 2000 pages. What the materials that you are studying? They don't have any fast track materials, chart books and all. Can they study chart book, heart surgery? Yes or no? Step 1, cut. Step 2, squeeze it out, take it out. You can't study, yes or no? So they need to have a process. They everywhere, yes or no? Yeah, fine. So competence is your moral responsibility. Getting it? Making yourself competent is your moral responsibility. Not just, see, auditor must maintain professional knowledge, skills based on current standard legislation, latest laws and regulations applicable. You must also act due care. Another responsibility is what? Due care. You must act diligently, thoroughly, timely. Suppose a client approached you in the last minute to file IT return. You agreed, I will file within the due date. Later tomorrow you are saying, sorry sir, you came in the last minute, how can I do? Then why you took the work? You said within the time, no. If at all you are not delivering on time the work, that comes under timely delivery failure. Due care, you failed it. Are you getting it? You are recklessly doing audit. Due care, you are failing it. Next, another important principle, confidentiality. Confidentiality means what? Whatever the information the client is sharing with you, you must respect confidentiality. You must keep the information obtained in your professional relationship, in your business relationship from the client confidential. Yes or no? Confidentiality ensures free flow of information between the client and the auditor, employer, employee. See, remember, this code of ethics, not only for practicing CS it is applicable, even for employee CS also it is applicable. Suppose, we have something called code of ethics, schedule 1, schedule 2, part 1, part 2, part 3. Part 1 is applicable for practicing people, part 2 is applicable for employees. Able to understand? Schedule 2, part 1, practicing people, part 2, generally for every member. Able to understand? So, for employee chartered accountants also, there are code of ethics. If at all you are working as an employee, tomorrow you leak the information of the company to some competitor, he can file a complaint with institute. Employee who is a chartered accountant breached. What are you doing? Didn't you taught him ethics? They will question. Able to understand. Next. So, however, it won't be, it should not be shared with anybody without client consent. Confidential information, no, you can disclose only in 3 circumstances required by law, permitted in the law and authorized by client, or you have a professional duty. NFRA is coming and doing review. You can't say confidentiality, my client data I can't show you. You have to show. Are you clear? Next. Another thing is what? Professional behavior. Getting it? Accountants should not engage in any activity that might harm the reputation of the professionals. Getting it? If at all you are transacting in Hawala, you are supporting your client in Hawala operations and all, you are bringing disrepute to the profession. Narendra Modi in one of the international conference told, the Prime Minister told, you people are encouraging Hawala and all, you people are supporting clients and all. So what nation building are you doing? He indirectly questioned. Next. Accountants must comply with relevant laws and regulations in order to avoid actions that discredit the profession. Clear? Fundamental principles is over. Then one of the most important principle is what? Independence of the auditor. What is independence? So professional integrity and independence, they are at most essential in accountancy. What is independence? Independence means you are taking a decision not influenced by another person. You are taking decisions based on the facts and circumstances, based on the law or regulation, by using your professional judgment, then correct. If at all you are taking a decision as per his likings, as per sir likings, or some your boss or client likings, you are prohibited. You know, in listed companies, if at all I am an auditor of listed company, I have a disclosure requirement. I need to disclose to institute some information. More than 2 years continuously. If I am getting fees from one company, which is 40% of my firm turnover, out of my firm gross receipts, 40% I'm getting from only one client. I need to disclose it to the institute, and the institute will keep my firm in a hit list. Too much dependence on one client, financial interest, dependency on the client. It's a self-interest threat. Getting it? So we will discuss independence related threats. We will discuss next. So independence is a state of mind as well as personal character. Do not confuse difference between legal and independence. No, don't confuse with legal standards, all that. These standards will change, but ethic spirit is always same. Independence is 2 types: independence of mind, independence of appearance. Independence of mind means what? It's a state of mind where you take a judgment unbiased. I mean, maybe the other person is my brother, but I am very independent. Getting it? I take a decision irrespective of my relationship, all that. That is a state of mind. Independence of mind talks about state of mind. Integrity, objectivity, skepticism, all that I apply when I am taking decision. What is independence in appearance? In appearance means what? If at all a third party sees us, suppose I am acting as an auditor in a company where my grandfather is a grandfather is actually a chairman or managing director. And if I am accepting the audit of the company, saying that anyhow he is not my relative, yes or no, as per Companies Act also he is not covered in relative definition, I used that loophole in the law and then accepted the audit. If a third party came to know that we both are grandson and granddaughter, grandson and grandfather, they got to know that we both are very close relatives, immediately they will stop believing my audit report. Appearance, you lost independence related trust, you lost in appearance. So what independence and appearance is? As an auditor, as an accountant, you must avoid a situation which are so significant that an informed third party would conclude that integrity, objectivity, skepticism, everything is compromised. They both are grandfather and grandson. Obviously, how the hell he will do the audit properly? So an informed third party who has a basic understanding of the subject will immediately tell you you don't have integrity. Able to understand. Next. Now independence, it must exist in fact, means in mind and also in appearance. The relationship between the auditor and client should satisfy the auditor about his own independence. Any unbiased person should conclude that your independence is not compromised. This ensures confidence to the users in the financial statements. And remember, for listed companies, it is even more fundamental, even more crucial. You have to be very, very careful. As a stat auditor of listed company, you will cease to perform any function if the person do not have faith on independence. If users do not have faith on you, being the auditor of listed company, the very purpose of your audit itself is ceased, dead. Able to understand? Next, so the auditor is expected to be objective, unbiased, fearless, and honest opinion. Now remember, subjectivity, independence depends on state of mind and character. One person may feel independent in certain circumstance, another person may not feel the same in the same circumstance. So subjectivity, independence is subjective in nature. Yes or no? I am not independent of the company if my grandfather is the director. If my grandfather left the company, then I can act as an auditor. Able to understand? Next, now this independence is being affected by so many threats. This question also asked in the recent Jan 25. Right now I'm discussing independence topic from past 20 minutes. Only from this topic 10 marks question came. Only from this topic 10 marks question came in January exam. Getting it? But many students they keep this as a last priority. That's a problem. They think independence is every attempt pakka 5 marks. Every attempt, because it's 11th chapter in SA book. No. So they also study in last only. I keep it at beginning. One, you need to learn this first before you learn other chapters, and this is most important from exam point of view also. Pakka 4 to 5 marks question, pakka MCQ or descriptive, something pakka will come. Clear all of you? Now, International Federation of Accountants. There is an authority called IFAC. They identified independence will be affected by 5 sources, 5 types of threats. The threats are self-interest threat, self-review threat, advocacy threat, familiarity threat, and intimidation threat. And if you remember, I told you in the recent exam Jan 25, they gave you 5 examples and they simply asked you what is the threat, identify and define 1 or 2 lines. 5 marks question, so easy. Able to understand? Jan 25, people are saying Jan 25 paper tough because I feel pity on them. How easy the paper is. Yes or no? In our regular class we clearly solved on that. In our fast track, whatever, in our class we solved on that. Each and every question we solved, and first we solved in our book, we discussed in our book, and then we solved it. Next, so self-interest threat. What is self-interest threat? When this will occur? If auditing firm partner, the firm and the partner, firm or the partner, having financial interest in client. Having financial interest in client. Like what? Direct financial interest or indirect financial interest, or they took a loan or they gave a loan. Depending on the client fees, majorly you are depending on the client fees. Business relationship you are having, potential employment, client is offering you tomorrow so many other works also. Contingent fees. These all are what we call them as threats to independence. First threat, self-interest threat. Self-review. What is self-review? This will arise. Auditor, no, he is reviewing his own judgment from a previous audit work or non-audit work or something. Previously you only did that work. Now you are only checking that work. Maker and checker are same. That is called self-review threat. For example, you are the auditor right now. You were earlier a director in this company, or you were earlier a senior officer of the company. That's why in ICA Code of Ethics, once you are a director in a company, after coming out of the director position, 2 years you should not accept audit. That is not there in the Companies Act. That is there only in the ICA. Getting it? ICA Code of Ethics. You are performing services which are subject to audit. Some student asked me, sir, can auditor be providing compilation service as well as audit both? No. You are preparing financial statements to the company, and how can you audit the same? That's why 144 prohibited services. You cannot be a bookkeeper. You cannot be an internal auditor. You cannot be financial advisory. You cannot perform banking services. You cannot be management service. You can't provide. Actuarial you can't provide. Yes or no? Next. Non-audit services means what? Management service, internal audit, investment advisory, IT system and design, whatever is there in 144, they all come under what? They all come under non-audit services. In US and all, they call them as non-audit service. In European Union, they call them as non-audit service. Under Companies Act, we call them as prohibited services. 144. Able to understand? Next, advocacy. What is advocacy? You are promoting a client opinion. Okay, nothing wrong. If it is sufficiently backed by logic, nothing wrong. You are promoting to a point where objectivity may be perceived as compromised. People think you are no more, you are a puppet of the client. Yes or no? People think that you're a puppet of the client. Like the client is not at all, giving a logical answering, but you're suppose, auditor is acting as a mediator between the client and his competitor. And in a dispute resolution, some dispute resolution is going on, auditor is acting as an arbiter. Where is independence? Why are you dealing with that? That is their affairs. That is company operational affairs and all. Why are you involved? You are the auditor or you are a mediator? Yes or no? So when auditor deals with shares and securities of the company, dealing with means trading, for example, or auditor is acting as a client advocate in a particular litigation or in a third party dispute where third parties will perceive, they will feel that you are championing the client, means you are supporting the client. Familiarity threat. What is familiarity? When auditor becomes too close to client, they may end up being too sympathetic to client interest. For example, close family member, he is working in the senior position of the company. Former partner is a director in the company. My firm partner, he is a director in the company. Suppose, if I am the director previously, now auditor self-review threat. I am actually, one person is my partner previously. Now he is a director in the company. That creates familiarity. Because my own partner until now became a director. We both are close. Earlier I am a director, now I am the auditor. Means what? Earlier I might have taken some decisions, now I am reviewing. That's a self-review threat. You understood both? Yes or no? That's it. Then long-standing relationship between the auditor and the client. Me and client, for that company, I am auditor from past 40 years. I know everything about him, he know everything about me. Where is independence? Yes or no? You trust him so much, he trusts you so much, where independence is lost. The basic skepticism is lost. Next. Client, you are accepting gifts and hospitality. That is also one of the threat to independence. Now, intimidation threat, when it occurs, when the auditor is deterred from acting objectively, when auditor is prevented, like client is blackmailing you that he will replace you, he will remove you, or he is threatening you with a litigation, or he is asking you to reduce the work, reduce the fees also. These are all the examples of what? Intimidation threats. Totally independence. First of all, independence means what? Independence means judgment of a person shall not be subordinate to wishes and directions of another person who engaged you. You should take decisions with your knowledge, with your competence, with your conscience. Yes or no? Now, this independence is affected by 5 types of threats. That's it. Easy. Now, suppose there are threats. Suppose you are going to do some company audit or assurance or some service, they approached you. You found that some threat is there. What you should do? Should you accept it or what? See, can you put a safeguard or not? Suppose a company wanted to appoint me as an auditor. My wife is having shares in that company. How much? 90,000 face value. Then ask her to stop buying the shares of that company further. Getting it? Put a safeguard. You put a safeguard? Yes. Now the ownership of your wife, spouse, is it within the acceptable level? Yes. Then you accept the audit. Suppose you are unable to control her. Your wife told you, who are you to tell me? Yes or no? She is buying shares more and more after I tell her not to buy. Yes or no? Then what can I do? I can't put adequate safeguards. Yes or no? So what should I do? I should not accept the audit. I should decline the engagement. That's it. Answer over. So write about safeguards to independence. 4 marks question. Okay. Now what is safeguards? Auditor must always be independent. Should also appear independent. What are the key principles? Integrity, objectivity, skepticism. They all are required in order for you to be independent. Now before accepting the work, you must check whether there is a threat to the independence. If threats to independence exist, either withdraw from the task or take precautions to eliminate. Suppose if you cannot apply credible safeguards, you can't apply safeguards, decline the work. Sir, what if threat arises after accepting the audit? If at all 141 subsection 3 disqualification and all attract, you are deemed to be vacated the office. Suppose some other threat arises to independence, eliminate that. Or if not possible, withdraw from the engagement. Next, finally, skepticism is one of the fundamental principles for you to say that you are independent. You will not be skeptical in a scenario where you are in the influence of somebody. Able to understand? When you are in the influence of somebody, you will lose your skeptical mindset. That's why you see so-called intelligent scientists and all, when they go to Babaji, they lose everything. They forget everything, the science, what they learn, everything. Because skepticism, they lost there. That's why Babas are controlling. Of course, there are so many genuine Babas are also there. Non-genuine, unauthentic Babas are also there. Yes or no? But It's all. People know, they lose. The moment, in fact, what, in Swamiji ashrams and all, what they say, before you come inside, leave your, not footwear, doubts outside. Leave your doubts outside and come. It's some astrologer's case, no. Leave your disbeliefs and all outside before coming inside. So indirectly what they tell you, stop skeptical thinking. Surrender to me. That's it. Yes or no? Right. So skepticism means what? Skepticism means an attitude of questioning mind. As an auditor especially, you should be having that questioning mind. You should not trust any document unless you get an evidence on it. Yes or no? Balance sheet, Reliance Industries balance sheet is there, 9 lakh crore is there turnover. You cannot blindly say, Reliance company outside, I'm hearing news from so long, they're obviously genuine. No. See, check for authenticity. Is that correct or not? Look at the records. Only then get a clarification. Only then confirm that they are genuine. Yes or no? Skepticism means what? Attitude of questioning mind. Alert to unusual situation. Critical assessment of audit evidence. Audit evidence means what? Information. Whatever information you are getting, don't listen and leave it. Process it. Yes or no? Then. So, professional skepticism means what? Being alert to information which is contradicting with another information. Being alert to information that brings doubts on the reliability. Being alert to conditions indicating possible fraud. Being alert to where circumstances require me to perform additional work. Okay, I'm not giving detailed explanation on it. I hope you already understood. Next, what is the benefit of skepticism? Skepticism reduces risk of overlooking, overgeneralizing, making wrong decisions. Yes or no? Auditor, no. They can accept documents as genuine unless some doubts are there. By default, you can accept documents as genuine unless you find something contrary. Yes or no? However, always remember, you should evaluate reliability of information. If at all there is a fraud is suspected, investigate further. By the way, you're working as an auditor for this company from past 4 years. You know that management is very honest, all that. Does it mean you will switch off your skeptical mindset? You should always be skeptical. Auditor cannot ignore past experience of history. Yes or no? But still maintain skepticism. You may not ignore history of the management, that they're very honest, genuine in the history. Like, you can consider that in your mind, but at the same time remain skeptical. That's it. Ethics topic is over, which is approximately pakka 5 marks, 30 minutes over. Able to understand. That's it. Almost I covered every point, no? Yeah. So SA 210, agreeing the terms of audit engagement. Let's revise the standard 210. Agreeing the terms of an audit engagement. What is this standard is mainly talking about? Very simple. See, generally when we are doing a statutory audit, mandatory audit, directors must know what are their duties, and you being an auditor, you know obviously what are your duties. Even if the directors misunderstood that you not only do audit, but you will also file IT return, you will also prepare books of accounts, like, obviously people don't understand. They think auditor means he will take care of entire books, documents, everything. But we know very well, we are only here for audit. If a company appointed me as a statutory auditor, my duty is only audit. I should not do anything else. I should not do books of accounts, all that. But they are not aware of it. So, in order to avoid confusion and disputes at future date, we must give something called terms and conditions, nothing but contract, nothing but engagement letter. I told you one point in our class, if you recollect. Seller or service provider is the one who should dictate terms and conditions. Yes or no? Only a seller of the goods, only a provider of the service knows what are all the complex issues, what are all the issues that might arise in future. So in an audit service, you are the one doing audit. Remember, all our standards that we are going to discuss, they are all applicable for audit of general purpose financial statements. Being an auditor, you know what are all the issues and questions might arise tomorrow. You have to issue terms and conditions to client. The terms and conditions, we call them as what? Agreeing the terms of what? Engagement. So you have to agree terms of engagement with the client. You should send an engagement letter to the client so that client misunderstanding regarding what are all that you do, will be avoided. The misunderstandings of the client can be avoided to a great extent. Otherwise, he might be thinking, you will take care of IT return, you will take care of books of accounts, you only prepare financials, you only do audit. No, we should tell them that and all your responsibility. Preparing financial statements as per applicable financial reporting framework is your responsibility. Implementing internal control systems so that financial statements are free from MMS is your responsibility. Giving me the information, books of accounts, additional information. If I have a doubt, I can talk to each and every employee. Unrestricted access to employees is also your responsibility. Then what is my responsibility? My responsibility is to obtain reasonable assurance whether financial statements are free from material misstatements or not. Yes or no? Now, what exactly is my responsibility? What exactly is the client responsibility? What he can expect from me? You can expect from me an audit report. That is what my duty. The format of audit report is going to be like this. The expected content of the audit report is going to be like this. I should tell to the client how I am going to make the audit report. I may have no, you don't have to tell initial itself which opinion you should give. Which opinion you are going to give, you don't, because you also don't know. But you tell them that if everything is good, I give unmodified. If something is wrong, I will give modified opinion. At the beginning of the audit itself, expected form and content of the audit report must also be informed to the client. Able to understand? You should inform him what are his responsibilities. You should inform him what are your responsibilities. You should inform them what is your objective and scope. Yes or no? What is the objective of audit? What is the scope of audit? Tell the client that you are not an expert in everything. Yes or no? And what are your responsibilities? What are client responsibilities? What is the applicable financial reporting framework applicable? Tell them. Yes or no? And how the format of audit report is going to be, how the content of the report is going to be. An idea you give him, he will go and see standard and auditing. If at all he want to know, hey, what auditor is going to give me tomorrow at a future date, he said he will give me audit report, how audit report looks like, he will go and see the original standard. If at all he has a doubt, you tell them that you are going to give audit report as per 700. Able to understand. That's it. Now, there are some circumstances where engagement letter is not required. There are some circumstances. In Jan 25 MTP, they asked this question. What are the contents of engagement letter? Under what circumstances an engagement letter is not required? Certain terms need not be included. If the terms and conditions are already given in the law in detailed terms and conditions are given in the law itself. What is auditor duty? What is client duty? Clearly law itself. Then auditor need not include those terms in engagement letter. Except those terms, remaining terms, if at all you want to tell no, that you include. What are the terms that need not be included in engagement letter? If law and regulation under which you are doing audit, it is detailedly talks about the terms and conditions, then except that, remaining you can tell in the engagement letter. Why? Law, if at all, is clearly containing. Client must know the law. Ignorance of law, no excuse. So engagement letter is a document sent by auditor to client to reduce misunderstandings about what? About scope of audit, about objective of audit, about responsibilities of audit, about management responsibilities, about financial reporting framework, about audit report. Yes or no? Engagement letter must be in writing to ensure that both the parties are clear on nature. Especially in non-statutory, it is even more important. Many here students wrongly interpret. In non-statutory audit only engagement letter is required. In stat audit, engagement letter not required. That's wrong. In non-statutory audit, engagement letter is even most important because there is no law. If tomorrow, if there is an issue comes between you and the auditor, the client and the auditor, client said, sir, I told you have to do 10 branches audit. But I heard that only, 2 branches. I thought only 2 branches. I only completed 2 branches and I quoted fees for 2 branches. Later, client is telling me, no, sir, I told you 10 branches. For 10 branches put together only this fees. Dispute. Yes or no? Who will resolve this dispute? Because it's a matter of contract between you and the client. If it is put on paper clearly, you can easily show. Look, at that time you agreed 2 branches only. I told you signed it. Yes or no? Able to understand. So, the auditor must agree terms. With whom you should agree the terms and conditions? With obviously top management. In entire our auditing subject, top management referred as those charged with governance. Top management is referred as what? Those charged with governance. Those charged with governance. Governance means what? Governance means authority. Governance means accountability. A person in an organization who have both authority plus accountability, then the person is called as those charged with governance. Yes or no? That's it. One of the important question. This itself they will ask as a 4 marks question. In ICA book, there is a format of engagement letter. If possible, refer that. What the format says, you requested us to audit the financial statements of the company comprising balance sheet, P&L, cash flow, all that. Yes or no? We are pleased to confirm our acceptance and our understanding of this audit by these engagement letter. So what we understand about audit, you asked me to do audit, right? What is meant by audit? I am telling you through the engagement letter. So don't think otherwise. If you have some other meaning in your mind, audit means this only, I do this only, you have to do this only. Yes or no? You need to clearly tell the client through engagement letter. When engagement letter is to be issued, at the beginning of the auditor or at the end of the auditor? Beginning of the audit. There is something else called representation letter. We should get that at the end of the audit. Before signing the audit report, we should obtain management representation letter. We will discuss that in 580 standard. We have a chapter called completion and review. In that chapter, 580 standard is that there we will discuss. Clear all of you? Now look at it. There is something called preconditions for audit. Before you even give engagement letter, see whether preconditions present or not. Preconditions to audit is also called as responsibilities of management. Responsibilities of management and those charged with governance. Preconditions to audit can also be referred as responsibilities of management. In SA 200, the same is referred as premise to audit. The same is referred as premise. What should be the premise before you start the audit? What should be the scenario before you start the audit? Getting it? In 210 standard, it is called as precondition. In SA 200, it is called as premise. In SA 58, it is called as management responsibilities. Able to understand? So all the three are same. Now, precondition. What is a precondition to audit? Precondition to an audit. Before I start the audit, one important condition. Whatever financial reporting framework company decided to follow, that must be acceptable. And you should get an agreement. You should get an acknowledgement from management that premise to audit will be fulfilled by them. That they will accept their responsibilities. Yes or no? That is why we obtain this agreement through what? Engagement letter. So what is that audit? What is the audit responsibility on a precondition? Auditor must determine whether financial reporting framework is acceptable. Company is going to prepare financial statements, books of accounts. Already they started preparing all that. Suppose you found books of accounts are prepared on cash basis. Obviously financial statements will also be on cash. Is financial statements on cash basis acceptable in a company? If you know that it is not acceptable, yes or no? If the financial reporting framework is not acceptable, you should not accept the audit. You should not accept the audit. So first auditor has to determine whether financial reporting framework is acceptable. Then get management's agreement. Get their acknowledgement through engagement letter. What? Management is responsible for preparing financials. Management is responsible for designing and implementing necessary internal. Management is responsible to provide the auditor with access to all information, additional information, unrestricted access to persons within the entity. Suppose if preconditions are not present, first discuss with them. Sir, you are following cash basis of accounting, sir. Okay, that is not permitted. That is not an acceptable framework. Management immediately said, sir, we will rectify everything. Please give us time. They rectified. Then no problem. You can continue doing audit. Or reject the audit engagement. If preconditions are not present, reject it. You're getting it? Unless if the law or regulation says you can't. You can't reject. You are already appointed. You can't reject. It's a statutory or government corporation audit. You are already appointed. You can only give report. Yes or no? In that case, if the unless required by law, okay, when you should reject the audit? If financial reporting framework is unacceptable or management is not agreeing with their responsibilities regarding financial preparations, internal controls, access to information and people, they are not agreeing with that, then also reject. Yes or no? Suppose if management impose a limitation, getting it, the auditor shall not accept the audit. At the beginning of the audit itself, before you accept it itself, company is putting so many restrictions on you that you can't do the audit properly. don't accept. Suppose if limitations are imposed after accepting the audit, withdraw from the engagement. Limitation imposed on the auditor after accepting the audit, what to do? 705 standard we have, there we will discuss. Clear? Next. So objective and scope is very easy. Next, sometimes no, like change in terms, I'll come back to it later. Fine. So we understood what is precondition to audit. We understood what is engagement letter, why it is necessary, what are the contents of engagement letter also we understood. Now, is engagement letter to be sent in every audit? Recurring audit, suppose no, this company appointed me. This is a non-government company. They appointed me for 5 years of one term. First year I sent. Should I send second year, third year, fourth year, fifth year, every year also? Should I tell them what are the terms and conditions? Not required. But there are some scenarios, there are some circumstances where even though it's a recurring audit, you must send engagement. Generally, auditor must issue engagement letter for a newly appointed auditor. Yes or no? Newly appointed. For recurring audit, no. For recurring audit, no. You must decide whether engagement is needed or not, depending upon the circumstances and your common sense, professional judgment. Generally, what is a recurring audit? Recurring audit means what? If previous year auditor is reappointed in a 5 years engagement. No, last year you are the auditor. Now also you are only be the auditor. Next, there are some circumstances where engagement letter has to be reissued. One, company misunderstood the objective and scope of the audit. The top management, no, they misunderstood the terms and conditions which you originally gave. Give them one more letter with a detailed explanation so they will understand. Or changes in terms and conditions. Last year you were appointed only for doing 5 branches audit. Now company wants you to do 10 branches audit. Revise the terms, no, give one more time new engagement letter. Change in law and regulation. The law under which you are going to do the audit, the law itself is changed now. Again, give engagement letter. Change in financial reporting framework. Until now, companies preparing financials using accounting standard division 1. That is what you spoke in the engagement letter in the last year. Now, this year, companies preparing financials as per division 2, Ind AS. In the old engagement letter, division 1, you are saying no. Now, financial reporting framework changed no. So, give one more letter saying division 2 is applicable. Now, change in audit reporting, recent change in top management, significant change in size and nature of the entity. In all these circumstances, the auditor must issue engagement letter once again. Clear? Suppose I issued already engagement. Engagement letter I issued. You know what? Company is asking me to change some terms. Especially how you know? They're asking me to change terms. Before you decide, before you agree or disagree, they asked you for some changes in terms. First check, is it practical, possible or not? If auditor is asked to change the audit engagement to one that provides lower level of assurance, see whether it is a reasonable justification or not. For example, no, in audit, no. I told you, in audit we do many procedures, inquiry, external confirmation, reperformance, recalculation, so much. Company is asking, sir, external confirmation and all don't do, sir. Just to do analytical review, inquiry. Don't even verify books, please, documents. Kindly cooperate, they're asking. Array, if I do like that, I can only give a lower level of assurance. I cannot give a higher level of assurance. You are asking me from audit to review kind of work. Client also said, yes sir, do limited work and then give me audit report. No, it's not possible. Before agreeing to change, an audit engagement to review, or before changing from audit to related service. Suppose client is coming and asking, sir, you are very strict, sir. No, let us not continue as an auditor and client. You do one thing, you just do review. I will go and appoint some other auditor. They said, now they are asking you to change audit engagement to review engagement. Then auditor must assess, is legally possible or not, contractually possible or not, because you are not the one who appointed me. Shareholders appointed me. Under law, they appointed me. Look at the legal and contractual obligations before agreeing to change, especially when the change is resulting from audit to review, audit to related service. Are you clear? Yes or no? Now, sometimes no, some work you did no, until the change is accepted. Suppose you are going to accept the change. That work and all, you can use it even in the upcoming proposed work. To avoid confusion in reporting, the report on the new engagement, you are going to give a new report, right? Ultimately on the final engagement, whatever you decided, don't talk about original engagement. And once you accept the change, record new terms and conditions in a new engagement letter. Clear? So indirectly, what are they saying? Whenever a client is asking for change, the auditor can accept it when there is a reasonable justification. What do you mean by reasonable justification? Check legal and contractual obligations. If at all legally it is permitted, contractually it is permitted, yes, then it is reasonable. If it is legally is not permitted, then you will not accept. Yes or no? Once you accept no, agree and record new terms in a new letter. To avoid confusion, the report on the new engagement shall not include original. Non-acceptance of the change. The auditor shall not accept if there is no reasonable justification. Suppose client is asking you to change your rights terms. Now you can't accept it. Client is not cooperating you. Withdraw from the audit, and also check whether your withdrawal has to be communicated to any parties. By the way, why a client will ask you to change? Simple. Circumstances change, misunderstanding of original terms and conditions, or a client who cannot cooperate you, they want to restrict your scope. That's it. For example, if auditor cannot obtain evidence on trade receivables, management is requesting auditor to change to a review. Sir, why external confirmation? All that, sir. You saw already records. No, that's enough. Don't go for external confirmation. Indirectly, they are asking me to do lower level of assurance. So, in order to avoid qualified or disclaimer opinion, so the auditor must evaluate the situation carefully. What you will evaluate? Very simple. Is it reasonable? Reasonable when legally, contractually it is permitted. Then it is reasonable. Yes or no? So that's it. Completed. SA 210 is over. See how much time it took? Hardly 20 minutes. 18 minutes. Clear? Able to recollect everybody? That's it. This is another 5 marks topic. 10 marks we covered in less than 1 hour. Are you clear? Till now we completed 20 marks in the revision. See the amount of speed at which we are able to discuss. If you have a conceptual clarity, next time you imagine when you're reading it 1 more time, 2 more times if you're reading, imagine the kind of confidence you get. Scoring 80 plus, 70 plus is not at all a big deal in audit. It is just that you need to see the real concept, real understanding. Clear? That intensity is also important at your part in learning. That's it. Confident? That's it. Ethics and terms of engagement over. We'll begin audit report revision. Clear? So let's continue the next revision topic, that is audit report. Remember, this audit report weightage is going to be for minimum 50 into 20 marks. Very big chapter. Because along with audit report, we are going to discuss 1 or 2 standards belonging to completion and review topic. For example, there is a standard called 517 completion and review. That also will be discussing in audit report topic. Okay. Now, already we completed fundamentals, nature, objective and scope fully completed. Ethics and terms of engagement is also completed except quality control topic. Quality control topic I will cover at last. Okay. Now, directly audit report. So, we have in audit report totally, just a minute. We have in audit report chapter is broadly divided into 2 parts. This chapter we will broadly divide into 2 parts. 1, reporting standards. 2, reporting, very good, requirements. One is reporting standards, another one reporting requirements. What are the reporting standards that we have in CA Inter audit report chapter? 700, 701, 705, 706, 299, 600 basics only were there. Okay, basics only were there. 710, yes or no? And then we have 700, 701, 705, 706, 299, 600, 710. Then we also have, just a minute. Yeah, 570, which is something from other chapter, but we'll be discussing as part of this. Correct? Then we are also having reporting requirements. For example, everyone knows this CARO, right? CARO, 143 reporting requirement, fraud reporting requirement, all that. Okay, that's it. Now let's focus on 1 by 1 standards. Now see, 700, what is that standard is dealing with? Forming of an opinion, reporting on financial statements. 1, forming of an opinion, reporting on financial statements. Okay, so what the standard is dealing with, see, first to know, in this chapter, the objective is for us to learn how to prepare audit report. Directly we'll start with that. The process in this chapter is how to prepare audit report. Even in the recent JAN exam, many questions were asked very pinpointedly. Okay, I will discuss, as we are discussing the concepts, I will also discuss how the question was asked in JAN exam. Okay, now, so how to prepare audit report. This is what we are going to learn. The objective of this chapter is learning how to prepare audit report. That's it. If you understand audit report preparation process, that's it. You are commendable in this particular chapter. Now, how to prepare an audit report. Audit report will have something called Title. Any letter if you see, it will have some heading to it. So this chapter name is audit report. Nothing but how to prepare audit report. First thing, whenever we are giving audit report, it must have a heading, right? That heading is called as what? Title. And the title is called as Independent Auditor's Report. The title is called as independent. You see, we have given below itself. Here we have given what are the contents of the audit report. Below we have given what are the elements of the audit report. Detailed explanation. Title. The title must be what? Independent Auditor's Report. Title shall clearly indicate that the report is an independent auditor's. Okay, so accordingly the title is what? Independent Auditor's Report. For example, you see Tata Motors, there is an audit report. There is an audit report of Tata Motors. You see here, this is the first page in the audit report. I'll show you. This is the first page in the audit report of Tata Motors. So what they're showing? Independent Auditor's Report. Then the second element in audit report. The second element in audit report is what? Addressee. Yes or no? Just a minute. One minute. In this we need to discuss, I think. We actually I took class notes. Yes. So the second element is what in the audit report? Title is over. We understood how to put a title, correct? Now the second one is addressee. Addressee, you see Tata Motors, what they did? 2 members of the company. Nothing but conceptually addressee means what? Conceptually the addressee means, you see, it is decided based on engagement terms or law or regulation. 2 marks in a descriptive question you will have a 4 marks question. Inside that, as a 2 marks sub question they can ask this, or they may ask you as an MCQ also. What is addressee? Addressee is decided by terms of engagement, law or regulation. For example, generally auditor reports to shareholders in case of a company or those charged with governance depending upon the engagement terms, law or regulation. Clear? The third element in the audit report, remember we have seen in the first chapter, nature, objective and scope of audit. The objective of the auditor is to obtain reasonable assurance, yes or no, and to provide a report. And audit definition is, you see, with a view to express an opinion thereon. Ultimately, we should give opinion on financial statements, whether they are trustworthy or not, whether they are reliable or not, whether they are, true and fair or not. Giving opinion is the ultimate objective. Without wasting any time, first section in the audit report is what? Directly it is talking about opinion. That is what most important for the people also. See, first section in the audit report is called as opinion. But before discussing that, let us look at briefly what are the elements of audit report. Audit report will have a title. It will have something called addressee, opinion, basis for opinion, material uncertainty related to going concern, key audit matter, emphasis of matter, other matter, para. Suppose if you see ICI book, these 4 points you will not find. These 4 points you will not find in the SA 700 format. Why? These 4 are applicable only when the circumstance given under the standard is applicable. If at all 570, material uncertainty and circumstance arises, only 570 will apply. Key audit matter, key audit 701 circumstance, if at all. See, key audit matter, no, it is applicable only for certain entities. Where to whom it is applicable, we'll discuss. Emphasis of matter, other matter, there are some conditions for them. Only then these 4 will come in the audit report format. These 4 generally audit report format it will not have. SA 700 format will have only these elements. Understood? These 4 elements will not be there in SA 700 format. But what the format I am giving you here is a comprehensive format of audit report. Comprehensive format. That's why I kept them in a black color. So if at all they are applicable, they will be added. If it is not applicable, they will not be there in the audit report. Clear? Now, the ultimate objective of the auditor is what? Obviously to give opinion. Opinion is of 2 types, positive opinion, negative opinion. But in our audit subject, we call these opinions as unmodified opinion, modified opinion. Correct? We either call it as unmodified and modified. There is a simple logic behind this terminology. Unmodified, modified. Very simple. Tell me what I need to do in the audit. I already told you in the first chapter also. We need to verify balance sheet, P&L. It's like company is the one who is responsible for preparing financial statements. I have to check them and give my opinion. They prepared financial statements. I verify the financial statements. I should tell the people, I should tell the shareholders, they are good, they are trustworthy or not, they are true and fair or not. Simple. They are right or wrong, they are reliable or not. That's it, right? Are they reliable or not? I should tell. Suppose I verified the financial statements. I saw background books, I saw documents, I saw vouchers, everything I verified. I found financials don't require any modification. They don't require any modification. What does it mean? They don't require any modification means, are they having mistakes? No mistakes. No mistakes. Exactly. They don't require any modification means they don't have any mistake. I will also give my opinion without any modification. That is where we call it as unmodified opinion, which is also called as clean opinion, which is also called as unqualified opinion. This is also called as what? Clean opinion. Clean opinion of the auditor. For example, let us see illustrations in the audit report topic. For example, this is our website, rest of a CACMA website. In that, free resources you download. Here directly by default CA Inter is there. You see here audit and ethics new GOAT notes, that topic is there. Here our old material is also there. Old version material folder you open. Inside that 700 illustrations you download. Okay, 700 illustrations you download just for revision purpose. Remember, in CA Final and CA Inter there is a culture called asking drafting questions. They will ask you drafting questions also, so you have to be very clear on that. So briefly, if at all, we will see how they will be drafted. Briefly we will see how they will be drafted. Just a minute. Now look at it, how briefly they will be drafted. So what is the title? Independent audit report. Yes or no? Illustration. This is illustrative format, 700 format. Audit report of listed company prepared in accordance with fair presentation framework. Yes or no? See, independent audit report to the members. You see, opinion. The first section in the audit report is what? Opinion, which means what? Unqualified opinion. If at all you are giving unmodified, unqualified, suppose you concluded financial statements are free from material misstatements, you concluded that, you got evidence also, everything is clear, unmodified opinion you will give. How do you give unmodified opinion? You see, first we mentioned that we have audited financial statements of so and so company, yes or no, we have audited so and so company, balance sheet, P&L, introduction we will give. Then we will straight away give what? Opinion. In our opinion, to the best of our information, according to the explanation, aforesaid financials give information as per Companies Act and give true and fair view. See, without any objection, clean opinion I gave. Yes or no? That's why it is also called as what? Clean opinion. Look at Tata Motors also. They gave what? Exact copy pasted. Whatever is there in the ICA book, pronouncement, illustration, same copy pasted. In our opinion, to the best of our information, according to the information given to us, the company financials are giving true and fair view. Same copy pasted. Just that this is an audit report on consolidated financial statements, so the word consolidated will come at places. Okay, so remember, if at all you are doing audit of a company which is preparing both standalone financials and consolidated financials, you should give audit report on both standalone, both consolidation. Separate audit reports you must give. That time, no, your audit report must have a heading like this again. Okay, you are giving audit report. In two audit reports are there. This is dealing with standalone financials. Suppose if this is dealing with consolidated financials. Clear? Now in exam, not like this, not just this. This is drafting question. Sometimes I'll ask you a drafting question like this. What is auditor's opinion? Just now we discussed how the opinion looks like. We just now understood. By the way, if at all you are feeling little speed, decrease the speed. You will understand much more better. Clear? Clear? No? Yes, that's it. If clarity is there, speed increase or decrease also not an issue. Okay, fine. Next. Now tell me, what is there in the opinion section? Just now we saw real opinion para we saw. What is there in the opinion section? What auditor is in the opinion section? What is saying? We audited financials of company, balance sheet, P&L, cash flow, notes. Yes or no? You see what is auditor is saying? Identify the entity. First identify the entity being audited. Tata Motors, we have audited financials of Tata Motors. Identified entity or not? Next, state that financial statements have been audited. We have audited. Did they state it or not? Next, remember, we have audited is there, right? This wordings you should not use in case of disclaimer of opinion. If at all auditor is giving a disclaimer of opinion is a one subtype of modified opinion. If at all auditor is giving disclaimer of opinion, you cannot use the word we have audited. You will use the word we were engaged to audit. We were engaged to audit. That's it. So state that financials have been audited. Sorry, not this point. This point. Yes or no? Yes, this point. We have audited. That statement we cannot use in case of disclaimer. Next, third one is what? Opinion paragraph. No, include the heading with a side heading called opinion. And also identify the entity. State that financials are audited. Identify the title. Identify the title of each financials. You see here? Yes or no? Balance sheet, P&L. Yes or no? Summary of significant accounting policies, cash flow. Yes or no? Title is identified. Next, refers to no, refer to notes. Yes or no? And specify the date and period. For the period ended, for the as on, balance sheet date, as at, that is also referred. And not only that, opinion para also contains the actual opinion of the auditor. That is also there. Now in exam they might ask you what are the contents of opinion para. They might ask you what are the contents of opinion para. 4 marks question they might ask you. The auditor has to give an opinion. What are all the auditor shall include in opinion section? That they will ask you. Clear? That's it. Now look at next concept. Okay, slow. Unmodified opinion. What is unmodified? How it will be drafted? What is to be included? We understood. Now suppose I saw the balance sheet P&L. I found many mistakes. Like what kind of mistakes I found? For example, Tata Motors itself is there. Simple example, let us see. Okay, remember, if you recollect, misstatement has a definition. Misstatement definition can be in where and all. It can be in amount, it can be classification, it can be presentation, it can be disclosure. Suppose Tata Motors they have wrongly valued inventory. 47,000 crore inventory worth of inventory is there. In this 47,000 crore worth of inventory, some 1 crore worth of inventory is materially misstated. NRV value 50 lakhs only, but company showed it cost 1 crore. Remaining inventory is correctly valued based on my sample, everywhere correctly valued. Here alone I found a mistake. 50 lakhs is a mistake. But tell me, out of 47,000 crore, 50 lakh rupees mistake, is it material? We will ignore this. Which opinion I should give? If at all this mistake is found, I will still give unmodified opinion. No problem at all. But what if this mistake is approximately 50 crore? What if this mistake is approximately 50, or else more clearly 500 crore? What if this mistake is a 500 crore value? Okay, first of all, let us see profit of the company. Profit of the company is almost 31,000 crore is there. Yeah, okay, we can take 500 crore measurement. Okay, no issue. So 500 crore mistake is there. Now tell me, can I ignore this? This is big mistake. But can I say rest of the balance sheet? No, correct. Rest of the P&L correct. Only inventory valuation 500 crore worth of mistake is there. Cost is, NRV is lower by 500. Company did not consider that. So overvaluation happened. 500 crore worth of mistake is there. Now tell me, can I say entire balance sheet is misrepresented? Don't invest in Tata Motors. Not at all reliable company. Can I say that? If entire financial statements are correct only, true and fair, except this. So except 500 crore, that only you should tell. That is called qualified opinion. Qualified opinion means where financials are true and fair, except so and so matter, except that matter, rest of the financial statements are true and fair. That is called as qualified opinion. Correct? Suppose this mistake value, not 500, 5,000 crore. The inventory value of Tata Motors is actually NRV is 42,000 crore only, but company valued it 48,000 crore, approximately 6,000 crore overvaluation. Cost only they valued, by the way. Cost only they valued. NRV they ignored. For example, Now tell me at what value, I mean if NRV is ignored, tell me if 5,000, 6,000 crore worth of mistake is there, can I still say company financials are true and fair except 5,000 crore mistake? Arey 5,000 crore mistake, how come you say it is reliable? It's a very big mistake. Shareholder decision making will go wrong if this mistake is there. Pervasive. This mistake is called as what? Pervasive. Remember, pervasive means, see, generally what everybody thinks is, if so many mistakes are there in balance sheet, so many mistakes are there in P&L, multiple accounts misstated, then only people think it is pervasive. Not just that. Yeah, that is pervasive. That is one of the reason for pervasive. There is another reason also. There is another situation also. Mistake can be in only one place, but that could be substantial. See, 500 crore is a significant mistake, material mistake, but 5,000 crore is substantial, beyond material, beyond significant, substantial mistake. When you find a mistake which is substantial, you should give which opinion? Adverse opinion. You should give which opinion? Adverse opinion. And remember, tell me, here in both the cases, I have evidence. 500 crore NRV workings, I have NRV workings. I compared it. Evidence is there. I have proved the company that it's wrong. In both the cases, I have evidence. Suppose, let us look at another example. By the way, adverse opinion, you understood, everybody? So when do we give adverse opinion? If the financial statements are materially misstated and pervasively misstated, substantially misstated, then we should give which opinion? Adverse opinion we should give. Correct? Now, you know, Tata Motors, no? For example, same numbers we will take. Same numbers we will take. Out of 47,000 crore, no? 500 crore worth of inventory is with a third party. Is with whom? Third party. Amazon warehouse, they have some Amazon, with Amazon warehouse or with some dealers, with some automobile dealers, they have so many cars with them which are sold on credit or sale or return basis we give, for example. So inventory of the Tata Motors lying with third parties. Okay, now auditor want confirmation from them whether that much inventory is live, that much inventory is there with the third party or not. Auditor is looking for confirmation. Third parties are not responding. Company is also refusing. No sir, don't do confirmation and all. It's not correct. Literally 500 crore worth of evidence I am not getting. I don't know whether 500 crores. They are saying 47,700 crore. Except this 500 crore, remaining any inventory I am asking, they are showing me. This 500 crore, they are not talking about it. Can I say this 500 crore is fake? If you say fake, a company will ask you, show me the reason that it is fake. Sir, you don't know because we didn't give you information. It is not fake. We didn't give you information, we don't give you. That's it. But that 500 crore is there. Oh, 500 crore worth of inventory, they are not giving me information. I am not getting information from the company. Now tell me, very simple. Except this 500 crore, remaining all you verified? Huh? Yes, remaining I verified. Except this 500 crore. That only you say in the audit report. The Tata Motors financial statements are true and fair, except 500 crore for which evidence is not identified. We are unable to determine misstatement is there or not. We are unable to determine misstatement is there or not. We don't know on 500 crore. That only you say. Which means again you should give which opinion? Qualified opinion. So qualified opinion is in two cases. One, you found a material misstatement based on evidence you have. Two, for a material item, evidence is not available. For a material item, evidence is not available. Then also you'll give which opinion? Qualified only. Adverse opinion when I will give? Material misstatement is there, not only material, that is substantial. Substantial technical word is what? Pervasive. The misstatement is not only material but also pervasive. Yes or no? That's it. Suppose no, Tata Motors with the dealers, 5,000 crore worth of cars were there with the dealer. 5,000 crore worth of cars were there with the dealer. For entire 5,000 crore, I don't know whether they are really with the dealer or not. Company saying they are with the dealer. But when I want to go and verify, they are not permitting me. 5,000 crore worth of information, they are not letting me to verify. I don't know whether it is really there or not there. I don't know. I am not in a position to decide on 5,000 crore. But can I keep this 5,000 crore aside and can I give opinion on the remaining financials? No. I can't give like that. This is a major element. What if tomorrow it is not there? It's inflated. What if tomorrow this is overstated, inflated value? What if it is a fictitious item? entire decision making of the user will badly affect, which is pervasive. It's a material, substantial item for which I am not getting evidence, for which I don't know what happened behind. In that case, should I give opinion? I should not give opinion, because I don't have substantial evidence. Substantial evidence, I'm not getting evidence. It is not at all advisable for me to give opinion. Auditor, don't give opinion. Okay, what should I do without giving opinion? My duty is that one, give audit report. In that, mention that you're not giving opinion, and that situation is called as what? Disclaimer of opinion. That situation is called as disclaimer of opinion. Disclaimer of opinion is when we will give, when auditor is not obtained sufficient and appropriate evidence for material plus pervasive item. For material plus pervasive item. Look at this, 705 standard. We'll open 705. Inside that there is a table. Inside that there is a table here, you see. You can come to page number 37. So here, circumstances of opinion. What are the circumstances? For example, you got evidence. Whatever information you're asking, you got evidence. You proved mistakes are there. You found mistakes are there, but they are not material. Mistakes are there, but they are not material. You will give unqualified or unmodified. Suppose I found a material misstatement. But it is not pervasive. It is not substantial. It's material only. It will not drastically affect the decision making of everybody. Maybe 1 or 2 shareholders decision only it will affect, but not everybody. Material, but not pervasive. I will give qualified opinion. Suppose if the mistake is material and also pervasive, then we will give which opinion? Adverse opinion. Then we'll straight away give adverse opinion. Suppose I did not get evidence. You are not getting evidence. When I am bothered, only if it is material. For a material item, I am not getting evidence. Is it pervasive? No. That time you will give again qualified opinion. Suppose there is a material item for which I am not getting evidence, and moreover it is pervasive. Disclaimer. Now here you see, disclaimer of opinion. Now here you see that headings, if you see how cleverly we have used different headings. Is material misstatement exist? Question mark. Material item here, because when evidence is not obtained, we don't know MMS is there or not. MMS is only a possibility. Yes or no? Really there or not, we also don't know. That's why when you see the qualified opinion definition, you see types of opinions. This is nothing but 705 standard. It is below 705 standard. Types of modified opinion. Okay, what are the various types of modified opinion? Qualified opinion, adverse opinion, disclaimer of opinion. And you see the table, qualified opinion is given twice at 2 scenarios. Adverse opinion is given only in 1 scenario. Disclaimer 1 scenario. Unqualified 1 scenario. Qualified opinion is given in 2 scenarios, and that's why qualified opinion definition has 2 parts. So when a qualified opinion will be given, the auditor, based on sufficient appropriate evidence, concluded that misstatement exists which are material but not pervasive. Suppose if the mistake are pervasive, then you will give straight away adverse opinion. Qualified opinion, first part of the definition only, same for adverse opinion. Only one word will change. Here end will come, here but not will come. That's the only difference. Suppose, sir, I am not getting evidence, sir, and unable to obtain sufficient appropriate evidence, sir, but possibility is there. For what? Misstatements on financials. Possibility of misstatements is there. Have you detected? No, I didn't identify, sir. Why? I don't have evidence. Undetected misstatement. The possible effect on financial statements of undetected misstatement, if any, could be possibility. Could means what? Possibility. Material but not pervasive. Then also you will give qualified. Sir, material and pervasive. Then I will give which opinion? Disclaimer. And pervasive is straight away give disclaimer. Tell me, is disclaimer of opinion is so frequent? Extreme rare scenarios, multiple uncertainties, only then auditor will give what? Disclaimer of opinion. That's it. Yes or no? Now, one of the important criteria to decide whether should I give a qualified, adverse, disclaimer, most important criteria is what? Pervasive. What is the most important criteria? Pervasiveness of the effect or possible effect. Before I discuss pervasive meaning, let us discuss audit reporting points on the same. Audit report, see, hardly 27 minutes. We covered one of the major topic. So no. That's the power of real conceptual learning. If you learn conceptually, you can you can understand every provision. You can revise faster. Your ability to revise faster depends upon the amount of conceptual clarity you have. If the commendable clarity you have, revision becomes faster. If at all the subject is slow for you in revision, that means somewhere you do not have command on the subject. That's your command of the subject, speed of the revision, both are directly proportional. Okay, next. I hope you're able to follow everybody. All the points able to recollect. Because you all attended regular class. So you will be. Even others also can understand. Right now, I think I'm able to cover clearly. Yes. Because I'm making sure that you have not attended my class. I took one assumption that you have not attended my class, and that's how I'm actually telling you. Because this is going to be watched by many. Yes, you see 705 illustrations in audit report. 705. Next, you see 705 how audit report will be changed when there is a modified opinion. For example, first we are giving qualified opinion. How audit report will change? You know, in the recent exam, they asked one question. In the January exam, what question they asked? You know, here below it is there. How basis for opinion section is modified in case of modified opinion. Inside that, they asked in case of disclaimer of opinion, how it will be modified. This was asked for 4 marks. 4 or 5 marks in January exam. This point was tested. So you can understand this point only when you see the real audit report. Without looking at a real audit report, you can't comprehend this point. You can't really understand the question. Yes or no? So these 2 points are very, very peculiar. But anyhow, don't worry. First, let me show you. Now, 705 related standard. This is below that some illustrations were there. So what are they saying here? You know, the auditor concluded that material uncertainty, okay, not that. Here, inventories are misstated. Misstatement is material, but not pervasive. Qualified opinion is appropriate is what auditor decided. You see how audit report will be drafted in case of qualified opinion. Heading is same, title, independent auditor report, addressee to the members of the company as usual. Qualified opinion, side heading, you see how they modified? Qualified. In case of unqualified opinion, the side heading will be simply opinion. Tata Motor side heading is simply opinion. Yes or no? Now, this point we have audited, in our opinion, everything is same. But in our opinion, to the best of our information, the aforesaid financial statements give information as per the act and give true and fair view. Positive opinion. He gave a positive opinion. Conditional positive opinion he gave. He has not given absolute positive opinion, conditional positive, because in between he has not given a clean straight opinion. In between, except he has used one exception, except for effect of a matter. What is the matter? Inventory in this example. Except inventory effect. You know what effect? What happened? Described in basis for qualified opinion section of our report. Oh, in the same report another section is there. Basis for qualified opinion, like that another section is there. In this report, some matter is described, except the effect of the matter. In exams, no, sometimes they'll give MCQ, subject to matter, subject to, you know, provided that, like that they will use, except for. Which one is correct? Except for. Except is the word which is correct. Except for the effect of the matter. What matter? Inventory. Okay, inventory. So, in the basis for qualified opinion, the auditor gave a reason. Why? What happened? Why he gave a qualified opinion? What is the reason he gave a reason? See, even if you look at the contents of audit report, no? If you look at the contents of audit report, for example, just a minute. So, contents of audit report, if you see, the second below, immediately after audit report, what is there? Basis. Okay, you gave opinion. On what basis? What basis you gave opinion? The basis is, you see here, one para is there. When you are giving unqualified opinion, side heading is also basis for opinion, simply. Yes or no? When you are giving an unqualified opinion, basis for para is having only one para. Yes or no? Basis for opinion. What auditor is saying? What is the basis for opinion? We conducted audit. How? As per standards on auditing specified under Companies Act. Okay. We are independent of the company. We fulfilled ethical responsibilities. Remember, in ethics topic we discussed. Yes or no? We believe that evidence we obtained is sufficient and appropriate to provide a basis for the opinion. We obtained sufficient evidence and then only we are giving opinion. Don't worry. You are asking me how did I give opinion? I gave opinion as per my audit, which is performed as per standards. I am independent of the company. I obtained evidence. Based on all this, I gave the opinion. Okay, you do audit as per standards, no? What you will do? Under standards, no? Under those standards, we have some responsibilities. Under many standards, we have totally 35 auditing standards plus 3 special purpose standards, 38 auditing standards. You know, we have, apart from that, some 7 more other standards. We have assurance standard, review standard, related service standard, plus 1 quality control. Total 46 standards we have. We do audit as per auditing standards. That to 35 auditing standards applicable. Correct? Now, so, you know, under those standards, we have so many responsibilities. Okay, what are they? They were described under, they are described in auditor responsibilities for audit of financial statements section of our report. In the same report, below, there is a section. What section? Auditor responsibilities for audit of financial statement section. Below, it is explained. Go and refer. Are you good? I mean, are you getting it? Yes or no? So they are telling, go, auditor responsibility section is there. There I have given completely about what are all my responsibilities. See, I do audit as per standards. I have so many responsibilities. If you want, go and read that. I am independent of the company. I obtained evidence. This is the basis for my opinion. Are you clear? Suppose when you are giving a qualified opinion, you should clearly tell what mistake happened in the financials also. That's why you see, right now, whatever I told, no, in 700 format, we conducted our audit as per standards. That para as it is there. But before that, they even clearly mentioned what they mentioned. Inventories are misstated. You know, they have not followed accounting standard. The company records indicate that inventories are misstated. If at all, you know, had management, you see, had management stated, if at all management correctly stated, auditor has to clearly explain how, what elements of balance sheet, what elements of P&L would have affected. If this mistake is not there, how much would be the profit of the company? If this mistake is not there, how much is sales of the company, cost of sales of the company, tax liability of the company, reserves and surplus of the company? You should not only tell the mistake, you should also quantify the mistake. This is how you should modify the basis for opinion section when you are giving a modified opinion. Correct? Yes. So look at, so when you are expressing a modified opinion, you should clearly modify. You see how you should modify. In 705 standard we have this concept, how basis for opinion para gets modified. In case of modified opinion, here you can add how basis for opinion section gets altered or gets modified in case of modified opinion. Suppose, no, just now we saw material misstatement is in a specific amount. Company inventory valued at cost only. NRV they did mention amount misstated. What auditor has to do? If material misstatement is related to specific amount, the auditor shall include the description. Auditor told lower of cost or NRV, whichever is lower, the company did not follow. That's a violation in accounting standard. He described. Not only that, quantification of the effect also you should mention. Quantify also you must do, unless impracticable. Here, inventory only mistake, no. Because of inventory, what balance sheet item, what P&L items affected, I can easily figure out and I can give reasons clearly. Yes or no? Quantification is not, if at all not possible, I will not give. If quantification is possible, I will quantify. Unable. Suppose you are unable to quantify. If quantification is not practicable, auditor shall mention that. For example, in 705, there is another illustration. Illustration number 2. Adverse opinion. You are giving adverse opinion. Why? What happened here? The consolidated statements are materially misstated due to non-consolidation of subsidiary. A company, this company has not consolidated a subsidiary company. That time, adverse opinion. Report on audit of consolidated financials. What opinion? Adverse opinion. So here, no, the company has not consolidated one subsidiary. In consolidation, every subsidiary must be consolidated. If you did not consolidate one subsidiary, so many balance sheet items, so many P&L items, every line item will affect. No, if you do not consolidate one subsidiary, is consolidated financials showing true and fair? Not at all. Straight away they are misleading, because one subsidiary itself is not consolidated. How come it is reliable? That is not family group picture. It's an adverse, it's a material and also pervasive. Many items in the balance sheet P&L have affected. You see, adverse opinion. You have audited. In our opinion, to the best of our information, you see here, it's not except. It's not except because. What matter they used? Because of significance of matter. Because of significance of matter described in basis for adverse opinion section. Now you see, basis for adverse opinion. As usual, again, in unqualified opinion also we see this matter. We conducted our audit as per standards. Our responsibilities are further described in auditor responsibility section. We are independent of the group. We complied with code of ethics. Evidence obtained by us is sufficient and appropriate. Everything they could normally. But why you gave adverse opinion? That reason also you should tell, right? That as explained in so and so note number, the company, the group, no, they did not consolidated. If at all company consolidated, many elements will be affected. What is the effect? Quantification. What is the quantification? Could not be determined. Why? Every item will affect, no? So how come auditor can quantify each and every item? Minorities interest, reserves, equity, fixed assets, current liabilities, non-current liabilities, P&L, revenue from operation, expenses, every item will affect. Unable to quantify, yes or no? So when you are unable to quantify, auditor has to state that. The auditor has to state that. If quantification is not practicable, the auditor has to state so. Sometimes, no, this is when material misstatement is related to a specific amount or amounts, including quantitative disclosures. Quantitative disclosures means what? For example, if you recollect schedule 3, trade receivable is there. Balance sheet trade receivable 100 crore. You should show trade receivable breakup below in the notes to accounts. Less than 6 months, more than 6 months, more than 1 year, more than 2 years. There's some number you did wrongly. That's a misstatement in quantitative disclosure. That time also you should quantify where it is exactly happened. Yes or no? Sometimes mistakes might happen in narrative disclosure. Narrative disclosure means what? For example, no, Tata Motors is giving so many narrative disclosures. What narrative? Here, no, they said narrative disclosures. You see, they said these financials are prepared as per Ind AS. Suppose actually company prepared using normal accounting standard, but here they are saying Ind AS. In whatever they're describing, have they misstated or not? Statements, theory related matter. In the notes to accounts, practical matter not. Theory matter is materially misstated. We will call it as narrative disclosure mistake. If narrative disclosure misstatement is there, what auditor has to do? Explain how the misstatement is made. Sometimes company itself did not disclose. It's not wrong disclosure. They didn't disclose itself. Then discuss with top management, describe in the audit report, in basis for opinion section, is there right? Basis for qualified, basis for adverse, whatever. Non-disclosure is a material misstatement, correct? Non-disclosure is a material. Describe what is omitted. Include the information if practicable. What information company omitted? No. Segment reporting they didn't give. Related party disclosure they didn't give. You include it here if practicable. If not practicable, say that related party disclosures are not given. Nature of omitted information, related party transactions, segment information, trade receivable breakup, what is not shown, MSME related details, what is not shown, mention that nature. Clear? Sometimes you will give modified opinion because you are unable to obtain evidence. When you are unable to obtain evidence, you will again give two types of modified opinion there, either qualified, disclaimer, just now we have seen, yes or no. Now when you are unable to obtain evidence, you should also modify the opinion, right? You should describe the reasons for inability, why, what happened, why you could not obtain the evidence. You should clearly mention the reason. In the recent January exam, they asked this question: the auditor did not get trade receivable something amount, some big amount he did not receive, evidence he did not get. What auditor has to do? You should tell that disclaimer of opinion should be given. Okay, how basis for opinion section will be modified? How basis for opinion section will be modified? Yes or no? Here in the, many students are taking it granted. They think that they're thinking it's a very straight question. You see here what is happening. Debtors constitute 60% major item. Yes or no? And outstanding amount is more than 1 lakh. Management resisted. No external confirmation. Forum decided to disclaim the opinion. 505, 705 put together they asked. Yes or no? Seek your guidance on amendment to be made in the basis for opinion section. What question they are asking? Right now I am showing you, right? What amendment they should make in basis for opinion. Modified opinion in basis for opinion para. In case of disclaimer of opinion, what amendment you should make? Very simple. You remember basis for opinion para? What basis for opinion para will contain? We conducted our audit as per standards. Our responsibilities are described in auditor responsibility section. We are independent of the company. We will fulfill ethics. We obtained evidence. These points we will state, no? When you are giving disclaimer, you should not state them. That's it. When you are giving disclaimer, you should not state them. What? A reference. You should not talk about reference to auditor responsibility. You should not talk about evidence obtained in basis for opinion. Nothing but you see in 705 disclaimer of opinion section, disclaimer of opinion related is there. You see basis for disclaimer of opinion. When you are giving disclaimer of opinion, side heading will be disclaimer of opinion, basis for disclaimer of opinion. Disclaimer of opinion, you see what they gave: directly group joint venture 90% value, auditors were not allowed, auditors were not allowed access. Yes or no? Accordingly, auditors don't know what to do here. They directly mention reason. Are they talking about we conduct our audit as per standards, our responsibilities? That is missing here. It is there in unqualified opinion, qualified opinion, adverse opinion, but not there in disclaimer of opinion. Indirectly, when you are giving disclaimer of opinion, basis section shall not contain those statements. Correct? This is what they asked in exam. At how many marks they have asked for? 5 marks, I guess so. 5 or 4 marks. 4 marks it was asked for. Clear? That's it. With this disclaimer of opinion is also covered. See, since it's a revision class, I'm not going too in depth also. Okay, so we already discussed in our class much more elaborately like how all that reporting happens. Getting it? I hope you're able to recollect. Yes, that's it. Next, any other matter because of which modified opinion is given, that shall also be included in modified opinion. Able to understand? Same way, when auditor is giving disclaimer of opinion, no, auditor responsibility section also will be modified. First of all, auditor responsibility section, what will be there? First, let us look at that. And when disclaimer of opinion is given, how it will be modified, that also we will see. First, before that, by the way, we came up to here because of what? Pervasive definition. Correct? What is pervasive definition? Pervasive definition. Pervasive describes impact of misstatements or undetected misstatements. Pervasiveness is talking about impact of mistake, or undetected means possible mistake that are not confined to specific. They are not in single, or sometimes in single item only, but which represent substantial portion, or pervasive may be in relation to disclosures that are fundamental to users' understanding of financial statements. Pervasive is something either not specific or maybe specific, but 90% but substantial portion. Yes or no? Or maybe related to fundamental disclosures. If at all these types of mistakes there, we will call it as pervasive nature. Pervasive is very important to determine which type of modified opinion to give. Now in exam, 4 marks question they have asked many times, which type of modified opinion auditor has to give is based upon what factors? 2 factors: nature of the matter because of which you want to modify, nature of the matter giving rise to modification, pervasiveness of the matter. Pervasiveness means, nature of the matter means what? Is it because material mistake there? Material mistake there means what? You have evidence, or you are unable to obtain evidence leading to possible material misstatement. Why are you modifying? I found a mistake, that is one reason. 2, I am unable to find any mistake because I don't have evidence. Either of these 2 reasons is what you decided to give modified. Now which modified opinion? Qualified, adverse? It depends on pervasiveness. Pervasiveness of the effect or possible effect. Effect means what? When actual misstatement is found. Possible means what? When undetected misstatement is there. Yes, easy or not, that's it. So with this entire 705 standard is mainly over almost. Now finally one more small topic. Suppose you are not getting evidence. Why? Management is not cooperating. If management is not cooperating, there is a limitation. Ask them to remove. Please remove the limitation. Request them. Management refuses. They are not removing it. You communicate with the top management. You try to perform audit with alternative sources if available. Suppose you are unable to obtain evidence even with alternatives. You are not able to obtain evidence even in alternative way. Then look at the possible effect. You are ultimately not getting evidence. Look at the possible effect of undetected misstatements. Sir, they are material but not pervasive. Then give audit report with a qualified opinion. Suppose if it is material and pervasive, withdraw from the audit, resign. Suppose management is not giving you data and the possible effect is going to be material and pervasive. Major evidence they are not giving me. Substantial item they are not giving me evidence. I am not able to conclude on the substantial item. Don't disclaim the opinion directly. First resign if possible. If resigning is not possible, you should disclaim the opinion. When resigning is not possible, for listed companies, there is something called LODR regulations. As per those regulations, auditor cannot just like that withdraw. There are some formalities the auditor has to go through, which is covered in CA final. Clear? That's it. Now, before you withdraw, you might have done little bit of audit, you might have identified some mistakes, in this 10 days some audit you did before you decided to resign from the company. You might have identified some mistakes, communicated to those charged with governance. Which mistakes? Material misstatements because of which you would have given modified opinion. Yes or no? Communicated. The same thing is given as a diagram. And whenever we are giving a modified opinion, in the audit report we saw side headings has to be changed. Qualified, basis for qualified opinion. Adverse, basis for adverse opinion. Disclaimer of opinion, basis for disclaimer of opinion. Correct or not? That's it. Entire 705 is majorly over. One point alone is kept pending. How auditor responsibility section will be modified. Here, how basis for opinion section will be modified in case of disclaimer. When we give disclaimer, basis for opinion section will not contain some statements. Same way, auditor responsibility section will also be drastically modified. First of all, how auditor responsibility section looks like, that we will see now. Clear? Until now, that's it. 50 minutes till now. The major standard we covered. In our class, we discussed almost 3 hours this topic. 2.5 3 hours we covered almost 3 hours easily. But it was very detailed. Next. Now look at this. So yes, title, addressee, opinion, basis for opinion. Just now we covered. Now responsibilities of management. What are responsibilities of management? We already saw preconditions to audit. What are responsibilities of management? You see here, responsibilities: preparing financials as per applicable framework, internal controls, verifying going concern. Yes or no? These are the responsibilities of management. Once responsibilities of management is given, next you should give auditor responsibilities. What you will give an auditor responsibilities? you will talk about so many things. Auditor responsibility section, no, if you see Tata Motors auditor responsibility section, which is nothing but ICA book copy paste only. Auditor responsibility section, if you see Tata Motors, for example, you see here, this is the audit report. Auditor responsibility section, you see how lengthy. Yeah, you see this. What is auditor responsibility? Getting reasonable assurance. Reasonable assurance is a high level of assurance. Misstatement can arise from fraud or error. And now apart from that, we have to be judgmental, we have to be skeptical throughout the audit. Identifying risk, identifying risk, getting understanding of controls, accounting policies, going concern, uncertainty, all that evaluation, overall presentation, yes or no. All this auditor has to do. Further, auditor has to communicate with top management certain things. With the top management independence, you should communicate, and you may select from communication some matters as key audit matters. This and all you should draft where? Under auditor responsibility section, you should mention all this. The same thing is given in our book. Auditor responsibilities, no, you shall describe objectives of the auditor. What is objective? Reasonable assurance and giving a report. Then you should explain what is reasonable assurance. High level of assurance but not a guarantee. You shall also give the meaning of misstatement. Then in the same auditor responsibility, you should also talk about additional responsibilities. What are additional responsibilities? You should exercise judgment and skepticism. And you should also talk about audit process, identify and assessing the risk, responding it, getting evidence, understanding controls, accounting policies, going concern, fair presentation, overall presentation, structure, content of the financials. Just now we saw. Yes or no? In case of group audit, division of responsibility. Generally, this division of responsibility, we already give it in other matter para. What is other matter para? We will discuss. Since we are giving it on other matter paragraph, we generally don't give it in auditor responsibility section. Again, auditor responsibility section has a third part, communication. What are all communication responsibilities? We have a dedicated standard called 260, which is in the upcoming chapter. There we will revise. Clear? That's it. What you need to communicate? Timing, scope and timing, significant findings, deficiencies in internal control. In case of listed entities, you should give a statement of compliance with independence. Statement of compliance with independence. Key audit matters also possible. That fact also you communicate here. Of course, for key audit matter, separate section is there. There you should talk. Clear? That's it. So now location. This auditor responsibility is just now I spoke, right? Where it should be kept? Same within the audit report. See, Tata Motors within audit report only they gave, no? Yes or no? Or you can give it as an annexure, appendix, or audit responsibilities. No, you type it on a website. You type and keep it on a website. That link you can give if it is permitted by law explicitly. If law does not permit it, don't keep it. Here, all of you. Now, you see, auditor responsibility section, so much is there. Under auditor responsibility part of the audit report, so much you should talk. Suppose, when auditor is giving disclaimer of opinion, auditor responsibility section, how it is drafted, you see, our responsibility is to conduct audit. However, because of matter described in basis for disclaimer, we were not able to obtain evidence. Accordingly, we are independent of the company. We fulfilled ethical requirement. Array, auditor responsibility has three parts. Nothing is mentioned here. In case of disclaimer, since you're not giving any opinion, people are not bothered about your responsibilities. They just want to know what is your main responsibility, why you didn't give opinion, are you independent of the company or not, just tell me and go. That's it. So the same is given as a theory question in exam. The same can be given as a theory. Suppose if auditor is giving disclaimer of opinion, how auditor responsibility section will look like? When auditor is disclaiming, the auditor shall amend responsibility section to include only the following. What you should include? A statement that auditor is responsible to conduct an audit as per standards on auditing. A statement that basis for disclaimer of opinion, because of the fact mentioned in basis for disclaimer of opinion, the auditor could not obtain sufficient appropriate evidence, and a statement of independence and ethical. And remember, most important, when we are giving disclaimer of opinion, key audit matter shall not be communicated. What is key audit matter? Why we shall not communicate? We'll discuss in the key audit matter standard. Clear? or not? Yes, let us finish. Let us conclude 700 standard briefly, and then we will proceed further. Clear until now? So auditor responsibility section over. Then we have another section in the audit report, other information. Remember, other matter para is different, other information para is different. Other information para we don't have in the syllabus. Then we should give report on other legal and regulatory requirement, which we will discuss later. Signature of the auditor. How auditor shall sign? This itself can be asked as a 3 marks question. 3 or 4 marks question. Signature. Generally, report will be signed by personal name, in the personal name of the auditor when he is a individually practicing CA. Suppose I am a firm, sole proprietor firm or a partnership firm, then my firm name also shall be given. Not only my personal name, my firm name shall also be given. And not only that, along with signature, you should mention your membership number. You should also mention your firm registration number. Once you sign the audit report, you should also mention the place. Yes or no? You should also mention the place of signature. Ordinarily which place? The city where you are signing, that city name you should put. Yes or no? Then you should also mention date of audit report. What is the date of audit report? The date of audit report shall be usually the date not earlier than, you cannot put date earlier than approval of financial statements. Financial statements approval date is there, right? You can't put the date earlier than that. Simple logic. Financials approval means what? That balance sheet and P&L which is signed by management is given to public. On that public related balance sheet P&L only you should give opinion. Then how come you give audit report before this date? That's the logic. That's why you see Tata Motors in all the companies. No, I even showed you date of audit report, date of approval, both are same. Yes or no? Then, moreover, not only approval, you should not give the audit report before obtaining sufficient appropriate. Before getting evidence, how can I give opinion? How can I give report? That's the logic. Then last one, unique document identification number. This is to prevent forgery. We will have something called ICA portal. It's an ICA portal. We will have a UDIN portal. Members will have. In that portal, no, whenever I am signing a document, no, what document I am signing, document details I should give in the portal. Then it will give me unique number. That number I will put on the document. 16 character unique number I will allotted. That number I will put. Third parties should rely this document only when the number is there, not my sign. My sign is no more valid. Only my document number is valid. This is to prevent forgery. And all documents, actually it is not February, you can put July. You can directly put what? July. With effect from 1st July 2019, every document and certificate you are signing, no, must contain UDIN document. Clear? Easy? Then that's it. So these are the contents of the audit report. If you once again go back, so date must be on or after approval and UDIN number, correct? Now tell me, basis for opinion para, just we saw. What all should be there in basis for opinion? State that audit is conducted as per standards. State that you are independent of the company. State that you obtain sufficient appropriate. Refer to the section that contains auditor responsibilities. These statements you should not include when? Exactly, when auditor is giving disclaimer of opinion, these statements should not be included. This is what asked in Jan 25 exam. That is what shown in 705 also. Yes or no? That's it. 700, 705 majorly completed. Now let's look at few more sections of the audit report. Material uncertainty, key audit matter, emphasis of matter, other matter para. Okay, fine. We'll take 5 minutes gap and then continue. 1 hour exactly we finish this. We spent approx 3 hours, no, 3.5 hours, no, in our this one fast track, right? Yes. Clear, everyone? Yes. Let's continue the remaining contents of the audit report. Now let's begin emphasis of matter paragraph, other matter paragraph. Okay. So what is an emphasis of matter para? See, suppose if you look at Tata Motors audit report, it will have notes to accounts itself is 100, 120, 130, so many pages. Yes or no? But as an auditor, I should read full audit report, correct? When full financial statements I should read, full financials, full notes to accounts, everything I should read. When I am reading that balance sheet P&L notes, no, I felt some note points very important. 38, note number 38, for example, I felt it is very important because their company is facing one pending litigation in one of the factory related issue, a very big pending litigation. If at all that litigation becomes successful for the other party, the company has to close the factory in that location, which will affect major sales of the company temporarily for certain period. Environmental issue. Such an important incident, they honestly disclosed in the notes to accounts. They disclosed everything honestly. Tell me, when they disclose everything honestly, when they are not misleading anything, can I give a modified opinion? But that note number 38 in the financial statements is something very important. What shall I do? I want every shareholder to read this information. What shall I do? I will emphasize it. I will highlight it. Where? In the audit report, emphasis of matter paragraph and other matter paragraph in the independent auditor's report. What is an emphasis of matter para? Just now I told, it's a paragraph in the audit report. It is referring to some matter. Where that matter is, note number 38, nothing but what? Presented or disclosed in financial statements. In auditor's judgment is important that it is fundamental to users understanding of financial statements. It is fundamental to users understanding of financials. Some matter which is very important for users understanding of fundamental to financials, if at all that is presented, getting it, in the financials some matter is presented which is very important for users, auditor can refer about that in audit report in some para called emphasis of matter para. How emphasis of matter paragraph will be used? Emphasis of matter paragraph can be included in audit report in respect of a matter. By the way, tell me, suppose company did some wrong disclosure there. They are not clearly disclosing the pending litigation. They are misleading people there. What should I do? When they are misleading that matter, no, in the notes to account, they are misleading. Modified opinion. Array misstatement, disclosure misstatement, modified opinion. I should not use it that time, emphasis of matter. When it is materially misstated, I should give a modified opinion directly. When can I highlight a matter under emphasis of matter para? Only when it is free from material misstatement. That's why in emphasis of matter para there is one more word. Only when it is appropriately presented or disclosed. When a matter is appropriately presented, appropriately disclosed in financial statements, then only I should refer about emphasis of matter para. Correct? Then so emphasis of matter paragraph is a para which is a emphasis of matter paragraph is a para in the audit report that is referring to some matter which is appropriately presented or disclosed in financials. In auditor's judgment is of that important for fundamental understanding of users. Yes or no? Then now how it will, when it will be used, it is not required to modify. The auditor is not required to modify opinion on that matter. Suppose if a matter is materially misstated and where you have to give a modified opinion, you can't use that matter under emphasis, prohibited. You cannot use like that. That matter must be free from material. It must be appropriately presented. Then only you can highlight. Moreover, it is not decided as a key audit matter. What are the examples? What matters generally auditor emphasize? Some uncertainty about litigation, just now I told. Major catastrophe happened, that is disclosed in the financial statements that the company suffered so and so loss after 31st March. Some significant subsequent event, early application of some accounting. Company followed a new accounting standard much more early. So they highlighted that, in the notes to accounts. You can highlight that. You can highlight that point in the audit report. Able to understand. Now, how should I present emphasis of para? How should I present Air India audit report? We will see. How should I present emphasis of matter paragraph? Just a minute. Emphasis of matter paragraph. Emphasis of matter paragraph, how it shall be presented? It shall be presented in a separate side heading. Correct? In audit report, separate side heading is there. You see, Air India opinion is there, basis for opinion is there, emphasis of matter is there, separate side heading. Many students think, sir, if qualified opinion is given, emphasis should not be given. No, it's not about these two. Below here, note number 29 is there. For example, on this, if you are giving qualified opinion, this cannot be given under emphasis. That is what the meaning. Many students confuse between overall audit report opinion and emphasis. No, it's on that matter. Which matter? If at all you want to highlight that under emphasis, on that matter you should not give qualified opinion. Sir, note number 29, note number 26, 49. On these matters, I don't have any qualified opinion. Now can I use emphasis? Absolutely. Then why he gave qualified opinion? Sir, this is on some other matter in the notes, not on the note number 26, 29. Understood. Now, emphasis. Put a separate section in the audit report. Side-heading emphasis. Draw attention. Give reference to note point. Give reference to note point. And at the end of the matter, mention that our opinion is not modified. Our opinion is not modified. At the end of the matter, you should give our opinion is not modified in respect of the above matter. Next. Now look at this. How? Manner of presentation. You know, in exam they'll ask you, define emphasis of matter paragraph. How to present it? Manner. Include the para in a separate section. Heading, emphasis of matter. Express the matter. Reference also you should give. You see, we draw attention to note number 26, correct? State that your opinion is not modified. At the end of the para in the audit report, our opinion is not modified on the above. Means we don't have any objection. Indirectly we are clarifying, correct? By the way, can I give emphasis of matter paragraph as a substitute for a modified opinion? Never. When something is wrong, you should give modified opinion only. On that you should not give emphasis. Emphasis of matter paragraph is not a substitute for modified opinion. Emphasis of matter paragraph is not a substitute for disclosures required under applicable framework. Emphasis of matter paragraph is not a substitute for 570 reporting, where the entity will continue as a going concern. That's it. Clear, all of you? Then in the same audit report, there can also be some other matter that is called as other matter paragraph. What is other matter paragraph? Other matter paragraph is also paragraph. That is also in the audit report only, which is referring to a matter not presented, not disclosed in financials. Because no, see, in the audit report, no, I want to refer about some matter presented or disclosed in financials, I have emphasis. If you want to talk about something else, not presented, not disclosed in financials, but it is relevant for users. For what? For understanding about the audit, for understanding about the auditor responsibilities, for understanding about auditor's report, to make the users understand not about financials, to make the users understand about audit, auditor responsibility, auditor report. That time I can use other matter paragraph. Just like emphasis, other matter paragraph also shall be given in a separate section in the audit report with a side heading called other matter. Same way, other matter paragraph I can include only if two conditions are satisfied, not prohibited by law. In India, nowhere it is prohibited. That's why every company happily, every auditor will use other matter para. Also, it is not decided as a key audit matter. Suppose if a particular matter is decided as a key audit matter. Sir, what is key audit matter? We'll discuss in some time now. So, if a matter is decided as a key audit matter, which is also one more element in the audit report, why duplication? You can discuss it under key audit matter. Yes or no? But remember, key audit matter, emphasis, they are all different. Fine. Once I complete key audit matter, then I will discuss about what is key audit, what is emphasis, what is other matter. Everything I discuss that time. Clear or not? Yes. Next, communication with governance. If emphasis of matter paragraph, other matter paragraph is expected to be included, the auditor shall communicate with those charged with governance, including the wordings of the para. Okay, whenever you decided to include emphasis of matter and other matter para, you shall communicate with top management. Very simple. Whenever you want to include any matter, emphasis, other, modified opinion, key audit matter, material uncertainty related to going concern, simply, I told you at the beginning, 700 format don't have those 4 points. If at all you want to include any of them, or you want to give a modified opinion, draft audit report shall be given to management, because these are all additional reports, additional information in audit report. If you are giving unqualified opinion, you are not including emphasis, you are not including other matter, you straight away can give happily audit report without giving to the management. But if at all you want to modify the audit report, you must communicate with the top management. Now, sir, what is the example of other matter para? Classic example we can take, simple classic example. For example, in other matter paragraph, generally what auditor will describe? Auditor will describe about definition, you see, about the audit, about the responsibilities of the auditor, about the audit report. The audit, auditor responsibilities, auditor's report. About these three issues you have to discuss. Yes or no? Now, for example, you imagine there is a company called State Bank of India Limited. It's a bank. Simple classic example, simplest way. State Bank of India, they prepare both standalone financials and consolidated financials. Now, standalone financials is nothing but, head office plus branches. All branches plus head office combined financials is called as standalone financials. Whereas State Bank of India has appointed Mr. P, who is a principal auditor. Nothing but he is a bank auditor. For the entire State Bank of India, he is the auditor. Actually, State Bank of India has a joint auditors. 12 joint auditors were there. All 12 put together, we can call them as what? Principal auditors. Let us name them as P. Are you getting it? They are principal auditors. Now, head office, entire, who should give audit report on standalone financial statements? P should give. Because he is the auditor of the bank. He should give audit report on standalone financial statements, P. Correct? But branches, right? 25,000 branches they have. State Bank of India have 25,000 branches. You see the breakup of the branch, 6,000 branches were only audited. 19,000 branches were unaudited. These are branches not audited. You just have to give disclosure requirement. In bank audit chapter also we have seen. In the revision of bank audit chapter, I will tell you, the auditor has to disclose in other matter paragraph in the bank related audit report how many branches are unaudited. Regarding the audit, you should give a disclosure. How many were unaudited? You should give a disclosure regarding audit because it is affecting your responsibility. They were not audited. Now, 6,000 branches were audited by branch auditors. We can call them as B, branch auditors. Now, tell me, these branch auditors, almost 25,000 put together, 90% of the financial operations. These branches, maybe 80%, for example, entire branches of State Bank of India, 90%, approximately 90%. 90% of the entire finance activities are happening in branches. But these branches are not audited by B. Who audited them? Branch auditors, or they were not audited. But who is giving audit report on entire standalone financials? Principal auditor. But who audited actually? Branch auditor. Now, how did principal auditor giving opinion on standalone financial statements? Based on branch auditor's report. Branch auditors will do audit and give a report to principal auditor, and principal auditor using those reports, he will give opinion on the overall balance sheet P&L. Sir, how do he will take their reports and give opinion? What if branch auditor gave a negative opinion? What he should do? That and all we have in CA final. We have SA 600. There is a standard in-depth discussion is there in CA final. There we will discuss. Clear until now? Everybody? Yes. So on these branches, so the principal auditor giving opinion on entire company based on, depending on branch audit report. But tell me, public thinks what? He only verified everything. But in reality, did he verify? He has not verified in reality. What if tomorrow some fraud is discovered in the branch? Every public person will go and blame principal auditor. You are the reason why you did not find a mistake, all that. That's why principal auditor should tell public in the audit report itself. What he should tell? In other matter paragraph, principal auditor should tell the public that, look, 6,000 branches are not audited by me. They were audited by other auditors. Approximately this much amount they only audited. But I am the one giving audit report. I agree. But my audit report is based on their audit reports. They said everything is good. So I am saying you everything is good. How you believe my opinion? I believed their opinion. This is called division of responsibility statement. The principal auditor shall state division of responsibility when he is using the work of other auditor. When the principal auditor is using the work of other auditor, the principal auditor shall demonstrate responsibility of the principal auditor shall communicate, the principal auditor shall describe other auditors, responsibilities in the other matter paragraph. Clear? Yes or no? Everybody? Same way when you are doing consolidated financial statements. So, see, when a company is preparing consolidated financials, same auditor should give audit report on that also. But this consolidated financials is a consolidation of standalone financials of holding company, nothing but State Bank, plus standalone financials of subsidiary, associate, joint venture. Correct? But these subsidiary, associate, joint venture are audited by subsidiary auditors. But consolidated financials, on that audit report is given by P. But in that financials, consolidated financials, subsidiary data is also there, right? Subsidiary numbers are also there, right? But I didn't audit, but I am giving it. How I am giving opinion on the consolidated financials even though some of the information is audited by other auditor? By using their reports. So whatever in the consolidated financials, I audited only holding company assets and liabilities, incomes and expense. The assets and liability, income and expense also includes subsidiary company incomes and assets, which is not audited by me. But I am only giving opinion on the total assets and total liabilities. But subsidiary related assets and liabilities not audited by me. That is audited by subsidiary auditors. But I gave opinion. I am giving opinion on consolidation based on their reports. This point also where you should highlight other matter paragraph. Clear? Other matter paragraph is used like this. For example, you see in Tata Motors, they have clearly mentioned, you see here, we did not audit. What are they saying? We did not audit. Okay. So it's 58 subsidiaries, 2 direct subsidiaries, 58 step down subsidiaries. Yes or no? Why? I mean, what happened for them? They were whose financials? You see here, whose financials were? What happened? These financials were audited by other auditors, and our reports, insofar as amounts and disclosures relating to these subsidiaries, our opinion is purely based on other auditors. Correct? These our opinion. We have audited all this conversion. You see here, our opinion on the consolidation is not modified. By the way, we relied upon other auditors' work. What are the principal auditors are saying here? To the extent of subsidiary related data, which is included in holding company consolidated financials data, my opinion is based on other auditors' opinion. Indirectly, he is stating about responsibilities of other auditors, where he is stating other matter paragraph. That's it. Other matter paragraph over. Clear? Now, remember, State Bank of India is being audited under joint audit. They have 12 joint auditors. State Bank of India is having 12 joint auditors. Now, what is the concept of joint audit? First, we will cover that concept and then we'll go back and continue. Clear? What is a joint audit? Very simple. Appointing 2 or more than 2 auditors. Auditors can be individuals, firms, combination of individual and firms. That is called as what? Joint audit. The scope of work must be same. The year must be same. The act under which they were appointed must be same. Both of their duties and rights must be same. Scope must be same. Then only they are called as joint auditor. Suppose a company has auditor for Companies Act, one auditor is there. Income Tax Act, another auditor is there. Can I call them joint audit? Both are under 2 different statutes. I am having auditor for 23-24, 24-25. 2 auditors are there right now. Can I call them as joint auditor? No. Both are 2 different years they are doing audit. Yes or no? That's it. Now, when joint auditors were appointed, how they do the work? They divide the work and then do. When joint auditors are appointed, joint auditors divide the work and then do. Correct? So, joint auditor, they will have individual or separate responsibilities or joint responsibilities. When the work is divided among joint auditor, each joint auditor is responsible only for their allocated work, which may be based on assets and liabilities, income and expenditure, geographical area, identified unit, period of financial statements. Getting it? Joint auditors, when the work is divided, each joint auditor is responsible only for work allocated to them. How the joint auditor responsibility? Assets and liabilities, income and expenditure, geographical area, identified units, any of these way work can be divided. Yes or no? Like you do assets, I will do liability. You do income, I will do expenditure. You do north, I will do south. You do 4 units, I will do 4 units. You do 6 months audit, I will do 6 months audit. Sometimes, see, when the work is divided like this, each joint auditor is responsible. For example, State Bank of India is having 12 auditors. They 12 divided the work. Each one is responsible only for their work. If other joint auditor is negligent in his work, no, I am not responsible. Getting it? He is only answerable. Some cases, combined responsibility. All of them together will be responsible when work is not divided and performed collectively, decisions taken collectively in all common areas, or matter is brought to all attention and everyone agreed on that. And whether financial statements are prepared as per applicable framework, whether presentation and disclosure are as per applicable framework, whether audit report issued is properly as per the SA 700 format or not, all joint auditors are responsible. Sir, why audit report? Why audit report? All of them are combinedly responsible. Because in a joint audit report is given commonly by all of them. One report only they will give. For example, you see State Bank of India report. For example, State Bank of India report, if you see this is the auditor's report of State Bank of India. This is auditor's report ending, you see. All the joint auditors signed it. 12 joint auditors signed the State Bank of India report. Since all the auditors signing one audit report means how many audit reports they are giving? One audit report. Look at the reporting by joint auditors. Look at reporting by joint auditors. Look at the reporting by joint auditors. What is this? Audit reporting in case of joint audit. Generally, joint auditors issue common conclusions and a common opinion. A joint auditor is not bound by majority. If there is a difference of opinion, disagreeing auditor can issue separate opinion. Yes or no? Joint auditors are not bound by majority. If at all the auditor is, if at all they have a difference of opinion, then what happens? He can issue a separate report, separate opinion. Yes or no? Very simple. Suppose State Bank of India 12 joint auditors, but they're right. Generally they give commonly. If one of them is saying, sir, actually State Bank of India, you see, they gave unmodified opinion. But one auditor, sir, the area where I did, it's a substantial mistake. He want to give adverse opinion. Remaining joint auditor, sir, it's only material, sir, not pervasive. You can give qualified opinion. No, sir, I will give adverse opinion only. Then do one thing. You give separate report, sir. Is there any bound, is there any responsibility for one joint auditor to follow majority? No. A joint auditor is not bound by majority. Suppose if you're disagreeing, what will happen? You give another report. You give your own audit report. They will give 11 of them together. They will give one audit report. Then 2 audit reports will come. If which one shareholders has to believe? Anything. Because joint auditor who is giving adverse opinion, in basis for adverse opinion, he will tell the reason to the people. Shareholders will decide which one to believe. That's their choice. Are you getting it? Now, when different audit reports are there in joint audit, each audit report shall refer about other joint auditors report. Getting it? So cross-referencing must be there. Clear? Then, by the way, joint auditors must coordinate with each other. Any matter, if one joint auditor identifies some matter not belonging to me, his issue, I should communicate him. Same way, he should also communicate me before audit report date. Also, sir, should I verify joint auditor's work, how he is performing? No need. He is also CA along with you. He is also COP. He is also liable for standards on auditing. He know everything. You don't have to. What if you do mistake? Because all of us are doing commonly and then giving opinion. No. What if because of that fraud is happened? It's okay. He is only answerable. You are not answerable. No. Work divided. He is only answerable. Yes or no? Special considerations. Whenever you are appointed as a joint auditor, you should specifically focus on certain things. How audit will happen. Every partner from the firm, State Bank of India 12, is there 12 firms are there, right? As a joint auditor, from each firm, partner, important team member, all of them should be involved in planning process. All of them should be involved in planning process. All of them should, each joint auditor should do risk of MMS and communicate it to others. Each joint auditor shall do risk assessment and communicate to other joint auditors, and all the joint auditors shall establish joint audit strategy. Once a strategy is established, all the joint auditors must develop joint audit plan before starting the audit, addressing division of areas and common areas, addressing reporting objectives, addressing significant factors among joint auditors, addressing preliminary engagement activities and resources allocation. Joint audit plan must be developed. What points they should address when they are developing joint audit plan? This itself can be given as a 4 marks question. Remember, the audit reporting, 4 marks question possible. Responsibility, what are the areas where combined responsibilities are? 4 marks question is possible. What are the responsibilities of joint auditor? This itself can be asked as a 5 marks question. Coordination between the joint auditor, 3 marks question. Special considerations in joint auditor, 4 or 5 marks question. Only main points you should write. Understood? Sometimes in depth, what write about joint audit plan, what considerations joint auditor shall consider when they are developing plan. When you are preparing plan, no, identify division of areas and common areas. What are the reporting objectives? Remember, reporting objectives are different from reporting requirements. And what are the important factors to be communicated? Preliminary engagement activities, how many resources are required? Preliminary engagement activities, important factors, reporting objectives, division, common area, resources required. Considering all these, they develop a joint audit plan. Next, they will discuss and document what kind of audit procedures to be performed, nature, timing, extent of common areas and specific areas, nature, timing, extent of procedures for common areas, procedures for specific areas, yes or no, they should discuss and proceed further. And further, remember, joint auditors must obtain common engagement letter and a common management representation letter regarding management responsibilities. We have seen already engagement letter, so you should give engagement letter, obtain management acknowledgement commonly. Yes, management representation. What is representation? Written representation 580, we have a separate standard, we will discuss in the upcoming chapter. Getting it? Next, finally, once work allocation is done, plan is developed, engagement letter given. Now you have allocated work among everybody, right? Document that. Not only document the work, because tomorrow if some fraud happened, who did that work? Everybody should be able to answer. Not only documenting, you should also communicate it to those charged with governance. 299 over. 700, 705, 706, 299, 4 standards we covered predominantly. In 700 only some 2 or 3 small concepts are there. That's it. Clear, all of you? Then now let us discuss 701 key audit matter. Let us discuss 701 key audit matter. What is this 701 is talking about? Communicating key audit matter in the independent auditor's report. Communicating key audit matter in the independent audit. What is a key audit matter? Let's look at how Tata Motors auditors are using key audit matter. Let us look at how Tata Motors, see, so many they're using. Tata Motors, no, they are giving key audit matters. You see, they have given something called side heading, key audit matters. You see what they wrote? Key audit matters. No, they are the matters in professional judgment based on consideration of reports of auditors, whatever, were of most significant. They were most significant in audit of current period. These matters were addressed in the context of audit. We do not provide separate opinion on these matters. Tata Motors are giving, Tata Motors auditors are giving, they are talking about key audit matter. What they are saying, these matters were addressed in the current period and they are not providing any separate opinion on these matters. Now you see how they are giving the key audit matter communication. What they are explaining, very simple. You know, they are explaining something. Jaguar Land Rover, they are the one who are having most amount of property, plant and equipment. Okay, here no, what is the impairment happened? Impairment related issue. Impairment happened in this, so that is selected as a key audit matter. Okay, impairment happened. By the way, is there any material mistake in that? No, it's not material mistake. Key audit matter is not about mistakes related. Important matter, key, important audit matter I am communicating. Why are you communicating? Just whatever important, no, in audit I'm just communicating people so that they will understand what are all important areas in the audit. They will understand, that's it. Sir, is there any mistake in that? Is there any fraud in that? No, it's not about mistake. See, if mistake is there, fraud is there, I will modify the opinion. Why I will communicate in key audit matter? Then what is key audit matter? Important audit matter. Why are you communicating? Useful for the people, that's it. So key audit matter, you see, so what is the key audit matter? They mentioned here. Then how the matter was addressed in our audit. Second, what are they communicating? How the matter was addressed in the audit. How the matter was addressed by the auditor in the audit? No, they verified that impairment, they verified in audit. The audit is a verified impairment related discussion. Okay, how they verified? They verified accuracy, they verified some historical comparison, they verified that auditors, component, industry, expert help and all they took. Sensitivity analysis, assumptions and all. Impairment loss computation involves assumptions and all. They did some valuation, they did some impairment reversals and all, they verified. What are all auditor verified regarding impairment? They are communicating. Indirectly, what auditor is trying to tell? What is the important issue that he faced and how he performed the audit. Nothing but audit procedure. What is important audit area? What audit procedure you perform? Briefly you are telling the people. By the way, are we highlighting any point mentioned in notes to accounts? Are we highlighting any? We draw attention to so and so point in the balance sheet. First of all, whatever you are communicating key audit matter, no, that may be disclosed in financials, may not be disclosed in financials. Key audit matter is not about something disclosed or not disclosed in financial. Then what is key audit matter? I told no, I'm doing audit in the company. Getting it? When I'm doing audit in the company, I found something very important. There I gave major amount of time. What I did, why I gave so much time, I'm just communicating people. That's it. Suppose company recently installed SAP system. Until earlier, they used to follow some ERP software. Now ERP software changed. Because of this, 20 days I'm spending time only on that, learning ERP software, all that. I can tell that as a key audit matter. I can communicate that as a key audit matter. Why? What happened in the company? Some accounting software changed, and what you did on that, I can tell about my experience on that. It is nowhere disclosed in financial statements. I can talk on key audit matter section anything, whether it is discussed in financials or not, doesn't matter. It occupied my time so much that I can talk about. It's a significant point. Significant auditor's attention. Key audit matters are those which require significant auditor's attention. That is what key audit matter. That I can talk here. Clear, all of you? Everybody? Yes. So indirectly, what is a key audit matter? Look at it. What is a key audit matter? Key audit matters are those matters in professional judgment. Yes or no? In auditor's professional judgment were of most significant in audit of current period. These matters are selected from matters with those charged with governance. Key audit matters are matters that are so important in auditor's judgment. Yes or no? To users understanding. Yes, I mean obviously for users point of view only. Whatever I feel very important, I will communicate it to users. Why are you communicating? What is the purpose? What is the purpose of communicating? It enhances value of the audit report. Audit report is not a boring document. It will give some information about insights about audit. How I am doing in the audit, no, it gives some insights. It also offer, key audit matter is offering additional information so that users will understand how auditor will do. What are the significant management judgments? Where and all important issues are there? Users also will understand. According to auditor, what are the important issues in the company? Users will get to know. According to auditor, what are all auditor focused so much time? They will also get to know. Yes or no? By the way, tell me, how to decide key audit matter? Generally, key audit matters are selected from various matters communicated with those charged with governance. If you remember, there is a standard called 260. Communication with those charged with governance. What are all you should communicate? Planned scope and timing of the audit. Responsibility of auditor. Significant matters. Significant matters means what? Key audit matters. By the way, every matter you tell to management, top management, will you communicate it in key audit matter? No. Whatever you feel to communicate, that only you will communicate. Clear or not? Now, how auditor will select them? maybe, three criterias. The auditor considerations include, when auditor is communicating key audit matter, the auditor's consideration include what and all? Areas of higher risk involving significant management judgment or accounting estimates with high estimation uncertainty. Getting it? Key audit matters are communicated from areas where high risk is involved or areas where significant judgment is involved. For example, right now we saw Tata Motors impairment. Impairment is selected as a key audit matter because it involves significant judgment, it involves high estimation uncertainty. In exam, half mark for this, half mark for this, half mark for this. That's how they will allocate. And because of significant event, significant transaction, 1 mark or half mark for this, then key audit matters are derived from matters communicated with those, 1 mark for that. That's how mark allocation will happen. Able to understand? All of you, by the way, is suppose company they forgot some important disclosure in financials. Now they're requesting you, sir, we forgot a disclosure, sir, can you please disclose in the audit report under key audit? No, when you did not disclose, it's a non-disclosure, it's a material misstatement, I will give modified opinion. Yes or no? Key audit matter is not a substitute for disclosures in financial reporting framework. Sir, mistake is there in the balance sheet, sir, can I discuss it under key audit matter? Prohibited. When mistake is there in the balance sheet, key audit matter is not a substitute for modified. When mistake is there, you should give a modified opinion. Sir, can I give is key audit matter, are we giving any separate opinion? Key audit matter is not a separate opinion. Key audit matter is not a substitute for material uncertainty under going concern. What is material uncertainty? We'll discuss later. Then what is key audit matter? That's what I'm telling. Important matter in the audit. I did 50 days audit. 10 days I spent on 3 issues only. Important issues. I can communicate them. What you will communicate? What is the issue? I will tell. How I resolved it in the audit, I will tell. That's it. What is emphasis of matter? In the balance sheet P&L notes, if important point is there, every one of you, if at all they need to read, I can highlight that. That is emphasis. Then what is other matter para? Responsibilities of auditor, joint auditors referencing to other auditors report, that and all will be there in other matter. So key audit matter, how I did audit, I will explain with some examples. Emphasis of matter, highlighting important points in the financial statements which are presented and disclosed. Other matter paragraph, discussing about auditor responsibilities like division of responsibility, other auditors report, that and all I will discuss in other matter para. Clear? Everybody? That's it. Now, key audit matter applicability, most important. It is applicable for listed entities. Compulsory for listed entities, auditor must communicate key audit matter, 1 or 2 at least communicate. Or second, when key audit matter shall also be communicated listed, okay. If law or regulation requires, in India there is no law, or if it is interest, significant public interest, that matter is important for public interest felt by auditor, then also he can communicate. And remember, prohibited communicating key audit matter in the audit report. Key audit matter heading itself should not be there when you are giving disclaimer of opinion. When auditor disclaims opinion on the financial statements, you shall not include key audit matter. Very simple. Disclaimer means what? Majorly we didn't audit. We did not audit majorly everything. That is the reason we are giving disclaimer. When you did not audit everything, how do you know important audit? When you did every auditor, when you covered everything in the audit, you know which one is important. When you did not audit, how do you know which one is important? So, communicating key audit matter is prohibited in case of disclaimer of opinion. Finally, how should you communicate? Manner of communication. This itself can be asked as a 4 marks question. Yes or no? This itself can be asked as a 4 marks. Purpose of communicating, definition of key audit matter, applicability of key audit matter. Any way they can ask, and all these questions were tested in past. How you should communicate? Introduction. Key audit matters, no? In a separate section of the audit report we will communicate. Introductory language will be key audit matters or in auditor's professional judgment were of most significant in current period, and these matters were addressed in the context of audit and does not provide separate opinion. These matters were addressed in the context of audit, and auditor will not provide any separate opinion. Like that you should write introduction language. That is what is there in Tata Motors Key Audit Matter introduction. That is what is there in the State Bank of India introduction matter. Clear? And whenever you are including Key Audit Matter, you shall always communicate to the top management. Okay, the auditor shall communicate with top management about matters which are decided as key audit. Suppose no, I am doing listed company audit. Literally, I don't have a Key Audit Matter. Then put a heading. Say that there are no Key Audit Matter. If no Key Audit Matters are determined, the auditor's conclusion, depending upon the facts. Okay, suppose no, if Key Audit Matters are not decided, no, if there is no Key Audit Matter, say the management that there are no Key Audit Matter. In the audit report, put a cited in Key Audit Matter, mention that there are no Key Audit Matter. Compulsory, like this you should mention. Clear? That's it. 701 is completed. Clear? Remember, whether they may ask this as a descriptive question, they may ask as an MCQ. Everywhere conceptually I clearly told you how an MCQ can come, all that. Especially, you know, this question, no, sometimes they will ask you this question as, under what circumstances Key Audit Matters shall not be communicated. Every student will write applicability. Applicability they will write. What you should write, you know, you should write applicability. You should also write Key Audit Matter is not communicated as a substitute for disclosure, as a substitute for modified, as a separate opinion, or not a substitute for material uncertainty. Able to understand? Clear? That's it. You know, even in the audit report, no, when we are discussing 700, 705 formats, no, they will ask you, tell me, when we are giving unqualified opinion, we have audited. First para we will start with, we have audited. When we are giving qualified opinion, we have audited. Even adverse opinion, we have audited. But in disclaimer, I told you, we were engaged to audit. This can be asked as an MCQ. Careful. Same way, when we are giving unqualified opinion, how it looks like, in our opinion, the aforesaid financials are true and fair. Whereas in qualified opinion, in our opinion, to the best of information, all that, except for the effect of the matter, the aforesaid financials are true and fair. Except for the effect of the matter, except for the, that will be tested as an MCQ. Be careful. If it is adverse opinion, because of, the wordings will be because of significance of matter described in basis for adverse opinion section of our report. Clear? Every point that we are discussing can be either asked as an MCQ or as a descriptive. Any way it can be asked. Clear? I think wherever possible, I think I gave references to questions also, right? I hope everywhere maximum I gave references. Fine. That's it. With this, Key Audit Matter is completed. Then now you see, in this, no, we completed Key Audit Matter. Yes or no? Yes, Key Audit Matter, emphasis of matter, other matter, para, all the three completed. Now let's understand material uncertainty related to going concern. Material uncertainty related to going concern. After finishing that, we will discuss CARO. We will discuss CARO 2020 we will discuss. Okay, report on other legal and regulatory requirements. Once we discuss this chapter will be over. Now, going concern. Going concern is covered under which chapter? SA 570, completion and review chapter. In our book, that is actually 4th chapter. Okay, let's go to the 4th chapter. What's the page number? Huh? Okay. Yes, got it. This alone we will finish and then wind up. Okay, then we'll continue the next some other session. Going concern, you see. So going concern, you know, just a minute, loading. Yeah. So I have given one diagram here. There are so many concepts that are discussed in 570. There are so many concepts which are discussed in 570. Going concern. What is going concern? Very simple. A company by default prepare financial statements using fundamental assumption called going concern. They prepare using fundamental assumption called going concern. You know what does it mean actually? They are saying indirectly to people, we will continue our business also in the future. We will continue our business in future. That's why we are following going concern assumption. That's why historical cost method they are following for non-current assets. Generally, plant and machinery, some value is there. Tata Motors, 3 lakh crore plant and machinery is there. If you sell them, no, 10,000 crore also they will not get. But then why are they showing 3 lakh crore? Because they don't have intention to sell. Yes or no? So since they don't have intention to sell is not there, means what are you doing? You want to continue the business. That's why I'm choosing going concern. My question, can you continue the business? My question here is what? Can you continue the business? See, if you can continue the business successfully, use going concern, no problem. What if you cannot continue the business? What if you cannot continue the business? Suppose company is facing severe losses, employees are already on strike, company bank accounts are already freezed, regulatory proceedings are already going on, customers, website and all stopped functioning, product manufacturing stopped. Now tell me, is the company actually continuing? But they prepared financial statements using going concern basis. They prepared financial statements using going concern basis. In reality, the company continue actually already operations and all stopped. How come they use going concern assumption then? You're not functioning already. You are now itself not continuing. Forget about future. Now itself you are not continuing. Then can the company use going concern assumption? They should not. Auditor has to check whether company can use going concern basis of accounting or not. Look at the objective of the standard. What is the objective of the standard? The objective of the standard is the auditor has to obtain evidence, sufficient evidence on appropriateness of management's use of going concern basis in preparing financial statements. Management is preparing financials on going concern. Is it okay? Auditor has to get evidence. When you are getting this evidence, when you are verifying company going concern, you may conclude sometimes material uncertainty. What is material uncertainty? That we are going to discuss. Clear? Now look at, the entire process of SA 570 is given here. What is that? You need to verify going concern, right? Who has to verify whether company is a going concern or not? Primarily, who should verify? Management. The auditor has to first ask management whether they did preliminary fundamental assessment of going concern. Preliminary, did they have going concern assessment? Ask them. Sir, they didn't do. They didn't do assessment. Array, that's their responsibility, which they didn't do. Ask them to do. Sir, they're not doing, sir. Give modified opinion. Give modified opinion. Sir, they finally did, sir. Management done? Yes, they did that. They did that. Evaluate it. They did assessment, right? Check that workings. Why are you checking the workings? I want evidence whether going concern assumption can be used by the management or not. Is it permitted for them or not? I want evidence on that. So, get evidence on that. We verify the workings. Suppose no, management performed the assessment ultimately. Now, you have the performed? Yes, performed. Take the assessment. Okay, I took it. What should I do? Identify events and conditions. Identify events and conditions. The second step. What events and conditions? Events and conditions that affect going concern. Events and conditions that generally affect going concern. How the standard uses here sentence, if events and conditions that may cast significant doubt on the auditor's ability to continue as a going concern. That's how the standard uses the word. Events and conditions that may cast a significant doubt on the entity's ability to continue as a going concern. That's the sentence. Indirectly, what is shortcut? Events and conditions, are they affecting going concern? What events, what conditions? Very simple. The events and conditions are broadly categorized into 3 types. The events and conditions are broadly categorized into 3 categories. Financial events, operating events, financial events, operating events, other events and conditions. For example, in exam they may ask you, what are financial events and conditions? 4 marks. Give 4 examples of operating events, 4 marks. Give few examples of other events, 3 marks question they might ask you. For example, other events, the company is not complying with regulatory norms. Paytm, they did not comply KYC norm. RBI cancelled their bank license. Suddenly Paytm stopped working. A penalty against the company, penal proceedings against the company. Changes in law or regulation. If law has been changed, automatically company will stop. If at all a law has been brought where the company business has to be stopped immediately. Next, catastrophe occurred, entire factory was submerged in water, no insurance for the factory, automatically company will cease. Yes or no? Sometimes some operating indicators will be there. These see, by the way, suppose if an event or condition is there, these events are there, does it mean pakka compulsory company will close? No. You should check further. If these events are there, auditor has to do further investigation, additional audit procedure. Okay, what auditor has to do, we'll discuss. Now, what are operating indicators? Management want to liquidate the company. Loss of important management person, he died very recently, top managing director died in an accident. Loss of market, labor difficulties, shortage of raw material, important supplies shortage is there, and emergence of highly successful competitor. Okay, if at all, for example, ChatGPT is there, AI, DeepSeek, when they come, ChatGPT, entire Nasdaq, everything, stock market came down suddenly. Getting it? These are operating indicators that will threaten company's future, that affects company's going concern. Apart from this, financially also you will find some symptoms. Financially also you will find some events and conditions. For example, company has a net current liability position. Company has a borrowings where there is no renewal. Borrowings are approaching maturity. I need to pay them day after tomorrow. Debenture holders. Company don't have cash. Short-term borrowings they are taking for long-term assets. That's why in CARO we have to report in 9th clause whether long-term loans were applied for short-term purpose. One more reporting is there, whether loans obtained for one purpose used for some other purpose. Why? You need to, these are all some significant issues, corporate governance issues. Understood? Then indication of withdrawal of support from creditors. Creditors stopped supporting the company. Getting it? Then negative cash flows, adverse ratios, operating losses, inability to pay creditors on time, loan terms and conditions I am not able to do, I am converting from credit to cash on delivery. These are all going concern indicators. Okay, indicators are there. What auditor has to do? If yes, you see, additional procedures, if events or conditions are identified. Suppose when you're checking the company, you found these indicators. Management did preliminary assessment. Inside the assessment workings, when you're seeing, you found all these indicators. What auditor has to do? Additional procedure. Why? To identify, to determine whether a material uncertainty exists. You should decide, okay, indicator is there. Is it resulting into going concern threat? You should check. Going concern threat is primarily referred as what in the standard? Material uncertainty related to going concern. Sir, company has a loss, sir. Company lost major market, sir. License was cancelled, sir. These items may indicate material uncertainty. How do you know material uncertainty there or not? Additional audit procedures you should. Suppose company lost license. I went and told, sir, you can't continue business. Company immediately told, sir, we got another license. We applied for it. Next year we will get that license. Nothing to worry. The company told me like this. Then I will ask proof from the company. What plan you have? What action you are going to take? How feasible it is? And I asked the company, sir, do you have a cash flow forecast? Company prepared a cash flow forecast. In the recent Jan exam, this is what they asked. They asked this first point as a 3 marks question, the second point as a 2 marks, totally 5 marks question they asked. In Jan 25 exam, they asked these two put together 5 marks question. Understood? Now, what, they gave one question in the exam. What question they gave in the exam? For example, you see here itself, you see, we already discussed this in regular class. Okay, what happened, suppliers are demanding cash payment, means they are not giving credit. Company profits, they downwarded, declined. Yes or no? So management had not taken any steps. Keeping in view above fact, answer the following. First question, what can be the purpose of the auditor in this above? Why auditor is checking all that? Very simple. He is trying to identify events and conditions that may cast a significant doubt on entity's ability to continue as a going concern. If events and conditions are identified, what should be the likely purpose? SA 570. The auditor has to obtain sufficient appropriate evidence whether the management's use of going concern assumption is appropriate or not. For that, auditor has to verify preliminary assessment of the management to identify whether any events and conditions are there. If events and conditions are there, auditor has to determine material uncertainty exists or not. 3 marks answer for that. Then second part of the question, what they're asking, second part of the question, you see, auditor no, here no, the company gave, here no, the auditor has asked for cash flow forecast for next 12 months. From balance sheet at next 12 months projected cash flow they asked. Company gave. State any 2 processes in relation to cash flow forecast. Exactly 2 points only there in the book also. You need to write that. So why are you asking cash flow forecast? You know, company showed cash flow statement. Next 12 months cash flow forecast they showed. See sir, our position is very strong. We will recover all that. Our cash flow is positive in the next year also. Why we have a problem on going concern? They are trying to communicate the auditor that they don't have any problem on going concern. What auditor has to verify in cash flow forecast? If entity prepared a cash flow forecast, evaluate reliability of underlying data, whether adequate support are there for assumptions. This is one of the procedures that you must do when you identify events or conditions that may cast a doubt on going concern. If the auditor identifies some events, some conditions that may cast a doubt on going concern, you should check whether it is affecting going concern or not, whether it is having a material uncertainty or not, whether it resulted into material uncertainty or not. You should check. How do you check material uncertainty is there or not? Ask management what plans they're having. Sir, you have negative cash flow, you have supplier, you lost one important supplier, you lost management, you lost license. What are you going to do so that the company going concern will not affect? Company told, sir, we have some plans. Auditor evaluates likelihood of plans for future actions, what action they're going to take. Plan auditor will see, and he will also see how far these plans works, feasibility of the plan. Auditor will also see cash flow forecast, and when he's checking cash flow forecast, forecast means based on assumptions, right? He will see whether adequate support is there for assumptions, what data they use it for forecast. And management they prepared this cash flow forecast 2 months back itself, not when I'm asking you. They prepared 2 months back itself. Management plans and all 2 months back itself, they drafted all that. Now, is there any additional information? Is there any additional information from past 2 months? That also I should check. Finally, I will ask a written declaration. Management, give me one declaration. What declaration? You told me these plans, right? You told me these actions, right? You told me about feasibility of the plans and all, right? Cash flow, everything, right? They are all genuine. You give me a declaration. Written representations from management and top management regarding their plans, future actions, their feasibility. In exam, they can ask you like this: what audit procedures auditor has to do if auditor identifies events or conditions that may cast a significant doubt on entity's ability to continue as a going concern? What additional procedures? Name any 4. They may ask you. Many times this question was asked. Getting it? Name any 4. Already 5 points were there, 4 we covered. Suppose no, sir, we asked information, sir, management did not prepare going concern assessment at all. Then ask them to do, then get it. Are you clear? Suppose no, sir, management, they are not doing going concern assessment, sir. They are not willing, sir. They are not doing going concern assessment. Management is unwilling to make a assessment related to going concern. What is its impact on the audit report? Check out. Express, qualified, or disclaimer. Generally we give disclaimer. If at all sufficient appropriate evidence is not there, then why standard also says qualified, sir? When qualified, when disclaimer? Very simple. It depends upon degree of uncertainty. If the uncertainty degree is very high, disclaimer. If uncertainty is very basic level, qualified. When uncertainty is low, when uncertainty is high, when a real situation comes, guidance notes will be there. You follow that. Exam point of view, this is enough. Clear? Next. Suppose, just 1 minute. You see, when we are taking revision, some students are relaxed. Some students are intensely focusing. Why only few are successful in life? This is the reason. Everybody sit for 10 hours. Everybody work for 8 hours. Everybody work for 9 hours. In that 8-9 hours, how long you are carrying your intensity, that defines your success. Getting it? Whether you grow in life or not, how long intensely you can work. Everybody works hard. People outsider think, oh my god, students are 10 hours, they're sitting in the class. Outsider think you're doing hard work, but the intensity of work is different. Getting it? Only those who carry that intensity till the end, they win the race. Winning race, Olympics and all, you see, running competition and all, those who are intense from the very gunshot, only they will win till the touching of flag. Yes or no? Till the finish line. Those who are intense till the finish line, they are the gold medalist. Rest are the losers. Okay, so that intensity, holding that intensity is not that easy. You have to be extremely determined. Extremely determined means it's not hard work again. You have to be very focused, very determined. At any cost, that coming exam I should qualify. If not, what will happen? You will sit another 4 months. Is it better to be productive 1 month or to be average for another 1 year? That you should decide. Getting it? If you are intense for next 1.5 months, you will qualify. I'm telling you. No doubt at all. Everybody, whoever is intense, will qualify pakka. Will qualify pakka. But law of nature, it will not let everybody to be intense. That's the nature. That's how the nature works. Your determination, how long you're carrying against odds, that is what most important. Entire everything, the nature try to disturb you like anything. You should not affect by that. Okay, that is when your willpower overshadow the nature, then you will succeed in life. Nature try to disturb you. They try to give you pressure, but you should not focus. My goal is May exam. My goal is that particular exam. 1.5 month, daily 8 hours, no matter what, I must intensely work. That's it. If you blindly fix, every day if you motivate yourself, it works. Imagine I'm taking these many hours of class with the same level of intensity. In fact, my intensity increases at the end. In fact, only because one thing, I want to give the best class ever. That's it. When my objective is clear, you can see my throat. When I started the class, how it is. When I'm completing, how it is. In fact, I'll have a slight pain also in the chest, like slight pain. That energy drain will be there. Dehydration pain, I feel that sometimes. Getting it? Still, it's okay. Let me proceed. Let me finish it off. It's okay. Hardly another 20 days I work. Another 1 month I work. Then I can take a break. Again, exams time I will be back with the students. I will again motivate them. That's what the motivation for me. Clear? Next. Fine. So, when auditor identifies, first step is what? Auditor has to check preliminary assessment of the management. Why you should ask preliminary assessment? To identify events and conditions there. If events and conditions there, what you should do? Additional procedures. Why you do additional procedures? Material uncertainty there or not. Why material uncertainty you should check? To know whether going concern is appropriate or inappropriate. Are you getting it? Now look at. So what are examples of additional procedures they have given? Please read this on your own. Sometimes in exam this also will be asked. You may have to do additional procedures. Give few examples of additional audit procedure. You should write this answer only. Clear? Next. Now, okay, sir, I did additional procedure, sir. Now okay, now conclude. Now conclude on certainty. Now you did additional work. No, now you will understand material uncertainty there or not there. You will understand. Now, sir, material uncertainty exists, sir. Material uncertainty exists. Then check out whether going concern is okay or not okay. Check out. For example, Air India. There is an Air India. What happened in Air India? Very simple. They have 70,000 crore accumulated losses. You see, Air India has used this para in the audit report. What happened? 70,000 crore accumulated losses, 54,000 crore net current liability position, current year 7,000 crore loss. In spite of this, going concern, they took appropriate. But actually, they took appropriate. They took it as appropriate. But actually, tell me here, how can the company continue? When I look at this position, without cash, how can you run the business? You don't have a cash. In fact, negative is there. How can you run? Material uncertainty there or not? What Air India management told, Government of India is supporting. That's why we are happily going on. Government of India is supporting. Technically, when I see this position, your future is uncertain. Your company future is uncertain. When you will, close the business, nobody knows. Sir, don't worry. Government is supporting. Oh, which means even though material uncertainty is there, company successfully continuing because of government support. Now can I say there is no uncertainty for Air India? Okay, government supporting, then no problem. No. How long government will support? This is a question. Management also don't know. So that's why what company did, they openly told shareholders fact. In the notes to accounts in the Air India, note number 53, this is 1920 financial year related audit report. 1920 financial statements you download in Google, open notes to accounts, note number 53, standalone financial statements. Air India management clearly told this point. The company has these many losses. The company position is like this. The company suffering is like this. Government is supporting right now. The moment government stops support, we will not sell, we will not realize balance sheet values just like that. Whatever balance sheet values are historical cost. They are not NRVs. NRVs are much lower. We may not realize the assets and liabilities in ordinary course of business if at all going concern is missing. But company still chosen going concern assumption because of continued support from Government of India. But still there is a material uncertainty. Now there is no problem. Going concern is appropriate, but material uncertainty exists. Air India clearly told going concern is good, sir, right now, but uncertainty is there. Within next 1 year, by the way, we said going concern standard, right? You should check whether company can continue or not. How long? 1 year. You should check 1 year from balance sheet date. From balance sheet date, next 1 year, can the company continue? Check out. Yes, sir. Company can continue for the next 1 year without any issue, sir. No problem. Sir, within next 1 year only Air India having uncertainty, sir. How long government supports also, we don't know, sir. Then see whether management disclosed it. Yes, company disclosed honestly, if management use of going concern is appropriate, Air India situation, it's good. However, material uncertainty exists. Then the auditor shall decide whether the financial statements are disclosing the events and conditions that cast a significant doubt. Auditor has to immediately check, sir, uncertainty is there. Management told, sir, in note number 53, we clearly demonstrated, sir, nothing to worry. We are not misleading shareholders. We are honestly disclosing. Then see whether they are clearly disclosing existence of material uncertainty and fact that entity may not be able to realize its assets and liabilities in ordinary course of business. Here may be unable. Unable means what? May not realize. So did management told the fact? In notes they clearly told the fact. Suppose no, sometimes no, when events and conditions there, loss is there, when I perform additional procedures, I concluded company future no problem at all. They have very good name, fame, everything is good. Some financial symptoms are there, operating loss is there. That's part of business sometimes. That is not a situation of going concern issue. Material uncertainty not existing. Then auditor has to check. Symptoms you found right, events and conditions you found right. Check schedule 3. Did schedule 3 asking the events to be disclosed? Check out. Yes, suppose schedule 3 asking. See whether company disclosed the symptoms at least. They disclosed. You give unmodified opinion. You give unmodified opinion. In the diagram, I will go back and connect once. Finally, reporting. How to do audit reporting. Remember, after this, rest of the provision is there. Still going concern standard is big, very big standard. Okay, only half we completed. Another half also will finish it off. Now, audit reporting. Sir, company has, I performed audit procedure and I found out that ultimately material uncertainty, forget about material uncertainty, it is beyond that. Going concern is no more. Already manufacturing process stopped, production stopped, sales stopped, employees vacated the company. Going concern is not appropriate, sir. Okay, see the balance sheet P&L. Did they mention that? Sir, they prepared on going concern basis. Financials are prepared on going concern basis. Some misstatement, something fundamental to the user's disclosures. Misstatement is related to a disclosure which is fundamental to the financial statements. Yes or no? Pervasive level misstatement. If financial statements are prepared using going concern, but in auditor's judgment it is inappropriate, the auditor shall express an adverse opinion. You clear? Suppose going concern is appropriate, but material uncertainty exists. Going concern is appropriate, but material uncertainty exists. If the financial statements adequately disclose the material uncertainty, suppose no material uncertainty is there. Air India, they disclose honestly, note number 53. Material uncertainty is there, they disclose honestly. Express unmodified opinion. Express unmodified opinion in a separate section in the auditor report. Express unmodified, give unmodified opinion, no problem. But see, when I give unmodified opinion in going concern, no, people think everything is good. Actually, note number 53, so much big point is there. Company going concern issue discussed. What should I do? I can actually highlight that note number 53, emphasis of matter para. But SA 570 standard says, don't use emphasis. Use a dedicated para, dedicated side heading called material uncertainty related to going concern. Use a dedicated side heading called material uncertainty related to going concern. Use that side heading. Draw attention to the note point in the financial statements. State that material uncertainty exists. Also state that your opinion is not modified. Air India auditors, you see, material uncertainty, no, see, they kept it as a separate section. The company has incurred, note number 53, drawing attention, opinion is not modified. See, actually it is emphasis of matter para only, but heading should not be emphasis. Here what are you doing? Actually something presented in financials you are highlighting, but it is not something you are highlighting. It is going concern issue you are highlighting. If it is a going concern material uncertainty situation, you are highlighting material uncertainty related to going concern side heading you must use, and use the para like this. So what is the reporting requirement here? State that first, give an unmodified opinion. Financials are honestly disclosing material uncertainty. Use of going concern is fine, but material uncertainty exists. Financials are adequately disclosing. Give unmodified opinion. Also, include in separate section of the audit report material uncertainty related to going concern, and draw attention to note number Air India auditors mention note number 53. State that material uncertainty exists. Also state that auditor opinion is not modified. You see here, auditor have mentioned auditor opinion is not modified. They clearly mentioned this is present. This presentation is almost 100% same like emphasis of matter para. Suppose no, company is not disclosing. Such a severe issue, company is not disclosing. When something important they didn't disclose, non-disclosure is a material misstatement. You need to give a modified opinion. If the financial statements do not adequately disclose material uncertainty, the auditor shall express a qualified opinion, adverse opinion under 705. In the basis for qualified, basis for adverse, state that material uncertainty exists and the financials are not disclosing properly this matter. That's why we are qualifying. Sir, financials are disclosing clearly, sir. Then honestly they are disclosing unmodified. Highlight that once again under material uncertainty para. Clear? This is the reporting on going concern. Now what is the audit procedure related to going concern? Write about assessment of going concern. First of all, whose responsibility to assess going concern? Management. Okay, so the auditor shall check management assessment of going concern. Can auditor rectify lack of analysis by management? Suppose management did not analysis, is auditor has to rectify that? No. Auditor is not responsible to rectify lack of analysis. Sometimes no, management might not have done detailed analysis. That time auditor can conclude on going concern basis also. Even though detailed analysis is not there, auditor may still conclude going concern appropriate. For example, entity has a profitable operations, ready access to funds. In these cases, no, even though company did not perform detailed analysis, I can still accept, yes, going concern is appropriate. Even though detailed analysis is not performed. In these cases, auditor may conclude on appropriateness of going concern. Sometimes in exam they will give this question. Auditor shall evaluate entity's assessment of going concern. However, the management did not have detailed analysis. Under what circumstances lack of detailed analysis by the management can be accepted by the auditor and conclude as appropriateness of going concern? How can the auditor conclude like that? Repeat if at all you didn't understand. Okay, repeat the video. Now, under what? Company has history of profitability operations, ready access to funds, banks and all ready to give loans. Getting it? In these cases, auditor can conclude that going concern is appropriate. Sir, company does not have a detailed history of profit, company does not have anything, then you have to do process followed by the management, assumptions what they used, what plans they have. If at all management does not perform detailed assessment, okay, you should ask them to do detailed assessment and look at the process, how they assessed, look at the assumptions they used, what are the future plans for the company. Every company will prepare budgets for next year. They are nothing but management plans for future. Next, you have working capital management topic in financial management. There you will understand regarding budgeting concept, stock budgeting, cash budgeting, like that. So many budgeting concepts are there. There you will understand. Okay, next, how long management should assess? Management, first of all, auditor should check going concern, right? For how long? Management did for how many months? After balance sheet did check out, for that many months you should do. Management will do for how many months? As per framework. Framework says minimum 12 months. Suppose if management assessment is less than 12 months, the auditor shall request minimum 12 months. Suppose management, no, going concern working did for 6 months only, and I'm asking company, please sir, no, with 6 months and all I can't accept, you must do it for 12 months. Company is not doing it. Modified opinion. If management is unwilling to make assessment or unwilling to extend assessment to minimum 12 months from balance sheet date, auditor will give modified opinion. Clear? All of you, just 10 more minutes we will finish. Clear? 10 to 15 minutes. What is the risk assessment procedure related to going concern? This itself can be asked as a 5 marks question. Once it was asked, risk assessment. What is risk assessment? Very simple. There is a standard called 315. What the standard says, auditor has to consider whether events and conditions exist that may cast a significant doubt on going concern. What events are existing, what conditions are existing that may cast a doubt on going concern. Okay, auditor has to see. For that, we will evaluate management's preliminary assessment. We will check first how management did preliminary. They performed it. If performed, management performed. Discuss them, discuss with them. See whether events and conditions are there. Suppose events and conditions are there, what you should do? Additional audit procedures to identify material uncertainty. If material uncertainty is there, you should check appropriate, inappropriate, disclosure, not disclosure, accordingly reporting. Correct? Evaluate management plans. Now they have some symptoms. What plan management is having to deal with this? Identify. Sir, management did not perform, sir. Why they didn't perform? Ask. And how did they choose going concern assumption without checking going concern? Ask them. Then inquire whether any events and conditions are identified. And remember, going concern assessment, is it only one time process or continuous process? Continuous. Auditor shall remain alert throughout the audit for evidence of events or conditions that may cast a significant doubt on entity's ability to continue as a going concern. Easy. Next, finally, what are the responsibilities of auditor under 570? This itself can be asked as a 4 marks or 5 marks question. What are the responsibilities of the auditor? Very simple. I should obtain evidence. What evidence? Regarding whether management's use of going concern is appropriate or not. Conclude whether material uncertainty exists about the entity. So get evidence whether company is going concern. They are using going concern. Is it okay? Get evidence. When it is okay, I will see preliminary assessment. I will see whether any symptoms are there. Symptoms are there or symptoms are not at all there. Then I will assume that it is appropriate. Symptoms are there. Then I will perform additional procedures to conclude uncertainty. If uncertainty is there, then I will check whether is it appropriate or inappropriate. Accordingly, I will report. Now tell me, auditor should evaluate about going concern, right? Is this required when financial reporting framework is silent on this? Compulsory. Even if the applicable financial reporting framework does not explicitly require the management to assess going concern. Management itself don't have duty in the law. Management itself don't have duty in the accounting standard schedule 3 that they need to do preliminary. Actually, I went for audit. I asked the company, sir, preliminary assessment you did. Sir, as per what law we should do, sir? They said, sir, preliminary assessment about going concern you must do irrespective of law, sir. You must do preliminary assessment. That point you see here, it will be there. Management must assess entities going concern. Even if the financial reporting framework does not explicitly talk, first they spoke about responsibility for going concern of management. Responsibility of management towards going concern. Then they're talking about auditor responsibility. Whether financial reporting framework is explicitly saying or not at all saying, doesn't matter. Management must do preliminary assessment. Auditor must evaluate management's assessment. Sir, management does not assess. Ask them to do assessment, yes or no. By the way, suppose audit report no, gave unqualified opinion regarding going concern, that side heading material uncertainty, nothing is there in the audit report. Regarding going concern, auditor did not talk anything. Silent in audit report about going concern. Does it mean guarantee? Guarantee by the auditor on the company? No. As per SA 200, auditor's ability to detect material misstatement is is limited. Yes or no? Limitations, inherent limitations. If you see last point, auditor's ability to obtain information about future events is limited. Yes or no? Auditor cannot predict future. Therefore, absence of material uncertainty in audit report. Suppose if auditor does not talk about company's material uncertainty, that cannot be considered as a guarantee to the going concern. Clear? Again, at the end of the standard, once I will revise, so once I will show you the diagram, we'll conclude and then we'll wind up. Okay. Now, remember, going concern assessment involves, who will do assessment? Primarily management. Going concern assessment involves assumptions, judgments. Yes or no? These judgments are affected by some factors. Uncertainty. This assumption will have some uncertainty. Some uncertainty sometimes will be high, sometimes will be low. The uncertainty increases regarding future outcomes. The far future, if it is the more, suppose next 2 months what will happen, I can little bit I can predict. After 10 months what will happen, I can't predict that much. The uncertainty about events and conditions at a future date, the uncertainty increases. Yes or no? Further, size, complexity, all these also influence your judgment quality. By the way, whose judgment here? Management. Management has to judge about going concern. This management judgment is affected by various factors. 1, degree of uncertainty. 2, entity specific factors like say entity size, complexity, condition of the business, all that. And remember, management might have concluded going concern appropriate when they do assessment on 5th April. That time, whatever management concluded, they are correct. But on 10th August, that may go wrong. Because in between some subsequent event might happen. Big accident happened, explosion happened in the factory. So judgments are always based on information available at that time when the judgment is made. Events occurred later may lead to an outcome that will affect your original judgment. Correct? Next, management's assessment involves making judgments about uncertain future outcomes. Correct? All of you. Finally, sir, entity is not a going concern. What will happen, sir? Very simple. They should prepare financials on liquidation basis, inventories, assets, everything shall be recognized on NRV. If going concern basis or accounting is used, no, then assets and liabilities are recorded assuming normal realization. Fixed asset, no, normal realization means what? We use the asset, next 10 years we will recover. That's why impairment loss and all you will see. Recoverable value is more than always NRV. That's why fixed assets will be shown in the balance sheet at historical cost. Clear? Finally, once we will come back to this. Now, going concern, what auditor has to check? Preliminary assessment of management. Yes, they performed. Then you should discuss with them assessment, verify what they did, identify whether any events or conditions are there. Yes, events identified. You must do further audit or additional audit procedure to determine material uncertainty exists or not. Sir, I did additional work, sir. Material uncertainty, you see, material uncertainty does not exist. But symptoms are there, no? Sir, symptoms common, no, sometimes. Sometimes loss is possible in the company. Very temporary that loss, sir. Company is already having sound financial position right now. So, it is not an uncertainty. Okay, then fine. By the way, applicable framework is there, right? Applicable financial reporting. Is it requiring disclosure of the events and conditions? No, sir. That framework is, our schedule 3 is actually silent, sir. No need to disclose about that. Then you give unmodified. Sir, for example, no, applicable framework says, even though going concern issue is not there, symptoms are there, no? Disclose it. Framework says that. Then see whether company disclosed or not. Yeah, sir, they disclosed it. Unmodified. They didn't disclose. Non-disclosure of information as per applicable framework. Modified opinion. Suppose, sir, when I investigated events and conditions, no, Air India situations are uncertain. Material uncertainty exists. Okay. Is this uncertainty, how level it is? What is the level of uncertainty? Sir, it's worse, sir. Company cannot continue the business. They can't continue. Impossible. Is it disclosed in the financials? No, not disclosed. But which means financials are prepared on going concern basis. Yes, they're prepared on going concern basis. But what is your opinion on that? Going concern is inappropriate. Adverse opinion. Sir, they disclose it in financials. Then you give unmodified opinion, emphasis of matter, para. Yes or no? This is not there anywhere in the ICI book. I told you in our regular class also this point. This was asked in CA final. This was asked in CA final in May 24, question number 1B. Why? Because yesterday only I was telling in fast track CA final audit batch this question. Getting it? So in May 24, question number 1B, shocking that was. And what they asked, you know, drafting they asked actually, 5 marks drafting question. How opinion para, basis for opinion, emphasis of matter paragraph, drafting question they asked it. Very simple. This situation not there in your CA inter. Don't worry, you can ignore this if at all. Okay, you can only remember this part. Clear? But in regular we discussed very in depth this point also. Remember? Then, sir, material uncertainty is there, sir. Actually, Air India is suffering so many losses, so uncertain. But right now they are still okay, no problem, because government of India is supporting. Okay, but still problem is a problem. Did they disclose it in the financials? Sir, they didn't disclose. They did not disclose. Load. Yeah, they did not disclose. Financial statements are not disclosing. Auditor shall express either qualified or adverse opinion. Sir, financials are disclosing, sir. Financials are disclosing clearly, sir. Then when they're disclosing everything, you can't object anything. Give unmodified opinion. And remember, material uncertainty they are disclosing. You should highlight that because very sensitive issue. Material uncertainty related to going concern. Side heading you put in audit report. Where? In the audit report, where? Immediately after basis for opinion para. Put a side heading. Draw attention to that point. Mention that your opinion is not modified on that matter. Once again, watch going concern. Even of you. But I hope everything I covered right. Clearly, I packed all the logics in it everywhere. Yes or no? So you see, when I'm revising, I went in a different way. When you're reading, no, you can go in the standard way, no problem at all. For making people understand, because in revision class, it's not just about reading and, you know, I also think of little explanation on that. That's it. Clear all of you? That's it. Now, finally, once I will go back to Air India audit report and give one small clarification. Sir, material uncertainty related to going concern. When this will be given, when auditor give unmodified opinion on going concern issue. But Air India, no, auditors gave qualified opinion, no. Then why this came? Auditor gave qualified opinion on different matter, not going concern matter. Are you getting it? On going concern matter, they don't have any problem. Company honestly disclosed. So since many confuse here, I'm clarifying it. First of all, many won't confuse because they won't understand much. Okay, many students, they won't understand much. Honest, I'm telling you openly. Okay, that's it. So confident, going concern over. Just 3 minutes. Okay, let me go back to audit report and conclude one small point. Let me go back to audit report. You know, let's go back to audit report. Contents of audit report. What's the page number? 30? Okay, fine. Yes, once again go back to contents of the auditor's report. Yes. Now we finished material uncertainty related to going concern. Typically, if you observe, within 2.5 hours, we finished how to prepare audit report. We actually completed what are all standards, 700 over, 701 over, 705, 706, 299, 570. 570 is biggest among all this. 6 standards we completed technically. We still have 720 CARO 143 reporting. If that is over, audit report is over. And you know what? Till now we covered approximately 5 to 5.5 hours of revision, where we completed 40 to 45 marks weightage. 5.5 hours to 6 hours revision. Getting it? Maybe worst is 6 hours. If CARO 5, 7, 10 also we include, no, maximum 5.5 to 6 hours, and we are completing 45 marks worth of revision. Clear? Very productively we did this time. Next, that's because of the book effect. Earlier, no, the same topics I take 7.5 hours. The same topics, 2.5 hours revision time we saved because of the book simplification. Able to understand? Then finally, we are still pending with one topic. What is the topic which is pending? Report on other legal and regulatory requirement plus 710 standard revision is pending. This we need to discuss, and then CARO and all we need to discuss. Once that is over, this audit report chapter is over. Completion and review chapter also, one major standard we covered. That's it. Okay, we'll continue in the next session, the revision. Confident? Yes. Yeah. Thank you. Thank you. So we'll begin we'll continue the discussion on SA 710. Okay, we are still pending with 710 and CARO. So once these two are completed, the entire audit report revision is also completed. Fine. So 710, what is 710? Comparative information. 710 is talking about comparative information, corresponding figures, comparative financial statements. Both it is talking about. So once 710 and CARO is also completed, maybe in 700 some 2 or 3 small concepts are there. Qualitative aspects of entities, accounting practices, like that, some discussion is there. That also will revise. Okay. So this is 710. So what is 710? Comparative information and comparative information, corresponding figures and comparative financial statements. Like what is comparative information is about? Actual standard is comparative information. These two are about two methods of comparative information. This is the standard. Often students confuse between these words. They think comparative information, corresponding figures are same. No. Comparative information is the actual technical term. What is a comparative information? You see any balance sheet and P&L of any company, along with current year figures, they also give you prior period figures. Correct? That prior period figures are called as what? Comparative information. That's it. That is what comparative information means. Now, how these prior period figures are given? What is the importance of these prior period figures? That is decided by approach. That is decided by approach. And the approach is, one approach is corresponding figures approach. Another approach is comparative financial statements approach. In India, financial reporting frameworks that we follow will only follow corresponding figures approach. They do not follow comparative financial statements approach. In India, for preparing general purpose financial statements, we follow corresponding figures approach. Even in the recent Jan 25 exam, the question that they have asked is this one. What if prior period financial statements were audited by predecessor auditor? Correctly? In the recent Jan 25 exam, this one was asked. Even in our regular class, we have seen. What if prior period financial statements were audited by predecessor auditor? Fine. Anyhow, let's discuss one by one what is comparative information, all that. For example, you see any Tata Motors, for example, balance sheet P&L, simple. This is called as comparative information. What is this is called as? You see here, last year, actually this is the balance sheet as on 31st March 2024, latest balance sheet of Tata Motors. Okay, 2025 is yet to complete. In May 2025 month, you will find this final audited report, audit balance sheet, all that. Now you see, this is current year figure. These are what? This is what? Comparative information. As per SA 710, this is actually called as what? Comparative information. And how this comparative information is given? The approach, corresponding figures approach. The comparative information is given under corresponding figures approach. from audit point of view, are they simply treated as corresponding figures or are they treated as comparative financial statements? See, basically they are comparative information, that's it. From auditor's point of view, what are they? From auditor point of view, this comparative information is classified into two types: corresponding figures or comparative financial statement. What is the difference? In case, if at all this is a corresponding figures approach, we do not give opinion on prior period. Our audit report on this balance sheet, we give opinion only on current year. Our opinion do not cover prior period. Suppose if this is a comparative financial statements approach, but remember, whether it is corresponding figure, comparative financial statements, in both the cases, this is called as comparative information only. This is comparative information basically. But if at all we are giving opinion on this, if at all we are giving opinion on comparative information also, if at all we are giving opinion on comparative information also, then the approach is called as comparative financial statements. In India or anywhere in the world, in general purpose frameworks, nobody gives opinion on the comparative information. Look at how clearly I'm using the terminology. You know, in a comparative financial statement approach on comparative information, nobody will, across the world, opinion will be given on comparative financial statements. But this approach is not followed anywhere in the world, because the kind of comparative information we give is called as corresponding figures approach. Now, how comparative information is given? So look at this. Comparative information means what? What is a comparative information? They are nothing but amounts and disclosures of one or more prior period. Amounts and disclosures of one or more prior period included in financial statements as per financial reporting framework. For example, in China, IFRS, they give 3 years figures. Totally, current year, last year, that before year. 3 years figures they will give you. In India, only one prior period figure is given. In some countries, 2 prior periods are given as a comparative information. But across the world, the auditor's opinion will only talk about current period figures. In such a case, the prior period comparative information is given, right? They are simply called as corresponding figures. They are not comparative financial statements. We are not doing any comparative financial statements audit. We are only doing current year financial statements audit, where comparative information is given only as a corresponding figure. That's it. You understood the meaning now? Much more better way, the meaning we got. Clear? Now, what is the audit procedure for comparative information? This itself can be asked as a 4 marks question. What is the audit procedure? Very simple. Auditor has to verify whether financial statements includes comparative information and see it is properly classified. Now, the comparative information, last year information which you are showing in current year balance sheet, current year P&L, it must agree to prior period balance sheet. P&L will be there. Amounts and disclosures, it should match. Very simple. Current year balance sheet, last year figure must match with last year balance sheet, current year figure. Last year balance sheet inside the current year figure of that last year. That should match. Current year balance sheet, last year figure will be there, right? This should match with last year balance sheet, current year figure. That's it. Simple. Correct? Next. And the auditor has to verify consistency of accounting policies. See whether accounting policies, whatever shown in the last financial statements, are they regularly, consistently followed? If at all any changes are there, are they properly accounted? Are they properly disclosed? Suppose no. If a material misstatement is identified in comparative financial statements, if a material misstatement is identified in comparative, determine whether that MMS is carry forwarded in current year. Simple. When comparative information is given, what is auditor responsibility? Remember, this standard is in addition to the standard called 510. Many students, they don't understand 710 and 510 correctly. 710 talks about comparative information related responsibility. 510 talks about opening balances responsibility. We'll discuss that opening balance revision later. Clear? Now, so what auditor has to do? He need to identify whether in the comparative any MMS is there. If so, whether that MMS is impacting in the current period or not. Suppose if prior period financial statements were audited by same auditor, and we found MMS in the last year, then first I will try to apply 560 requirement and try to rectify the last year financials itself. Suppose if time limit is over for the last year, this year I identified, I am the auditor of last year, I identified a material misstatement in the last year. When I identified this year, by this time already financials are approved, shareholders meeting, I mean AGM is over, everything is over already, last year's AGM. Now I will tell management to record it as a prior period item. If at all time permits, what I will do, madam, don't record in current year, directly adjust in last year. We will revise the financials and then issue revised financials. That procedure we can do as per 560 if possibility is there. Clear? Then further, finally, auditor has to get a written representation that all periods written representation for all periods referred to in auditor's opinion. Generally, in a comparative information corresponding figures approach, our opinion refers only to current period. We need to get a representation. That's it. Then also obtain a specific representation regarding prior period item disclosed in current year statement of P&L. If at all any prior period item is accounted by the company, in the current year, get a specific representation for PPIs. Every year whenever you are doing audit, for prior period items, you must get a specific representations. If what are all prior period items, ask them, list of it, they will give a representation. Suppose they said no prior period items, get a representation that there are no prior period items. Clear? This is the audit procedure for comparative information. Now remember, what is the nature of comparative information? The standard name itself is comparative information. But from auditor's point of view, this comparative information can be in two approaches: corresponding figures approach, comparative financial statements approach. Any of these approach can be there from auditor point of view. But the standard is dealing with what? Comparative information only. Clear? Now, what is the nature of comparative information? The nature is very simple. There are two approaches to auditors reporting, which means these approaches are specific for what? Auditors reporting point of view. They're mainly dealing with what? Auditors reporting point of view. Yes or no? On comparative, like what are the, from auditors point of view, comparative information, I classify them into two types. Corresponding figures, they are only mere corresponding figures, or are they also forming part of financial statements for comparative purpose? For example, if at all I have to give opinion on comparative information also as part of my audit, current year financials I should give opinion on, last year previous year figures also I should give opinion, then the financial statements are set to be comparative financial statements. You must give opinion on current year, last year. You must do audit of all the periods covered in financial statements. This is not at all popular anywhere in the world. Maybe some special purpose frameworks might have been there, or in India some companies, listed companies, they present some financials called restated financial statements as per SEBI requirement. Restated financials are presented for some 2 or 3 years. So that time only probably this standard might come into picture. Second part of the standard. Generally in India, last year figures are given as a corresponding figure. We don't have to give opinion on the last year figure, which means the last year figures are merely mentioned as a corresponding figure. They are not mentioned as a comparative financial statement. Clear? Able to understand? That's why I always tell my regular students also, never miss marathons. Because in marathons, sometimes I'll give a different way of better explanation even. Able to understand? Sometimes. Not all points that we cover in regular class will be covered in marathon, obviously. But I just tell. So, next time also, when you're preparing, please compulsorily watch these marathons and then prepare. Once watch the marathon, again don't go and prepare. Next step. Now tell me, which approach auditor has to follow? Sir, should auditor give opinion only on the current period? Should auditor give opinion on the current year and last year, that last year, what? Which approach is specified by law or regulation, as well as terms of the engagement? Yes or no? What is the difference? What is the audit reporting difference? I told corresponding figures, comparative financial statements is only an audit reporting difference. Is only a difference in audit reporting. Both are at the end of the day comparative information only. That is comparative information. But the difference between audit approach is, in corresponding figures, we give only opinion on current period, whereas in comparative financial statements, the opinion refers to each period presented in financial statements. Now, sir, what if It is corresponding figures, because this is what we follow in India and across the world. All general purpose financial statements, if we see, auditor's report, auditor's opinion only talks about current period numbers. It will not talk about comparative information. Then why comparative information is given? It is given only as a corresponding figure. In that case, what is auditor reporting requirement? Very simple. You know, what is a corresponding figures? Very simple. Corresponding figures is a comparative information. Corresponding figures. What is corresponding figure? Comparative information. That is a comparative information where prior period data is presented as part of current period financial statements, and they shall be read only in relation to current period. Like comparative we are given, right? How depth we will give details, it is dictated by current period. If current period we are giving so in-depth data, then prior period also will be given in the in-depth way. Breakup will be given accordingly. Then what is the auditor's opinion on the corresponding figures? You generally don't refer anything about corresponding figures. Why the hell I will talk about corresponding figures in the audit report? My objective is to give opinion on the current period financial statements. However, there are four circumstances. Where I will refer about corresponding figures. Circumstance, you know, in reverse I will come. Sir, prior period financial statements were not audited. In that case, in other matter paragraph, in the other matter paragraph of the current year auditor's report, in other matter paragraph of the current period audit report, we need to mention that, you know, auditor state, you know, if the prior period financials are not audited, state the same in other matter paragraph that corresponding figures are unaudited. By the way, this statement you are making, right, does it mean are you exempted to verify accuracy of opening balances? No. This statement does not reduce your responsibility to obtain sufficient appropriate evidence. This is one circumstance where corresponding figures information I will refer in the audit report. Suppose another circumstance, prior period financials, no, audited not by me, somebody else have audited. That time what I should refer? If prior period financials were audited by predecessor auditor, then the current auditor shall refer to predecessor auditor report. What he need to refer? In other matter paragraph, mention that last year financials were audited by previous auditor. What opinion he expressed? If at all modified opinion is given, that basis for opinion para copy pasted. Date of the predecessor auditor report also you mention. Are you clear? Then, so generally corresponding figures, do we talk about that in audit report? Generally no. Four circumstances, two circumstances over. Another circumstance, suppose no material misstatement is there in the prior period. If a material misstatement exists in prior period on which unmodified opinion is issued, last year financials, no, unmodified opinion we gave, either we have given or previous auditor might have given, whatever the reason. Verify whether misstatement was corrected under current year or not. Check out. Corrected, no problem, happily proceed further. And if not corrected, in the current year also we should give a qualified or adverse opinion. That's it. Further, in prior period some modification is there. If prior period report includes a qualified or disclaimer adverse and the matter remains unresolved, current year also auditor has to modify. In the basis for modified opinion para, refer both corresponding figures and current year figures. You know, if unresolved matter is affecting materially current period figures. Sometimes, you know, last year it is unresolved. This year it don't have a material impact. In other cases, not material in current period. In that case, you know, explain the current period opinion is, you will modify still current period. Why? You know, comparability is affected. Because you are comparing the right amount with wrong amount in the last year. So comparability is affected. For that reason also you will give once again modified on the current period. Simple. Last year some modified opinion is given by auditor. The reason why he gave modified was not resolved in the current year or last year. Both the cases. Yes or no? Suppose last year that unresolved mistake is there. No, modified opinion. Unresolved mistake is there, right? This year also not resolved, right? This year modify the opinion. Suppose last year it was material. So auditor gave modified opinion. This year it was not material. But last year figure was misstated, right? Comparability point of view, you will have a misunderstanding, right? For that reason, I will modify this. So now here, sir, here also unresolved mistake in the last year. Here also material misstatement in prior period. What is the difference, sir, between A and B? In both the cases, they are talking about mistakes in the last year only, no? In A, last year already auditor gave a modified opinion. Whereas in B point, mistake is there in the last year, but last year auditor gave unmodified opinion. That's the difference between A point and B point. Able to understand? Now, this unmodified opinion in the last year was either given by myself or some other auditor. If some other auditor has given the opinion, you shall also give disclosure. In the exam, I guess this one and this one, B and D put together, is what in the January 25 exam they have asked. For example, you see Jan 25 paper. In corresponding figures approach, I will show you the corresponding figures approach related. Not that. This is those charged with governance. Yes, this one. Yes. You see here, 7 and 5 marks question. Oval Enterprises is under legal obligation to represent it current year financial statements along with previous year financial statements. Okay, they need to present both. Current associates have been appointed as stat auditor for the year. Current notice is that last year financial statements contains adverse opinion for the financials as a whole due to misstatement in the evaluation and disclosure of debtors. Okay, legal obligation to represent it current year statements along with previous year financial statements. Oh my god, actually they didn't ask corresponding figures approach, they asked comparative financial statements approach. Actually in the, okay, fine, I'll come back. So the question which they are asking is regarding comparative financial statements, but the reporting requirement is similar. The reporting requirement is similar. Fine. So comparative. Now current associates, they has been appointed as stat auditor for the year. Current notice that last year financials contain adverse opinion as a whole due to misstatement in evaluation. Guides CA Karan for his duty regarding treatment and addressing the issue while drafting his audit report. What disclosures is required to make? Corresponding figure. They have asked the question on comparative financial statements, not corresponding figures. But if you see, if prior period financial statements were audited by predecessor auditor. Okay, here in this question, who has done the prior period financial statements audit? Who has done the financial current associates have been appointed as for this year, means last year somebody else have audited. So this point is applicable. Which point is applicable? If prior period financials were audited by predecessor auditor. In other matter paragraph, state that it was audited by predecessor. Type of opinion, date of opinion, date, yes or no. Now if a material misstatement exists in prior period on which predecessor auditor expressed unmodified opinion, communicate with management and notify the predecessor auditor. This is one more important. This is one important point. So we should communicate with predecessor auditor if at all we identify any material misstatement belonging to prior period. And if prior period financials, so predecessor auditor, sir, wait, still just little bit time only. Oh no, I will amend the last year financials, company will amend, I will also give amended audit report. Like that it did subsequent event procedure. Then the predecessor auditor will issue a new audit report, and at that time current auditor will report only on current period. Suppose if predecessor auditor has not given a revised audit report, then I will give modified opinion on the current period, because the same mistake is carried forward and kept in current period. Actually we thought of corresponding figures. In the question they gave very clearly, it is a comparative financial statements. In the bracket they gave very clearly. In the bracket what they gave very clearly. I will also add a clarification video on that. Okay, that's it. In the bracket they very clearly mentioned that it is comparative financial statements approach. Confident all of you? That's it. With this 710 standard is completed. Generally comparative financial statements question 99.99% they won't ask, but for the first time they asked it in Jan 25 exam. Okay, so originally we thought of corresponding figures. I also did not observe this particular word. Okay, but now I observed it immediately. So it is actually what approach? Comparative financial statements approach. That's it. Fine. 710 is over. Confident? This understanding is enough in 710. Fine. Let's discuss the branch audit topic. Then immediately we'll go for 143 reporting requirements. Okay, branch audit. First of all, a company is not required to maintain branch accounts separately. First understand that. Most of the companies that we see today in India, they maintain centralized accounting. They will not have a separate concept called branch accounts. Branch accounts is popular in insurance companies, public sector insurance companies, public sector banks only even now. In very few private sector companies also they still maintain branch accounts concept. That's it. Generally branch accounts is not popular. So first of all, branch accounts is not compulsory. Suppose if a company is maintaining branch accounts separately, then should company appoint auditors separately for the branches? Not required. The same auditor can do audit of the branches also. So who can be appointed as a branch auditor? The company auditor himself will do. or another CA can be appointed. Suppose if the branch is at a foreign country, then our main auditor he will go and do, our company auditor we can do, or we can send another chartered accountant, or another in that country some auditor would have been there, right? As per the law of that country, we can also appoint him as a branch auditor. Remember, audit process is same across the world. So at the end of the day, the auditor has to go to the foreign branch, verify whether branch records are accurate or not, and then give us. Then accordingly we will merge and then proceed further. Simple. Correct? Now, branch auditor submits the report to company auditor, who includes in the report as necessary, and even reporting of fraud, reporting on CARO, like that, so many reporting requirements there, right? They were equally applicable to branch auditor as well. So this is regarding branch audit, basic discussion. Now remember, when branch is being audited by some other auditor, if you remember, I given you one example in State Bank of India. State Bank of India, they are preparing consolidated financials, standalone financials. Consolidated financial statements is nothing but standalone financials of State Bank of India plus standalone financials of other companies. Both put together when we combine, that is called as consolidated financials. What about standalone financials? Head office plus branches. Now, from consolidated financials point of view, subsidiary, other companies are there at subsidiary joint venture, they are called as components. From standalone point of view, all the branches are called as components. At the end of the day, branch, subsidiaries, joint venture, they are all simply called as what? Components. If component is audited by other auditor, I told you other matter paragraph that time discussion, if component is audited by other auditor, but on the entire consolidated financials and standalone financials, I am only giving audit report, my report only is going to public think that I did entire audit, 100% data audit, public thinks I only did. No, I did not do. Components are audited by other auditors. In standalone financials, branches or components, consolidated financials, subsidiary company, joint venture, associate, they are components, and all these components are audited by other auditors. To that extent, I relied upon their report and I am giving my opinion. Like that, principal auditor has to give a disclosure in other matter paragraph 706. Correct? This is what we already understood. Now, indirectly here, principal auditor is using the reports of other auditor, right? We are taking the reports and then believing on that, right? We call that incident scenario as principal auditor using the work of other auditor. That time, what are the formalities applicable? SA 600 standard is applicable. Using the work of another auditor, using the work of another auditor, or using the work of other auditor. Anyway, you can use. Able to understand. Now, entire 600 we don't have in our syllabus. We only have a brief. Who is the principal auditor? He is responsible for entity financials. Yes or no? That financials includes what? Component information. That component is audited by other auditors. Who is other auditor? He is responsible for component financials, which is included in financial information audited by principal. What is a component? Division and branch is called as a component from standalone point of view. Consolidation point of view, subsidiary, joint venture, and other entity are treated as component. Yes or no? That's it. Now, using the work of another auditor, if branch accounts are audited by another auditor, principal auditor and branch auditor should have a clear role of each other and understand, and they should understand their roles and have a proper coordination. The 600 standard, no, what it says, principal auditor, you can happily trust other auditors' work. You are not responsible for his work, even though his work is included in your overall audit report. Yes or no? If something goes wrong in component, tomorrow he is only answerable. That is why you have to mention in division of you have to mention division of responsibility in other matter paragraph. Correct? Now, for that, what are the processes you should do? What you can do? You can inform other auditor how his work is going to be used. You can also inform what are the special consideration he should focus on. You can discuss what are the procedures he did at branches and all. Yes or no? Through a checklist or questionnaire or summary. Or you can perform additional works. We call them as supplementary audit procedures. Principal auditor can directly go to the component and do additional work. That is called as supplementary procedure. If necessary, you can visit the other auditor and meet and decide accordingly. That's it. Branch audit concept is over. Easy. Clear. We discussed very clearly on this in our session. So in depth we discussed. So no, we even discussed about coffee day case scenario. Getting it? That's it. Fine. Anyhow, clear on this. From revision point of view, this is more than sufficient. Okay, that's it. So let's begin part 2 of audit report chapter, that is reporting requirements. Okay, part 2 of the audit reporting chapter. Like as I told you, in this audit report, we divide the entire chapter into 2 parts. Part 1, reporting standards, which we completed right now. What are the standards that we completed until now? 700, 701, 705, 706, 710, 570, 299. Yes or no? And even 600, whatever the basic discussion is that also we completed. Almost 1, 2, 3, 4, 5, 6, 7 standards mainly we completed. Big standards, all are 7 standards we completed. Yes or no? Now let us discuss reporting requirements. What is this reporting requirement importance? First of all, in our SA 700 format, if you go, in our SA 700 format, if you observe, you see, contents of audit report, if you observe, we already covered all the contents, correct? Now we are covering signature also over, by the way. Report on other legal and regulatory requirements. Within the same audit report, we should give other reporting requirements. We should talk about other reporting requirements. In audit report, from opinion section, is that right? From opinion section till other information section. From opinion section till other information section, you see, other information section, we call them as report on financial statements. We call them as what? Report on financial statements. These are all reporting requirement as per standards on auditing. Whereas this 12th point is there, right? In our format, this is an other reporting requirement. This is an other reporting. This is not a requirement as per standard. This is not a requirement as per standard. Suppose if the auditor has to give reporting as per standards on the financial statements and also has to give some other reporting requirement as per law and regulation, for example, then other reporting requirements, where it should come in the audit report? This is the question. Other reporting requirements comes after report on financial statements. That is what mentioned in other reporting requirements side heading. If you see other reporting responsibilities, what they said, the other reporting requirement shall be presented immediately after report on financials. What do you mean by report on financials? Just now I showed, no. Part 1 of the audit report. If you see the real audit report also, the audit report is broadly divided into 2 parts. Auditor's report up to other information section is part 1. That has a name, that is given as a name called report on financials. What you report here? You will report as per standards on auditing. In this, everything is because of a standard requirement. Now, this one is what? It's a reporting requirement as per law, as per regulation. This is not a standard reporting requirement. Other reporting requirement. When other reporting requirement and standard reporting requirement both are there, first standards related reporting you mention in the audit report, then you mention other reporting requirements. That's what other reporting responsibilities discussion is about. Clear? And I even showed you in the illustration font size difference. Remember how part 1 and part 2 looks like? Okay, fine. This is enough. Now, what is other reporting requirements? What is other reporting requirements here? Other reporting requirements, which is called as actually report on legal and regulatory requirement. What are they? In Companies Act, we have 143 subsection 1, 6 inquiries we need to do. Then 143, we have another section 143 subsection 3. We should talk about 16 checklist items. Actually 10 were there. Clause number A to clause number J. Only 10 were there. Inside clause number J, 6 items were there. So accordingly, I classify them as 16 items, 16 matters. Then we have 143 subsection 11, which is actually dealing with the CARO 2020, where 21 clauses were there, 21 matters were there. Apart from that, we also have one more reporting requirement, 143 subsection 12. Remember, 143 section itself is what section? Duty of auditor. 143 section is talking about what? Duties of auditor. First of all, there is a section called 143 subsection 2. What that section says, you must give audit report. You must give audit report. 143 subsection 4 is there. It says what? If you give any negative comment in the audit report, you should give explanation. Then 143.3 says what? 143.1.3 says, you need to comment on some additional matters. 143.11, what it says, you should comment on CARO, central government notified matters. Central government notified CARO 2020. This is the structure of 143 mainly. Again, we have 143.12. If you identify a fraud, then depending upon the amount involved, more than or equal to 1 crore, you identified, then report to central government within 60 days. In which form? ADT 4 form you have to report. Suppose if the fraud amount you identified, who identified? Auditor, statutory auditor identified the fraud, and if it is less than 1 crore, then you just have to report to board of directors or audit committee, as the case may be. If audit committee is there, report them. If audit committee is not there in the company, report to board of directors. Yes or no? What you should report? Nature of fraud, parties involved, amount involved. Again, this board of directors know this information as it is shall be mentioned in board report. In the board of directors, in the board report, they should mention as it is information in board report, plus one more matter also they should. These three they should report, plus one more. What actions they have taken. This is the reporting requirement relating to fraud. Now, you know, I'm not going to cover this in the revision. I'm not going to cover this in the revision. I am going to cover CARO in the revision. 143 subsection 11. In 143.3 also some 2 or 3 important points were there. Only that I will cover. 143 subsection 11. Like, see, if at all you want to have an in-depth understanding of 3 and all, no, you can refer my previous version marathon. Not an issue. Previous version for September attempt I did one marathon. The same thing is used for Jan attempt also. Jan 25 attempt. The same can be used. No doubt at all. No changes at all in this entire. Even in CARO also no changes at all. Clear? That's it. Now let's try to discuss CARO 2020. Let's try to discuss CARO 2020. CARO 2020 is what, you know, it's actually an order given by central government, you know, and with respect to the power they are having under Companies Act 143 subsection 12, sorry 11. With the power they have in 143 subsection 11, central government has a power to issue some order. Which order? An order on which auditors have to give a comment thereon. You know, just now I told 143. What are the requirements I told? 143 subsection 1, 143 subsection 3, 143 subsection 11. This is what dealing with CARO. Here 21 matters were there. Here 16 matters were there. Here 6 matters were there. Yes or no? You know, on these 6 matters, auditor shall report only when the answer is negative. If auditor is satisfied with them, no need to report at all. You see Tata Motors, you will not find 143.1 reporting requirements in audit report. You see Reliance, you will not find 143.1. You know, 6 enquiries. Auditor has to inquire them. If something negative is there, she shall report. If no negative is there, you can ignore. Whereas 143.3, 16 matters. 143 subsection 11 CARO, 21 clauses, total 21 matters. On these, no, you must report whether your opinion is positive or negative, both. Whether your opinion is positive or negative, you must report. Now let's discuss 143 subsection 11, nothing but Companies Auditor Report Order CARO. Now, to whom CARO is applicable? By the way, CARO reporting is not applicable for every auditor of every company. CARO is applicable only for certain companies. Like certain companies are excluded. To which companies it is applicable? They did not give to which companies it is applicable. They told for which companies it is not applicable. Yes or no? CARO is applicable for all companies, even a foreign company. However, it does not apply. It does not apply to banks, insurance companies, Section 8 companies, 1% companies, small companies. By the way, remember, in this entire list, NBFC is not covered, which means CARO is applicable even for NBFCs. Non-banking finance companies also CARO is applicable. Getting it? Banks it is not applicable. Bank can be commercial bank, you know, all that's whatever. Insurance, Section 8 company, 1% company, small company. Small company means what? Capital less than 4 crore, turnover less than 40 crore. Then that is called as a small company. Then there is another category called last one. Any other private limited company which satisfy following 4 conditions. If a private company satisfying 4 conditions, what are they? Not a subsidiary or holding. Here there is a big twist. Here there is a big twist. Be careful. Not a subsidiary or holding, not a subsidiary or holding of a public company. Or aggregate paid up capital and reserves shall not exceed 1 crore on balance sheet date. Aggregate borrowings from banks and FIs shall not exceed 1 crore at any time during the year. At any time means what? In the entire 365 days, what is your total loan outstanding? Less than or equal to 1 crore always. Whose turnover does not exceed 10 crore. But you know, we know a private limited company whose turnover is less than 4 crore. Sorry, whose capital is less than 4 crore, whose turnover is less than 40 crore, that private company directly becomes what? Small company. Now, in such a case, this clause, this exception number 6 don't have any validity at all now. Once upon a time, this exception 6, private limited company CARO does not apply, right? It has some validity, but now it don't have any validity. This exception number 6 is useless because every private company today will come under what? Small company. Whatever section 6 is there, right? They all first satisfy small company definition. Sir, small company means turnover and capital loan. You know, what if borrowings are more than 1 crore? What about that? It doesn't matter. For small company, checking, no, if a private company has a turnover less than 40 crore, if a private company has a capital less than 4 crore, how much they're borrowing doesn't matter. It's a small company. And if it's a small company, CARO does not apply. The auditor of such a private limited company, they don't need to give CARO report. In exam, if at all they give you a private limited company, turnover details, capital details, all that, you straight away apply 4 crore logic, 40 crore logic. That's it. If at all 4 crore, 40 crore logic does not satisfy, then straight away CARO is applicable. That's it. Leo, sometimes in exam they'll ask you a theory question. Write about applicability of CARO 2020. Applicability they may ask you. Theory question they may ask you. That time you should write about private limited company exception also. Clear? We have seen in our regular class in CARO guidance note. There is a guidance note on CARO inside that point number 12. That actually clarified this provision. Right now, whatever we have seen, yes or no? That's it. Now, by the way, is CARO report applicable for consolidated financial statements? No. In CARO, we have totally 20 first clauses. First 20 clauses are applicable for standalone financials related audit report. The remaining 21st clause is there, right? That is applicable for consolidated financial statements audit report. 21st clause of CARO is applicable only for the auditor's report on consolidated financials. First 20 clauses are applicable for the auditor's report on standalone financial statements. Correct or not? That's it. Next. Now, what are the matters to be included in CARO report? What are the matters to be included in CARO report? First and foremost matter, you must talk about fixed asset. See how audit report is becoming more informative today. How informative the audit report is becoming. You see, Tata Motors auditors have also given CARO report. Tata Motors auditors, they have given CARO report. This is consolidated financial statements. Okay, now let us go to standalone financial statements. We will do a side-by-side comparison for few items at least. If not every item, we will do at least for a few items. So we'll open consolidated financial standalone financial statements of Tata Motors. Yes, this is auditor's report. This is auditor's report on standalone financial statements. Inside this, by the way, we are discussing which section of the auditor's report. Report on other legal and regulatory requirements. Inside that, CARO report. What auditors gave? They asked you to refer Annexure A. So Annexure A, they are giving CARO report inside that. You see, CARO, Annexure A. Annexure A to the independent audit report. What is this? Report on other legal requirements. Yes or no? Now, you see, first matter, fixed assets. You know, second matter, inventory. They didn't mention the high headings. That's it. We mentioned in our book headings. That's it. Even in the ICA book, they don't have mentioned headings. We mention headings in our book. Clear? That's it. Now, this point we will see simultaneously. We will see reporting requirements here also. Briefly, we will see. Not every point. For some points, we will see. Okay. Only important clauses I will cover in CARO. Not every clause. Maximum I will see. I will see whatever is possible. I will cover. Okay. Next. And I will also revise CARO in just 7 or 8 minutes. Entire all 21 clauses. Okay, we will revise within 7 or 8 minutes all 21 clauses. Now look at. Or else maybe I already did one 8 minutes video. That itself I'll merge it here. Best. Fine. So first we will discuss what is there. First and foremost matter, auditor has to give a comment is what? Fixed assets. What auditor has to talk about fixed assets? 5 different aspects you should talk in the CARO. Yes or no? 5 aspects. First one, fixed asset register. Auditor has to ask, auditor has to check whether company is maintaining a fixed asset register, proper record, which will contain details of all the fixed assets, how many were there, where they were installed, situation, quantitative. That is first point you should check. Yeah, company maintained a, report it here positively, yes or no. Second point, whether property, plant and equipment is physically verified. These fixed assets must be verified physically by the management at reasonable interval. If any discrepancy is noticed, how they were dealt in the books also auditor has to check. Company, see, it's not auditor responsibility to physically verify. Company has to do physically fixed assets verification, whether all the assets which they installed, are they in good condition, are they present, yes or no, or anything was stolen. Our company has to do physical verification at reasonable interval. Tata Motors, they are doing once in 3 years. The physical verification is done once in 3 years. You know what auditors of Tata Motor replied? For the Tata Motors, once in 3 years is reasonable, no problem at all. Considering the size of the company, considering the nature of the assets, once in 3 years is, it's okay. Then third reporting requirement, title of immovable property, whether title deeds, nothing but registration deeds for immovable property, are they in whose name they are asking? Are they in the name of the company? Are they in company name? If not, you showed some immovable property, land and building in balance sheet of the company, but when you see the registration deeds, they are not in the name of the company, they are in the name of a director, for example. If not in the name of the company, auditor has to disclose the following information. Remember, auditor has to disclose, and not only that, even the company has to disclose in Schedule 3 under additional regulatory information. The company shall also disclose this under Schedule 3 as a additional regulatory information, and this company will disclose it as an additional regulatory. We will once again discuss this point in items of financial statements revision. Okay, fine. What the company has to disclose? Simple. What is the point we are talking about? Fixed assets. Third point we are talking title deeds. They are not in the name of the company, but it is company owned only. Then they are in whose name? First of all, description of the property. For example, factory building. Gross carrying value 1.5 crore. Held in the name of Ram. Who is he? Director. Period held. Since incorporation, it is in the name of director only. Reasons. Explanation in the class. I gave an explanation in the class already. Yes or no? Reason. For example, maybe company want to save registration cost, or very recently company, it was a sole proprietorship firm, converted into a company. Registration was kept pending. We will do registration within the next 3 to 4 months time. Clear? Next, revaluation. The fourth aspect in fixed asset is whether property, plant and equipment were revalued. Whether fixed assets are revalued. Check out. Say, yes sir, in the company where I am doing audit, they revalued. Who did revaluation? Is it done by a registered valuer? And if at all, because of revaluation, change is more than 10% in net carrying value of each class of plant and machinery. What is a net carrying value? Very simple. If you see fixed asset schedule, PPE schedule, you will have gross carrying value minus accumulated depreciation. Then what you will get is net carrying value. In this net carrying value, net carrying value, if the difference is, before revaluation, identify net carrying value. After revaluation, identify net carrying value. If at all the difference is more than 10%, it may be plus, it may be minus, doesn't matter. Difference is more than 10%. Auditor has to specify the amount of change. Specifically mention how much amount it changed. Now, by the way, net carrying value of all property, plant and equipment, or each class of PPE? Each class of PPE. What do you mean by each class of PPE? Suppose you see property, plant and equipment, class number 1, building, class number 2, plant and machinery, class number 3, furniture, class number 4, vehicles. Like that, each class is there. Gross carrying value, net carrying value is there. Before revaluation, net carrying value. After revaluation, each class you should see. If the difference between them is more than 10%, auditor has to report it. Yes or no? Next. Now, fifth point. Whether any proceedings under Benami Transaction Act is initiated or pending against the company. On the company, any Benami transaction proceedings going on? Check out. If so, whether company made proper disclosures in the financials. Auditor has to check whether the Benami transaction proceedings are disclosed or not. You should check. Simple. Over 5 points. Fixed asset register, physical verification, title deeds of immovable property, revaluation, and Benami transaction. Anybody will remember all these side headings, but what is tested in exam is not the side heading or the main heading. They will test you the matter inside. Some students, what I notice is they remember all 21 clauses headings, but that is not tested in exam. Yes or no? Write 21 clauses. No, they won't ask that. What they will ask, write about fixed assets related reporting requirement in CARO. Any 3 reporting requirements they'll ask, and each one will have a 1 mark weightage. That is what they will ask you. Clear? Then second reporting requirement, second matter which auditor has to report is inventory. Second matter which auditor has to report is inventory. Only 2 aspects auditor has to verify. One, physical verification of the inventory. Whether physical verification of inventory has been conducted at reasonable interval. Is the company doing physical verification of inventory checkout? Yes. Are they doing it reasonable interval? Yes, they are doing it reasonable. Then come and comment. Suppose no, if discrepancy is there. By the way, you see here physical verification is there, right? When company identified any difference, no, if reasonable interval and discrepancies here it is there, right? Actually in the original law they use the word any material discrepancy. What they use the word? Material discrepancy. How they were dealt in the books. If at all fixed assets are physical verified, some shortage or excess we found, how they dealt in the books, they will record properly. Omissions they will record, any asset missing they will record it as a deletion, something they will record. You just have to check management workings whether they did properly or not. Here if discrepancy is 10% or more, they specifically mentioned difference in physical verification, recorded inventory, physical inventory, difference must be minimum how much? 10% in aggregate of each class of inventory. Each class of inventory means what? 3 inventories: raw material, work in progress, finished goods. So in each class, if there is a difference between physical quantity and recorded quantity by more than minimum 10%, then how they were recorded in books, auditor has to check. Suppose you see Tata Motors, they clearly mentioned, yes or no, they were frequently verified. In our opinion, the frequency of verification is reasonable. No discrepancies were noticed. The Tata Motors auditors reported on the company that there is no difference at all. Everything is fair. Yes or no? Next, working capital loan related to inventory. Remember, in bank audit you might have covered, when the company has borrowed any overdraft or cash credit, they need to give stock statements to the bank. And a stock statement which is older than 3 months, then the bank will classify that loan account as irregular. Remember? Yeah. So a company has to periodically submit stock statements to the company. Stock statements they are submitting. No. Auditor has to check what, whether returns, quarterly statements filed with banks, filed with the financial institutions, are they matching with books? In reality, many companies, what they do, in books, stock value is different. But when I'm reporting to bank, I will inflate the stock and then report to get more drawing power. Sir, what is drawing power? What is the benefit of that? We will discuss in bank audit revision. Clear? That's it. If not, give the details. So, for example, company filed a stock statement with the bank, quarterly stock statement they filed. Okay, in that stock value, book value as on the same date, both are not matching. Auditor has to report it. This reporting applies. This stock statement reporting applies only when the working capital sanctioned limit is in excess of 5 crore. Only when the working capital limit, sanctioned limit is more than 5 crore. Remember, when you are computing the sanctioned limit, you should take fund-based credit facilities, non-fund-based credit facilities, both. Fund-based means what? Overdraft, cash credit, loan, term loan, that and all you should cover. Working capital loan. Non-fund-based means what? Letter of credit given, guarantee given. They are non-fund-based. For working capital, bank gave a letter of credit to the company. It is not involving any amount to transfer to the company. But still, for CARO applicability purpose, for second clause applicability purpose, second matter, second point applicability purpose, working capital limit 5 crore includes non-fund based credit facility also. Clear? All of you? Next. Then the third one. Loans, advances, investments and guarantees. Loans, advances, investments and guarantees. Inside this we totally have 6 clauses. Inside it we totally have 6 clauses. A, B, C, D, E, F. Whereas point number A, point number E, they does not apply to a company whose principal business is to give loans, indirectly NBFCs. In clause number 3, matter number 3, first of all, for NBFC, all 21 matters in CARO applicable. But in the third matter, Submatter A, submatter E, they don't apply to NBFCs. What are submatter A, submatter E? First we will discuss in the order. Now first auditor has to check whether company has invested in another company, or gave a loan, gave an advance in the nature of loan, or given a guarantee, provided security to some other entity. If so, audit company has to, you need to get the data from the company and report. What data you should report? Aggregate amount. What is the aggregate amount of? What is the aggregate amount of loans, advances, guarantee, security to subsidiary, associate, joint venture? How much aggregate amount we gave during the year? Total loans given during the year. What is balance out, and how to others, how much we gave? What is the aggregate amount of loan? What is the aggregate amount of loan given to subsidiaries? What is the aggregate amount of loan given to others? First give that information. Not only that, as on 31st March, what is balance outstanding with subsidiaries, associates, how much, with others, how much? You should give that. Very simple. The company gave loans, advances in the nature of loan, investments, guarantees, or security to another entity. Please give the following information. How much they gave to subsidiary, associate, joint venture, how much they gave to others. Plus, you should also disclose how much is outstanding as on 31st March. Remember, we are giving loans, means it's a receivable for the company. It's a receivable for the company. How much is outstanding as on 31st March with respect to subsidiaries, and with respect to others, how much is outstanding on 31st March. That breakup must be given. And remember, this A point breakup details is not applicable to NBFC. They are not applicable to NBFC. Breakup details no need to be given. Then generally, whenever we are giving loans, we generally give loans based on some terms and conditions, right? Whether the terms and conditions are prejudicial, are they reasonable or unreasonable, auditor has to check. We will see as per articles of association whether a company can give loan or not. We will see at what rate of interest they can give. We will see. If at all in reality the loan is given not as per the articles, some other terms they used, then we classify that situation as not prejudicial to the company. Yes or no? Next, now third point, auditor has to check and report. Okay, you gave loan, terms and conditions also good. Are they repaying regularly? Check out whether the repayment receipts are regular, because you gave a loan, your company gave a loan, your company has to receive. It's a asset for the company. Yes or no? Suppose no, if there is amount is overdue, if not amount like some default is there, you gave a loan, they are not repaying me on time, overdue period cross at 90 days, what steps a company has taken to recover them, auditor has to report. Clear? Then whether loans and advances which fall due in this year, suppose you gave loans, right? In this year some EMIs are due, you gave a loan, there are some loans which are repayable by the other parties to this company which are due in the current year. They need to repay in the current year, but what happened, they didn't repay. Why? The company extended them, the company gave a fresh loan to them, or the company rescheduled the loan terms and conditions. If at all the company gave any loans, extension, rescheduling, all that, how much is the total amount of that extended loans, grants, extended loans, refresh loans were given, rescheduled loans, how much? Suppose in this year company gave 100 crore total loan, out of 100 crore, 40 crore is rescheduled loan, 40 crore is a fresh loan given to existing borrowers to repay the old loan. How much of it? Mention. What is this percentage to the aggregate loans given in the current year? 40% of the current year loans given were rescheduled loans. Mention that. Now remember the sixth point, renewals, extensions, reschedule, fresh loan point is not applicable to NBFC. It is not applicable. Yes or no? Then finally, whether the company gave any demand loan. Demand loan means what? I gave a loan to my subsidiary. When they should repay? Whenever I ask. Whenever I ask, they will repay. It's called demand loan, without specifying any terms of repayment. Loan given without specifying any terms of repayment. If so, how much amount company gave like that? What is this percentage of loan to the total loan? Current year we have 100 crore loan. No, 80% of the loans are demand loans given to subsidiaries, associates, joint ventures. And out of this demand loan, how much amount is given to promoters, related parties? That also you should give breakup. Tata Motors given a disclosure on this. Please open Tata Motors report if at all you want to have a practical example on that. Clear? Then now remember, in the third class, we are giving loans, investments, advances, all that, right? Now what about Companies Act provision on the same? That is addressed in fourth clause. In the fourth matter in the CARO, they are asking us to check Companies Act provisions also. Third clause extension only fourth clause. Technically speaking, fourth clause is not a different matter. Fourth matter is an extension to third matter. Instead of giving it as a third matter part, they gave a separate matter. When you are giving loans, 6 matters you should check. To whom it is given, subsidiary is a related parties how much, to others how much, outstanding amount how much as on 31st March. That's one of the reporting requirement. Second, terms and conditions reasonable or not. In the third clause, second point. Third clause, third point, are they repaying regularly? Fourth point, overdue. Is there any loan due in the current year which is rescheduled or extended, or fresh loan is given? What is the amount? What is its percentage to the total loan? Fifth point, sixth point, whether the company has given any demand loans to related parties. Yes or no? Whether the company has given demand loans, check out. And if so, how much is the demand loan given? How much of it is given to promoters? Check out. Further, loans and advances, investments, guarantee, security, right? Verify provisions of 185, 186 in the Companies Act. Companies Act provisions are also complied or not, check out. Fifth matter, sir, company accepted public deposit. Company accepted public deposit. If a company has accepted public deposits, auditor has to check compliance with section 73 to 76 RBI directives, company law board, and in case of non-compliance, auditor has to mention the non-compliance. Remember, sometimes in MCQ, they will give you all these points. Which point is not applicable, they will give you, or they will give you any 2 or 3 subclauses from the third clause, and they will ask you whether the company is liable for reporting. In the case study, they will mention the company is engaged in lending business, and whether the following reporting applicable or not, they'll give you. If at all that is coming under E point and A point, you should say company, for the company it is not applicable because the company is engaged in lending business. Very carefully you should study the questions. In our classroom, we solved all that. Yes or no? It was asked not in inter, it was asked in CA final also. I'm telling you, CA final paper is not advanced paper, nothing such that. CA inter, CA final, the paper standard is same only. If at all you both are having same syllabus, CARO is there in CA final for you also, both of you. Same way they will ask questions. In fact, sometimes the paper is very tough in CA inter only, the topic. In CA final, that much tough question they will not ask. Clear? Next. Deposits. They may ask you this itself for 4 marks question. Clear? Next. Cost records. Is the company liable to maintain cost records? Check out. 148 section is there which talks about cost records. If so, are they made and maintaining? That's it. Are they maintaining or not? Check out. Is the cost records enoughly maintained, sufficiently maintained, in what condition they are maintained, are they accurate? No need to check. Clear? Are they maintained or not? Check out. That's it. Prima facie examination enough. Then statutory dues. Then what? Statutory dues. What is a statutory due? Very simple. Provident fund, ESI, taxes, income tax, advance tax, GST, customs, profession tax, property tax. All these are what? Statutory dues. Dues payable under some law or regulation. We call them as what? Statutory dues. Getting it? What auditor has to check? Auditor, the statutory due is broadly divided into 2 categories. Undisputed, disputed. Disputed means what? Company already filed a GST return or IT return. Department sent a notice to the company to demand. Department sent a notice demanding additional tax. Now the company filed a case against the department at a higher level court. At a tribunal level, company filed a case against the department. Like, we don't have to pay. They are unnecessarily asking. They passed a demand order on me. I don't have to pay. Please, you help me. I went to tribunal. Now the case is under dispute, because department sent me demand notice. Did I accept it? Dispute started. That is called what? Disputed statutory due. Have you paid amount? No. So if dues are not deposited on account of dispute, the auditor has to simply indicate how much amount is involved in the dispute, where the dispute is pending. For example, you see Tata Motors, they have clearly given disputed dues according to the information. Getting it? So the following dues are pending on account of dispute. Income tax belonging to so many years, this much amount. Yes or no? Where it is pending? High Court. Forum, where it is pending. What auditor has to talk about? Nature of the due, where the amount is, where the forum, where the dispute is pending. Amount involved. You see how much detailed disclosure they are giving. In CARO, in fact, we should only talk about how much amount, where the dispute is pending. But to make people understand better, what is the due? Income tax. How much amount? 4 crore. Where it is pending? High Court. Which year it is belonging to? 90 to 93 assessment year. Like the Tata Motors is clearly showing. Auditors are showing. Yes or no? Now, suppose no, you know very well, we pay GST every month. We pay TDS. We discussed in TDS also. Yes, on a current month TDS we will pay by next month 7th date. So some provident fund, current month provident fund we will pay by next month 15th or 20. Like every month we have to pay some taxes and dues to the statutory authorities. Do we pay them when they are sending notice, or do we pay them voluntarily? Voluntarily we will pay every month. Yes or no? Now auditor has to check whether the company is regular in depositing undisputed statutory dues. Is the company regularly depositing? Check out. If not, indicate what is the arrears outstanding on balance sheet date, which is outstanding for more than 6 months. Suppose as on 31st March, no, GST payable is there, provident fund payable is there, TDS payable and all is there. As on 31st March, payables are there. They belong to which one? Check out. Sir, they are not latest, sir. It's already 6 months back only they are liable to be paid, sir. 6 months back only they are liable to be paid. More than 6 months they are overdue. Even as on 31st March it is overdue. That has to be reported by auditor. Able to understand. Next, you know, sometimes the company undisclosed income is discovered by department. You know, some transactions, no, they are not recorded in books of the company. And you know what? It was discovered during the year in a tax assessment case under income tax law. Some undisclosed incomes were disclosed now. Now, auditor has to check whether the same is properly recorded in books. Company, black money discovered by department in the current year. Earlier they didn't record. Now it is discovered. Now the same is accounted by the company or not also, you should check. How they will account it? Treat it as a prior period item. Clear? Then, default in repayment of loans. Then what? Default in repayment of loans. What auditor has to check here? Whether the company defaulted. By the way, here 9th point, no, loans means which loans? Loans given or loans taken? Borrowings. Yes or no? Now, whether company has defaulted. By the way, here default in repayment, no, 6 points were there. You see, totally 6 reporting requirements were there inside this. What are they? Default, lender wise default you should give. Is the company declared as a willful defaulter? Company got loans but diverted for some other purpose. Short term loans are diverted. Loans taken for subsidy purposes. Loans against pledge of shares held in subsidiaries. 6 aspects it is talking about. First one, what is the first one? Whether the company defaulted, whether the company defaulted in repayment of loans to any lender. Yes, company defaulted, sir. If yes, indicate the following. Especially, you know, lender wise default, lender wise. In case if the lender is a bank, in case the lender is a financial institution, in case the lender is a government, state government loan we took, or we have taken a loan from bank and FI, to which bank you defaulted. For example, you know what you need to do, what auditor has to disclose in case of a default to lenders. Auditor has to disclose what is the borrowing. Sir, working capital loan. Name of the lender, ICICI Bank. How much amount not paid on due date? 10 lakh 10,000 rupees. Whether principal or interest, both it is. 10 lakhs is principal, 10,000 is interest. How many days delay? Some 25 days, 30 days delay is there. Remarks, company is paying soon, sir. Very soon they said they will pay. But as on 31st March, these are all the defaults. Lender wise, you should give this breakup. Clear? Now, further, you know, auditor has to check whether the company is declared as a willful defaulter by any lender. For that, no, company CIBIL report you generate. Company have a PAN number, CIBIL report you generate. In the CIBIL report, you will find whether the company was defaulted, whether the company was treated as a willful defaulter by any lender. Third one, diversion of funds. Auditor has to report about diversion of funds. What is it? Suppose company bought term loans. You know, company bought term loans. Whether term loans are applied for same purpose. Check out whether the term loans were applied for same purpose. If not, like company borrowed building construction loan and now they are using it for salary repayments. Indicate the amount of loan diverted and purpose. The company during the year bought a building loan, diverted for salary repayment. Same way, whether any short-term funds were diverted, like for example, whether short-term funds borrowed, no, are the user for long-term purpose? Very risk this is, going concern indicator this is. Sometimes company will take funds. For what purpose? Not for them, to meet obligation of subsidiaries, nothing but for children's purpose. Company has children, no, subsidiary, associate, joint venture. The company took a loan. not for the company's own reason. They have borrowed it for the purpose of subsidiary, associate, joint venture. If so, if the company borrowed any such loan, details thereof with transactions and amount, how much loan you borrowed, for whose purpose you borrowed, please report it. Now sometimes company will borrow loan. Now tell me, banker will give loan only when you give security. Company gave a security. What shares held in subsidiary companies. Company has shares in subsidiary companies, Tata Motors, they have shares in Jaguar company. That shares the company assigned to bank. The company kept to a bank as a security. Now they took a loan. Now what auditor has to report? First of all, whether the company has raised any loans during the year. Did the company raise a loan during the year? On pledge of securities held in subsidiary, associate, joint venture. If so, give details. If at all, also report whether the company has defaulted in repayment of these loans. Whether these loans are defaulted. What will happen if you default these loans in this loan? Bank will become owner for those shares. You will lose holding company status. You will lose what? Holding company status. Because my shares in subsidiary company I kept with the banker and got a loan. If I default, what will happen? The shares will be transferred in the name of the bank. I will not become holding company anymore. Yes or no? Next. This is regarding borrowings from banks, FIs, government, debenture holders, all that. Sir, what if I raised money? One of the source of finance for me is not only borrowings. Another source of finance is public funds. Suppose IPO, FPO, company, whether money raised by IPO, whether money raised by further public offer, are they utilized for the purpose they were raised? Suppose company during the year, they raised money from public. Share capital, they issued shares and then bought money. Prospectus, they will mention some purpose. Whatever money they raised, is it used for the same purpose mentioned in the prospectus or not? Check out. If not, what is the default? Default means what? Used for some other purpose. Delay means what? Borrowed money, they raised money to shareholders and all. They told what in the prospectus, within next 6 months we are starting project. 1 year already gone. 31st March came. Company not yet started. Delay. Subsequent rectification. Now they started the project. Or originally they raised money from public. They used it for some other purpose. Now again ultimately used it for prospectus mentioned purpose. Clear? If there is a delay, default, subsequent rectification, everything shall be reported. Yes or no? Same way, sometimes company raises share capital money through preferential allotment also. See, entire 10th clause is what? Company raising funds by issuing securities. IPO, FPO, preferential allotment. Whether company made any preferential allotment or private placement, if so, check 42 section compliance, private placement compliance, and also see for what purpose amount is raised, for what purpose it is used. If not, provide the details, amount involved, how much, what is the non-compliance, both has to be reported. Next, fraud reporting. Almost out of 21, 10 major clauses completed. Now on very small clauses. 11, clause number 11, fraud reporting. Whether any fraud by the company or any fraud on the company. By the company means what? Generally management will do frauds on third parties. On the company means what? On company somebody is doing fraud. Who will do? Either management will do, employees will do, or third parties will do. On the company anybody can do. By the company means management doing on third parties. Whether any frauds were made by the company or any frauds were identified on the company have been noticed or reported. Who noticed and reported? Management only, not the auditor. So you ask management, sir, is there any frauds in this company during the year? If so, if yes, what is the nature of the fraud? What is the amount involved has to be indicated. Tata Motors in 22-23 financial year audit report, they mentioned that 3 employees have done a suppliers related fraud, vendor related fraud for 15 crore. They reported that. Next. Now, you need to check, you need to report one more point. Whether any report under 143.12, just now we discussed at the beginning, 143.12 is what? Reporting of fraud by the auditor to central government in ADT4. Whether auditors filed ADT4 form with the central government, they're asking. When I will file ADT form with central government? Only when the fraud amount is more than or equal to 1 crore. Indirectly they're asking, is there any fraud more than 1 crore? Then, every company, especially listed companies, they should maintain whistleblower complaint policy. Whistleblower mechanism they should maintain. Whether they're maintaining or not, check out. And the company would have received some whistleblower complaints, right? Take them into consideration. They are fraud risk factors. They will be helpful for you in risk assessment. So the CARO is asking whether the auditor considered whistleblower complaints. See, you don't have to give a list of complaints here. There is no requirement on giving a list of it. They are just asking, dear auditor, you consider whistleblower complaints. Company received 105 complaints this year. You saw the complaints, huh? In your audit you consider. That's it. Next, Nidhi company. What is it? Nidhi company. What is the Nidhi company compliance? Very simple. Nidhi companies, they should maintain own funds, net owned funds. They should maintain net owned funds of 1 rupee for every 20 rupees liability. We discussed what is the liability here, all that in the class. Nidhi company will accept deposits. Able to understand how much deposit they can accept maximum? 20 times of own funds of the Nidhi company. So that is what 1:20, net owned funds to liability, yes or no? Not only that, Nidhi company has to maintain a liquidity. Just like a bank, how they will maintain statutory liquidity ratio, Nidhi company also has to maintain a liquidity reserve. How much reserve? 10% of the unencumbered term deposit. Nidhi company is accepting some term deposit. Nidhi company is accepting deposits from public, deposits from members, Total deposits multiplied by 10%. They should maintain it as a fixed deposit. Whether Nidhi company is maintaining 10% unencumbered term deposit as per Nidhi rules. Whether Nidhi company has defaulted in payment of interest on deposits to members, in repayment of principal thereof. If so, details. Nidhi company has to report, the auditors of Nidhi company has to report whether Nidhi company is paying interest to members on time, check out. Whether Nidhi company is paying principal also to members on time, check out. If not, details. Clear? Related party transactions, 2 things you need to check. Compliance with Companies Act section 177, 188 you should check. You should also see whether related party transactions are properly disclosed as per accounting standard or not, you should check. That's it. Internal audit system, clause number 14. What are they saying? Whether company has internal audit system. We have seen in 610 standard also. In our regular class we discuss in 610. So in 610 standard I will talk about what is internal audit system, internal audit function, all that I will discuss in 610 revision. Clear? Now, whether the company has internal audit system commensurate with the size of the company. Look at the company size. How many internal auditors they have, check out. Are they okay? The size, is that okay? Nothing but they are indirectly asking internal auditor, are they namesake, are they really having a department? Reports of internal auditor, no? Internal auditors will give reports. As a stat auditor, you should compulsorily read them. You should read them. Have you read it? Have you considered it or not? CARO is asking you. Clear? Non-cash. Whether company has entered into any non-cash transactions with the directors. Sometimes in exam they'll give you the company transferred a land to director in exchange of car owned by the director. It's a non-cash transaction. They will ask you what is the reporting requirement by the auditor. It's a non-cash transaction, comes under clause number 15. So if so, whether provisions of 192, whenever a company is doing non-cash transaction with the directors, section 192 says some conditions. Are they satisfied or not? Auditor has to check and then report in CARO. Clear? Now NBFC related reporting. You need to check. You are doing audit of a company, right? You need to check whether the company is required to be registered under RBI NBFC law. I told you in our regular class also we covered principal business criteria. If NBFC financial assets are more than 50% of total assets, NBFC financial incomes are more than 50% of total incomes. If both the conditions are satisfied, it must register under RBI 45 IA as a NBFC. You need to check. Suppose I am doing audit of Tata Motors. I need to check total assets. If financial assets are more than 50% and income of Tata Motors more than 50% is from financial activities, then that should be registered as a NBFC. But luckily, their financial assets are very low. Sir, what are financial assets? Loans and advances, investments. Loans and advances, investments. They are treated as what? Financial assets. Next. Has the company carried out any NBFC activity without registration? Suppose no NBFC, company is an NBFC. Principal business criteria they are doing, but they didn't register. Without registration, are they doing business of NBFC? Comment. Is the company core investment company? Third point is what? Is the company core investment company? Core investment company means what? In a company total balance sheet assets, 90% of the total balance sheet assets, minimum 90% should be investments. If 90% of the assets of the company are investments, then that's a core investment company. So check whether Tata Motors, the company that we are doing audit, 90% of the assets are investments. No, Tata Motors is not a core investment company. Whether, if at all it's a core investment company, is it fulfilling 90% criteria? Check out. In case company is exempted, again, core investment companies, they are classified as per NBFC guidelines. We have NBFC audit in CA final, there we will discuss. Getting it? These core investment companies, some are liable for registration, some are exempted. If at all the company you're doing audit is a core investment company, but they're exempted, see whether exemption criteria satisfied or not, check out. What is the exemption criteria, for core investment companies? Total asset size 100 crore. If the asset size is less than 100 crore for a core investment company, that is exempted. If asset size is more than 100 crore for a core investment company, that has to register. Then, how many core investment companies are there in the group? Tata Motors said 6 companies were there in the core investment group. In the Tata Motors said, in the Tata group, 6 core investment companies were there. Auditors have clearly mentioned that. Clear? Next, cash losses. Whether the company has incurred cash loss in the current year as well as in the preceding year. If so, how much is the cash loss? How to find out cash loss? Very simple. You do cash flow statement, right? In cash flow statement, you first start net profit as per P&L, correct? Now, before working capital changes, you will find out cash flow, right? Cash flow before working capital changes. If that is negative, that's a cash loss. If that is negative, that's a cash loss. In cash flow statement, you start with net profit as per P&L. Suppose that is loss. You adjust non-cash items and all, right? Before working capital changes, you adjust all the P&L non-cash items, right? That figure you get, right? That's a cash loss. If at all that is negative, it's a cash loss. As per P&L, company may have a profit, but in the cash flow statement, cash flow before working capital changes, if it is negative, then they have a cash loss. See, sir, cash loss is there, sir. In current year, it is there, sir. But previous year, it is profit only, sir. Cash profit only. Cash loss is not there. Report about current year. Sir, in current year, there is no cash loss, sir. But previous year, cash loss is there, sir. Then report about previous year. Sir, both are cash losses, sir. Then report both. Simple. Whether company has suffered any cash loss in the current year and previous year, check out and report accordingly. Clear? Next, resignation. See, in the current year, any auditor resigned. If so, the current auditor has to check. Current auditor has to take into account considerations of the issues, objections, concerns. The auditor resigned. No, why he resigned? Check out. What reasons he mentioned? Consider. And then accordingly you do your audit. Have you considered or not? CARO is asking you. Suppose I am the auditor who was appointed under casual vacancy because of resignation of existing auditor. I need to report on 18th clause specifically. Clear? Next, 20th CSR compliance and then 21. First I will discuss these two, then I will go for 19th material uncertainty. Yes or no? CSR. Very simple. Companies, they have to spend every year 2% of the average profits on CSR activities. Companies, how they can spend 2%? Suppose Reliance is there, 50,000 crore profit, 2% means what? 1,000 crore. They need to spend on CSR 1,000 crore. How CSR can be spent? Directly you can spend you must spend within 31st March. If you do not spend within 31st March, you should transfer within 6 months from the end of the 31st March to Schedule 7 fund. Correct? However, if company take up some project, which is more than 1 year validity, yes or no, then the amount whatever allocated for project, it must be kept in a separate bank account. This is briefly the CSR provision, and we discussed in our class regularly very in depth about it. This understanding is enough. If you want to have a CSR clarity, look at law revision. Getting it? CSR related law revision will be there in our marathon YouTube. You just go ahead, then you will understand this point much more better. Suppose other than project means what? Company decided to spend some 200 crore within this year only, but they could only spend 150 crore. Remaining 50 crore is unutilized, not yet spent. Is this 50 crore allocated for any project? No, they have not allocated. Then what the company has to do? They must transfer that amount within 6 months. They must transfer that amount within 6 months to Schedule 7 fund, where any amount other than ongoing project, company has transferred that unspent money to Schedule 7 fund. Sir, amount is kept aside. CSR money kept aside. 800 crore we kept aside for project purpose, sir. As on 31st March, 150 crore used. Still 650 crore is there. What about this? It must be transferred to a special account, nothing but a separate bank account. Auditor has to check whether project related money kept aside, transferred to special account, whether other than project related money which is unutilized as on 31st March, it should be transferred to Schedule 7 funds. That's it. Whether company transferred or not, check out and report under this particular clause. Clear? Clause number 21. This clause number 21 is applicable for audit report given on consolidated financials. This 21 is not applicable for audit reports on standalone financials. This 21 clause is applicable only for audit reports given on consolidated financial statements. Yes or no? No. What auditor has to report here? I am giving audit report on consolidated financials. Inside that CARO report I should give only 21st clause I will talk. What I will talk here? In consolidated financials, no. Many companies are included, right? Subsidiaries, associates, they're all included, right? These subsidiaries, associates, no, they were audited by their auditors, right? They have given CARO reports, right? Inside the CARO reports, no, they might have given some qualifications, adverse remarks, right? Summarize that and then give a list here. Summarize all the qualifications at one place and then give a list here. So here, shareholders will get what information? Holding company auditors in CARO report, what qualifications they gave. Subsidiary companies auditors in CARO reports, what qualifications they gave. The associate companies auditors audit reports in CARO reports, what qualifications they gave. At one place they will see. Are you clear? So whether there have been any qualification adverse remark by respective auditors in CARO reports of companies which are included in consolidated financial statements. If yes, indicate the details of companies and paragraph numbers. In Tata Motors consolidated financials related audit report, you got 21st clause, directly auditor what in the Tata Motors subsidiary company, clause number 4, clause number 8, clause number 12. These are the clauses which are having qualifications. Tata Motors passenger vehicle, associate company or subsidiary company, clause number 2, clause number 3B, clause number 4C, like that, something like that they'll reply. Able to understand? That's it. By the way, here in reporting in CARO, the reporting requirement must be whether positive or negative, both you must report. If a point is not applicable, say that it is not applicable. Finally, 19th clause. What is the 19th clause is asking? This 19th clause is asking, you have to check. You have to check. When you are giving audit report, no, suppose I am giving audit report. Sir, 31st March is the financial year, sir. I am giving audit report on 10th June, sir. On 10th June, once again check. Once again check on 10th June. What you should check? As on 31st March, company has so many current liabilities, right? As on 31st March, company has so many current liabilities, right? Current liability means what? They're all current liability as on 31st March means they should be repayable within next 12 months. As on 10th June, you should check. Whatever liabilities company showed on 31st March, can they repay within 1 year? Can they repay within next 1 year? From 31st March, can they repay within next 1 year? Do they have that repayment capacity? You should check this point. You should check this company ability on audit report date. You should check the company ability on audit report date. Whether the auditor is of the opinion that no uncertainty exists as on audit report date, that company is capable of meeting its liabilities existing on balance sheet date. Liabilities existing on balance sheet date, not liabilities existing on audit report. Auditor has to check this company repayment capacity on which date? Audit report date you should check. Which liabilities repayment capacity? Liabilities existing on balance sheet date. MCQ might come. Clear? That's it. CARO is completed. Entire CARO is completed. Hardly less than 40 minutes we spent on CARO. Productively we discussed every point. Felt clear about it? That's it. Okay, that's it. We'll continue the next chapter revision in the next session. Yes, audit documentation. Remember, whatever we do in audit, we should document. Why first of all documentation? I told in our regular class also how documentation looks like. Documentation is like soft copy, electronic, as well as it is a hard copy. Like when we are doing audit, no. See, for a particular company, when we are doing audit, no, we do verification of opening balances. We first go and try to understand the company. Yes or no? We will understand what is the company, what is their memorandum of association is saying, what articles of association is saying. We verify so many documents. We talk to so many people. We see purchase process, how it is happening. We see sales, how it is happening. First, we do something called risk assessment. In risk assessment means what? You are understanding the company. You are understanding the environment. Yes or no? So get first an understanding of the company. Now relating to this understanding, you will be reading so many documents, so many contracts, so many commitments which the company entered into, so many agreements will be there. First get that copy of all that, you get that document. Tomorrow if somebody asked you, do you know about the company? Suppose no, there are so many auditors who have signed audit report, yet they don't understand what the company is doing. First question, when the NFRA is doing review, all that, they will ask you an inquiry, what you know about the company you audited. You should be able to tell what company is doing, how their business practices, how their business strategies, all that. Yes or no? Understanding the company. What to understand in the company? We are going to discuss that in risk assessment chapter. We are having a chapter called risk assessment. Inside that we'll be revising what to understand about the company. So documented. Now you verified opening balances, documented. Purchases you verified, documented. Sales you verified, documented. Whatever you are verifying, gather that and document it. Now how can you document? Either electronically you can document or physical hard copy you can document. Today we are all doing audits digitally. In fact, that is concept we call it as remote audit. What is it? Concept is called as remote audit. Nothing but work from home. Many big four employees working from home. Many big four no. Like suppose you're joining in a big four or some audit firm. You are doing audit of some foreign company sitting in India. Remotely you're doing audit. Working papers are maintained in soft copy. That's it. Now, what is that documentation? What is that working paper is what we are going to revise in this chapter. What is that? Audit documentation standard. We are actually going to discuss, we are actually discussing 230 standard. What the standard says? Audit documentation refers to record of audit procedures performed, relevant evidence obtained, conclusions reached by the auditor. It is also known as working papers and work papers. So, audit documentation refers to audit procedures performed, audit evidence obtained, conclusions which auditor is reaching. So what are all processes? You are verifying so many purchases, sales, you are verifying. Whatever you are verifying, record it. Whatever information you are getting, record it. Whatever decisions you have taken on purchases, what is your call? On sales, what is your decision? On inventory, what is your decision? Record it. Now, whatever the process of recording is there, right? We call it as audit documentation. Getting it? This is also called as working papers and work papers. Now, there is another definition called audit file. What is a file? You know, whatever you are working, you need to document, right? That's called documentation, right? This documentation you will store, where you will store? Computer, soft copy, electronically, or hard copy. That is called as audit file. Audit file means medium of storing documentation. Audit file is one or more folders or storage medium containing audit documentation for a specific engagement. MCQ might come for all engagements, option A. B, for audit engagements, option C. For assurance engagement only, option D. For a specific engagement. Tell me, we must maintain documentation for each client separately? We must maintain exclusive file for each year audit? Yes. So that's it. Now, tell me, what is the purpose of documentation? What is the nature of documentation? Nature is very simple. What is the documentation nature? It's an evidence. It's an evidence that you planned and performed the audit as per standards on auditing, as per law and regulation. It's an evidence for your auditor's conclusion. You gave unmodified opinion. Tomorrow NFRA is asking question, how did you give unmodified? Sir, I have verified everything. I took a conclusion that everything is financial statements are true and fair. How did you to conclusion? I verified purchases. Everything is true and fair. How did you know it is true and fair? You must show the proof. Audit documentation is evidence for the conclusions reached by the auditor. Evidence for audit was planned and performed as per law. Purpose, audit documentation, it helps you in so many ways. It helps you, to plan and perform the audit in a better way. Yes or no? It will help you to direct your team, supervise your team, review their work properly. Documentation team, when they're working, they gather documentation, right? So they need to work carefully. If they did not work, if they did not work carefully, through documentation I can discover them. It will make them accountable. When I say please document what you did, they do carefully. If I say no need of documentation, they do carelessly. Yes or no? That's it. Documentation, record of important matters for future audit. It will help you for future audit. You are appointed as an auditor for 5 years. First year you did lot of work. Second year your audit firm, some other articles and all were there. They don't have to stress much. They can look at the previous year documentation and easily can plan the next year audit. Yes or no? Documentation helps quality control reviews. Documentation helps external inspection by NFRA quality review board. Like there are so many inspection authorities, ROC inspection, that and all, it will help able to understand. Next, manner, how you should document. What is the manner of documentation? In exam they'll ask you what is the nature of documentation and purpose of documentation. 4 marks or 5 marks question they'll ask you. Or what is audit documentation? 3 marks meaning they'll ask you. Yes or no? Now, what is the manner of documentation? The auditor must prepare documentation in such a way an experienced another auditor. Some other experienced auditor is there, right? He is not part of your team. He is not part of your team. I told you, entire audit is performed by our audit firm, one of the team. The team is called as what? Engagement team. Documentation who will prepare? The team will prepare. In how they should prepare, in what way they should prepare, documentation shall be prepared in such a manner that an experienced auditor who do not have connection with the audit, means he is not part of your team. For that audit, he is not part of your team, but he has a knowledge of auditing, he has a knowledge of financial reporting framework, he has a knowledge of accounting standard, he has a knowledge of auditing standard, he also knows about the client business. Experienced auditor is a person who has a reasonable knowledge of all this. By looking at your documentation, by reading your documentation, will understand what audit procedures you perform, nature, timing, extent, how you performed risk assessment, how you performed a further audit, what is the result of the procedure, what information you obtain, what significant matters you reached, what significant matters you identified, what professional judgment you made on the significant matter. Sir, what is significant matter? What is professional judgment? Last concept in this chapter is that only. In documentation, last topic is that only. Able to understand. Next, what do you mean by documenting nature, timing, extent? I remember I showed you audit plan also. Documenting nature, timing, extent means what? Suppose inventory, no, I verified physically. I went for physical verification. Nature of audit procedure is physical verification. Timing, I did at the year end. Extent, I went for 3 to 4 days and I observed complete management process. Nature, timing, extent, you should document. In documenting nature, timing, extent, first what are all you should document? First you should document what test you performed. Nothing but what? Identify characteristics of specific items tested. I tested inventory, existence and condition I tested. Who performed? The engagement partner performed. Who reviewed? Who reviewed? Another partner of the firm reviewed. Date on which they reviewed. Extent of the review. Full my work is reviewed. Yes or no? Document discussion of significant matters. When I go for inventory, I got some doubts on third party. Inventory kept with third party. Significant. I discuss significant issues. What matters you discussed exactly? With whom you discussed? Yes or no? Suppose if at all the information obtained by is inconsistent. You got some information that is not matching with some other information. Have you resolved that inconsistency? Have you addressed that inconsistency? That also you should document. When you are documenting audit procedures, auditor must also document what test he performed, who reviewed, what are the significant matters, with whom the matters were discussed and resolved, how the inconsistencies were resolved. Everything you should document. Whatever work you're doing, entire that work has to be documented. Clear? Next, in what form you should document? Sir, should I document electronically or physically? What content I should document? Suppose there are so many documents, sir. Purchase vouchers, 200 vouchers are there. Should I take a Xerox copy and then document? What should I do? What content I should document? How much I should document? How I should document? How much content, to what extent? It depends upon size and complexity of the entity, nature of procedures performed. Suppose I just did observation, documentation may not be there. I inspected one memorandum of association, I take a photocopy and then document it. Depends upon risk. If at all in purchases risk is high, I will document entire purchase manual. Then if significance of the information obtained, I am getting so much of information from the client, evidence from the client. If I feel that is significant, I will take a photocopy of it. Yes or no? Exceptions identified. We will discuss what is this word exception in 505. That time I will once again connect it here. Exception means what? Inconsistencies. Getting it? If at all inconsistencies or more I need to resolve, right? You may have to document. And audit methodology and tools used, document. What are the form, extent, content of documentation? It depends upon size of the entity, nature of the procedure, risk involved, significance of the evidence obtained, exceptions identified, methodology. It also depends on audit tools and methodologies. Examples: I will document my program, analysis I will document, memorandum issues I will document, significant matters I will document, confirmation letters and representation letters I obtain, that I will document, checklist I will document, I will be discussing WhatsApp, mail and all with the client, that I will document. Sometimes I will also include Copies of entity records. Don't use the word entity record I will document. Copy of entity record also sometimes I can document. The auditor may also include copy of entity records as a part of documentation. Example, significant contracts and agreements, memorandum of association, articles of association, company bylaws and all. Yes or no? Audit doc. By the way, just because you're keeping a copy of it, company is thinking to discard them. Auditor is already having a copy of it. No, why should I maintain? Companies thinking to discard. No, audit documentation is not a substitute for entity records. Yes or no? Next, audit documentation do not include superseded drafts. You should not document. See, sometimes no, superseded means what? First you took one photocopy, in that some mistake is there. Again you took one more Xerox. After typing properly, after when you took one more. Now this new Xerox or new printout, the new printout which you took superseded the old printout. Should you retain old printout also? No need. That's it. Yes, notes showing incomplete or preliminary thinking. For example, when I'm taking class, I'm writing like this. Some students, they will ask me this running notes also. Hey, I just randomly scribbled. What I scribble also I don't know. Yes or no? This is called preliminary thinking. You know, sometimes when you're doing accounts, costing problem, you'll do some numbers. No, that also you will document. You will revise that also later on. No need. Are you getting it? Yes. So auditors preliminary thinking, that and all no need to document. Previous versions corrected for typing errors and all. Old version documents are there. In that, no, now I did some typing correction and all, and I took new document. Old document don't. Duplicate copies. Why a multiple of the same copy? Why you take multiple prints? Only one is enough. Yes or no? Audit documentation do not include superseded documents. This itself can be asked as a 4 marks question. Audit documentation also, they will ask you what is meaning of documentation. Give you examples of documentation. Can copy of entity accounting record be documented? And what is not included in documentation? Like this, they may ask you 5 marks question, entire this content. Are you clear? Now, what is audit file? Just now we covered. Now tell me, when you should prepare this documentation? After completing the auditor, while doing the auditor? Timely preparation. The auditor must prepare documentation on a timely basis. You know, documentation prepared after work is completed is less accurate than the documentation when work you are doing. Correct? Now you document what are all important data. Is that when you're verifying purchases, you felt something important, immediately document it. Later, once you complete the audit, no, neatly arrange them. Purchases related documents all at one place, sales related documents all at one place, inventory related workings at one place, employee cost workings at one place. You sort it and document it, arrange it. That process is called as assembly. That process is called as what? Assembly. You know, the audit file must be assembled and completed timely after date of audit report. So audit documentation must be assembled in a timely manner. Yes or no? And complete it compulsorily after the date of audit report. And there is a standard called standard on quality control. That standard says a partnership firm, you are the audit firm, right? Establish rules for this. In your firm, rules established for assembly purpose. The rules must say for audit file, no, complete assembly process within 60 days from the date of audit report. Once you give audit report, within 60 days assemble the final audit file. Remaining, sir, I am also doing review work, sir. I am also doing assurance. I am also doing related. For them, what is the time limit? That you decide. For audits, 60 days. Are you clear? Then, remember, assembly of documentation. Like once audit is completed, you're rearranging the papers, computer soft copy folders and all, you're organizing everything, right? That's an audit procedure or administrative process? Administrative. That is not audit procedure. Audit procedure means verifying clients' financial statements, all that. You already completed that. You gave audit report also. What you will perform now? Administrative. The final audit assembly, file assembly is an administrative process. Do not involve new procedures or conclusions. Changes can be made. Can we make changes to documentation? Yes, you can make, which are administrative in nature. Already covered that point. What documentation do not include? That is nothing but administrative. What are they? Deleting, discarding, superseded, cross-referencing working papers, signing of checklist. I'm calling my articles and all. I'm asking them to sign on the papers. What are all they brought? Yes or no? Documenting evidence obtained, documenting the evidence obtained, discussed and agreed upon before audit reported. What are all the documents important? That and all we will keep it. Remaining unnecessary items and all we will throw it, discard it. Are you clear? So they will ask you in an exam, write about assembly of documentation, 4 marks or 5 marks question. Many times they asked. Now, once you assemble it, what you should do? Keep it. store it, retain it. For how long? See, standard on quality control says minimum no shorter than 7 years from the date of audit report or group audit report, whichever is later. Yes or no? After the final audit file is assembled, the auditor shall not delete or discard the audit documentation before the retention period is completed. You should, as it is, keep it intact. You should not change anything later on. Once audit is completed, once audit documentation is freezed, you should not delete anything inside that. You should keep it as it is for 7 years. What about other engagements? Sir, I am also having documentation for review. I also gather documentation for assurance and related. What about that? Firm will decide for what period you should. But for audit, 7 years. Yes or no? Who is the owner for documentation? Whose property? Auditor. As per SQC, the documentation is the property of the auditor. The auditor, at his wish, can share the extract of documentation to the client, third parties, with the consent of the client, provided it does not affect your independence, integrity, professional behavior, confidentiality, all that. Okay, that's it. Clear? Easy or not? Now, then you should also document what? You should document significant matters. Professional judgment also you should document. Before that, no, let me devise this one, audit summary. There is also something called audit summary memorandum. What is audit summary memorandum? The auditor prepare a summary. Completion memorandum, which is also called as. Generally, it will help in large audits. Getting it? For large and complex audits, no, whatever works you did in the last 200 mandates. Okay, 200 mandates you worked almost. What are all works you did? What are all evidences you gathered? What are all decisions you have taken? With whom and all you discussed? Keep a design as a summary. Before you conclude on the audit, develop a summary. See the entire summary once. Then you take a conclusion. Then you express the opinion. Getting it? So a summary can help in effective and efficient review and inspection of audit documentation, especially for large and complex audit. It will help the auditor to address all the significant matters, all the significant issues considered by me or not. He can easily check with the summary. Yes or no? So audit summary memorandum. What you should include in the summary? Significant matters which are identified in the audit. How these matters and all were dealt by you. Is it resolved or not resolved? All that you should document. That is called as audit summary memorandum. Yes or no? This summary will help the auditor to evaluate whether standards and objectives are achieved, whether overall objectives are achieved. As a whole, you got a reasonable assurance on the financials or not. Summary memorandum will help you. Remember, significant matters and all you should document at one place. That summary memorandum is one of the best example where all the significant matters will be documented at one place. Clear? Next. Now, what is a significant matter, sir? Significant matter. Many a times we are getting this word. What is a significant matter? Whether a matter is a significant or not, auditor has to do an objective analysis, unbiased analysis of facts and circumstances. What is a significant? When a matter is significant, auditor's professional judgment. Objective auditor, based on the facts and circumstances, he will decide whether a matter is a significant or not. Yes or no? Example, matters that give rise to significant risk. Suppose if at all something is giving me significant risk, that's a significant matter. Circumstances causing significant difficulty in doing audit. You know, I'm taking extreme difficulty in GST verification. Company does not maintain proper GST records. I'm unable to verify GST properly. That's a significant difficulty. That's a significant matter. I should raise that issue with the management. I should discuss with them and then resolve it. Then findings. I found something in audit where my opinion gets modified, or emphasis of matter paragraph might be included. If at all an issue is such severe, because of that I may have to modify the opinion, or an emphasis of matter paragraph has to be used. We already discussed what is emphasis of matter paragraph in audit report. Yes or no? Important matters. If at all that is so important, then that is also called as what? Significant matter. Yes or no? Or result. I got some result in audit. I verified something. I found one result. What? Financials are materially misstated. Or now I need to revise my risk assessment. I need to revise my risk assessment. Earlier I thought low risk in sales. In sales I thought low risk. Now I got to know that in the sales is high risk is there. So that time also I should document. Clear? Now, not only matter what judgment used there. How do you decided that it is a significant matter? That judgment process also you should document. What is it? Situations. The auditor must document use of professional judgment. And you see, later on you say everywhere, sir, that time I thought it is genuine, sir. That's why I documented. How you thought genuine? That thought, how you thought, related some information you might have gathered, no, document it. Yes or no? Rationale for conclusion. Document the rationale when a requirement asks the auditor to consider information that is significant. So if at all some accounting standard and all is saying you have to verify so and so, you might have considered that as a very important point. Document it. The document the basis for conclusion on a subject to judgment, like accounting estimate. Document wherever some estimation issues are involved. Subject to judgment. Subject to means what? Here you took a called, here you took a decision that so and so asset useful life is 30 years, 20 years. On what basis you took 30 years is reasonable? Some information you have verified, no? Documented. Yes or no? You document if at all you are having any concerns on documents or evidences. Some information company gave you, some deeds, sale deeds and all they gave you, you got some doubts on that. Later you went for expert opinion and finally resolved. Document that. This is called documentation of professional judgment. Nothing. At the time whenever you're doing work, you decided something. Have you decided that? Okay, tomorrow if you think, you will forget this. If tomorrow NFR is coming, sir, on what basis you decided this is correct? Sir, papers and all is there. I'm unable to recollect what I did. I will document my professional judgment. Are you getting it? That is called documentation of professional judgment. Are you clear? Documenting professional judgment explains auditor's conclusion and reinforce the quality of the conclusion. Earlier I decided something. Now today if they are asking information, I'm unable to recollect. That's why document. If you document your professional judgment, you can once again prove on what basis you took some decision. Yes or no? That's it. With this, entire documentation topic is completed, which is 5 marks, 25, less than 25 minutes. Clear all of you? Yes or no? Read it once again thoroughly, you will get it. Okay, yes. Perfect. So, without any delay, let's begin discussion of the next topic, that is completion and review chapter. In CA Inter, we have a chapter called completion and review. Let's revise that chapter. This chapter consists of totally 6 standards. By the way, I actually scheduled this particular topic for live at 11 o'clock, but I postponed it to 12:15 now because I have to go to a hospital. Nothing serious. Tomorrow morning, my wife's, we are expecting second baby tomorrow morning. So for that, some formalities will be are there in the hospital to do some checkup, basic checkup, all that. So tomorrow morning, 6 to 7 around the time, the surgery is going to happen, and we are expecting second baby tomorrow morning. Fine. Tomorrow evening I'll tell you. I'll post it on YouTube. What exactly? I mean, baby boy or baby girl. I'm not sure. I wish to be a girl child. I wish it should be a girl because I already have one son, 2 years old son I have. So that's it. Imagine, in spite of this precious moments, we are taking live class at this moment. It's okay. It is something that I promised long ago. Fine. So let's proceed discussion of this chapter, completion and review. You know, in this chapter, we totally have 6 standards. We have 6 standards totally. 260, 265, 450, 560, 570, 580. These are the 6 standards that are there in this chapter. Whereas 570, I have already covered it as part of audit report topic. If you see audit report related revision class, okay, which I already covered in part 1 audit marathon, which is of 7 hours video, for example. So inside that 570 is already covered. So now we are left with only remaining 5 standards. Fatafat, within 60 minutes, within 1 hour, I will finish all these topics. Trust me guys, you will get a clarity like never before. On these 5 standards, I will give you amazing clarity. Tomorrow, whatever the question going to come in this chapter, right now in this 1 hour itself, I'm going to tell you what kind of questions will come. Definitely from the list of questions which I'm going to tell you right now, from this list only you will find that. Okay, fine. Now, 450. First, let's begin the chapter with SA 450. You know, evaluation of misstatements identified in an audit. Evaluation of misstatements identified in an audit. That is a standard heading. Evaluation of misstatements. You know, in this 450 standard, there are 4 topics which are predominant. What is meaning? First one that you need to understand is what is an uncorrected misstatement. The meaning you need to understand. Then we need to understand the concept of accumulation of misstatements. Then we need to understand communication of misstatements to the management and to those charged with governance, and documentation of the misstatements. 4 issues are covered. Now let's decode one by one. 450. materiality. What is the standard talking about? Evaluation of misstatements identified during the audit. Like whatever, once you completed the audit, once when you're doing the audit, you definitely come across certain misstatements. Like you will be identifying some misstatements. So how to evaluate them? You know, in this, we need to understand a term called uncorrected misstatements. You know, the word misstatement is used at so many places. Risk of material misstatement, uncorrected misstatement, undetected misstatement, projected misstatement, tolerable misstatement, expected misstatement, anomalous misstatement, non-anomalous misstatement, so many. So many ways the word misstatement is used. Here one term, that is uncorrected misstatement. Uncorrected means what? We identified a mistake in audit. We identified it. We detected it. It's a real mistake. And it is not yet rectified in the financial statements. That's it. That's called uncorrected misstatements. Uncorrected misstatements refers to misstatements that auditor has accumulated during the audit which have not been corrected yet. So the misstatements which are accumulated but not corrected. So before forming an opinion, auditor has to identify, evaluate effect of identified misstatement, effect of uncorrected. You see, identified misstatements, uncorrected. Identified misstatement is two types. Uncorrected, corrected. Some misstatements, management will correct immediately. Some mistakes they will not correct it. Those mistakes which management have not corrected, what is its impact on the financial statements? That is most important while forming an opinion on the financial statements. Now, see, that's uncorrected misstatement meaning. Now, first of all, accumulation. What do you mean by accumulation of misstatements? See, whenever we are doing audit, whenever we find any mistake, we should accumulate it. Now, here, there are three levels of materiality. There are three levels of materiality in accumulation of misstatements. There is something called performance materiality, overall materiality, triviality level materiality. Any mistakes less than triviality level, we will ignore directly. Any mistake above trivial level, whatever mistakes are there, we will gather, we will accumulate. If the accumulated misstatements total is reaching performance materiality level or is crossing performance materiality level, then we conclude that financial statements are materially misstated, and where we express a modified opinion. If at all they are crossing performance materiality level itself, we will conclude that accumulated misstatements, if at all they are reaching performance materiality level itself, we assume that, we conclude that the financial statements as a whole are not free from material misstatements. Accordingly, we will give modified opinion. Here in sampling, tolerable misstatement, overall materiality, performance materiality, like that, some definitely some points and all came, some link and all is there. Right now that is not relevant. This point alone you remember. So any misstatements which is above triviality level, that alone we accumulate. Mistakes which are more than trivial in nature, only those mistakes we will accumulate. Look at, the auditor shall accumulate. Accumulate means what? Gather. Whatever mistakes your team members are identifying, tell them that beyond this level, beyond the trivial level, please accumulate it. So accumulate mistake, the auditor shall accumulate misstatements identified except those that are clearly trivial. Suppose if a mistake is trivial in nature, less than trivial in nature, don't accumulate. Any mistake which is above trivial in nature, accumulate. In the recent CA final, an MCQ question has been asked on this. In CA final also we have 450 standard. In CA final, MCQ was asked on this May 25 exams. Now, what are various examples of misstatements? Very simple: omission of transactions, wrong capitalization of machinery repair expenditure, overvaluation of stock, undervaluation of stock. Simple. There are so many ways misstatements can happen. Now, you know what? Whenever we identify mistakes, generally what happens, we will first interpret what mistake is it. Is this mistake repetitive in nature or non-repetitive in nature? We evaluate the mistake nature. Is it due to fraud or is it due to error? We will identify. According to the type of misstatements, after we evaluate the nature of the mistake, sometimes what will happen, we will change our audit strategy. We will change our audit plan. The auditor shall determine whether overall strategy plan needs any revision. So whether audit strategy plan, does it require revision because of the nature of identified misstatements and circumstances of their occurrence, and further auditor will change the strategy and plan if aggregate misstatements accumulated approach materiality. Just now I told which materiality? Performance materiality. If the total of accumulated misstatements are reaching performance materiality level, if the total is reaching performance materiality level, we generally change our audit strategy, audit plan. We will try to cover more samples and try to interpret the results once again. Then the auditor whenever auditor identified mistakes, whenever the auditor identified mistake, we generally tell the management, dear management, I found so and so mistake, which are trivial, which are beyond trivial in nature. They are not trivial, they are very bigger than trivial in nature. So we tell the management, we request them to review. We will request management to review all the transactions and balances to understand why this mistake happened, and we will also tell the management, we will request management to perform procedures to identify real mistake, actual mistake in the population. And if management identified and corrected misstatements as per the auditor's request, we will do additional verification to ensure that there are no misstatements remain. That's it. So accumulation. So what is accumulation? First, accumulate the mistakes which are not clearly trivial, like which are beyond trivial, accumulate. If they are trivial and less than trivial, ignore. And mistakes example they gave, revision. If at all, based on the nature of mistake and circumstance in which they occur, or if the aggregate mistakes are approaching materiality, the auditor shall revise the strategy and plan. They will tell you under what circumstances the audit strategy and plan has to be revised. As per SA 450, they will ask you. Under what circumstance audit plan and strategy has to be revised? In light of 450, they'll ask you. Many students will go and write 300 related, revision of strategy and plan, changes in circumstance, changes in conditions, identification of new matter. That answer they'll write and come. That's wrong. That is 300 answer. This is 450 answer. So the auditor shall determine whether change to strategy plan is required in light of nature of the misstatement, circumstance in which they occur, as well as third scenario, if aggregate misstatements accumulated is approaching materiality, then also the auditor will revise the strategy. Okay, you identified mistakes. What you will do in that time? We will request management to review all the transactions balances once again to identify total actual misstatement. And if management identified and corrected, I will once again check whether are there any mistakes that are there. That's it. This is what accumulation. So this straight away, this question itself straight away can be asked as a 4 marks question. Write about accumulation of misstatements in the audit. That itself can be asked as a straight 4 marks question. Now, okay, you accumulated, you identified. What you need to do? Communicate. Why you need to communicate? So that the mistakes has to be corrected. Yes or no? You found a mistake. Tell the management, communicate them and ask them to correct it. So the auditor communicate all the misstatements accumulated to the management, and this communication enables the management to evaluate or disagree if necessary. Management will listen to you. Sir, it's a mistake. They will evaluate. Is it really a mistake or not mistake? Because auditor might think it's a mistake. From management point of view, this may not be a mistake. So, an auditor, what they will do? They will request management to correct it. Correction helps to maintain proper records. Sir, management is refusing, sir. They are not correcting. I told that there is a mistake. Management is telling, no, sir, inventory valuation is correctly we did. Our NRV calculation is like this only. This is correct NRV calculation. You auditor is doing wrong calculation. So management is disagreeing with the auditor. Understand what is the reason why management is refusing. Take that understanding in evaluating whether financials are free from MMS. So if management is refusing to correct misstatements communicated by the auditor, ask them the reason why they are refusing. Look at the reason which they are giving. In light of audit, what is its impact? Understand. Now, reconfirm, once again confirm whether materiality is still appropriate based on actual financial result prior to evaluating uncorrected. Before you decide about mistakes, all that, once again check whether materiality level and all is correct or not, so that you can proceed whether material misstatements are there or not. If at all uncorrected misstatements are material, determine whether uncorrected misstatements are material, considering size of the mistake, nature of the mistake, and circumstance in which they occurred. So what is the size of the amount? What is the nature? Fraud or error? Circumstance when it is occurred. Is it here and in between? So effect of prior period uncorrected misstatements. So if at all any misstatements are there in the prior period, what is its impact on the current period? That also take into account. And you must communicate to top management. Generally, when you identify mistake, you communicate to the respective management, like accountant or finance manager. If they are not responding, if they are not agree to change, then you will communicate to top management like audit committee, directors. The auditor shall communicate with those charged with governance uncorrected misstatements and what is their impact, and request correction of uncorrected misstatements. Discuss what is the effect of prior period misstatements on the, if at all any prior period mistakes also there, discuss with top management what is its impact, and get a written representation that uncorrected misstatements are immaterial. Like I communicated with top management. First I communicated with management, they refused, and I asked them what is the reason, all that. Then I felt that their answers are not correct. Then I communicated to top management. Top management rectified some mistakes they didn't rectify. Now when I ask them why are you not rectifying some mistakes, they are telling that they are immaterial, sir. They are immaterial, sir. So we don't have to rectify it. Get a declaration that they believe that it is immaterial. Get a declaration that the uncorrected misstatements are immaterial. That is the reason why top management is not correcting them. Like that, get a declaration. And what is the summary of those misstatements which are not corrected and corrected? A list of mistakes communicated to the management and top management, corrected how many, uncorrected how many, list of it also, attach it as an annexure to the written representation. So get a representation from the management and top management that uncorrected misstatements are immaterial, and a summary of these uncorrected misstatements shall be included or attached to representation. MCQ might be asked on this. Next, finally, auditor has to document misstatements identified. Like what you need to document? What is the triviality level? What is the triviality level? You fix it. What is the triviality level? That triviality level you document. The audit documentation must include amount below which misstatements are considered clearly trivial. Trivial means what? Negligible. Triviality level means negligible. By remember, immaterial is different, trivial is different. Suppose if a mistake is less than materiality level, then that is immaterial. But that immaterial mistake may be more than trivial level. So remember, many students they may confuse that immaterial and triviality both are same. No, they both are different. Triviality means negligible. If it is less than trivial, it's negligible mistake. If it is more than trivial, it is to be considered, it is to be accumulated. And total mistakes identified, we will accumulate and compare it with the materiality. If the total mistake is less than performance materiality, then we assume that the mistakes are immaterial. But remember, they are more than trivial. So be careful. Now, accumulation. So auditor has to document all mistakes accumulated during the audit, and you need to mark whether they're corrected or uncorrected or all that. Suppose if some mistakes are uncorrected, what is your conclusion? Whether uncorrected misstatements are material or management told that they're immaterial. They gave a representation that they're immaterial. But according to you, are they material or immaterial? You should also conclude. And what is the basis for your conclusion? You decided some material or immaterial, right? Some mistakes are uncorrected, right? Uncorrected misstatements total are they material or immaterial? That also you should decide. So documentation, directly this itself can be asked as a 4 marks question. That's it. SA 450 is done. So documentation of misstatements, communication of misstatements, accumulation of misstatements, and what is the meaning of the misstatement. That's it. 450 is done. Confident? Easy or not? So next, let's proceed discussing 260 standard. 260 standard. You know, in the recent Jan 25 exam, everybody, most of you know that Jan 25 paper was one of the tough paper, correct? Everybody told. So, but the questions asked in Jan 25 paper and all, we predicted in marathon itself. Many students who followed our EVO, whatever the classes or marathon thoroughly and followed the book, they know that question paper is very much predictable. That is not at all a tough paper. But anyhow, you see how the question was asked. SA 260. Now, before I go into SA 260, what are the points? By the way, SA 450, what is the meaning of misstatement? Accumulation concept, communication of misstatement, documentation. All the 4 elements we covered. Now 260. We have here four points to discuss in 260. You know, what is actually SA 260? Communication with those charged with governance. Communication with those charged with governance. The standard itself is saying the auditor has to communicate with top management. What to communicate, how to communicate, when to communicate, all that standard is answering. So what the standard impliedly telling, dear auditor, don't do audit blindly without talking to top management. You must talk to top management. You must communicate them some important matters. What are all you must communicate to top management? The standard is explaining. And the standard talks about what is the benefit of two-way communication. The auditor and the top management of the company, they must have a proper two-way communication. And who are top management? Top management means those charged with the governance. Who are they? This is what they have asked in Jan 2025 exam. Who are those charged with governance? This is what they ask. And what matters to be communicated and how to communicate. Communication process, especially independence related communication in case of listed company. So each of it we will discuss now. Now let's first discuss, who are those charged with governance. This is what Jan 25 exam they have asked. Jan 25 attempt. Again, don't immediately say, sir, in Jan they asked, May attempt they won't ask this. Come on, don't be foolish like that. Okay, paper setters will not do set like that. They may test this, who knows? So who are those charged with governance? They're very simple. Top management is either a person or an organization who oversees strategic direction, who have accountability, and who are responsible for financial reporting. They are responsible for directing the company. They are only accountable for the company. They are responsible even for financial reporting. A person who has all these responsibilities, we call them as those charged with governance. In Companies Act, they are nothing but key managerial persons. And in In some entities, top management may include management also. Those charged with governance, sometimes they also involve in management of affairs of the company. Depending on governance structure, some entities, no, they have a supervisory board. Okay, in some entities, no, both the functions are performed by single board. Governance roles can be part of the entity legal structure. For example, in a company, directors themselves are those charged with governance. In case of a partnership firm, partners itself those charged with governance. In partnership firm, partner himself is doing business, part of management. He himself taking decisions also, those charged with governance. He himself accountable if something goes wrong also. So the partner himself might be those charged with governance, the partner himself might be management. In some entities, the people who are running the business, people who are deciding the business, both are different. In some entities, they both are one and same. And in some cases, top management, those charged with governance also manages the entity, whereas in other entity, they might be different. You know, ultimately, governance means what? Authority, accountability, both. Authority, the person must have authority, and the person must also have accountability. So in governance is usually collective responsibility, like a board of directors, supervisory board like audit committee, all that. In small entities, governance may be resting with only one person. In a sole proprietor concern, those charged with governance means proprietor. He himself is manager, he himself is owner. So that's it. So who has to decide top management? Ultimately, sir, who is those charged with governance, sir? You don't worry. Ask the person who appointed you. So the auditor may need to discuss and agree with the engaging party on relevant persons to communicate with as per 260. So the auditor understanding of the entity will help to identify who are the right people. So that is why you need to understand the entity and its environment as per 315 to know who are exactly the governance people, who are governance, who is management, who is governance. Are they same or are they different? What is this organization? All that you need to decide. That's it. So directly they may ask you a question like this: who are those charged with governance? Depending upon governance structure, this itself can be asked as a 4 marks question. Any 4 points in this you need to write, and this 4th point also you should write. That's it. I hope you are clear. 260. Now, you know, what are the matters to be communicated? What auditor has to communicate? First, you should communicate your responsibility. You should also communicate, okay, the auditor first shall communicate what is his responsibility. You should clearly tell the management that, look, management, I am an auditor. I am responsible only to give opinion on the financial statements, performing and expressing opinion. And just because you appointed me, your responsibilities will not change. Your responsibility will remain intact. So the audit does not relieve management or top management of their responsibilities. See, those charged with governance means top management. Very simple. But when you're writing an answer, no, when you're writing in the answer sheet, no, you should always write those charged with governance clearly. So the auditor must communicate his responsibilities related to audit, including forming and expressing of an opinion, and statement that audit does not reduce their responsibilities. So that is the first thing. So one of the most important thing auditor has to communicate is audit responsibility. How do we communicate? Terms of engagement, engagement letter. Remember engagement letter, SA 210, contents of engagement letter, objective and scope, management responsibility, auditor responsibility. So auditor responsibilities we are communicating through engagement letter already. Second, planned scope and timing of the audit. You know, the auditor provides an overview of planned scope and timing of the audit, including significant risks identified. There is one question on this. Auditor decided to do surprise check. Without informing anybody, he directly went and started surprise check. Management objected. Is it correct? Yes, they are correct. You didn't even tell the management that you will do surprise check. See, you need not tell them when you will do surprise check. If that is the case, that is not a surprise. But you should tell the fact to the management that you will be doing surprise check. Okay, so you may do surprise check whenever you want, but tell the management that you may be doing surprise check. Give a prior intimation to them that during you know, any like next 3 months or 4 months, I may be doing a surprise visit. Give them an intimation so that they will make you you know, they will make arrangements for all that. You know, planned scope and timing of the audit. Scope and timing of the audit you must communicate. Why you need to communicate scope and timing of the audit? So that they will make arrangement. When you're going, your team member, your articles, so many of you are going, so they need to make certain arrangements. Accountant must be available to you. Some staff must be coordinating you. How do you visit the production center? So management has to plan certain things. So that's why you should communicate scope and timing of the audit. And you should communicate, most important, you should communicate in independence compliance in case of listed companies. Straight away a 4 marks question might come. Okay, auditor has to, for listed entities, auditor shall communicate. For listed entities, auditor shall communicate a statement confirming, compliance with ethical requirements on independence by the firm, by the team, by the network firms. So when you're auditing listed companies, no, there are so many ethical requirements. What are the ethical requirements when we are doing audit of listed entity? We have a discussion in CA final professional ethics chapter, like fees, how much we should charge, other services can we provide like that or not, network firms, network guidelines, so many rules and regulations were there, which we will discuss in CA final. So the auditor has to communicate to the management, those charged with governance, regarding how they complied with independence requirement. Yes, sir, I am independent. I complied with independent. I need to give a statement of compliance to the management regarding independence. Further, when I am communicating regarding independence compliance to the top management of listed company, I should also communicate the following. What are the relationships and other matters that may impact independence, including total fees that we are charging for audit and non-audit? When I'm communicating to the top management, I should tell them, sir, we the auditors are providing you audit services like this, non-audit services also like this. Fees for audit is this much, fees for non-audit this much. Our network firms are also providing you some services. What are all relationships your firm, your network firm, your partners, what are all relationships that you are having? You must communicate with top management. Fees will be allocated into categories to help top management, governance management, assess the impact on independence. See, sometimes if auditor is depending too much on the client fee, that's a self-interest threat. Yes or no? So you need to clearly communicate them how much fees you are getting for audit services, attestation services, how much you are getting for non-assurance engagement. You should communicate so that they will decide whether are you independent, are there any self-interest threat like that, they will decide. So auditor has to communicate. Further, fine. Definitely when you are communicating about independence related compliances, definitely some threats would have been there. And you might have implemented safeguards on it. Communicate, explain safeguards applied to eliminate the threats or reduce the threats to acceptable level. So what are the safeguards that you implemented so that threats will be controlled, the threats will be eliminated, or threats will be reduced to an acceptable level. So straight question can come many times asked on 260. Communication of independence in case of listed companies is most important when the auditor is communicating to top management. So communication of independence means what? First, a statement. Auditor has to give a compliance statement, a statement that the firm, the partners, the engagement team, the network firms, they all complied with ethical requirements, and details of relationships that the firm, network firms has with the company, and other matters that may impact independence, details of relationships and other matters that also communicate them, including total fees charged for audit and non-audit. Divide the fees must be allocated into assurance and non-assurance so that the top management will decide. Further, what are the safeguards that you implemented to eliminate the threat or to reduce it to acceptable level, that also you should communicate. So this is about communication of independence in case of listed entities. Straight away a 4 marks question might come. Be careful. Next, you should communicate significant findings in the audit. So you will be doing audit, right? So when you're doing the audit, you might have found, you might come across some significant findings. All the significant findings also you must communicate. The auditor must communicate the following significant findings. 1. Significant findings about entities accounting practices. What is your view, auditor's view, on significant qualitative aspects of accounting practices, including accounting policies, estimates, disclosures? I explain why certain practices may not be most appropriate. So in management, their accounting policies, accounting estimates, their accounting practices observed. Okay, and in that, if some practice is not correct, communicate them why it is not correct. So auditor's view on qualitative aspect of entities accounting practices. Generally, first time when you're doing audit, you may not communicate this because you don't have any idea on accounting practices, because you didn't understand the practices, their culture. Over a period of time, when you're doing audit for 3-4 years, you will understand their practices. Next, communicate significant difficulties encountered in audit. Are there any difficulties that you faced in audit? Communicate. For example, management is not giving you data. Communicate them. Management is putting pressure on you. Communicate them. Management is putting limitations on you. Communicate them. These are all significant difficulties in audit. And if top management and management, if those charged with governance and management are different, communicate significant matters discussed with the management, written representations also you communicate. So you need to communicate generally significant matters, whatever you discussed with the management, whatever significant matters that you discuss with the management, what is the discussion take place, with whom you discussed, what they replied, that entire discussion, share it with the top management. Remember, in this entire standard, here we are discussing matters to be communicated to whom? Those charged with governance. All these matters are something that we need to communicate to those charged with governance. And Further, circumstances affecting form and content of audit report. If at all you want to include emphasis of matter para, other matter para, or you want to give modified opinion, or you want to use material uncertainty related to going concern, MURGC para, you want to modify the audit report. Why are you modifying the audit report? Whether you are modifying opinion, whether you are including emphasis of para, other matter para, other information para, MURGC para, whatever the reason, you are modifying the audit report. Circumstances affecting the form and content of the audit report. Communicate the management. What are the circumstances and any other significant, any other matters which according to the auditor's professional judgment, they require oversight of financial reporting, oversight of top management. That's it. These are the matters which auditor has to communicate. What are the auditor has to communicate? Auditor responsibilities, which he will communicate it through engagement letter, planned scope and timing of the audit, significant findings like entity accounting practices, significant difficulties, significant matters, whatever you discuss with the management, modifications that are there in the audit report, any other significant matter. And in case of listed entity, compliance with independence, that statement you need to give. And you should also discuss with management relationships, all that. You should also discuss with management how much fees you are charging for audit and non-audit. You must also discuss with management. You must also communicate to top management regarding safeguards that you implemented. That's it. And it is you, it is Mr. Auditor, you who is responsible for establishing communication process. You should only establish communication process. The auditor must communicate form, timing and general content. So you should tell the management in what format you will communicate, when and all you will communicate, what generally you communicate. Just give them an idea. Sir, as I'm going through the audit for the next 40 days, next 50 days, next 3 months or 4 months, I will be giving you update on a weekly basis. Just tell them that. The auditor shall communicate significant findings in writing. If oral communication is not sufficient, if at all any significant matter is there, you felt that orally it should not be communicated, then you must communicate in writing. And communication need not cover every matter. You don't have to tell, yeah sir, just today morning I came, just now I had a breakfast. No need to communicate each and every issue. Communicate what you feel required. And adequacy, auditor has to evaluate whether two-way communication is adequate, assess what is its impact on the risk, determine its impact on the obtaining sufficient, appropriate, and take adequate action, appropriate action. You must check whether communication between you and the top management is adequate. You know, if top management and you, there's a proper communication between you, proper rapport is there between you, they will give you information on time, they will give you information correctly. So you must establish a very cordial connection with the top management. And if any matters are communicated orally, please document what you communicated, when you communicated, to whom it is communicated, you know, all that you document. Suppose if mistake is if at all any communication is made in writing to top management, just keep a copy of it, as a part of documentation. That's it. Now, so two-way communication process. So two-way communication process. An effective two-way communication process is important. Why? You know, it benefits auditor. How it benefits, you know, it benefits the auditor. How it benefits the auditor? He will get a benefit. You know, the auditor relies on top management for information about the entity, including the audit evidence. Yes or no? So you will get a better evidence if at all you are communicating with top management. It will help top management also. Those charged with governance in fulfilling their role in overseeing financial reporting process and reducing the risk. If you communicate with them, if there is a proper communication between the auditor and top management, it is helpful for the top management to identify the mistakes at an earlier stage, so that the financial statements are free from MMS. It will help both of them. The auditor and top management together can develop a constructive working relationship to support audit process while maintaining independence and objectivity. So an effective two-way communication is important for both auditor and top management, as well as the auditor, as well as the top management, those charged with governance. That's it. 260 standard is over. See how easy the standard is. So an effective, so what we actually completed, an effective two-way communication, how it is beneficial for both of them, how it is beneficial for auditor, how it is beneficial for top management, how it is beneficial. Who are top management? Those charged with governance, who are they? What are the matters to be communicated, especially independence in case of listed companies? That also be discussed. What is the establishing communication process? That also completed. One more standard over. Pakka 5 marks question possibility on 260. Right now, whatever I discussed in the last 15 minutes, mark my word, Pakka 5 marks question, or maybe a 2 marks MCQ will be there. Whoever have watched this 15 minutes, past 30 minutes, right now you are securing close to 10 marks. Mark my word. Tomorrow after the paper, you come back and see this video. Definitely the question which is tested in exam would have been covered in this. Pakka. That's it. Next. SA 265. What is SA 265? In SA 265, we have totally 5 issues to understand. 5 issues mainly to understand. What is 265? Just 1 minute. I hope you're enjoying. You are getting some clarity on this revision. Next, SA 265. What is 265? Communicating deficiencies in internal control to the management and those charged with governance. Communication to management and those charged with governance. Both of them you are communicating. What are you communicating? Deficiencies in internal control. You are communicating deficiencies in internal control. Communicating deficiencies in internal control to top management and management. Like here you are communicating to two people. Like first of all, what are you communicating? Deficiency in internal control. To whom you are communicating? Those charged with governance, and you're also communicating to management. If it is a significant deficiency, you will communicate it to top management. If it is a normal deficiency, the standard calls it as other deficiencies. The standard divides SA 265 divides deficiency into two types. Significant deficiency, other deficiency. Significant deficiency you communicate to those charged with governance. Other deficiency you will communicate simply to management. Remember, sometimes management and those charged with governance will be one and same. That time you will just communicate to management. That itself is treated as communication to top management. If at all management and those charged with governance are one and same, communication to management itself is equal to communication to those charged with governance. That's it. So now, what is a deficiency? What is a deficiency? Deficiency means what? Deficiency and significant deficiency means what? By the way, before I discuss, what are the points that we are going to discuss in this? First, we are going to understand what is deficiency, what is significant deficiency. How do you decide whether a deficiency is a significant deficiency or not? Somebody is asking smart notes who I'm following goat notes is also there, which is also effective. Yeah, goat notes is very effective. I'm telling you, both are effective. Goat notes is now much more simpler and easy. Now, how do you decide whether deficiency is a significant deficiency or not? What factors that decide significant deficiency? Will there be any indicators like significant deficiency? How do I find? Will there be any indicator symptoms? Yes, symptoms will be there. And how to communicate them? And management letter, LOW, is nothing but letter of weakness. How do you communicate? You communicate them in writing. How do you communicate them? Through a management letter or through a letter of weakness. Remember, management letter is different. Management representation letter is different. MRL is SA 580 written representation. Management letter means 265 letter of weakness. Fine. Anyhow, one by one, let's discuss. One by one, we will discuss. Deficiency and significant deficiency. A deficiency means what? Control is there, but the control is ineffective. Means the control is existing but not operating effectively. It is not preventing fraud. It is not preventing error. It is not preventing or detecting misstatement. The control is there for namesake, but it's not working effectively. That's a deficiency. Or control is missing. There must be a control to prevent an error, to prevent a fraud, to prevent a misstatement, to prevent some misstatements. No, controls must be there. That control itself is missing. Both are deficiencies. A control is designed, implemented, operated where it fails to prevent, fails to detect, fails to correct a material misstatement. A control that is necessary to prevent misstatement, necessary to detect, necessary to correct, that is also missing. A control which is ineffective, which is failing, or a control which is missing, both constitute deficiency. Be careful. Now, significant deficiency. What is a significant deficiency? First of all, it's a deficiency. It's a deficiency in internal control or a combination of deficiencies in auditor's judgment is most important to merit the attention of top management. If I feel some control weakness is there, some controls are not working, some controls are missing, and I want this information, this point top management must know. That is so important that this deficiency merit top management attention. It merit those charged with governance attention. Then the deficiency is called as a significant deficiency. Very simple. Basically, deficiency. Either ineffective control or control is missing. Absence of control or ineffective control. Both are deficiencies. And if I feel this deficiency knowledge, top management should aware of. They must know this. Such a kind of severity it is. Then the deficiency is called as significant deficiencies. How do you determine significance of a deficiency? What is the likelihood of the recurrence? If control is weak or if the control is missing, what is the possibility of occurrence of misstatements? What is the magnitude? How much mistake might happen? If the mistake is very high amount and possibility is very great, then we classify the deficiency as significant deficiencies. Remember, by the way, significant deficiencies might exist. even though the auditor has not identified any mistake. Just because some, say for example, a bank locker, no, the cashier does not put lock to the cash box. Just because he didn't put a lock, can I say that pakka cash theft happened? But if cash theft happened, I can say that lock system is weak. Correct? Exactly. Now, how do you decide whether significant deficiency is there? The matters which auditor may consider in determining whether a deficiency or a combination of deficiencies constitute significant, whether deficiencies are they significant or not. How do I decide? First, likelihood of deficiencies leading to misstatement. Whether this deficiency lead to a misstatement, what is the possibility, what is the chances? How much susceptibility to loss or fraud related to an asset and liability, subjectivity and complexity involved in determining accounting estimates, how much amount is exposed to the deficiency, because of this deficiency amount how much is exposed, volume of activity in that account or transactions which is affected because of this deficiency, how much mistake might happen, how much transaction is affected because of this, and what is the importance of controls to the financial. In control, no, control is ineffective or control is missing. Either the control is ineffective or the control is missing. That is what deficiency, right? What is the importance of that control to financial reporting process, to the financial statements preparation process? What is the impact of this control? Now, especially significance of controls to financial, including monitoring controls, management oversight, fraud prevention controls, controls over selection and application of accounting policies, controls over significant transactions with related parties, controls for transactions outside normal course of business, controls over period and financial reporting process such as non-recurring. These are all various controls. These are all various controls which are significant for financial reporting. They may ask you the 6th point itself for 4 marks question. The auditor has to decide whether a deficiency or a combination of deficiency constitutes significant deficiency or not. Auditor has to decide. While deciding significant deficiency, one of the factors the auditor will consider is importance of control to financial reporting. Give few examples of those controls. What controls are relevant to financial reporting? Example, general monitoring controls, that is relevant to financial reporting. Controls over fraud prevention and detection, fraud prevention detection related controls, controls over accounting policies, controls over significant transactions with related parties, controls over transactions outside normal course of business, controls over period and financial reporting process like non-recurring journal entries related controls. These are all various controls which will impact financial reporting. And what is the importance of these controls? If that control is deficient, I may consider that as significant deficiency. Then frequency of exceptions arising. If this control is not working properly, to what is the frequency of mistakes or exceptions possible? Just 1 minute. Yeah, next. Interaction, how the deficiency interacts with other controls. Don't worry, very simple. I'll simplify this like anything now. What are the factors? 1. This you remember, this you write. They may ask you straight away this main question itself for 4 marks question. This main question, deficiency and significant deficiency, straight away, meaning of deficiency, meaning of significant deficiency, they may ask you. Or what are the factors that decide significant deficiency? So, first point, likelihood of deficiencies leading to mistake. Subjectivity and complexity involved, especially in accounting estimates such as fair value accounting estimates. Amount exposed, volume of activity, and 6. That's it. So 1, 3, 4, 5, 6. These 5 points are enough. The importance of control to financial reporting. These 5 points, main points, that's enough. If at all the question is on matters that affect, matters that decide whether deficiency is a significant deficiency or not. Now sometimes in exam, examiner will go beyond. Importance of control to financial reporting is one of the parameter, right? Importance of controls too. If the control is more important to financial reporting, the deficiency in that control may call it as significant deficiency. What do you mean by significance of controls to financial reporting? Like which controls? Including example, general monitoring controls such as oversight of the management, controls over fraud, controls over application of accounting policy, controls related to related parties, controls per transaction outside normal course of business, controls on period end financial reporting process such as non-recurring journal entries like outstanding entries, prepaid entries, all that. So these are all the various controls which are examples of controls related to financial reporting. So these are all various controls, these are all various examples, various factors which auditor takes into account to determine whether a deficiency is a significant deficiency or not. Next, will there be any indicators? Yes. Mistake is there, fraud is there. That's an indicator that some significant deficiency is there. Ineffective control environment, one of the indicators is ineffective control environment. Our auditor found out a mistake, misstatements are found, Misstatements found during the auditor's process that were not prevented or detected by internal control. We found a mistake. That itself is a proof that yes, some significant deficiency is there. Material misstatements, prior period material mistakes. Okay, some mistakes were there in the current year statement of P&L which are prior period in nature. Therefore, some deficiency pakka is there. Management inability to oversee. Evidence of management inability to oversee. Management is not able to see the financial reporting process correctly, carefully. That itself is an evidence that some deficiency will be there. Yes or no? And finally, ineffective control environment. The control environment is ineffective. Like evidence that control environment is ineffective. For example, management fraud is there. It may be material or not, doesn't matter, but top management fraud is there. That's an evidence that top management control environment is not proper. That's an evidence that significant deficiency is there. Management fails to implement remedial action. Like some, previously we have reported some significant deficiencies. Management does not implement any remedial action for that. Lack of risk assessment process, where it would be practically, generally every company has to do risk assessment on their own. That risk assessment process itself is missing. If that risk assessment process missing means there will be a high possibility that employee will take it granted. Entities risk assessment is entities doing risk assessment, but it is ineffective. Ineffective response to significant. Entity do risk assessment, they identified significant risk, but they're not doing any actions on them. They're not taking any actions on the significant risk they identified. And significant transactions involving management interest. Top management directors are having interest in some transactions. Some transactions are conducted with some partnership firms and LLPs where directors are having major interest. So that itself is one more indicator that significant deficiency might be there, fraud might be there, error might be there. So what are indicators of significant deficiency? Ineffective control environment, auditor identified mistakes, prior period mistakes, management inability to oversee financial reporting process. These are all various indicators. Now in exam, they might ask you this first point itself as a 4 marks. One of the indicator of significant deficiency is ineffective control environment. Give few examples. Evidence of aspect of control environment is ineffective. In this, any 4 points you write. Absence of risk assessment, ineffective risk assessment, management fraud, no remedial actions for the significant deficiencies which they identify. Management fraud is there. Deficiencies which we communicated previously, but no action on them. Risk assessment process is not at all there, or it is there but ineffective. These are all various points. 4 points you should write. Straight away a 4 marks question can come on this. Next. Now communicating. So first we understood what is a deficiency, what is a significant deficiency. How do you decide whether a deficiency is significant or not? Factors. Then third one, indicators of significant deficiency. Now communicating, to whom you should communicate? Communicate in writing any significant deficiencies in internal control during the audit on a timely basis. Communicate to management on a timely basis. In writing, significant deficiencies, communicated or to be communicated to top management. So tell the management that these are significant deficiencies which we want to communicate to top management. That information also give it to the management. And other deficiencies, but not, which are important for management attention, communicate them also. Getting it? That's it. So the auditor must determine based on the work performed whether deficiencies in internal control existing. If so, auditor must check whether they are significant either individually or in combination. If they are significant, tell the management that you are going to communicate them to top management. If there are other deficiencies, communicate to management directly. Both you must communicate in writing. That's it. Now, contents of written communication. Now you need to communicate them in writing, right? That is called letter of weakness, also called as management letter. It is called as both letter of weakness, also it is called as management letter. So the written communication, so description and potential effect. A description of deficiency and explanation. So you should write, sir, in purchases, GRN control is missing, purchase order control is missing, vendor master is updated directly. So describe the deficiency and how it will impact, how a fraud might come, how an error might come, impact. And specific explanation, the auditor must mention in letter of weakness clearly that the purpose of audit is to express opinion. See, what is your objective? Is your objective to communicate all the deficiencies? No. Your objective is to give opinion on the financial statements. And internal control was considered to design audit procedures but not to express opinion on effective. Tell me, are we responsible to give opinion on internal controls? Is that our duty? No, mention that also. Management this is a letter of weakness to top management. In this letter, I am listing out some deficiencies which I identified in the audit. But remember, this is not my duty. My duty is to give opinion on the financial statements. But as a part of the audit, I verify internal controls. When I'm verifying internal controls to plan my audit, I came across some deficiencies. So these are the list. And the reported matters are limited to deficiencies identified during the audit. I need to clearly tell them that whatever I am communicating, they are only those which I identified. They are not exhaustive. In the company, so many weaknesses will be there in the control. I don't know all the weaknesses. Whatever I found out, they are limited to what we identified in audit. That fact also you should communicate. So directly, this itself can be asked as a 4 marks question. Contents of written communication. Contents of written. Adarsh, it's a live ma. Okay, it's a live. Premier, you will find a tag called Premier. It's a live. Okay, fine. So contents of written communication. So description, describe the deficiency. What is the impact? Specific explanation. Mention your purpose of audit and mention that you consider internal control, and also what are all the mistakes, what are all deficiencies you are communicating. It's only you identified. Whatever you are communicating is only you identified. Whatever deficiencies you identified, only you are communicating. You are not communicating full length of all deficiencies in internal control. That fact also you should tell them. That's it. So another 15 minutes, we completed this standard also. 265 is also over. I hope you are clear. Yes or no? So deficiencies in internal control may be identified by the auditor during risk assessment process or some other stage of audit. At any stage you may identify. Yes or no? So that's it. 265 standard is also over. Now look at, so we understood what is a deficiency, what is a significant deficiency. We understood how to decide whether a deficiency is significant or not. Indicators of deficiencies, communication of deficiencies we understood. What is management letter, letter of weakness, what are the contents of letter, what is the contents of written communication. So that you should. That's it. 265 standard is over. You see how easy this chapter is. Then SA 260, SA 580. If these two we finish, this particular chapter will be over. Now, SA 560, subsequent event. Generally, many students will confuse. Subsequent event means those events that are subsequent events are those that occur after the balance sheet date but before the financial statements are approved. That is accounting standard definition. But in auditing standard, the definition is much more bigger. Many students don't know, but right now I don't want to give all the entire backdrop, all that. So I will directly enter into the matter. Just a minute. Yes. Directly. So what is subsequent event definition in audit? Events occurring after the date of financial statements. Date of financial statements means nothing but 31st March. Date of financial statements means the end date of the latest period covered. So events occurring after the date of financials but before auditor's report date. Generally, audit report date and approval of financial statements date will be one and same. Financial statements approval date and audit report date both will be one and same. And most importantly, fact came to the knowledge, fact that became known to the auditor when after the date of audit report. If at all auditor got to know subsequent event information after the audit report date, what to do? So events occurring after the date of financial statements but before the date of the auditor report, and that fact came to the auditor's knowledge after the date of auditor's report. For example, so 31st March is the date of financial statements. 10th June is the date of auditor report. In between, 15 events happen. 14 events are non-adjusting events, whereas one event is adjusting event. And as a part of auditor, before I give audit report, all the 15 events I verified. I also found out that there are only 15 events. I also found out the only 15. Management also found 15. They rectified. Everything is over. Accounting standard 4 responsibility I fulfilled. But I gave audit report, right? Somewhere on 15th June, I discovered 16th event. There is actually 16 events happened during this period between 31st March and 10th June. 16 events happened. But I only know 15 events. But after I gave the audit report, now on 15th June, I got to know 16th event. I got to know another event, which is adjusting event. Or maybe non-adjusting but require disclosure. Material non-adjusting event I discovered now. Remember, this event happened between 31st March and 10th June only. But I discovered it on 15th June after audit report is prepared. What should I do? This is what SA 560 is talking about. SA 560 is not talking about remaining 15 events which you already identified and rectified. They are talking about that event which you identified after audit report is given. Now, the standard talks about two situations. The standard talks about two situations. Just a minute. So the standard talks about two situations. Case number 1, case number 2. 1. You identified after 10th June. 10th June in our example is what? Audit report date. You identified after 10th June. But before financial statements are issued. Financial statements issued means notice date. For example, notice date is 10th August in this company. Let us assume. You identified before, on or before 10th August. Case number 1. Case number 2. You identified after 10th August. What do you mean by after 10th August? Case number 2, events identified after financials are issued to the public. Case number 1, events identified before the financials are issued to the public. Case number 2, event identified after financials are issued to the public. Like what to do in case number 1, what to do in case number 2. That's what they're asking. In one of the recent exam, in Jan exam, I guess itself, in Jan 25 itself, this case number 1 or case number 2, one of this case has been asked as a descriptive question for 5 marks. Be careful. Now, case number 1, sir, I identified event between this period, sir. Like event happened before audit report date only. Event happened during May month only. But I found out that event after 10th June, but before financials are issued. Very simple. Auditor, what you have to do? What you have to do first? Fact identified before the date financials are issued to the public. If a fact came to the knowledge of auditor after the date of audit report, but before financial statements are issued to the public, first discuss the matter with the management. See, financials need amendment. If so, how management is going to amend it? Ask them. Sir, management is amending, sir. They're very humble. They're amending, sir. If management is amending financials, perform procedures on the amendment, whether they rectify financials correctly or not. Extend the audit procedure to the date of new audit report. Provide new audit report on the amended financials. Like financials are amended, right? Now give a new audit report. Ensure that new audit report is not dated earlier than the approval date. See that the audit report is not dated earlier than the revised date. Now you see, originally financials are approved on 10th June. Your audit report is also on 10th June. Now on 15th June or 16th June, you found out one more event. Now you communicated management. They amended financials. Now the financials are amended on 20th June again. Now you are giving audit report once again on 20th June. So you should, now the revised audit report date is 20th June. Be careful. So perform procedures up to 20th June once again. Whether the amendment is correctly there or not, check out. Ensure that new audit report is not earlier than the approval of the amended financials. So new audit report date you will give with the 20th June. Next, suppose management is not amending the financials. If report is not yet provided, management does not amend. Sorry sir, financials are approved. You also give audit report. Why we will amend? They replied like this. The auditor modified the opinion. You take back audit report. You have not yet given audit report, no? Tore that. Give a modified opinion because you found out a subsequent event because of which adjustment is required in financials, whereas the financials are not amended because management is not interested to amend. You modify, you amend the audit report. If report is already given, sir, I already gave management the report, sir. Notify, tell them. Tell the management and top management, those charged with governance, like don't issue the financials and audit report until amendment is made. If unamended financials audit report is issued to the public directly without your consent they issued, you must take appropriate action. Legal opinion we must take here. So this is case number 1. Sometimes no, you got to know about subsequent event. Remember, subsequent event happened before 10th June only. Here, subsequent event happened before 10th June only. But after the financials are issued to the public, you got to know that. Event happened before 10th June. You gave audit report on 10th June. Event is happened before 10th June, but you found out that after 10th August. 10th August is the date of financial statements issued in our example is 10th August. After 10th August, you got to know this. Very simple. First again, discuss the matter with management. See whether financials need amendment. Inquire how management is planning to address this issue. If management is amending, check the following. Perform necessary procedures on the amendment. Like they're amending the financials, they're revising the financials. Remember, here already previous version financials and audit report is given to public. Review management steps to ensure recipients of previously issued financials and audit report are informed of the situation. Management, no, they sent a mail. Dear all shareholders, please ignore the previously issued balance sheet P&L audit report. We are sending revised one. Like that they sent a mail. Then happy. extend audit procedure to the date of new audit report. You know, original audit report date is 10th June. Now the new audit report is 20th August. So up to 20th August, you apply subsequent event procedure and provide a new audit report. And remember, if management is not amending, notify the management, you know, and top management that auditor will seek future. If management does not take any necessary steps, auditor will take appropriate action. That's it. Here, amendment not restricted to subsequent event. This point is not there in India. That is not required. We will discuss in our actual class so full length. This standard we will discuss much more in depth. Just here it's a revision, brief revision. I'm giving you a clarity. That's it. Now this, you know, case 1 or case 2, any of this can be asked. This E point is case 1. This F point is case number 2. Further, this D, what is the audit procedure for subsequent event? Obviously, the auditor shall perform procedures to get an evidence that all events between financial statement 31st March and audit report date which require adjustment, which require disclosure are identified, adjusted, disclosed. The auditor is generally not required to perform procedures on matters that were already satisfactory. You know, what is subsequent event? First, understand what management is doing for identifying subsequent events. Inquire with management and top management about any subsequent events which they identify. Read the minutes of the meetings held after the financial statements date. You know, on this an MCQ has been asked in the recent Jan 25 exam. You know, here they mentioned before. They mentioned before the word. This is actually after. So read the minutes of the meeting after the balance sheet date and inquire whether any matters that were not recorded in the minutes. Read latest interim financials. Review accounting records, budgets and other information after the balance sheet date. Any latest budgets, all that. Latest minutes of the meetings. See whether are there any subsequent events, transactions, events that are happened. Check out. And if auditor identifies any event, yeah, I identified 15 events I identified. See, verify that the events requiring adjustment or events requiring disclosures are appropriately adjusted and disclosed. And the auditor shall obtain written representation confirming that all subsequent events were properly accounted. Get a written representation, get a written declaration from the management that all subsequent events are identified, adjusted correctly. Over. The standard is over. So what is adjusting event and what is non-adjusting event? This itself can be asked as a side question, which is an accounting standard question. I hope you will read this on your own. Okay, that's it. That's it. So with this 560 standard is also over. Main crux of the standard I told. Guys, I told main crux of the standard. So definitions and types of events we understood. Audit procedure for subsequent event, case 1 and case 2. All the 4 issues in 560 we understood. Within 1 hour, we completed 4 standards. What are all we completed in completion and review? 450, 260, 265, 560. Now we are left with in this chapter 570, 580. 570 is already covered in audit report topic. It's covered as part of audit report topic. Now 580. Once 580, if it is covered, we will be completing completion and review topic as well. That's it. Just 1 minute. I hope you are getting clarity like never before. I hope you're able to quickly revise what is there in this subject. Yeah, now we'll proceed. So SA 580 written representation. The standard heading is written representation. Now in this standard we are going to discuss about almost some 7 topics. What is written representation? Can it be used as an audit evidence? Written representation types on management responsibilities. Other written representation. There are 2 types of representations. One is representation about management responsibilities and other representations. Okay, and what is the date of the representation and period? Conclusions and reporting and Under few cases, reconfirmation of representation is required. So what are the matters on which reconfirmation is obtained through written representation? Under what scenarios reconfirmation we will obtain through written representation? Okay, these are the matters which are important in 580. Technically speaking, this is 90% content of the standard, so don't worry. Now let's look at 580. 580. Just a minute. Yeah, so 580, guys, what is a written representation? First of all, definition. Written representation is a written statement. Representation means statement given by management. What are they giving in that? What are they giving through written representation? What are they mentioning in that? They are giving me information, additional information to support my audit evidence. Written representations or written statements provided by management to confirm specific matters or to support other information which I already obtained. I got some information, I got some evidence. To support this, they are giving additional data or they are confirming me something. They do not include financials, assertions therein and supporting records. Books of accounts and financial statements are also in writing, right? They are not representation. For books of accounts and financials, inside that some content is relating to that, management is giving me additional information. That's written representation. Books of account is not a written representation. Balance sheet P&L is not a written representation. But for balance sheet P&L, some matter is there. In books of accounts, some matters are there. On that, additional data company is giving me, management is giving me in writing. That's a written representation. Now, can written representation be used as an evidence? Of course, it's an important source of evidence. Audit evidence includes all information which auditor is using. Written representations are considered as audit evidence. It is a necessary source of audit evidence. And if management modifies or refuses, if at all management is not ready to give, it's a significant issue. It's a limitation on the auditor. And remember, written representation alone does not provide sufficient appropriate evidence. It is not a sufficient appropriate. Written representation is no doubt an evidence, but they do not provide sufficient appropriate. Sir, why written representation is necessary? Why in writing is necessary? If at all we ask them in writing, it will prompt management to consider the matter more seriously. Since I'm asking in writing, they will take it more seriously. They don't casually reply. In writing, they will reply very carefully. And written representations do not provide sufficient appropriate on their own. Only written representation is not sufficient. You see, subsequent event, just now we saw. We review latest interim financials. We review, budgets and all happen later on. We inquire management about subsequent events which they identify. So many works we do. And finally, we will ask written representation. Written representation is only confirmatory in nature, finally substantive, like it's only supporting in nature. That is never a main audit evidence, but that is also important evidence. Remember. Next, objective of the auditor. The auditor has to obtain written representations, okay, confirming that management and those charged with governance fulfilled their responsibilities. What are the responsibilities of management and those charged with governance? Preparing financial statements, providing information to the auditor. Two responsibilities. One, preparing financials and providing information to the auditor. Both they need to fulfill. They fulfilled or not? Ask them a representation. Yes, sir, we fulfilled, sir. We prepared financials as per applicable framework. We provided the auditor with complete information. Get a representation. And the auditor shall also obtain other representations. Other representations means what? If determined by auditor felt it is necessary. Some cases no auditor want written confirmation from management. There you can obtain, or required by other standards. For example, just now we saw in SA 560 standard is saying the auditor please obtain representation that all subsequent events are identified, adjusted, disclosed properly. So since 560 says I will get representation. So I will get written representation on fulfillment of responsibilities by management. I will get representation on completeness of information disclosure to the auditor. I will get representation wherever I require. I get a representation when other standards on auditing also requires it. 4 circumstances I will get written representation. And okay, you got representation. What you will do? I will respond to the whatever information they provided. They gave me I asked for some information. They gave me. Now I will respond. I will see that and then accordingly I will respond. Okay, sir, thank you, something like that. And if management does not provide, there I will respond with my modified opinion. If management is not giving me requested representation, I will modify. For example, I will directly go to the conclusions and reporting, the last section of the auditing standard 580. Suppose I'm asking a written statement, written declaration I'm asking from the management. They are not providing. Management fails to provide requested written representation. Ask them, first discuss with them, reevaluate the integrity impact. Take appropriate action, including disclaimer of opinion. See, if representation they're not giving me evidence. Absence of evidence means I'm unable to form the opinion. So I may give disclaimer of opinion. Written representation not they gave, but it is fake. They are giving me completely wrong statements. If auditor has concerns about competence integrity, or written representations are not consistent with other audit evidence, I have a doubts on management's eligibility, competence, I have a doubts on their integrity, I have doubts on their ethical values, I have doubts on their carefulness. They carelessly give written statements. If I feel written representations are inconsistent with other information, if I feel management is not competent, not with integrity, not with ethical values, then I will perform some processes to resolve the matter. If at all still not resolved, I will once again check, are they honest and competent, and I will check reliability of other represent. They gave all these some other representations, no, that reliability also I will check, and I will take appropriate action, including disclaimer of opinion. If representation provided by them is not reliable, why are they not reliable? The person who gave this statement is incompetent. The person who gave this statement is unethical. The person who gave this statement is not matching with other information which I have. In all these cases, I will try to resolve the matter. If unresolved, I will try to assess that impact on the overall audit. I will try to assess management's integrity, all that. And I've already, they gave so many representations, right? What is their validity? I will once again check, and I finally give a disclaimer of opinion. If requested representation not provided, or provided which is not reliable, unreliable evidence, or non-provision of evidence, in both the cases I may give a qualified opinion, or worst case disclaimer of opinion. Because if representation is not available, representation is not reliable, both leads to absence of evidence. If evidence is not available, I may give modified opinion. Next, so that's about conclusion and reporting. What is the date and period covered by representation? Date of representation, it must be near to audit report date. Written representations must be dated as near as possible to the date of audit report, as near as practicable to the date of audit report, but not after that. Evidence and all you must obtain before audit report date. After audit report is given, what is the point of getting representation? So since written representations are necessary evidence, you cannot express opinion before receiving them. Therefore, auditor has to receive representations before the audit report date. For what period? Representation they'll give. For which period? In audit report, what period I'm giving opinion? You are giving opinion on 1 year, then for that year related information. So written representation must cover all periods in the audit report. Getting it? Sometimes this question was asked in CA final once for 4 marks or 5 marks question. Sometimes I'm asking representation from CFO. Sir, give me declaration that you gave me complete information. CFO told me, sir, I just joined last month, sir. I am not there full year, sir. How can I give representation? Because I don't know. He cannot argue that. He is going to sign the financial statements, right? Then he has to give representation. If current management was not present during earlier period, they may claim that they cannot provide representation for that time because they are not available. This fact does not reduce their responsibility. They must provide representations as a whole. Accordingly, the auditor can request representation from the concerned management, whoever is present right now. So that's date and period of representation. Very important. Straight away, a 4 marks question straight away. Conclusions and reporting, a 5 marks question straight away might come. Further, written representations are 2 types broadly: management responsibilities and others. What is other representation? Other essays require the auditor to request. Like other representation means as per some other standard I may require, or if necessary the auditor may request additional representation to support other matters. So written representations are 2 types. Brain 1, fulfillment of management responsibility, that's one general representation. 2, representation about other representations when some other standard is requiring, or when auditor himself felt necessary. For example, these representations are supplementary representations. These are supplementary representation and do not form part of representation relating to management responsibility. What are the examples of supplementary? They may ask you directly in exam. Write about written representations other than management representation, other than management responsibility. Write about written representations that are dealing with the matters other than management responsibilities. Example, these representations are supplementary representations. For example, auditor may ask representation on application of accounting policies. Auditor may ask representations regarding assets and liabilities and valuation. Auditor can ask representation on title deeds, liens, encumbrances. Auditor may ask representation regarding compliance with laws, regulations. Auditor may ask representation on subsequent events. Auditor may ask representation on going concern matter. Auditor may ask representation on related party transactions. Any of these are all supplementary representations. That's it. Next, You know, reconfirmation of responsibilities through written representation. Actually, responsibilities management will accept through letter of engagement. Through letter of engagement, management will accept responsibilities. But there are some cases where through a written representation, we will once again get their reconfirmation. Sir, please give me once again, you are accepting all the responsibilities. Sir, I already gave in engagement letter, then that is okay. Suppose no, those who signed engagement letter no longer hold the relevant responsibility. The person who signed engagement letter and now who is responsible for financial reporting, both are different. Get from the latest person once again that, sir, you are accepting your responsibilities. Give me once again. The terms of engagement were prepared in last year. Last year or that before year, I prepared letter of engagement. This year I didn't prepare. So I can once again ask from the current management, please once again give me a confirmation that you still remember your responsibilities. There is an indication that management misunderstood their responsibility. I somewhere felt when I'm doing audit, they misunderstood the responsibility. So once again, through written representation, I will ask them to confirm their responsibilities, and circumstances of change making reconfirmation necessary. Straight away, they may ask you very important question, 4 marks or 5 marks question. So the auditor may ask management to reconfirm responsibilities to written representation. See, actually, management will acknowledge, management will confirm its responsibilities through engagement letter. But there are some cases where they will once again reconfirm their responsibilities, that too through written representation. See, management responsibilities, they always confirm through engagement letter. But here, they are reconfirming through representation. One, when those who signed the letter of engagement is no longer responsible, no longer existing. The terms of engagement are prepared in the previous years, or there is an indication that management misunderstands its responsibilities, or circumstances have been changed, making reconfirmation necessary. Finally, the one part, written representation about management responsibilities. Management must represent that it has fulfilled its responsibility for preparing financials in accordance with framework. Management has to give a specific representation that yes, they prepared financial statements as per applicable framework. You know, and the auditor may request management to include representation to provide, you know, accurate representation. Management may seek input from others. See, when they are giving representations on management responsibilities, you know, sometimes they may take help of others, actuaries, engineers, all that. So that's it. Sometimes no, management may use qualifying language like to the best of knowledge and belief. You can accept this if at all the person who is giving representation is a knowledgeable person. A knowledgeable person only can use the word to the best of my knowledge and belief. Others cannot use it. That's it. And management shall also provide representation about completeness of information provided to the auditor. Management must give a statement that it has provided the auditor with all information and access as agreed in the terms of engagement. Management must represent that all transactions were recorded and reflected in the financials. So management has to give a representation that they prepared financial statements as per applicable framework. Management has to give a representation that they provided information completed to the auditor. Management has to give a representation that all transactions were recorded correctly, and management also shall give other representation supplementary in nature wherever auditor has requested. Next, that's it. With this 580 standard main theme is completed. From whom you get the representation? The auditor shall request representation from management who have appropriate responsibilities for financial statements and having knowledge of that matter. Written representation related to fulfillment of management responsibilities, all that, you know, from whom, where auditor believes they have knowledge of the matter, who are responsible for financials. Generally from them only we will get the written representation. That's it. With this, entire 580 standard is over. Actually, there is so much of in-depth discussion on the standard and all, but since it's a revision class, I need to save your time. So the crux of the standard I told you, I assume that you already know the subject. Okay, that's the reason I'm not talking many logics here. I'm only revising you in a simplest way so that you understand. That's it. Okay, with this, the chapter completion and review is completed. All the 5 standards I completed within 75 minutes, 1 hour 15 minutes we completed. That to be discussed each and every concept. We didn't skip any concept. 90% of the concepts we covered. I hope you're happy with the revision, and I'll be very happy if you share your feedback on, you know, through comments, all that. That's it. All the very best. We'll come with another revision, okay, for another topic, audit evidence topic. That's it. uh, Hi guys, I hope the live is very clear to you. Hi guys, perfect. So we'll proceed. So guys, now we are going to revise another chapter called audit evidence. This audit evidence has totally these many concepts. Approximately we have 8 standards, and we also have 2 different concepts, something like concept of assertion and concept of audit trial. So what I am going to discuss, whatever I have ticked in green, that we are going to revise it now. So we are going to revise approximately 6 topics, like 4 standards we are going to revise and 2 different topics I'm going to revise. 4 standards I'm not at all touching in this revision. 500 I'm not touching, 520, 530, 610. They are equally important here. But in a revision class, I'm only covering these topics. These, whatever I'm not highlighting, whatever I strike off, that I'm not covering in the revision session. Okay. So actually I'm running very tight in terms of time, but it's okay. In the previous session also I told you tomorrow we are expecting a second baby. So but still in spite of that schedule, since I promised a day before exam revision, I'm taking it up. Already close to 4 hours I already gave. Yesterday I gave some 2.5 hours revision, and today morning also I gave 1 hour 15 minutes revision. Now this is another 1 hour 15 minutes it's going to be. So already 4.5 hours revision including this. Again, items of financial statements I will give guidance. In respect of items of financial statements, I will give guidance on that. How to read in items of financial statements, what to read exactly, what many students miss in that chapter, that also I'm going to cover. Now, without any delay, let's enter into the topic. 501, 505, 510, 550, concept of assertion, concept of audit trail. These are the 6 topics that we are going to discuss now. Now, first one, 501. See, many students, when they see 501, 505, they think there are nothing. There is no simple standards. They're all nothing. Where nothing is there in that. But when they see the question in the examination, they will think of like, where is it coming from? So that's how the students generally, like, they will be shocked to see the kind of questions. So don't take these standards as a simplest standard. They are all very complex standards, and let's decode that. Let's revise each and every complex part of it. Now in 501. What is 501 standard is talking about? 501 talks about, the heading is this: audit evidence, specific considerations for selected items. Audit evidence, specific considerations for selected items. Now the standard has selected 3 items: inventory, litigations and claims, segment information. The standard has selected 3 elements. One is inventory. Just a minute, let me open that. So the standard has selected totally 3 elements. One, you see I have highlighted with the black color here: inventory, litigations and claims, segment information. 3 were selected. Now what we need to consider, because here the standard says specific considerations for selected items. Selected items we saw. Specific consideration what? For inventory, you need to get evidence on existence and condition. Whereas for litigations, you need to get evidence on completeness of litigations and claims involving the entity. Whereas for segment information, you need to consider presentation and disclosure. So for inventory, existence and condition, you need to get evidence. For litigations, completeness of disclosure of litigations and claims. Even for litigations and claims also, they are mainly talking about disclosure. For segment information also, they are talking about presentation and disclosure. So with respect to inventory, we should get evidence on existence and condition of the inventory. With respect to litigations and claim, completeness of inventory. With respect to segment information, presentation and disclosure. Now directly, first let me go to segment information, which is the simplest one. Segment information. So what auditor has to get evidence about? What auditor has to get? In the recent Jan exam also, segment information, I think this question, understanding of management methods, has been asked. Okay, fine. Anyhow, segment information, we know it refers to details about different products and services of an enterprise. Yes or no? Where are and its operations in different geographical areas. So what is the audit evidence? The auditor shall obtain sufficient appropriate evidence regarding presentation and disclosure of segment information. So every company will present segment information, right? How are they presented? How are they disclosed? Whether are they in accordance with financial reporting framework? That is what we need to obtain evidence. So we need to obtain evidence on segment information, whether the segment information is presented and disclosed as per applicable framework. Suppose if the company Ind AS is applicable, as per Ind AS, segment information presented clearly or not, you need to get evidence. Now, in order to get this evidence, what you need to check? See, segment information, I hope you might have understood. There are some methods on identifying segments, identifying reportable segments. Some methods were there. So understand management methods for determining segment information. So management would have followed some methods, right? Management would have implemented some methods, right, to identify reportable segments. What methods they used, whether test those methods. Like test, management would have told some asset method, profits method, revenue method, some method. Test them. You also find out how many reportable segments came and see what segments they reported, what are reportable segments, whether matching or not. Perform analytical and other procedures as necessary. Analytical process means last year how many segments were there, this year how many segments were there. If any segment was discontinued, discontinuing operations requirement and all, you should check. The auditor is not required to give separate opinion. By the way, just because we are checking segment information, are we liable to give any separate opinion on segment reporting? No need. This is one of the selected items which the standards on auditing felt important. One of the important items. They just asked us to get sufficient appropriate evidence on presentation and disclosure of segment information. Now, you need to understand methods which management used, right? When you're understanding the methods, there are some matters which are relevant when you're understanding the methods used by management. Whatever methods management used, testing methods we call them as methods for identifying reportable segment. Okay, whatever methods they're using, when you're checking those methods, keep in mind the following matters like sales, transfers, inter-segment transactions and eliminations, comparisons with budgets and expected results, allocation of assets and cost among the segments, consistency with prior period, adequacy of disclosure. This itself can be asked as a 4 marks question, or write about audit evidence for segment information. This itself can be asked as a 3 or 4 marks question. That's it. So this is one segment. This is one part in 501. Now, another important one, litigations and claims. What is the audit procedure regarding litigations and claims? First, what auditor has to do here? Auditor, what is the auditor's objective here? The auditor has to obtain sufficient appropriate evidence whether the impact of pending litigations and claims of the entity, were they completely disclosed or not? Completeness they need to. Yes or no? So, yes, next. Audit procedures for litigations, audit procedures regarding litigation and claims. Litigations and claims may materially affect financial statements and require disclosure or accounting. Okay, fine. Audit procedure. What are the procedures to identify? Enquiry of management and in-house legal counsel. This is most important. Straight away they can ask as a 4 marks question. Audit procedures for litigations and claims. First to know, enquire management. Dear management, what are all the litigations were there? What are all the pending cases were there against the company? Not only management, enquire in-house legal counsel. Some large companies and all, they will have internal legal team. So ask them. Review minutes of top management. Review correspondence with external legal counsel. Review legal expenses account. Like here you see minutes of the top management meetings to identify are there any litigations which they covered. Look at correspondence with external lawyers. So through this correspondence, the auditor might discover any other pending cases against the company. Review legal expenses account. Legal expenses means what? Ledger account will be there. For what are all purpose legal expenses were incurred to check out. Through that, you may discover some pending cases against the company and use risk assessment insights. The company would have already performed risk assessment, right? So get those insights. These audit procedures may also provide evidence regarding valuation or measurement. When you're checking, when you're checking existence of litigations, you may also get evidence regarding valuation. Getting it? That's it. Next. Sometimes direct confirmation is important. Direct communication is important with the external legal counsel. Sometimes direct communication. So when to seek direct communication? Actually this was asked for 3 marks question. And procedure for direct communication, like when to seek direct communication, what is the process for direct communication? These two put together, they might ask as a 4 marks question. Be careful. When the auditor will get this is one item. There is another context. When meeting external counsel, see one point is direct communication with them. Like we don't meet, you send a direct communication. SA 505, you just send an external confirmation. When to do that? There are some cases where you want to meet them. When to meet them? For example, in certain cases, the auditor may judge it necessary to meet external legal counsel. For example, matter is a significant risk. So on the matter where auditor is checking, he felt that significant risk is involved and the case is being handled by external lawyer. So he may decide to meet them. Complex matter exists. disagreement between management and legal counsel. Some issues going on between the management of the company and the legal counsel. Some issues going on between them. There is a conflict going on between them, or disagreement is there. I want to get a clear picture about what exactly the litigation is about. Then I will meet external legal counsel. In exam, they will ask you, under what? They have asked once more, under what circumstances the auditor may require to meet external legal counsel in certain circumstances, in the following circumstances: when there is a significant risk, when the matter is complex, when there is a disagreement between management and legal counsel. In all these cases, the auditor may meet external. But remember, even if you want to go for these meetings, management's permission and management representative attendance is must. You can't directly privately contact external legal counsel without management's authority. So you must tell specifically to the management, get their permission, and go and meet to the external lawyers. And make sure that one of the representative of the management is also there along with you when you're meeting external legal counsel. This is meeting. Sometimes you want to send confirmation. When you will send direct confirmation, when you will directly communicate with them, when the risk of MMS is identified. If auditor felt that some MMS is possible in litigations and claims, you felt that company is omitting some material litigations, or audit procedure suggests some other litigation might exist. When I'm checking one case documents, I felt that this will have few more implications, few more cases also possible. Okay, you felt that. So you want to get a clear-cut opinion of the lawyer. So that time also you can communicate with external legal counsel. Now, suppose you want to do communication, right? How you can do communication? Through general letter of inquiry or through specific letter of inquiry. Letter of general letter of inquiry, letter of specific inquiry. What is general letter of inquiry? Very simple. General letter of inquiry, how I will send, I will draft mail like this: sir, we are the auditor of so and so company. So we understood that you are the lawyer of the company. Kindly let me know what are all the cases that you are dealing with the company, and give a list of it. Like that, I'm generally asking him. I am not mentioning him which case he is dealing at, case names and all. I'm not talking. I simply mention I'm auditor of the company. Please give me list of cases that you're dealing. That's a general letter of inquiry. Many lawyers, they don't respond to a general inquiries like this. Now, if a lawyer is prohibited from responding general inquiries like this, then you will specifically ask them, like specific inquiry. In case general inquiry, it is unlikely that external legal counsel responds. Like external legal counsel, they don't respond for general inquiry. The auditor shall use a specific inquiry, and in that letter, mention the list of litigations and claims, management's assessments of the outcomes. Sir, these are the list of litigations which management told me that you are dealing. So, dear Mr. Lawyer, you are dealing 10 cases about this company. For this company, this is what management told me, 10 cases. 5 cases, they said contingency in nature. 5 cases, provision is what they mentioned. So, request them. Request the lawyer. Confirm management's assessment. Like 10 cases you are dealing, sir. 5 cases like this is the status. 5 cases, this is the status. This is what management told me. Please confirm me whether management assessment is correct or not. So specifically mentioning list of cases and then sending them and asking them to confirm. This is specific inquiry where many lawyers will be willing to respond. So request that external legal counsel confirms management assessment and provide further information to the auditor if the list is incomplete or incorrect. So I will tell them, sir, these are the 10 cases which you are dealing. This is what company management told me, and the status of these 10 cases are as below. Like this is what management told me. Please confirm whether this 10 cases information correct or not as per your records. Also tell me if any of these cases not there, or if any other additional cases are, please give me. This is a specific inquiry. General inquiry means what? Through a letter of inquiry, ask external counsel to directly communicate with the auditor. If direct communication with auditor is prohibited for the ELC, external counsel, then perform alternative. What is the alternative procedure? If at all for a general inquiry, if legal counsel is not responding, then I will send a specific inquiry. Are you clear? So I hope now I don't know how many of you know this extent, know this depth that is there in the standard. SA 501, when they say nothing, very simple standard, inventory litigations. This is the depth of the standard. I hope now you are able to understand. Okay, so in exams, no, they once specifically asked about letter of specific inquiry. In one of the exam they asked. In one of the exam they specifically asked about when meeting external legal counsel is required. In one of the exam, under what circumstances direct communication is required. This is asked for 2 marks and this is asked for 2 marks. Like this also they might ask. So be careful. Don't take it granted. The subject auditing is very in-depth. You must know how depth the questions will come. This is the syllabus. This is what there in the ICA book. Many students don't even know that this much depth is there. That is why they fail in audit. Many students fail in audit not because they are not able to understand the subject. They don't even know syllabus what it is. They don't even know how much is there in, how much depth is there in the standard. That's it. You know, this was asked in one of the attempt. This was asked in one of the attempt. This was asked in one of the attempt. You can go and check in our question bank we gave. So be careful. Next, finally, now coming to inventory. So with respect to inventory, what auditor has to obtain? You must obtain sufficient appropriate evidence regarding existence of inventory and condition of the inventory. For example, here one point I will tell you. You know, company inventory is there in one godown. Auditor, no, he did not visit the godown. Instead of that, he saw existence of inventory through CCTV camera. So through CCTV camera, through photographs and all, he saw inventory whether they are existing or not. Is this a correct audit procedure as per 501? This is how a question has been asked in CA final. This is not correct. Through cameras and all, you may get evidence on existence, but you don't get evidence on condition. Sometimes MCQ will be asked. You know, when auditor is attending physical inventory counting, he need to obtain evidence on what? Option A, existence and condition. Option B, valuation and condition. Option C, valuation and existence. Option D, existence, condition, and valuation. Option A, only existence and condition of inventory. You know, valuation of inventory, whether correct or not, accounting standard is already there and we verify accounting standard. So we are not bothered about valuation. We are bothered about existence of inventory. Is inventory there physically, first of all? If it is there, in what condition it is there? Condition of inventory is important for valuation of inventory. If the inventory is in damaged or obsolete condition, then it is valued always at NRV. If the inventory is in good condition, then it is valued at cost or NRV, whichever is lower. Remember this principle. So condition of inventory is most important. So if you want to know condition of inventory, how can you check condition through photograph? How can you check condition of inventory through CCTV camera? You can't. So that is not an adequate audit procedure for 501 purpose. So what 501 says, you must obtain sufficient appropriate evidence regarding existence and condition of the inventory. For that, what auditor has to do? What is the audit procedure for obtaining evidence on existence and condition of inventory? The audit procedure is very simple. Attend physical inventory counting. Simple. Auditor attendance at physical inventory count. What he will do by attending? Evaluate management's instructions and procedure for recording and controlling. Look at what management instructions are. Look at how they are recording and controlling the counting. Like how are they counting it? What instructions management gave for counting? So whether are the counting procedures correct or not? First to look at. Inspect the inventory. Observe the count procedure. How are they counting? What management? First to look at the management instructions for counting. So, okay, management instructions and all seems logical. 2. Observe how they are counting. Are they counting as per management instruction? Check out. 3. You also inspect the inventory and you also perform test count. Like employees of the company will be counting and telling numbers and all. You also go to that rack and see whether that count is matching or not and reconcile with records. Physical counting is there, right? That count matching with the records or not. Inventory records will be there. Verify whether entity final inventory records accurately reflect the physical count result. And now when you are attending at physical inventory count, you need to inspect inventory for existence and condition and perform test count. Observe compliance with management instruction. Obtain audit evidence about reliability of management procedure. These procedures may be either a part of control checking or it may be part of substantive. So when you're attending physical inventory counting, the process of you're observing all this, right? This may be part of test of controls or this may be part of test of details. Anything it may be part of. Now matters relevant for attendance when you're thinking to attend physical inventory count. Suppose you decided to attend physical inventory count. There are some points that you should keep in mind. Like what is the nature of inventory? Is it a gold? I mean, if it is a jewelry business, it's a gold. Is it cotton or is it rice product or is it any industrial iron or oil? What exactly? What is the stage of completion of work in progress? What is the risk involved? Internal control system, whether proper procedures and instructions are given for counting, timing, when they are counting, 31st March or some other data, location of inventory, materiality and risk at different locations, need for an expert, whether entity using perpetual inventory records. So what are the matters relevant for attendance at inventory counting? 5 points. There are so many points, but there any 5 points you write, that's sufficient. Sometimes no. Company may not be doing inventory counting on 31st March. They might be doing inventory counting on some other date. What procedures extra you need to perform when inventory counting is at other than balance sheet date. If physical inventory counting occurs on a date other than financial statements date, then auditor has to perform additional procedures. Same, the above procedures you will perform. You will check management instructions, you will check how they are counting, you will test check inventory, you will inspect the inventory, all that you will do. In addition to that, since inventory counting is conducted at April month or May month, not on 31st March, intervening between these dates, what are all the transactions happen, whether they are properly recorded, auditor must perform additional procedures to ensure changes in inventory between count to date. For example, counting is on 15th April and balance sheet date 31st March. Are they properly recorded or not? I will check. So on 15th April, if inventory physical inventory matching with records, perfect. Now between 31st March and 15th April, what are all inventory movement is recorded, whether that is proper or not, check out. Then automatically you will get an evidence on 31st March inventory. Next, relevant matters auditor should consider to verify changes in inventory, whether perpetual records are maintained, reliability of perpetual inventory records, reasons for differences between physical count results and perpetual records. So this itself can be asked as a straight question, 4 marks question. What are the additional audit procedures if inventory counting is performed at a date other than date of financial statements? The auditor has to perform additional procedure to see that changes in inventory between the count to date 15th April and 31st March are properly recorded. And next, second one, additional procedures, especially to verify changes in inventory. They said, right, to verify changes, no, additional changes in inventory has been correctly recorded. And how do you verify, how do you know changes are correctly recorded? See whether perpetual inventory records are properly adjusted. For 15 days, whether perpetual records are adjusted correctly. Reliability of those records. How do I know perpetual records are reliable? I will see the actual transaction. Whenever an order is received, first records are updated, then goods are delivered. Like that. Reasons for difference, if at all, there between the physical count and perpetual records. Remember, in a perpetual system, physical inventory must match with records. There should not be any difference. If there is a difference, why there is a difference? Auditor has to investigate. So this itself can be asked as a 4 marks question. Sometimes, auditor may not be able to attend inventory. But before this, let me talk about when inventory is in the control of third party. Let me talk about inventory under the control of third party. Inventory under the control of third party. If inventory is under custody and control of third party, for example, inventory in transit, inventory with a job worker, inventory with another company, goods sent on sale or return basis, inventory lying with warehouse, Amazon warehouse. For example, many sellers, many manufacturers, their inventory will be lying with Amazon warehouse. Their inventory will be lying with Flipkart warehouse. Like that. Okay, so if at all inventory is with third party and is material to the financials, the auditor must obtain sufficient appropriate evidence regarding their existence and condition by following methods. 1, direct confirmation from third party about how much quantity he is having, what is the condition, or another process. Directly you go and inspect or perform other procedures. You inspect or perform other procedures appropriate. Sir, what are other procedures, sir? What are other procedures, sir? Examples of other procedures. In one of the exam they asked this. MCQ they asked in one of the MTP. Which of the following is not an example of other procedure? See, when inventory is with third party, auditor may perform either one of the following or both the following. 1, get a direct confirmation regarding quantity and condition. 2, perform inspection. You go directly inspect, or other audit procedures as appropriate. Other audit procedures means what? 4, inspect documentation such as warehouse receipts regarding inventory held by third party. Like, what is the proof that inventory is with third party? Request confirmation from other parties if inventory is pledged as collateral. Attend or arrange another auditor to attend third party. Obtain a report from another auditor or service audit report on adequacy. So inspect documentation such as warehouse receipts. Request confirmation from other parties. Attend or arrange another auditor to attend third party count procedure. Obtain report from another auditor or service auditor report. Suppose if the company inventory is kept in Amazon, Amazon will give an audit report, service auditor report. There is a report called 3402, SOC1 report, SOC2 report, like that some reports and all were there, which we will discuss in CA final. So when inventory is with other third party, request confirmation, directly go and do inspection or other procedures. Other procedure means what? Like, check the documentation. Request confirmation from other parties if inventory pledged as collateral. Attend third party physical count procedure. Third party is doing physical counting, right? Go and attend or send somebody else, or get a report from another auditor or service auditor on adequacy of third party internal controls over inventory. So get an evidence on counting, inventory controls, attend physical inventory counting done by third party, inspect documentation, or if the inventory is pledged as collateral, get a confirmation from them. These are examples of other audit procedures. In exam, they will ask you specifically this question, 4 marks. Our students will go and write some answer and come and thinking that that is right answer. But see how specific the standard is drafted. That this is the kind of clarity that you require. See, since it's a revision class, I can't give more, I can't discuss more, but still I'm almost from past 20 minutes I'm discussing this. Now, finally, sometimes auditor may not be able to attend the inventory. Suppose companies counting inventory on some other date, and on that date you are unable to attend. In such a case, if auditor is unable to attend physical inventory counting due to some unforeseen circumstance, then conduct or observe inventory count on an alternative date and perform procedures on intervening transactions. Suppose if inventory counting is impracticable means what? You can't go there at all. Auditor, there is a threat. If attendance at physical inventory counting is impracticable, then the auditor has to obtain evidence on alternative procedures. Modify the opinion if alternative procedures are not possible. Impracticality may arise due to nature of the inventory or location of the inventory, such as safety concerns at the site. By the way, what is not impracticality? Auditor is feeling difficult to go there. Auditor feel time waste. Auditor saying, no, inventory counting is costly. This is not a reason for impracticality. General inconvenience is not a valid reason. Now, what are the alternative procedures? Look at the documentation of subsequent sale of inventory. Suppose you can't go to the location of inventory because inventory location is at some location where war is happening right now. So it is not at all advisable for the auditor to go there. So it's impracticable. But how do you know inventory is there at that location? See, April month, May month, some sales were there from that godown. Sales were there means in the godown inventory is physically there, right? So that is called subsequent sale. Perform other valid procedures if practicable to verify existence. If evidence cannot be obtained, sir, alternative procedure also not possible, sir, then modify the opinion because there is a limitation on the scope. You are unable to obtain evidence regarding inventory you're lying in the godown, and you are unable to perform alternative procedure also. Therefore, you will directly give the modified opinion. That's it. 501 is over. I hope you are confident on 501. You see how much is there in 501? Let me show you the similar thing in 505 also. Like there's so many students have misconception. 501 very easy, 5 minutes or 10 minutes. 505 very easy, 5 minutes or 10 minutes. No, there are all so many complex things were there. This is how in exam they test. Even in 505 I will tell you how they tested in the recent exams. Now that's it. So with this 501 is complete. I hope you are clear on 501. Just a minute. I hope you learned some new points. Just a minute, ma. Next, yeah, SA 505 external confirmation. This is one standard where everybody thinks I know everything about the standard, but I will show you so many points which I think you might have neglected. Don't worry. External confirmation means what? Direct confirmation by auditor with the third party. Okay. Now, what many students think is external confirmation is what? A PCR will be there, positive confirmation is there, negative confirmation is there. That's it. No, that is very minimal. That's a very basic element in the standard. There are many things which are tested in the past exams, okay, which many students fail to pay attention. Now look at external. What's an external confirmation? Audit evidence which is obtained as a direct response to the auditor from a third party. From a third party, auditor is getting direct response, okay, to the auditor either in paper or electronic form, whatever it is. So then that is called as an external confirmation. Okay, like what is external confirmation? First, what is the external confirmation procedure? Where and all I use external confirmation? External confirmation procedures are generally used to confirm or to request information about some account balance and their elements. They can also be used to confirm terms of the agreement, contracts, transactions, absence of the conditions like side agreements. Are there any side agreements and all? Okay, so external confirmation can be used for confirming or getting information about account balances, their elements, transactions, terms and conditions, anything. Now, what is the procedure? First, identify the information. What is the external confirmation? First, identify the information. For what information you want confirmation? Sir, creditor, sir. I want information on creditors. I want information on debtors. I want information on inventory lying with third party, sir. Okay, identify the information. Now select the conforming party, appropriate conforming party. I know third party organization is there, but inside that who should reply, from whom you, to whom you should ask this confirmation? Accountant, finance manager, CFO of that company, who has to? So responses are more reliable when external confirmation request is sent to a party where auditor believes is knowledgeable about the information. So according to me, he knows in that organization, in that creditor organization, debtor organization, so and so manager, accounts manager knows about the information which I want. So then identify that party, you know. Then design the request. Design the request. You know, when you are designing the request, there are some factors. This itself was asked as a 4 marks question. Request, the external confirmation request must be properly addressed, and you must also include written information for direct response. When you are sending a mail, no, you should clearly tell to whom they should reply. Reply mail ID also you should clearly mention. Okay, now the design of confirmation request affects the response rate and reliability. How you are designing that affects response rate and reliability. You know, see, you need to make sure third party job simple. When you are designing the request, no, you fill the amount, you mention everything and tell them, sir, please, whether you agree or disagree, you just reply. You know, there are two types of designs. There are two design formats. External confirmations are broadly two types. There are two methods: positive confirmation request and negative confirmation request. In a positive confirmation request, third party has to respond whether he agree or disagree with the information. Whereas in a negative confirmation, the third party will respond only when he disagree. Now here, no, when you are designing the request, no, see, it may be positive or it may be negative. When you are designing the request, no, in a positive, no, how will I design? You know, sir, I am the auditor of so-and-so company, sir. In our company, your account is having a credit balance. Means he is a supplier. Our company has to pay him. So in our books of accounts, we found out that we are liable to pay you 10 lakh rupee as on 31st March. Kindly reply whether in your books of accounts, how much balance is there. I will ask him, sir, how much balance is there in your books of accounts? I will put a blank and then send him. Send. Some third parties, no, they will not respond if you ask them to fill the amount. If you ask them to fill the amount, they will not respond. Suppose you ask them, sir, 10 lakhs is there in our books of accounts, sir. Will you agree, yes or no? Just tick and send me. They may respond. This is a designing. See, here also, you see, positive confirmation request, no, it can be with a blank or it can be with a number, and where we may ask him yes or no. Both are positive only. In negative, what happens, you know, sir, in our books of accounts, 10 lakhs is the outstanding balance, sir, as on 31st March. Please respond if the amount is not correct. Please respond if the amount is not correct. If you do not agree with this, with the information, see, we are sending request, right? Confirmation request, right? Inside that some information we put, right? If with that information in the request, if third party don't want to agree, then only he should respond. That is NCR format. Able to understand? When NCR will be used, that point we have. There is a specific question asked in past examination. Under what circumstances negative confirmation request can be used? That specifically we will discuss. So, look at, so the design of the request affect the response rate. If at all responding is made very easy, the third party has to simply reply yes or no. They will respond very fast. If at all third party has to take some pressure, they have to take some stress, they need to open their books of accounts and fill the amount. If that is the way you are asking, they may not respond. So the design of request affect response rate and reliability. So when you are designing, no, you should keep in mind the following points. What assertion you are addressing? Assertion means, are you talking about the existence of account balance or are you talking about valuation? Which assertion you are addressing? Accordingly you should design. And identify the risk of MMS, layout and presentation of the request, past experience on civil audit, method of communication, management's authorization for confirmation parties, ability of the confirming party to provide requested information. Some third parties, no, the person manager may not have the authority to respond. So that is also important when you are designing the confirmation request. See, management authorization, method of communication, paper, mail, past experience, layout and presentation. You may use a positive format or negative format. Within the positive format, you may put a blank and then ask them to fill, or you mention the amount and ask them to respond yes or no. All these points you should keep in mind. See, if you are checking overstatement, then there is a way to ask. If you are checking understatement, you are worried about risk of understatement, then there is a way to design the request. So there are so many elements you need to consider when you are designing the confirmation request. So these are the factors. Any 4 points, 4 marks question they'll ask, any 4 points you need to write. Straight question like this can be asked. So okay, you design the request, now send it. Now send the request. Okay sir, I sent sir. Send the request including follow-up request as and when needed. Generally follow-up request will be there in positive confirmation request format. In a negative confirmation format, follow-up request may not be there. Okay, next. Ensure requests are properly addressed and validated addresses before sending. In exam they might ask you, write about sending the request. Use additional or follow-up request if replies are not received within reasonable time. To enhance reliability, use positive confirmation requests that do not state the amount. You see, don't mention amount. In a positive confirmation request, tell the third party to fill the amount and send. But if you do like this, it may reduce response rate due to extra effort is involved. So generally the best way to send a confirmation request is, sir, we are the auditor. As on 31st March in our books of accounts, there is a liability for you that we need to pay some amount to you. Blank amount, put a blank. Please fill the amount that we have to pay as per your records. Third parties may not respond for these kinds of requests. This layout and presentation is not acceptable for third parties because they need to put the amount. Some third parties, what they feel, if I put a wrong amount, a company will pay lesser amount to me. Like that, they'll be having some fears. Next. So what is the procedure? Very simple. First, determine the information. Identify appropriate confirming party. Design the request. Send the request including follow-up request. Over. This is the external confirmation procedure. Standard is not yet over, my dear. There is one more definition. Exception. There is a definition called exception. Many students don't know this. Exception definition is there. So that we will discuss now. Next. Negative confirmation request. What is a negative confirmation request? In a negative confirmation request, I will send confirmation request to the third party. In that information, I will mention like this. Sir, in our books of accounts, the account balance is like this. Please reply if you disagree. Ignore otherwise. Non-receipt of reply within 3 days. Non-receipt of reply within 3 days. We assume that you agreed with this. Like that we will mention and then send. Now 3 days over. Third party did not respond. We assume that third party agreed. But tell me, did third party explicitly agreed? No. You see, negative, see, that's why sometimes what happens, you send a negative request. Third party has not at all seen the mail. Third party has not seen the mail at all. He didn't open at all. He was on a vacation. But actually, our client books of accounts and third party books of accounts, there is a lot of difference. And when you investigate, you will know that our client book's only wrong. But what happened, you sent a negative request, third party did not reply. So what auditor felt, everything is matching, our client books of accounts are right. So that's why negative confirmation request is very dangerous. Negative confirmation request provide less persuasive evidence. It is less convincing than positive confirmation request. Auditor shall not use NCR. Negative confirmation request you are prohibited to use unless all the conditions below are satisfied. All the following conditions must be there. Then only in that scenario, in that class of transaction, in that account balance, negative confirmation can be used. Assessed low risk of MMS and obtain evidence of control effectiveness. In our client, no controls are effective, and on the debtors or creditors, you got an evidence that low risk is there. Population includes small items. They're all small items. Low exception rate is expected. Exception rate is low. What is exception? Exception rate is low, I agree. What is exception? Generally, exception means what, See, here you see, exception means difference between. Exception means what? Difference between information requested by auditor or contained in entity records and information provided by third party. So, I sent a confirmation request, right? Inside that I mentioned some amount. Third party also replied. He said that amount is same, no difference. Then there is no exception. Suppose, I mentioned amount 10 lakhs. Third party said, no sir, it is not 10 lakhs, sir, it is 11 lakhs. Now there is an exception. Information requested by the auditor and information provided by the third party, if there is a difference between them, then that's an exception. Generally, what information I request third party? Whatever information is there as per our company records. In our company books of accounts, what amount is there? That amount only I will request them to confirm. So that's why information requested by the auditor are contained in entity records and difference between this and this. That's why you see difference between yellow and green letter, which I highlighted here. So whenever there is a difference, you must analyze, and what is its impact on the entire population, you should check. Sometimes, see, remember, in our books of accounts, his balance is 10 lakhs. He replied saying 8 lakhs only. Can I straight away say our client books of accounts are wrong? No. See, when you sent a confirmation request, third party replied disagreement, that he did not agree with this. Disagreement is an exception. That's not misstatement. Many students will think if third party replied with a different amount, then our books of accounts are misstated. No, wrong. You need to investigate further why there is a difference between our records and third party records. Sometimes third party records might be wrong. So that's exception. Now, if you think exception rate is low, if the exception possibility is very low, there also you can send NCR. Exception rate low means what? Array, last week only both of them conformed with each other. This week no transaction happened. So obviously the exception possibility is very low. And no conditions exist that indicate that recipients will disregard the request. You know, I know very well, if I send a NCR, he will definitely see that. And if at all he ignore this means, if at all I did not get reply within 3 days means, I for sure know that he considered this. So that's it. If these 4 conditions are satisfied, NCR can be used. Now, suppose you sent a negative confirmation request, you did not receive any response. You did not receive any response, right? Non-receipt of a response means generally what you assume that everything is matching. But do you know explicitly the third party agreed this? No. Non-response to NCR does not explicitly confirm receipt by third party. You know, in the recent CA final May 25 exam, these were asked in MCQ SMA. In the recent May 25 CA final, these points were asked in MCQ. So depth. Okay. And this point was there even in CA Inter. Many, in MTPs and all, they tested once. Non-response to NCR provide significantly less persuasive evidence. So to an NCR, if you don't receive any response, what does it mean? Agreed or third party has not seen? What does it mean? We don't know. So there is no explicit confirmation here. He didn't respond. So explicitly we don't know whether he agreed or disagreed. We don't know. Recipients generally will respond if the information is not in their favor and less likely to respond otherwise. They will respond when they want to disagree, which is favoring with them. Suppose if information what we sent is not in their favor, then they will immediately respond. Suppose if the information as per our records is favoring them, they may not respond. So NCR, you did not receive any response. There are so many interpretations on it. That's it. So non-response to negative confirmation request, how should auditor interpret? This itself can be asked as a 4 marks question. This itself can be asked as a 4 marks question. And under what circumstances NCR can be used? This itself can be asked as a 4 marks question. Finally, evaluating evidence obtained through external confirmation. You know what? The second point is there, right? Again, there is an MCQ in CA final. In the recent May 25, in CA final they have asked this. Array yaar, CA Inter standard they tested in final. So there is a high possibility that in CA Inter also they will test. They tested it already. So now, whenever you are performing external confirmation, you might have got some result. The third party would have replied or not replied, or something would have been there. Please evaluate the results. Okay, whether the external confirmation have given you reliable evidence and relevant evidence, check out. See whether any further procedures are necessary. When you are evaluating individual confirmation request, like each confirmation request when you are evaluating, you can categorize the external confirmation result into 4 categories. The results is categorized into 4 parts. Response by third party, indicating agreement. Third party responded, everything is matching. Or a response, third party responded where you felt that is not a right response. You felt unreliable. Or non-response, third party did not respond. Exception, third party responded, but difference is there in the information. Like he gave some other information which is not matching with your records. So the result of external confirmation can be 4 categories. 4 categories. 1, agreement by third party. D, disagreement by third party. 3, third party reply is not reliable. 4, he didn't reply at all. That's it. Next. So the auditor's evaluation combined with other process helps in determining whether, so after looking at these results, you may have to decide whether further audit process may be required or not. You need to check out. That's it. 505 is over. Now finally, one more point. Sometimes management refuse to send external confirmation to 1 or 2 parties. Okay, they may say, sir, some issue is going on. Now if you send external confirmation again, so the client might misunderstand. Let's not. Okay, so the auditor shall inquire. If management is refusing, inquire the reasons about management's reasons for refusal and see whether that is valid and reasonable. Look at the evidence. Reasons for refusal may include some legal dispute going on or some negotiation that going on. So the auditor must seek evidence to validate the reasons. How the refusal impact the risk, modify the nature timing of procedures and get alternative. You want to get evidence through external, where external is not possible, so try to perform alternative procedure. So perform alternative procedure. And if management refusal is unreasonable, communicate with the top management, those charged with the governance. Further, such a refusal sometimes may indicate fraud risk factor, and what is its impact of refusal on auditor's report. Check out. Sometimes you may have to give a qualified opinion or disclaimer of opinion if the refusal is unreasonable. That's it. 505 is over. Tell me honestly, how many of you found out many new points in this? Imagine in a 15 minutes revision, I showed you so many new points. Remember, this is not something I'm discussing out of the box. This is there in the ICA book. Cross check. Right now, open ICA book and cross check. So many students, they were misguided by showing all the standard simple and nothing. Don't believe. Be clear. This is the depth of the standard. Mark my word, tomorrow exam you will find many advanced questions where some students might feel that it's not there. But don't worry, you all followed this, you all listen to this, you will not feel surprised if a question comes from in-depth corners of the standard. That's it. I hope you understood thoroughly 505. Next 510 initial audit engagement opening balances. So now, by the way, once just let me open. So 501 inventory completed, litigations and claims segment. 505 important definitions we understood, confirmation procedure, factors for designing confirmation request, management refusal, NCR, can we use a negative confirmation as audit to 4 conditions, evaluation of evidence. All these points we understood now. Correct? Now we will discuss 510. In 510 standard heading is what? Initial audit engagement opening balances. Initial audit engagements hyphen opening balances. Initial audit engagements dash opening balances. So this is the heading of the standard. 550 related parties. That's it. No more related party disclosures. No. Related parties. That's it. What is related party standard? We'll discuss later. Okay. 510. First, we need to understand opening balance definition, and there is a definition for initial audit engagement. First, we need to understand the definition. Then we need to understand what is the audit procedure for opening balance. Then we need to understand how to conclude and report, and to what extent audit procedures has to be performed for opening balances. What is the nature and extent of audit procedure for opening balances? That all, these 4 points we need to cover. Okay, in 510. So that's it. Just 2 minutes. Be online. I will be continuing. Just be online. 2 minutes. Yeah, somebody saying the book which they're following, many points are missing. Yeah, that's a problem. Many students were misguided with improper books. They say 100% ICA syllabus is covered, but not. Many, I should not say this, many faculties, some concepts which they can't explain, they remove it from the book. So that is something very serious sin. Fine. I'll go with 510 now. 510. What is 510? Initial audit engagement and opening balance. What is initial audit engagement? First time I'm doing audit of this entity. That's an initial audit engagement. And initial audit engagement. First time I'm doing audit for a particular client. That's an initial audit engagement. Or previously there is no auditor at all. Simple. There are 2 cases. Previously, the financial statements of the client were not at all audited, and I'm the one who appointed right now for the first time. 2, previously some other auditor was there, now I replaced him. Both these engagements are called as initial audit engagement. And when you are performing an initial audit engagement, you must obtain evidence about opening balances. That's very severe. Now, initial audit engagement, an engagement where prior period financials are not at all audited, or they were audited by predecessor auditor. That is called as an initial audit engagement. Opening balance means what? Opening balance means what? Account balances which are existing at the beginning of the accounting period, which are based on the prior period closing balances, last year closing balances carry forward. That itself is opening balance. Not only that, opening balances reflect prior period transactions, events and accounting policies. Opening balance also includes matters which are just disclosed. In the last year balance sheet P&L, notes to accounts, some disclosures were there, like contingencies, commitment disclosures. They will also be treated as opening balance. Remember, the definitions are important for MCQ purpose. Next. So what is the objective? Very simple. In an initial audit engagement, the objective is, you have to obtain sufficient appropriate evidence about whether opening balances contain misstatements which might affect the current period financials. Accounting policies, are they consistently applied? And if there are any changes to the accounting policies, whether the changes are correctly reflected. So first let us look at accounting policies point. Directly auditors' conclusions and reporting I will see. Okay, reporting on accounting policies, very simple. See, we have to get an evidence that last year whatever accounting policies were there, whether the same is followed. Sometimes changes will happen. Okay, changes, but let it be. Whether the changes in accounting policies were properly accounted and disclosed. If at all they were not properly accounted or not properly disclosed, then we should give a modified opinion, qualified or adverse opinion. If the auditor conclude current period accounting policies are not consistently applied, or changes in accounting policies are not properly accounted for or not adequately disclosed, the auditor must express a qualified opinion or adverse opinion. You have an evidence here. Accounting policies are not consistent, or there are some changes which are not properly accounted. Therefore, we must give adverse opinion or qualified opinion, as the case may be. Sometimes, reporting on opening balance. Directly, first let me talk about reporting on opening balance. Then I will talk about audit procedure. Reporting on opening balance. If you are unable to obtain evidence regarding opening balance, you are not getting evidence on opening balance, the auditor will express a qualified opinion or disclaimer of opinion. Suppose opening balance are materially misstated, which is affecting current period financial statements, and they are not properly accounted for or not adequately disclosed, the auditor must express a qualified opinion or adverse opinion, as the case may be. See, if you are unable to obtain evidence, disclaimer of opinion. You have an evidence that they are materially misstated in the current period, adverse opinion, worst scenario. Either qualified or adverse. Qualified disclaimer, qualified adverse. You see, part 1 revision audit reporting, I told where qualified opinion will come, where adverse opinion will come, where disclaimer will come, I clearly told. Next. Now, what is the audit procedure for opening balance? Verify that prior period closing balances are correctly brought forwarded or disclosed as a prior period item. See whether last year closing balances were they correctly brought forwarded. How do I know? How do I check? Perform one or more of the following procedure. Review audited financial statements of the prior period. Last year audited balance sheet is there, right? Check that with the current year opening trial balance. Like, evaluate whether current period processes provide evidence. Current period, no, some payment made to debtor. Opening date in April and May month, some payments were made to debtor. They were belonging to last year balances. See how much amount is paid. Oh, this much amount paid in the current year means last year outstanding amount is correct, right? Conduct specific procedures for opening balance. Specific procedure for opening balance means what? Opening trial balance we will match with last year audited balance sheet. Assets and all debit side of the trial balance. Liabilities and all credits in the trial balance. Like that we will tick. We will match like this. That's it. Next, suppose if auditor obtains evidence for misstatements in opening balance which will materially affect the current period, then perform additional procedures. Do go in depth, verify further to know what is its impact. If auditor concluded MMS exists, the auditor shall communicate to the management and top management, ask them to rectify the financial statements, ask them to show it as a prior period item. If they rectified and showed it as prior period item correctly, they accounted, then no problem. I will give unqualified opinion. Now, what is the nature? So, what procedure we need to perform? We understood now. So, what is the procedure for opening balance? 4 marks. Conclusions and reporting, straight away they can ask it as a 4 marks question. Now we are discussing about nature and extent of procedures. To what extent I will perform opening balance? The nature and extent is dependent upon accounting policies followed, nature of account balance and transaction, risk of MMS involved, significance of opening balance to current period. Suppose last year only we started business, no much business happened in the last year. So in the current year, opening balances may not be significant. So we just briefly verify whether predecessor auditor's opinion was modified. One more important thing, last year auditor gave a modified opinion. So then opening balances might play a very major role in the current year. So that also you should see. So factors affecting nature and extent of audit procedure, 4 marks question straight away. What are the factors that affect nature and extent of audit procedures for opening balance? What accounting policies they are following? What is the nature of accounting balance? Significance of opening balance? Whether prior period auditor has given a modified opinion. Suppose last year financials were audited by previous auditor. The auditor can obtain sufficient appropriate evidence by reviewing audited financial statements of the last year. Review supporting schedules and all. And reliance on ordinarily you happily trust last year closing balances unless current period procedures indicate some misstatements. Generally, you are eligible to trust last year closing balances because last year somebody has audited. So you don't have to doubt them. By default, you can trust that they are free from MMS. But in the current period, you found some mistakes might be there in the opening balance. Then only you will not trust it. For current assets and liabilities, evidence for current asset liability may be obtained during the current audit. Like how in the current audit evidence we get regarding current assets and liabilities. For trade receivables and payables, no, in the current year collections might be there or amounts might have been paid. That itself is an evidence for existence. Inventory, current year procedures may not provide sufficient evidence regarding opening inventory value. Therefore, additional procedures are necessary. With respect to inventory, generally in the current period, current year purchases and sales, if you're checking, you may not get evidence regarding opening stock. So for opening stock, if you want to get evidence, you need to perform additional procedures. First, do inventory counting and reconcile till opening balance. Perform process on valuation of opening item, test gross profit and cutoff. So for inventory, you may not get evidence by performing current procedures. You may not get evidence regarding opening balance in the current period. You may have to perform additional. Do first physical counting, trace back to opening balance all the transactions, and do valuation and perform cutoff procedures. That's so you can get evidence on opening value of inventory. For non-current assets, the evidence can be obtained in current period. Examining accounting records and underlying information, using confirmation with third parties, and additional. I think this non-current point is not that important, but this inventory point is very important. MCQ, it might be important. So MCQ, it might be important. That's it. Fight and standard is over. Who is a predecessor auditor? Predecessor auditor is auditor from another firm who audited the last year financials and is now replaced with you. You are the current auditor. So since you replaced the previous auditor, for you it is a first time audit. That's why it's called initial audit engagement. But we apply the standard even if it is a recurring engagement. Not just in initial audit engagement, we apply the standard, we follow the standard even if it is a recurring audit engagement. That's it. Fight and standard is over. Next, 550. I don't know whether I'm giving you additional points, all that. I don't know, but I hope I'm giving you, I hope I'm giving you crystal clear clarity in the shortest time. You see, 50 minutes hardly. We covered almost 3 standards, that 2 big standards, 501, 505, 550. Many of you, whoever thinks they're nothing small, easy standards, now you might have understood how lengthy these standards are, how much content is there inside these standards. That's it. Just 2 minutes, we'll continue 550. I'll be happy if you reply me, whether you're understanding or not, whether you're able to revise quickly or not. Yeah. Now, so look at this. 510 is over. Now 550. There are totally 5 concepts that we need to understand in related parties. Now, first we need to understand definition of related party. Many do not pay attention to the definition. Definition of related party is very important. Okay. Then what kind of related party relationships? Here there is a word called RPRT. Related party relationships and transactions. Related party relationships and transaction. Nature of related party relationships and transaction. That we need to understand. Then we need to understand understanding of entities, related party relationships and transactions. Existence of related parties. Small entities, how related party relationships and all will be there. Next. Now, meaning of related parties. Actually, many students think that related parties means we need to check disclosure requirement. Wrong. Here, the standard mainly deals with auditor responsibilities relating related parties. Specifically, it applies in relation to risk of MMS due to fraud. Most important, fraud risk factors in relation to related parties. That is what the primary focus of this standard. Now, what do you mean by related party? The standard first, what it says, follow applicable financial reporting framework definition. Suppose if accounting standard defines related party, follow accounting standard definition. If Ind AS defines related party, follow the definition. Suppose if the framework is silent. Suppose if accounting standard there is no related party requirement, or if Ind AS does not talk about related party, actually in reality they are talking. So auditing standard related party definition is useless basically. But in exams, MCQs they might ask. MCQ, in one of the MCQ they asked this note point. In one of the MCQs, they asked this note point. Okay, so now related party means what? If at all financial reporting framework is silent. So, who are related parties? Very simple. A person or entity that has control or influence over reporting entity. Reporting entity means the entity where we are reporting. Means our client. On our client, did somebody has control? Did somebody has influence? They are related party. Okay. Another entity over which reporting entity has control. Another company is there. On that company, our client has a control. Our client has an influence. They are related party. Another entity under common control. There is another company. Along with this company, there is another company. We both are under common control. Through common ownership, close family member, common. Like these are nothing but sister concerns. These are nothing but sister concerns. They are also related parties. Means the company which is controlling me or influencing me, or the company which I am controlling or I am influencing, or another country, another company where me and that company were controlled commonly by somebody. Means sister companies. These are all related parties. Now there is one exception here. Entities under common control of a state. State means what? Here it's not state government, central government, not that. State means government, that's it. Entities which are under common control of a government, they are not treated as related parties unless they involve in significant transactions and sharing of resources. So companies which are under common control of a government, they are not treated as related parties. Okay. However, if they engage in significant transactions with each other, then they will again be treated as related parties. So just because government is having common ownership in many companies, you can't say each company is related party to each other. No, that's it. Now, control means what? Govern. To govern the entity and operating policies. Significant influence means what? You can participate. If you are having power to govern, then that's control. If you have a right to participate, then it's influence. Now, how do you know that there is a control or influence? Other equity holdings we have. In that entity, we have equity ownership. Financial interest is there. Holdings of other financial interest. Being part of top management or being a close family member of top management. Significant business relationship with key management. So, in all these ways, we can have control. They may ask you as a 4 marks question. What are the factors? They may ask you, define control and significant influence, and what are the indicators of control and indicators of significant influence? They may ask you this entire segment as a 4 marks question. Next, some related parties will be there with a dominant influence. Related parties sometimes can exercise dominant influence over our company. This is relevant in assessing risk of MS due to fraud. Is there any related party who is dominant in the company? And I need to know what kind of transactions happen with them. Are there any fraud risk factors in that? Now, this SP points relevant, special purpose entity point irrelevant, not required. Now, nature of related party relationships and transaction. Many related party transactions, most of the related party transactions, they will happen just like a normal unrelated party transaction. Most of the related party transactions occurs in normal course of business and may not pose any higher risk. Okay, compared to unrelated parties. What kind of risk is there in unrelated party transaction? The same level of risk will be there in related party. Generally, most of the related party transactions are just neutral, normal like unrelated party transaction. The nature of related party relationship can sometimes result in higher risk of MMS. Some related party transaction may give higher risk. For example, related parties may have extensive complex structure. Like some related parties, they are not direct related parties. A complex structure is there. Information systems may fail to identify or summarize transactions and outstanding balances. Some related party transactions may not follow market terms and conditions. In all these cases, high risk will be there. Most of the related party relationships and transactions may carry no special risk. They will be ordinary. But in some cases, related party, the nature of relations and the nature of transaction can sometimes result in higher risk. Example, complex relation. Ineffective information systems like our computers, our systems are not capturing related party data, or related party transactions are happening at non-market terms. In all these cases, the related party relationships and transactions carry higher risk. They may ask you in exam, right? Generally related party transactions may not carry higher risk compared to unrelated party, but there are some circumstances where related party relationships and transactions may carry higher risk. Explain. You need to write this entire point B. They're indirectly asking you nature of related party relationships, nature of related party transaction. This question they're asking. Next. So that's why you need to understand who are all the related parties of the entity, what transactions happen with them. So identify, the auditor shall inquire Who are the entities related parties? Are there any changes compared to last year? What is the relationship between the entity and related party? Are they holding, are the associate, are the joint venture? What exactly? Whether entity entered into any transaction? If so, what is the type of transaction? Purchase, a sale, a loan? What is it? And what is the purpose of the transaction? So the auditor shall inquire who are the parties? Are there any changes compared to last year? Are there any transactions? What kind of relationships we had? Are there any transactions with them? If so, what kind of transaction? How much amount involved? What's the purpose? The auditor shall do risk assessment procedure, obtain an understanding of controls established to identify and disclosure of related party. So they may ask you, write about risk assessment procedure for related party, 4 marks question they might ask you. Or they might ask you this itself as a 5 marks question. Write about understanding of entities, related party relationships and transactions. This itself they can ask you as a 5 marks question. Next, SS controls for authorizing and approving significant transactions. See, in the company, what kind of controls are implemented to approve related party transaction? Evaluate controls for authorizing and approving significant transactions. See, are there any outside the normal course of business, any transaction? What controls the company has implemented? How they are authorizing that? Check out. And verify existence of related party. How do I know whether there are related party transactions in the company? First, I will ask company. How do I verify existence of related party? I will look at income tax returns. I will look at information filed with regulatories. I will look at shareholder records. I will look at agreements with top management. I will look at significant contracts and agreements. I will see invoices and correspondence. I will see life insurance policy and see who is the nominee and on what people they have taken. I will see just a minute. I will see internal auditors report. I will see the filings with regulators. I will see shareholder register. So any 5 points. What are the records and documents you will inspect to identify related party relationships and transactions? Any 5 points you can write. The auditor has to be alert for related party information while reviewing records and documents. So you have to be very alert throughout the audit. Next. So consideration specific to smaller entities. In smaller entities, the control environment, smaller entities often have a different control environment. Like governance roles may not include outside members. Same person is management, same person is top management. In some cases, governance is handled directly by the owner himself. Control activities in smaller entities are typically not formal. They are less formal. So there may not be documented. No documentation will be there. So who are related parties? What transactions happen with them? There won't be any records also. The owner may either mitigate by full active overseeing or potential increase through involvement of related party transaction. So what is the audit approach in smaller entities? For these smaller entities, auditor may obtain understanding of related parties by inquiring management, observing management oversight and review activities, inspecting relevant documents. So in smaller entities, auditor have to ask direct management who are the related parties, observe how they are having control on the financial reporting, inspect relevant documentation. In straight away, this itself can be asked as a 5 marks question. That's it. Okay. So that's it. With this, related party 550 standard is also over. So that's it. Major chapter is completed in audit evidence. See, we are not covering 4 standards. I told 500, 520, 530, 610 I'm not covering. And I told you I will cover 2 more topics also. One assertions topic I'm covering, 2 audit trail topic I'm covering. Yes or no? Like as I already told at the beginning. So now I will cover 501 over, 501 over. Okay, 505 over, 510 is over, 550 is also over. Now concept of assertion, concept of audit trail I will cover. Now let's proceed. So in this, we have something called assertion. Assertion means what? Yeah, assertion you see. Concept of assertion. Assertion means what? Very simple. Assertions are nothing but representations by management. They may be explicit assertion or they may be implicit assertion, which are mentioned in financial statements, which are verified by the auditor to identify potential misstatement. For example, here there is an example. For example, see, I found in balance sheet under current assets like cash in hand 8,000 rupees. Like in balance sheet of one company, cash in hand 8,000 is there. What is it asserting? What management is asserting there? What management is trying to tell through that balance sheet item? What management is saying indirectly? Management is indirectly saying the company, firm means company here, entity, firm, organization, concern, anything is same. The firm had 8,000 in hand in notes and coins. Indirectly, that's what they're saying. that the cash was free and available for expenditure. The books of account also show an identical amount at the end of the day. So when I see balance sheet 8,000 rupees cash in hand, this is what management is asserting. Suppose another example, plant and machinery 2 lakhs is the original cost, depreciation of accumulated how that much, current year depreciation this much, total accumulated 83, and net return on value 1,17,000. So they mention depreciation schedule like this. What is it asserting? Indirectly they are saying the firm have own plant and machinery, historical cost is 2 lakhs, plant and machinery is physically there, asset is being utilized for business purpose, total depreciation is 83,000 till the date, 13,000 is belonging to current year, and the amount of depreciation has been calculated based on some method of depreciation. So by mentioning this information, by giving this information, management is trying to tell indirectly so many things. See, impliedly they are saying they're owner of the plant and machinery. That's an implied assertion. Yes or no? And we are indirectly telling physically plant and machinery is existing. These are all various assertions. So broadly, assertions are divided into these categories. Assertions related to transactions and events. You know what? Auditor has to verify these assertions. We need to verify whether transactions events really occurred. We need to verify whether all transactions that should have been recorded, or recorded, whether they are all completely recorded. Whether transactions occurred. Occurrence means what? When I want to check overstatement, I will check occurrence, whether really transaction occurred. If it is really occurred, then recording is correct. Accuracy. Transactions events are recorded appropriately with correct amount, whether the amount at which they are recorded, are they correct? That's called accuracy assertion. Transactions and events are recorded in correct accounting period. Array sale is recorded in 31st March. See whether the sale really happened. Transactions and events are recorded in proper account. That is called classification. So with respect to transactions, I generally check 5 types of assertions. With respect to balance sheet items, I will check existence, I will check rights and obligation, I will check completeness of assets and liabilities accounting, I will see valuation, and I will see allocation. Whereas for presentation and disclosure items, I will check occurrence and rights, completeness, classification, accuracy, and valuation. And remember, these assertions I may combine sometimes, like you see here. Auditors may combine assertions across transactions and balances, provided all aspects are verified. Now further, nature of assertions. Generally, assertions are not specifically stated but are implied in nature. For example, here, plant and machinery 2 lakhs worth of amount we showed. Indirectly, what we are concluding, what plant and machinery is owned by the company. We are indirectly concluding that it is owned, company owned machinery. Balance sheet does not say own plant and machinery. They simply say plant and machinery. Ownership we are assuming. That's an implied assertion. Okay. Explicit. Some explicit assertions are made when specific details are needed to give a complete picture. For example, secured loans 4 lakhs. Name of the lender, nature of the security, interest rate payable. If at all we are mentioning them specifically, then that's an explicit. Negative. Sometimes assertions are negative in nature. Like negative means what? For example, negative assertion means, for example, implied negative assertion, I'll tell you. Suppose, in the balance sheet, there is no building. Like fixed asset schedule is given, asset schedule is given, depreciation schedule is given, but building point is not at all there. The word building itself is not there. Impliedly, we are saying that there is no building. Okay. Next, explicit negative assertion. Explicit negative assertion means what? I am showing buildings, and I am mentioning that 0, not existing. Explicitly I am saying that there is no building. That's it. So auditor, the financial statements contains an overall representation in relation to. So the auditor has to verify, if each, yeah, fine. This one you see. The auditor's opinion is based on overall representation. To form the opinion, auditor will verify all the assertions, whether they are explicit assertions or implicit assertions, both positive and negative assertions. Individual judgments leads to conclusion whether financial statements as a whole are free from material misstatements. So you need to verify all the assertions. So when you're reading balance sheet, try to figure out what are all it is trying to tell. Verify all those elements. That's what assertion concept is saying. That's it. That's what assertion concept is saying. Actually, much more in depth can be discussed in this, but that's okay. From revision point of view, this is more than sufficient. Then audit trail concept. Audit trail concept. So what is an audit trail? In calculator, when you're totaling some calculations, plus minus some total you did, you can do check, right? Like what are all items you added, what are items you reduced, you can check, right? That's actually an audit trail. That's actually an example of audit trail. Okay, so in companies, there will be so many people involved. So accountant is there, finance manager is there, purchase manager is there, production manager is there, storekeeper is there. Many of them will participate in accounting indirectly. So whenever somebody update any record, their name will be recorded. When they recorded, at what time they recorded this transaction, how much amount they recorded, later how the transaction is modified, is the narration modified, ledger account modified, everything will be recorded in the computer. That is called audit trail. So audit trail is documented, means recording flow of transaction that helps trace how a source document leads to a journal entry and ultimately reflected in financial statements. So purchases 10 lakh crore, purchases some 1 lakh crore is there. Breakup 10,000 purchase transactions are there. One transaction you take, that transaction, no, originally the transaction initiated through purchase order, 7 days back purchase order is there, then goods received on the second day, then they were entered in the inventory records on some third day, then it is voucher is prepared on fourth day, then finally entered in the books of accounts on fifth day, and that is how it is reflected in the financial statements. Entire flow of transaction I can see, that is called audit trail. Audit trail is used as audit evidence to establish authenticity and integrity of a transaction. It is a step-by-step record where we can trace accounting, trade, financial data into its source. So originally what happened? See, today purchase is reflected in balance P&L account, this much value. But before it is reflected here, it is reflected in so many places where originally it started. So I am tracing back to its source. That's called audit trail. Audit trails document evidence of events to reduce frauds, but maintaining audit trail is very storage cost is very high, database cost is very high, so system expenditure, time is required to analyze the data, some automated tools and all will be there. Okay, benefits of audit trail strengths, you know, this itself, benefits of audit trail, a 4 marks question can be asked, meaning of audit trail, a 4 marks question can be asked, any of this can be asked as an exam. Benefits, audit trail strengthens, it makes internal control strong, improve data security by fixing responsibility of user activities, rebuilding events when problem occur. If some transactions modify later, some fraud happened, I will rebuild what all happened previously. Okay, who entered this transaction, when they entered this transaction, everything will be recorded. You know, tracking user activity to identify responsible person. Audit trail analysis helps identify reason for problem, ensure that system operates as intended. Systems with audit trail features build confidence in auditors by verifying whether management controls were operating effectively. Audit trail helps to verify whether a transaction was performed by right person, authorized person or not. They enhance data security and increase reliability of audit evidence obtained during the audit. That's it. This is audit trail benefit. Yes or no? That's it. So with this, this audit evidence topic is mainly over. 4 standards are predominantly covered here. 4 standards are predominantly covered. Audit trail concept is covered, and I also covered assertions topic. That's it. Okay. So you know, internal audit, no, I will just SA 610, no, I will just give you a brief idea. SA 610, using the work of internal auditor. You know, you can use in 2 ways the work of internal auditor. Type 1, using the work which is performed by them. Type 2, using them directly. That's called direct assistance. You know, type 1, when you can use type 1, using the evaluation of internal audit function, type 1 when I can use, 3 points I will check. You know, organization status, objectivity I will check. You know, IAF organization status, whether do they support objectivity, whether internal audit function is having objectivity or not, that I will check. First point. Second point, I will check their competence. Third point, do they have a systematic and disciplined approach, I will check. In all these 3 cases, if the answer is yes, then I will use their work. Now, you know, competence, when you are checking, you know, directly in exam, no, competence itself can be asked as a 4 marks question, or objectivity and its evaluation, this itself can be asked as a 4 marks question. Be careful, anyway this can be asked. So see, I'm just telling you how a question can come. You know, here IAF work shall not be used, type 1 work don't use in the following 3 cases. Objectivity is not adequate, lack of, you know, lacks competence, does not apply systematic disciplined approach including quality control. In all these 3 cases, don't use internal audit work. Okay, next, nature and extent of work. So type 1 work, if I decided to use, to what extent I can use, what nature of work I will use. Generally we use internal audit work for testing operating effectiveness, inventory counting, performing substantive processes involving limited judgment. If there is a high judgment, we don't use their work. Tracing transactions through information system, testing compliance with regulatory requirement. Okay, next, circumstance where internal audit function work has to be used less, where we shall perform more of the work directly. More judgment is required in planning and performing, more judgment is involved in evaluating evidence. If the assessed risk of MMS at assertion level is high, you know, that time also you have to perform the work directly. Internal auditor is lacking objectivity, internal auditor is lacking competence, high risk is there, more judgment is involved. In all these 4 circumstances, you have to perform the work directly, depend less on the internal auditor. Okay, then external auditor usage of IAF staff for direct assistance. Direct assistance means what? Under my, you know, the internal audit department, some 2 or 3 members will come into my team members and we will work along with them. So prohibition, if if there are threats to objectivity and if they are lacking competence, I will not use them for direct assistance. So okay, suppose I decided to take them into my team, but I will not give the following 4 kinds of works. Areas involving significant judgment, I will not allocate to direct assistance people, or area related to high risk of MMS, I will not allocate to them. It is related to work which they already perform, that area I will not reallocate them. Or decisions I need to take under this standard, under 16 standard, I need to take some decisions. That decision making power I will not allocate to them. Before I use internal auditor for direct assistance, I will have to enter into agreement with 2 people. One, the persons whom you are taking direct assistance with, them you need to enter into agreement. Management. With management, that management will allow their internal auditors to work under my direction, and from internal auditor written agreement like that, they will maintain confidentiality of whatever I am instructing, and any threats to their objectivity they should immediately tell me. Like that I will enter into agreement with internal auditor. That's it. So this is 610 overview. I am not briefly, I just briefly discuss 610. Remaining 4 standards I'm not covering this in depth. Okay, I'm briefly discussing, just an idea I'm giving you. That's it. With this, audit evidence topic is over. Okay, that's it. So I hope you thoroughly enjoyed with this revision. So audit evidence topic, 4 standards I covered. 610 I briefly told you. Assertion topic I briefly told you. Auditorial topic briefly told you. But 4 standards I covered little better. Okay, so I covered, I properly revised it, and I also told you at every standard how a different question can come in exam. That's it. Okay, take care guys, all the very best. The video clarity, audio quality, everything is proper. So let's discuss audit of banks. Just hardly 40 minutes. This topic will be over. 40-45 minutes. I will tell you the main theme of this particular topic. Hope everything is clear. Kindly just confirm me once. Yeah, perfect. Perfect. So let's directly proceed discussing this bank audit topic. So audit of banks. In this I figured out 8 concepts which are very important. 1, various reports which a central statutory auditor or statutory central auditor has to give. What are the various reports? How to appoint the auditor of a bank? What are the various contents of audit report in case of a bank? And how to do audit of advances given by the bank? NPA norms, drawing power calculation, sanction limit means what, drawing power means what, how to calculate drawing power, and how to do audit of income and reversal of income, how to do audit of expenditure. If these points, if you're clear, bank audit is over. Hardly we will be spending another 40-45 minutes on this particular topic. See the kind of clarity that you're going to get. Amazing clarity I'll give you in this particular topic. Now, audit of banks. Okay, inside this, mainly I will discuss important points. What are the additional reports by statutory central auditor? Those of you, I have already taken something called SBI example. 12 joint auditors will be there. 6,000 branches audit were done in SBI. When I'm discussing other matter paragraph in audit report topic, I discussed. So banks will have something called central auditors, principal auditors, and branch auditors. Principal auditors are called as statutory central auditors. Branch auditors are called as simply statutory auditor. In a bank and insurance company, SA means statutory auditor, means generally branch auditor. SCA, statutory central auditor, means principal auditors of a bank. So that's what the main meaning. Now, so what are various reports? See, first of course they will give audit report. Apart from audit report, what are various reports which a bank auditors will give? I report on adequacy and operating effectiveness of internal controls. Okay, so this is annexed to the main audit report. So a report on IFCO for internal financial controls over financial reporting and their operating effectiveness. That is one report. Long form audit report. Bank auditors will also give one more report called long form audit report. SLR, statutory liquidity ratio. Banks have to maintain 2 reserve ratios, cash reserve ratio, statutory liquidity ratio. So whether they are complying with those ratios or not, the auditor has to give a report on that. The auditor has to give a report on IRAC norms, IRAC, income recognition, asset classification norms. Whether the bank has complied with IRAC or not, the auditor has to give a report. The auditor shall also give a report on adverse credit deposit ratio. One time they have asked one MCQ. Here they removed the word deposit and they put the word credit. Adverse credit lending ratio. They mentioned lending. Lending is wrong. Deposit ratio. Credit means lending. Deposit means bank accepting deposit. Lending. So lending to deposit ratio, that is right word. Be clear. So that's it. So these 5 points you write. In exam they may ask you, what are various other reports which a central statutory auditor of a bank shall give? These are the various reports the statutory auditor has to give. Apart from that, Ghosh committee report, Gilani committee report is there. Ghosh committee report is dealing with frauds and malpractices. Gilani committee report is dealing with controls and inspection. Internal controls and inspection of systems. That's it. Then, you know, there are various types of banks. Non-computerized banks, right now nothing is there in India like that. Is there? Right now, what are all the banks that we see in and around in India are fully computerized banks. Fully computerized banks, you know, they use something called core banking system, where all the branches are interconnected so that customers can access services from any branch of the bank. So auditor must ensure that RBI norms are incorporated in the computer system so that proper classification, provisioning, everything will be done. Auditor should exercise judgment, professional skepticism and prudence to validate system generate time to process. Higher productivity, lower productivity. Simple. Okay. Now, audit plan and what points the auditor has to consider. Just 1 minute. Yeah, I think proper. It is proper. Yes, it is proper now. Yes, look at now audit plan and points to be considered. What are the points to be considered in a bank? So when you are developing an audit plan in a bank, you should consider the nature and level of operation. You should consider what are the adverse features. You should also compare what is the level of compliance based on previous reports. Evaluate risks identified due to IFC and breaches and all that. So this is a very basic point. Control environment in a bank. What are the control environment in a bank? Control environment. Segregation of duties. This itself can be directly asked as a 4 marks question. Write about control environment in a bank. They may ask you this itself as a straight question. Segregation of duties like front office and back office. Accurate measurement and reporting of positions like cash balances, all that. Proper verification and approval of transactions. Regular reconciliation of positions and results. Setting appropriate limits for activities. Timely reporting and approval of exceptions. You know, in this any 4 points. Control environment, any 4 points. Physical security and contingency planning. This point is not relevant. Procedure for conducting bank audit is also not relevant. It's not that important at all. Then here no, reliance on others reports. 8th point, very important for 4 marks question. One time it was asked. You know, when we are conducting bank audit, no, the auditor will review other reports for identifying adverse comments, whether anybody else have made adverse comments on the bank. For that reason, various others report and all the auditor, stat auditor wants. For example, internal audit report, concurrent audit report, manager's change report, manager's charge, when a manager is taking a charge, that report, handing over report, and RBI inspection report, internal reports, previous auditor's report, security verification reports, various reports the auditor will go through in order to, when he is planning the audit, no, he will go through other people's reports like this to identify whether they made any adverse comments like that. So this itself was asked as a 4 marks question once, so be careful. Next, appointment by the auditor. So Companies Act, qualifications, disqualifications, everything is as per Companies Act only. Further, who will appoint the auditor? Normally for regional rural banks, board of directors will appoint after taking approval from central government. For State Bank of India, COG will appoint, C&AG will appoint. Okay, subsidiary auditors are appointed directly by State Bank of India itself. SBI has some subsidiaries. Their auditors will be appointed directly by SBI. Remaining nationalized banks, other than SBI, remaining nationalized banks, directors of the bank will appoint with RBI approval. Then all other banking companies, means these here all private banks and all covered. For them, auditor will be appointed by shareholders at AGM with RBI approval. So first this you should read, then you should read this, then you should read this, at last you should read this banks. So RRBs, SBI, other nationalized banks, remaining banks, means private banks and all, shareholders will appoint in the AGM, provided again the auditor which auditor will be recommended in the AGM, RBI will approve the auditor, that auditor will be recommended in the AGM. Next, remuneration. It is fixed under Companies Act only, 142 section. In a general meeting, in case of nationalized banks and State Bank and RRB, central government and RBI will together fix the remuneration. The powers of the auditors are same like company auditors under Companies Act. Reporting. So to whom auditor has to report? Reporting to central government. For nationalized banks, auditors has to report to central government. In that audit report, in other report on legal and regulatory requirements. There is a para in audit report. There is a section in audit report. Report on other legal and regulatory requirements. Under that, the statutory auditor has to comment on true and fair view. Whether the balance sheet and P&L are the present in true and fair view, he need to give a report. Whether explanations, information. So the stat auditor will be asking so much of information, no? Whether he is getting proper information or not. Ensure that transactions are within the powers of the bank and verify branch returns. Are they adequate for the purpose of audit? You need to comment on all this. And format of audit report, same SA 700 format only the audit report will be there. And in the audit report, no, quantification of advances, deposits, interest income, interest expenditure for unaudited branches must be given. In other matter paragraph, I already showed this when I'm discussing quantification. So the auditor has to tell how many branches are unaudited. Some 20,000 branches are unaudited. Okay, 20,000 branches are unaudited. What is the quantification? 30%. These 20,000 branches will occupy 30% of interest income, 25% of interest expenditure, 40% of advances, 35% of deposits. Like this, you should give a specific quantification. Okay, then report must comply with 143, and CARO is not applicable for a banking company. Be careful. So format of audit report, this itself can be asked as a 4 marks question. Be careful. Long form audit report. Further, for banks, you know, the auditor shall give, in addition to a normal audit report, the auditor shall also give something called long form audit report. So yes, everybody, I recommend you to watch at normal speed. Normal speed or reduce the playback speed. Since it's a revision, I'll be discussing little faster. So you either watch at normal speed or reduce the speed. Why are you hurrying? I'm already covering it in a super fast. So you please watch at normal speed or watch at a lesser speed. Long form audit report. You know, for all banks, public banker, private banker, foreign banker, doesn't matter. The auditor must submit something called long form audit report. This is something like a CARO only. Okay. Matters for long form audit report. What are the matters? In the long form audit report, what points will be there? RBI will decide. Long form audit report must be submitted by 30th June annually. So for example, financial year 24-25, March 2025 is the closing date. 30th June 2025. Next, proper planning. So even for LFAR also, you must do a proper planning so that you can submit on a timely basis. Executive summary. For LFAR, can you give a summary of LFAR? Yes, you can give, but that is optional, but recommended for key observations. So executive summary in LFAR is optional. It's not mandatory. For MCQ, it might be important. And finally, auditor must report fraudulent activities or suspicious transactions to RBI. Very important. And further, if auditor identified any fraud which is more than 1 crore, automatically 143 subsection 12 is applicable. In addition to reporting to RBI, auditors appointed under 139 means stat auditors, they should also report to central government if at all they identify any fraud where the amount involved is 1 crore and above. 143 subsection 12. That's it. So this is regarding reporting of frauds. Then now finally the most important. Now you see what are the points that we covered. Various reports stat auditors has to give completed. Auditors appointment we completed. Audit report content we completed. Now we are going to discuss about audit of advances. What are various advances? Advances is the one which is major asset in a bank. What are the major assets of a bank? Advances. Major liabilities of a bank? Deposits. Okay. So examination of advance, most important. Large advance 100% you should verify. Remaining advances on a sample basis. Sir, what is a large advance? An advance is considered as a large advance if the year-end balance is more than 10 crore. If the year-end balance of the advance is more than 10 crore, automatically it is considered as a large advance, or it is 10 crore. That is one limit. Sir, advance amount is less than 10 crore, sir. Can I straight away call it a small advance? No. Compare with another number. Is it minimum 10% of the aggregate year-end advance of the branch? Check out. Suppose, no, sir, there is one branch, sir. For example, Chennai, State Bank of India, one branch is there, sir. In this branch, you know, total advances as on 31st March from all customers. Total advances from all the customers 31st March, let us assume that is 100 crore. No, not even 100 crore, sorry. 20 crore only. 20 crore only. Now, in 20 crore, right? So, what is the large advance? Total outstanding balance with one customer is 10 crore, or it is more than 10% of the branch outstanding. Branch outstanding 20 into 10%. Oh, 2 crore. If one of the housing loan customer is there, sir, 3 crore outstanding amount is there. In this branch, total advance value itself is 20 crore. into 10% 2. Housing loan customer 3. Even though it is less than 10 crore, for that branch it's a large advance. So whether an advance is a large advance or not, one limit is 10 crore limit. If the amount is not exceeding 10 crore, it is less than 10 crore, then compare with the 10% of the branch outstanding, total outstanding. If it is, suppose if a particular loan to a particular customer, an outstanding loan from a particular customer, an advance from a particular customer is more than 10% of the total branch outstanding as on 31st March, then that is also treated as a large advance. So that's it. Whichever is less, that's why either 10 crore or 10% of the total branch outstanding as on 31st March, whichever is less, that itself is treated as what? Large advance. Large advances we do verify 100% in our audit, whereas remaining advances we verify on a sampling basis. And again, advances are two types in a bank: funded advances, non-funded. For example, I gave a guarantee. Bank gave a guarantee on to a customer, to third party on behalf of one of their customer. There is no fund transferred, so that's a non-funded. Okay, no actual fund transfer like letter of credit, bank guarantees, all that. Funded means what? Term loan, cash credit, OD, all these are funded. Means funds transfer will be there. In a loan agreement, if a fund is transferred, that's a funded loan. Remember, you have CARO, right? In CARO, working capital limit point is there, right? Clause number 2, second clause, inventory. Inside that working capital point is there, right? Sanction limit 5 crore is there, right? There, funded, non-funded, both you must consider for checking whether total advances is 2 crore crossed or not. And remember, advances can comprise term loans, all this. You know, bank has to disclose advances in the following way: bills purchased and discounted, how much? Cash credit, OD, how much? Term loans, how much? Further, loans and advances given by banks is again subclassified into secured, covered by guarantee, unsecured, how much? Again, loans given is categorized into two parts: outside India, how much? Inside India, how much? Inside India, priority sector, public sector, banks, others. To breakup you should give like that. Advances outside India, due from banks, due from others, how much? Like that. So you know, this disclosure requirement might be important for MCQ purpose. Remember, this disclosure requirement might be relevant for MCQ purpose. Be careful. Next. Then classification of advances based on security. You know, bank will accept two types of security. Nature of security, two types: primary security, collateral security. Primary security is the principal security offered by the borrower. Suppose I am buying a housing loan. I want to buy a house. For that I want to get a loan. The house itself is given as a loan. That's a primary security. Banker told me, sir, this house alone is not sufficient, sir. I want extra security also. Tomorrow if this house value is declined suddenly, I want extra security. Then the person gave his car as a security, as a second collateral. That's additional security provided by the borrower. On collateral security, bank will not have any right initially. If primary security fails, then only collateral security bank will exercise. Then what are various common securities which a bank will accept? Goods, gold ornaments, immovable property, plantation, LIC, life insurance policies, stock exchange securities. Any of this can be given as a security. Again, how to create a security, mode of creating the security. One is mortgage. If immovable property is given as a security to a bank, that's called as a mortgage. Mortgage is two types: registered mortgage, equitable mortgage. Equitable mortgage is there in the informal lending sector, like where ownership documents will be given to the bank, and then that's how mortgage is created. I will just give ownership documents to the bank. In a registered mortgage, we will go to register office and register the mortgage deed with the bank. So that's the registered mortgage is powerful, remember. So in an equitable mortgage, title deeds will be given to him and he will give a loan, but keeping the title deeds with him. That's not secure. Okay, registered, created using a registered instrument which is signed by mortgager, mortgagee, both. Pledge, gold loan is best example for pledge. Bailment or delivery of goods will happen. Ownership remains with the pledger. Hypothecation, ownership and possession remain with the borrower, who acts like a, for example, house, vehicle loans, bike loan, car loan. Yes or no? Here, no, bike loan you are getting, car loan you are getting, car will be with you only, no. That's called hypothecation. Okay, pledge and hypothecation both are on movable items. In pledge, no, goods will be given to the banker. In hypothecation, goods will be with you. OD, overdraft, cash credit, inventory loans, these are all working capital loans, generally in the form of hypothecation. Okay, and in hypothecation, borrower will submit periodically statements, assets and liabilities, assets, stock statement, debtor statement, to determine drawing power. Sir, what is drawing power? We will discuss that later. Assignment, LIC policy. Suppose no, I want to get a loan from a bank. I have an insurance policy. It has a surrender value of 2 crore. If I surrender the policy right now, I'll get 2 crore money, which means I have 2 crore worth of asset right now. I gave this policy to a banker, and I got 1.5 crore loan. The policy, I will assign it to the banker. So that's called assignment. So transfer existing or future debt, my receivable, my right, I will transfer to banker. Only actionable claims are accepted by banks. Set off is not a popular method, very rare. Generally, for example, I want to get a credit card. I don't have a credit score at all. My credit score and all is not, banker is not trusting me at all. So I did one thing. I gave 1 lakh fixed deposit. Then I got 75,000 rupees worth of credit limit credit card. Tomorrow, if I don't pay, this credit card liability will be set off with that FD. So set off is not a security basically, but here no, in set off no. In set off technique, no, it will enable bank to combine two accounts. Okay, deposit account and loan account. I have a credit card which is a loan account. I also have a FD with the banker. So accounts must be in the same name and same capacity. Right of set off applies to time barred debts also. All branches will be treated as one for the purpose of set off. That's it. Lien is not at all a mode of creating security. I don't believe it. That's not correct at all. Okay, fine. Next. So now we completed one more point. Audit of advances point we completed. Now let us now discuss about prudential norms, especially NPA norms. So classification of advances as per prudential. There is something called RBI prudential norms. As per RBI prudential norms, the loans and advances are broadly classified into two types: standard loans, NPA loans. Standard loans are nothing but standard regular. Regular means what? These are the assets where there is no stress signal at all. No stress signal. The standard accounts are again classified into another type, SMAs. Special mention account. SMA 0, SMA 1, SMA 2. SMA 1, accounts where some stress signal is there. SMA 1, sir, I gave a loan, sir. Customer defaulted. EMI due date came, he defaulted. Is the default more than 90 days now? Is overdue more than 90 days? No. Overdue is just between 30 days to 60 days. Overdue is between 60 days to 90 days. Then SMA 2, that is called as what? That is called as what? SMA 2, you see, SMA. So SMA 1, overdue between 30 days to 60 days. SMA 2, overdue between 60 days to 90 days. Or if an account is showing some stress, we can straight away classify it as SMA 0. Now, so that's it. These are all special mention accounts, standard accounts. These are all standard loans. Suppose if there is a default, and the default is more than 90 days, straight away that loan will be classified under NPA category. NPA category is again subclassified into three types: substandard, doubtful, loss. NPAs are again classified into three types: substandard, doubtful, loss. Now let's look at what is an NPA exactly. When a loan is treated as an NPA. Just 1 minute. Yeah, it's okay. Just 1 minute. Yeah. So when a loan is treated as an NPA, an asset becomes NPA when it stops generating income. Asset performing means what? It is giving me income. Non-performing is what? It is not generating income. That's it. An asset which stops generating income is called as NPA. So how to decide whether a loan is an NPA? For term loans, no, interest amount or principal amount or both, installment amount overdue for more than 90 days. If a term loan is overdue for more than 90 days, it's an NPA. Bills. If a bill is overdue for more than 90 days, then also it's an NPA. Whereas for cash, credit and OD, the account is out of order. If the account is out of order in a cash, credit and overdraft, then that straight away is treated as NPA. Out of order means what? Many a times it was asked, what do you mean by out of order? An OD account or cash credit account is treated as out of order if outstanding balance in the OD account, outstanding balance in the cash credit account is exceeding sanctioned limit or exceeding drawing power continuously. What is this? What is this outstanding balance exceeding sanction limit drawing power? What exactly that means? There is something called sanction limit drawing power. Sanction limit is given. Sanction limit is decided based on repayment capacity of borrower. Whereas drawing power is decided based on value of security given by borrower. A bank will give loan based on two criteria. One, whether a customer has a repayment capacity. That is the most important. Okay, this is the most important. Two, okay, he has a repayment capacity. What surety I'm getting? What security I'm getting? That is also important. Suppose customer can repay 10 crore within 1 year. Suppose the customer have a repayment capacity of 10 crore. Then the bank will sanction 10 crore loan, but they will not release 10 crore money. Okay, 10 crore you can take, I will give 10 crore loan, you can take, no problem. But if I have to give 10 crore worth of loan, give me 20% extra security. For example, 12 crore. You give me 12 crore worth of land, 12 crore worth of jewelry, 12 crore worth of asset security. Then I will release 10 crore fund. Customer know what he did, worth of asset only. Security value is 8 crore only he gave. Oh, he gave 8 crores only. 20% I will eliminate. Balance approximately some 6.5 crore. Only this much I will release money. Only this much I will allow the customer to withdraw. 20% margin I will maintain. Example, I'm just telling you. Getting it? So if you want to draw 10 crore, you give me 12 crore worth of security. If you want to draw 8 crore, give me 9.6 crore worth of security. So this is what the condition I put. So if a customer is giving 8 crore worth of security, I will eliminate 20%. Balance amount only I will give him for withdrawal purpose. So that is drawing power. So drawing power is decided based on the value of security given by the customer. Sanction limit is decided based on the repayment capacity. A OD account, a cash credit account is treated as NPA if it remains if it is out of order. First point in out of order, outstanding amount in the OD account and cash credit is crossing drawing power. Technically it should not cross, but if it is crossing drawing power, if it is crossing sanction limit, straight away that OD account is treated as out of order. Or sir, outstanding balance is less than sanction limit, is less than drawing power, but you know, no credits for 90 days continuously. Sometimes in exam they will give you balance sheet. They'll give you balance sheet dates. In exam they'll give you sometimes, just a minute, they'll give you sometimes balance sheet and dates. Okay, so customer is withdrawing, only debits are there, he is not repaying at all, credits not there. So the withdrawals were there, no credits at all. No credits means what? Bank is not receiving any payment. If no credits are there for more than 90 days, if no repayment is there for more than 90 days, automatically, you see, if no repayments are there for more than 90 days, then also the OD account is treated as out of order. Sir, credits are there, sir, repayment is there, but insufficient to cover the interest amount debited. We debited interest, customer repaid, but interest amount also not recovered. More than 90 days, interest amount fully is not paid, then also that is treated as an out of order. Then so here they have given, here we have given some example. Okay, so what is overdue? Very simple, if an amount is not paid on due date, that's an overdue amount. That's it. So that's about out of order. And remember, NPA classification is always based on record of recovery. Sometimes in exam they'll confuse you. They say bank customer gave 100 crore worth of property asset, he failed to repay the loan, 90 days crossed, but remember 100 crore worth of asset is there. Loan amount is just 10 crore. He didn't repay for more than 90 days, but 100 crore worth of asset is there with the bank. Doesn't matter. NPA classification is based on recovery. If recovery is not there for more than 90 days, security is there, sir, customer is good, sir, customer is honest, sir, that and all doesn't matter. We will classify it as an NPA. That's it. And if the moment you classify it as an NPA, you need to create provision. So NPA classification is based on record of recovery, not based on security, not based on guarantee, not based on net worth of the borrower. And remember, once a particular loan of a borrower is classified as NPA, remaining loans of the borrower with the same bank will also be classified as an NPA. Suppose mine is a State Bank of India. I gave 5 loans to a customer. Housing loan became NPA. Remaining 4 loans also becomes NPA. Sir, he has a loan with ICICI Bank also. For ICICI Bank, he is repaying everything on time. That will also become NPA? No. With the same bank where one of the loan became NPA, remaining loans became NPA. With other bank, it will not affect. With other, see, every bank has to decide NPA on their own. That's it. That's it. Next, further, the moment a loan became an NPA, it has to be classified under substandard doubtful loss. Substandard means what? It is NPA for less than 12 months. Up to 12 months, no. Once 90 days crossed, it's an NPA. 91st day onwards, that itself is first day again. So up to 12 months, it is treated as substandard. On a substandard asset, provision has to be created on outstanding amount. 15% provision is required. Secured, unsecured portion, doesn't matter. Straight away 15% provision. Doubtful asset. Assets which are in substandard, suppose already NPA over, 12 months over. After NPA, 12 months over, then it will go into doubtful category. The moment it goes to doubtful category, unsecured portion of the loan 100% advance, secured portion we will classify into D1, D2, D3. First 1 year after substandard category, after substandard after 1 year, D1, 25% secured. 1 to 2 years, 1 to 3 years, 40%. Beyond 3 years, 100%. Suppose if the asset is treated as loss asset, okay, and not fully written off in the bank, then 100% provision you can maintain. That's it. A loss asset, no, they either they can create 100% provision or they will write off completely. Any of it can be done. That's it. 1 minute. Yeah, that's it. I hope everything is clear. Next. Now, this is one standard NPA norm. That is normal NPA norm. Normal NPA norm is what? Term loan more than 90 days overdue, bills purchased more than 90 days, credit, cash credit and overdraft out of order. These are the cases. Apart from this, there are some special NPA norms. What are the special NPA norms? Accounts regularized at the balance sheet date, near balance sheet date. Means actually during the year it became NPA. But again customer repaid by 31st March. Now again it became NPA. If at all, you know what happens, in some banks, no, customer will repay before 31st March. Again after March, no, he will withdraw money. Oh, just to remove NPA logic, just to make sure there is no NPAs on 31st March, customer repay temporarily, again he withdrawn later. If at all you think it is something a bank manipulation, you will treat it as NPA even though there is a repayment. So these are the accounts where credits were there just before balance sheet date. You know, these accounts asset classification of these kind of accounts, no, be handled with care. If data indicates weakness, the account is treated as NPA, and the auditor shall check sample transactions before and after closing of the year. And if credits are reversed during the first few days after closing, so after 31st March it became regular, again later on the payments are reversed. It's an inherent weakness, straight away we will classify it as NPA. Government guaranteed advances. Government guaranteed advances are two types: central government guaranteed advance, state government guaranteed advance. State government guaranteed advance, straight away NPA. If there is a overdue for more than 90 days, straight away NPA. Principal amount to NPA, interest and all we will not recognize. See, what is the consequence of NPA? Suppose if a loan is given, a loan is treated as NPA. What is the consequence of treating a loan as an NPA? Very simple. We will create a provision on the outstanding amount. That is one consequence. Two, interest on that amount, interest on that loan, bank will not recognize on accrual basis. Once the loan became NPA, on that loan, interest income is not recognized on accrual. You know, banks will recognize accrual. Banks follow accrual basis for income recognition, expense recognition, all that. Accrual means what? The moment month over, they will recognize the income. The moment 31st March comes, full year interest they will recognize, whether you repay or not. That is called accrual. But if the loan is NPA, and NPA, interest amount they cannot recognize on accrual unless customer repays. Now, central government guaranteed advance. So that is state government, normal treatment. For central government guaranteed advance, no, advances are treated as standard asset. Sir, actually there is a default. More than 90 days is there. Default is there. More than 90 days gone. More than 90 days is there. Default is there. Still it is treated as a standard asset only. If the guarantee is not repudiated, not revoked, means not invoked or not repudiated, means not cancelled. Very simple. However, for income recognition, it is treated as NPA. Central government guaranteed advance, principal outstanding, it is treated as standard asset, no provisioning. Whereas for interest recognition point of view, it is treated as NPA, means we will not recognize interest income. Whereas state government guaranteed, no, it is straight away NPA for principal purpose interest. So principal amount, state government guaranteed advance, if at all it became NPA, provision has to be created at 15%, 25, 40, 100 as the case may be. Interest also we will not recognize. Whereas central government guaranteed advance, we will not create a provision. Even though the loan became NPA, we will not create a provision because central government guarantee is there. However, in both the cases, interest will not be recognized on accrual basis. That's it. Next, advances under consortium. Consortium means what? You know, multiple banks together giving a loan, single loan to a customer. Okay, generally big infrastructure projects and all, consortium loans will be there in infrastructure projects. So loans given by two or more banks jointly by forming a group, that's called consortium. Now the bank which is giving high amount of loan will lead that group, that's called lead bank. You know, in consortium loans also, each bank will get loan recovery from the borrower. So each bank will classify the borrower account based on respective bank recovery. That's it. If borrower remit funds to the lead bank, but lead bank is not transferring to remaining banks, remaining bank will treat the customer account as NPA automatically. So lead bank will compute drawing power and allocate to member banks. Borrower may require may request lead bank to adjust the drawing power between the banks, all that. Now here they have given computation of drawing power in the ICA book. This method, this format is wrong. ICA has given a wrong format. How to compute drawing power, I will tell you. Very important, this even in the recent CA final exam also they have asked drawing power calculation in the MCQ. They have asked MCQ in CA final May 25 exam. They have asked in inter also many times they asked how to calculate drawing power. In exam they will give you stock value, they'll give you debtors value. Okay, they will also give you creditors value. Now stock, sometimes in the stock, like total stock value 100 crore. Now they will give you 10 crore worth of stock is obsolete or damage, something they'll give you, which means you should consider only 90 crore. Then they will give you something called debtors. Total debtors is 20 crore. In this, more than 90 days outstanding debtors are some 5 crore. So you should only consider 15 crore. Okay, so inventory, only 90 crore worth of inventory, excluding damaged inventory, absolute, that has to be considered. Debtors, excluding long outstanding, more than 90 days overdue debtors, bank will not consider. So remaining 15 crore, fine. So creditors, let us assume 30 crore creditor is there. Now how to compute the drawing power? Stock is how much? 90 crore minus creditors how much? 30. So creditors means what? See, when you're considering stock, when you're calculating drawing power, when you're considering stock, only one stock has to be considered. 90 crore is a total stock value, considerable stock value, minus 30 crore outstanding, 60. This is inventory, this is stock. Debtors, 15 crore, correct? 15 crore minus inventory. Bank is creating 30% margin, means they will not give you full value of inventory as a loan, 30% margin. On debtors, some 40% margin is there. So balance 42 is equal to 18 is equal to 15 4s are 6. Okay, that's it. So 9 crore. So total drawing power is 51 crore. Like this you need to compute. So very simple, stock value they will give you, from that creditors value reduce, letter of credit value reduce, you will get paid stock value. Out of the paid stock, this is paid stock value. So paid means my own stock. In this my own stock, eliminate the margin, balance amount, you can draw the money. Debtors also, eliminate ineligible debtors, then out of that eliminate margin, then you will get considerable debtors ultimately. So this much you can withdraw in the form of an OD or cash credit from me, from the bank. So this is how drawing power has to be calculated. Remember this particular format. Okay, next, accounts with erosion in security value. Remember, one of the point why a bank will give is based on the security. And you know what happened now? If realizable value of the security is less than 10% of the outstanding amount, directly the bank will classify that loan as a loss asset and write off. Actually, customer is repaying regularly. In spite is repaying regularly, bank will treat that loan as a loss asset straight away. When very simple. Outstanding amount 100 crore is there. Security, customer gave a security already long back. The value is 200 crore earlier. But right now the security value is 5 crore. Realizable value of the security is 5 crore, which is less than 10% of the outstanding loan. Array, customer is repaying on time, that doesn't matter. Straight away classify that as a loss asset and write off fully. Doubtful. So, erosion refers to destruction in value of the security. So the customer gave some security, that security value itself is gone. That's called erosion. That time how to treat it as? Loss asset. You will treat that loan as a loss asset if the value of the security is less than 10% of the outstanding loan. Suppose if the value of the security is less than 50% of the previous valuation. Last time we did valued some 6 months before. That time what value is there? Now we did again value. The current value is less than 50% of the last time valuation. Then the loan amount is treated as doubtful and provisioning will be made as per doubtful assets. Next, advances against term deposit NSC KVP. Generally, if a customer is not repaying, if more than 90 days he is not repaying, straight away we will treat as NPA. Correct? Based on record of recovery we will apply. But if the customer gave a security and that security is a term deposit and the security is a national savings certificate or Kisan Vikas Patra, Indra Vikas Patra, that Patras he gave a security, then we will not classify the loan as NPA. Sir, 90 days crossed, sir, overdue crossed more than 90 days. We will not treat it as NPA so long the asset is, so long the loan is secured by them until adequate margin is available. So which means principal is treated as standard asset, interest also recognized on accrual basis, both. Remember, central government guaranteed advance. If there is a more than 90 days overdue, principal we will not classify it as an NPA. No provision. But interest point of view we will stop. But if it is a term deposit, NSC, KVP, IVP security, even interest is recognized on accrual basis. Loan is treated as standard asset. So long margin is adequate, we will classify it as standard. Interest also recognized on accrual basis. Next, Agricultural advances. There are agricultural advances broadly classified into two types: long duration crop loan, short duration crop loan. Okay, so what is a long duration crop? Crop with a crop season more than 1 year. If a crop has a season for more than 1 year, that's a long duration crop. For example, mango. Mango is a long duration crop. Tobacco is a long duration crop. There are many long duration crops. Short duration crop. Vegetables, short duration crops generally. Now, crop season. Crop season means the period up to which harvesting of crops are raised. This crop season is determined by state level bankers committee in each state. In each state, the state level bankers committee will decide crop season. If the crop season is more than 1 year, it's a long duration crop. Remaining crops are simply short duration crop. Now, you gave an agriculture loan. Sir, it's a short duration crop loan I gave, sir, to a farmer who is planting short duration crop. For him I gave a loan. What is a NPA now? It is treated as NPA if installment is overdue for 2 crop seasons. In a short duration crop, the agricultural advance is treated as NPA if the installment is overdue for 2 crop season. Whereas a long duration crop, it is treated as NPA if the installment is remaining overdue for 1 crop season. That's special NPA norms mostly over. Okay, next, computation of drawing power. What is drawing power? I already told. Drawing power is the limit up to which a firm can withdraw from the working capital loan given. Sanction limit is the limit, the total exposure a bank can take for a particular client. DP is calculated based on security value, whereas sanction limit is based on repayment capacity, which is the maximum loan a bank can give. Rules for DP. Accounts, no. The loan accounts must be less than drawing power and sanction limit. If any account outstanding balance is exceeding drawing power sanction limit, it must be brought to the top management. Drawing power in the working capital account must be covered by proper security. DP must be calculated based on the latest stock statement. That stock statement shall not be older than 3 months. If there is an outstanding loan where stock statement is older than 3 months, then the account is treated as irregular. Irregular means what? NPA. So DP, drawing power computation, must follow guidelines of the bank. Special focus must be given on sundry creditors. I told you, identify paid stock. From the paid stock, eliminate margin. Then only the balance amount is considered for drawing power. So, what are the auditor's concerns in drawing power and sanction limit? Verify stock statements, quarter returns, and other borrowers' data. Compare monthly stock statements, all that. Stock audit. Stock audit is required where loan accounts are having funded exposure more than 5 crore. Auditors can recommend stock audit in other cases also. Review stock audit reports during the audit, focusing on valuation of security and calculation of drawing power, all that. In case of consortium lending, stock audit report shall be obtained from lead banker, because lead banker will do stock audit. Audit of advances. In audit of advances, controls you need to verify. Efficacy of advances, efficacy of controls. Controls means what? See that advances are made only after verifying borrower credit worthiness. See whether the bank has a credit worthiness process or not. See necessary documents are executed before disbursing the loan. Compliance with the terms of the sanction. See whether the bank is checking end use of the funds. See whether the bank is maintaining margin. See whether bank is creating a security or not. See that drawing power registered is updated on a monthly basis. Accounts should stay within the drawing power. Irregular accounts shall be reported to controlling authorities. Review each advance account once in a year or more frequently in case of large advances. Substantive. The auditor can obtain sufficient appropriate procedure by verifying recorded loan amount, checking loan documentation, review account operation, ensure security valuation, all that. Then finally we have something called audit of incomes. In audit of incomes, you see here we have completed. Now what are all the points we have completed already in bank audit? Audit of advance, audit reports, all that is completed. NPA norms, special NPA norms completed. DP calculation I have completed. Now audit of income, reversal of income, and expenditure audit. So if this is completed, bank audit is over. 5 marks is yours. Next, generally what audit of income. Bank recognize income on accrual basis unless collection is uncertain. Whereas on NPA, no income is recognized on NPA until it is realized. However, for newly classified NPAs, if at all any loan is recently classified as NPA, if any interest is recognized on accrual but not yet recovered, shall be reversed. Once an account is turning into NPA, unrealized interest is reversed and recorded in some dummy account called memorandum account. Remember, interest on term deposit, interest on loans against term deposits, interest on Loans against term deposit, that's the right word, okay, can be recognized on due date as long as adequate margin is existing. Bills purchased and discounted. For any outstanding bills which are purchased, which is outstanding as on 31st March, the discount received shall be apportioned between 2 years. The unexpired discount must be shown under other liabilities. Interest on rediscounted bills should not be netted off from the discount earned. These are all important for MCQs. Bills collection. Bills for collection. Suppose if a customer submitted me bills, I will ask him, you want me to discount or you want me to just collect? Collect, he told me. Then income will be recognized only after actual collection. Branch commission is due and recognized only after the bill is actually collected. Partial recoveries in NPA. In absence of clarity, bank must adopt a consistent policy. Recognize income only when certainty attaches. Ensure that interest is not from any fresh loan given. Reversal of interest on NPA. What is this reversal? If an advance becomes NPA, the entire accrued interest must be reversed. If at all already recognized on accrual basis and not yet recovered, reverse it. Even for government guaranteed advances, interest has to be reversed. Fees, commission, everything has to be reversed. For wrongly recognized income, reverse the amount to provide equal or make a provision. And remaining, take out finance. This itself can be asked as a 3 marks question. What is take out finance? Originally, one bank will give a loan. Now that loan will be taken over by another bank. Means the customer will transfer that loan from previous bank to this bank. That is called take out finance. A take out finance replaces an initial loan with a long-term financing. This is generally used in property developments, infrastructure projects. That is also classified as NPA. Income should be recognized only when realized from borrower. So what is the objective of takeover finance? Address sectorial gap, boost availability of long-term firms, all that. That's a very simple thing. Audit of expenses. In expense audit, interest expenditure is most important. Interest expenditure on deposits, FDs, savings deposit, all that will be the right. So that is the interest expenditure for the bank. Get a quarterly analysis of deposits and compute weighted average interest. Compare average interest rate with previous years. Obtain general ledger breakup of interest. Perform monthly or quarterly cost analysis and document various reasons. Sometimes they'll ask you analytical procedures on interest audit. 1, 2, 4. These 3 points only they'll ask you. And further, auditor has to test check calculations. This itself they can ask you for a 4 marks question. So interest calculations, the auditor has to perform test check of calculation of interest. What? See that interest is provided on all FDs up to balance sheet date. Rates comply with bank regulations, RBI directives. Interest on savings accounts follow as per the bank rules. Interest on interbranch is provided. And also see interest rate changes as per the rate card. And recompute the interest accrual by considering various parameters. Audit of provisions and contingencies is one of the exams they have asked this. That's it. I think this is not a big deal. Provisions means what? See, understand bank's provisioning process for standard assets and non-performing. Verify loan classification correctly done or not. Reconcile loan classification with various general ledger. Audit tax provisions also. Review for provision for various other expenses, all that. See that provision is calculated as per regulatory requirements and as per RBI circulars, all that. That's it. Actually, up to NPA norms is there, that is only critical part. So that we have understood with a very clear discussion. That's it. 46 minutes bank audit is over. I hope you have thoroughly recollected everything in the bank audit. Apart from this, is there any other important question? One question is there. I'll show you one more question. Risk management process in a bank. Risk management in a process. This is also important. Once in one of the attempts it was asked in old scheme. So bank must have, top management must involve. Bank must identify the risk. Bank must implement various control activities like segregation of duty, all that. Banks must regularly check their monitoring activities. Bank shall maintain reliable information system. These are all part of risk management process. These are nothing but 5 control 5 elements of control system. Internal control system has 5 components, right? That only here they named it in a different way. That's it. Okay, this itself was asked as once as a 4 marks question previously, long ago. That's it. There is no other question which is important in bank audit. Everything is covered. Everything is covered. That's it. So I hope you thoroughly enjoyed with the bank audit session. Okay, yeah, we'll continue tomorrow the remaining live sessions. That's it. Take care. I think the audio, video, everything is perfect, guys. Perfect. So now let's begin. Let's continue the discussion of audit strategy, planning and program. Okay. So this particular chapter will have a weightage of minimum 9 to 12 marks. And you know what? This chapter is just 10 pages. Only 10 pages, 5 papers, both the sides, 10 pages. That's it. Very small chapter. But the weightage is close to minimum 9 marks to 12 marks. Why? Even though it's the smallest chapter, the weightage is very high. Like, why it is so? It's not the pages which is important. It's the complexity of the content which is most important. You know, in this chapter, the content is very complex. And in fact, most of the times till date, I never uploaded this topic as a revision on the YouTube. Till date, I never uploaded because I feel one of the very patent. It's like I have a patent on this chapter because I decoded this chapter like anything. But for the first time, after the live is completed also the video will be remaining, don't worry at all. Okay, so fine. So but for the first time I'm doing this revision to make sure everyone benefited from this. So in this chapter there are 3 terms. What are the 3 terms that are there? Strategy, planning and program. Audit strategy, audit planning and audit program. Yes, audit program is very important. Every topic in this chapter is equally important. Are it 10 pages chapter? Yeah, any question can come from this. Any topic can be tested from this. Now, so audit strategy, planning and program. Basically, this chapter is nothing but SA 300 standard. What is SA 300 standard? You can see here SA 300, planning and audit of financial statement. You see the word used is planning. Planning and audit of financial statements, whereas the chapter heading is what? Strategy, planning and program. Okay, planning of an audit of financial statements. What do you mean by planning? Planning includes 3 terms: strategy, plan, program. Audit strategy, audit plan, audit program. All the 3 we will call it as planning. So this is the most important thing. Now first, the most important thing, what are the elements of planning? What are the elements of planning? There are 2 elements in planning. Just a minute. Yeah, there are 2 elements in planning. One, preliminary engagement activity. One is preliminary engagement activity, one of the element of planning. Remember, I'm not talking about planning activity. Planning activity is another element of planning. There are 2 elements of planning. One, preliminary engagement activity. 2, planning activities. Planning activities includes 2 more. One is establishing strategy, another one development of an audit plan. So strategy establishment, development of an audit plan, both are together, we call it as planning activities. Preliminary engagement activity is one of the planning activity. Now, what are preliminary engagement activities? Here I am going to cover. What are preliminary engagement activities? Here I am going to cover. Now, so this understanding is very important. Now, what is the difference between strategy, plan and program? Even though the chapter heading is planning, okay, I actually call it as plan. Audit plan, audit strategy, audit plan, audit program. Audit strategy is never visible in the form of a document. Audit strategy is nothing but in the mindset of the auditor. In the mind of the auditor, what is he thinking about? How he is going to do the audit as a whole? That is strategy. Whereas audit plan, audit program, they both will be in a documented format. Audit plan will be documented, audit program will also be documented. Generally, strategy you will not find any documentation. Strategy is like a preliminary thinking of the auditor. Whatever the auditor is thinking about how to do this audit, what to do in this audit, that is preliminary thinking. Now this entire process, whether you call it as strategy, whether you call it as plan, whether you call it as program, this entire process is called as audit planning. This entire process is called as audit planning. Now, many times in exam they have asked this question: what are the benefits of planning? 4 marks question, 5 marks question. Benefits of planning means what? Many students here, what they think, benefits of audit plan. That's wrong. Plan is different, strategy is different, program is different, planning is different. Planning means everything. Designing a strategy, development of a strategy, development of a plan, development of a program, all are elements of planning. They are all part of the planning. Now look at benefits of planning activities. What are planning activities? Planning is important so that you will do timely execution. Yes or no? And it ensures compliance with standards, enhances the audit engagement. Whatever the audit you are conducting, the quality will be enhanced. Planning ensures you comply with various auditing standards. Planning will help you to effectively and efficiently do a timely execution. So that is what importance. Benefits what? It helps you to focus on important areas. Audit planning benefits the auditor to focus on important areas. Most important question this is. Planning will help you to identify and resolve potential problems. So all potential problems you can resolve, and it will help you to organize and manage the audit for efficiency and effectiveness. It will help you in assisting the team members with appropriate competence. It facilitates direction, supervision, review of team members. It will help you to coordinate branch auditors, experts, all that, internal auditors, branch auditors, experts. Coordination is a benefit of planning. It helps you to facilitate, it helps you to direct, supervise and review team members' work. It helps you to select team members with the right competences. It helps you to organize and manage the audit so that you can do an efficient and effective audit. It helps you to identify potential problems in timely manner. Remember, this is planning benefits. Planning means what? Entire strategy, audit plan, audit program, whatever thing you take, they're all part of planning process. Generally, planning benefits are what? That's why here many students confuse. Sir, suppose we have another topic called advantages of program. We have another question called advantages of overall audit strategy. We have two more topics. How overall audit strategy assists the auditor, how strategy benefits the auditor. 2, how program benefits the auditor. In those two also, some of these points will be repeated. That is where many students confuse. Sir, in audit strategy chapter, many points are confusing. Why in planning some points are repeated there? How to remember? No need to worry. Planning is a overall. Whereas audit strategy is a very normal term. Audit program is a very narrow term. These two are narrow. Planning is a wide term. Planning includes everything. That's it. This is the main difference. Okay. Next. So if at all you are doing a proper planning, if at all you are planning the audit in an efficient manner, you can reduce the audit risk to an acceptable low level. You can reduce the risk to low level. Okay, that's it. Now again coming back. So what are the elements of planning? 2. One is preliminary engagement activity, and another one is planning activity include overall audit strategy establishment, plan establishment. Now preliminary engagement activity, 3 activities are mainly called as preliminary engagement. 1, acceptance and continuation of client relationship. This is there in 220. This point is explaining 220. What do you mean by acceptance and continuation of client relationship? The firm, the audit firm, whoever is doing audit, getting it, before they accept a client, before they accept an engagement with an existing client. See, there are 2 things, new client or existing client. From a new client, you are accepting new engagement from new client, or before accepting new engagement from existing client. Suppose existing client I have, for whom I am already doing company audit. The existing client is asking me to do income tax audit also. Means I am going to accept new engagement from existing client. Or existing client, I completed 5 years audit. The existing client is asking me, sir, can you accept for next 5 years also appointment? Then continuation of an existing engagement with existing client. So 1, new engagement from new client. 2, new engagement from existing client. 3, continuation of existing engagement with existing client. If any of these 3 proposals came to you, what a firm has to consider? So those points are covered under acceptance and continuation of client relationship. So before accepting or before continuing the engagement, 4 points you need to get. Integrity of the owners. Get integrity. Look at their integrity. How are they? Like, are they honest people? What is the reputation? How far they are they are honoring accounting standards. What is their business practices? How is their treatment with the auditors? Discussing with previous auditors. All that comes under what? Integrity of the principal owners. Are there any raids going on? Are there any issues going on? So get that information. Integrity of the owners. Competence of the team members to perform. See, before I accept a client, first I will say, is he good guy? Is the client a honest guy? Second thing, he is asking me to do some work, right? Can I do that work? Suppose if a bank is asking me to do a bank audit, I don't have experience at all in bank audit. I will not do. So second important thing before I accept a client, what should I check is competence of my team members. Whether do I have competence, competence of the engagement team. Third one, any matters arising during current or previous engagement. Suppose if my existing client is asking me to take a new work, or my existing client is asking me to continue the work, getting it. So I will look into matters which are there in the current and previous. And for initial audit engagement, previous auditor also I need to communicate. First time they're asking me, then I will also communicate with their previous auditor. So preliminary engagement activities, one of the basic thing that you need to do at the beginning stage of the audit before you accept the audit is first one, acceptance and continuation. Second one, compliance with ethical requirements. Third one, establishing terms. First one, do procedures as per 220. First do procedures as per 220. Then check ethical requirements. Then do procedures as per SA 210. Sir, what is SA 210? I already covered it in part 1 audit marathon. Establishing understanding of the terms of engagement. Now establishing terms. Send an engagement letter before starting the audit to avoid misunderstanding, and see that there is no confusion with the client regarding the terms. What are terms of engagement? Terms of engagement are what? Objective and scope of audit, management responsibility, auditor responsibility, financial reporting framework, audit reporting. These are all various contents of the engagement letter, right? So get an acknowledgement on these elements. Then ethical requirements. Auditor has to, in fact there is a chapter, ethics and terms of engagement. We have a chapter in ICA, it is 11th chapter, whereas in our GOAT notes it is 2nd chapter. Continuously evaluate compliance with ethical requirements, including independence. The engagement partner means what? The one who is going to sign the audit report ultimately. The engagement partner shall remain alert for evidence of non-compliance with ethical requirements. In case of non-compliance, please take appropriate action. Engagement partner shall form conclusion on compliance of independence. This is very important topic, one of the important in requirement in a planning activities, relevant ethical requirements, compliance with relevant ethical requirements. They may ask you this itself as a 5 marks question. Continuously you should evaluate compliance with ethical requirements. In case of non-compliance, engagement partner shall be remain alert to see whether there is any non-compliance. If there is any non-compliance with with ethical requirements, take appropriate. For example, non-compliance with ethical requirement means, for example, I accepted one company audit. In that company, my relative has shareholding more than 1 lakh. What should I do? So these are all non-compliant. What should I do? So that's it. Now, engagement partner shall form conclusion on compliance. So how will you conclude whether the firm is complying with independence or not? Whether an audit firm, whether the team members, are they complying with independence or not? How do you conclude? First, obtain information to identify threats. I will ask all the partners, my team members, whether do they have any shares in the company like that. I will evaluate identified breaches of the firm independent policies. Our firm will have SQC policies will be there. Quality control manuals will be there. Quality control system will be there. Independence related policies will be there. Ethical requirement policies will be there. With those policies and rules, I will check. Take appropriate action to eliminate the threat. Suppose if any threat is there, I will try to eliminate the threat, or I will reduce it to acceptable level. And I will report to the firm in case of unresolved matters. Even after applying resolution, if at all I am unable to resolve some threats, I will report it to the firm's main CEO. Firm's managing partner will be there. To him I will be reporting. Sir, what is firm's managing partner, firm's CEO, all that? We have never seen these words. It is there in SQC. It is there in SQC. That's it. So this is a preliminary engagement activity. So sometimes in exam, this itself they'll ask you as a 5 marks question. What are preliminary engagement activity? You need to write the headings and 2 points. Write the headings, 2 points. Write the heading, 2 points. Sometimes in exams, only relevant ethical requirements they will ask. Sometimes in exam, only acceptance and continuation of client relationship point alone they will be asking. So be careful. These are planning. What do you mean by planning? I told you what is the benefit of planning, what are the elements of planning, what are the planning activities, what are preliminary engagement. This is one of the element of planning, right? Now tell me, planning is a continuous process. It's not a one-time process. Like, I will plan audit at the beginning. As I proceed further, if at all I find some changes are required, I will change it. So planning is not a one time, it's a continuous process. Planning is not a discrete, it is not a separate phase in audit. It's there throughout the audit. It's a continuous and repetitive, iterative process. So generally planning begins after completion of previous audit and continue until completion of the current audit. Once I complete previous audit in the same company, I will immediately start working about the next year audit. Then the audit plan should be reviewed periodically to ensure that any newly identified areas will not be missed. Now, what are the considerations in planning? What you will consider when you're planning? Obviously, considerations in planning. Again, here, no, you will find another question. What points you will consider while developing audit strategy? What points you will consider while developing audit plan? What points you will consider while developing a program? Like this, you will find 3 more questions. This is considerations in planning, considerations in strategy, considerations in program, considerations in plan. There are 3 more ways. That is why even though the chapter is less than 10 pages, even though the high weightage is very high, there are high chances that if this question is asked, a student might write some other answer. That is the reason why this chapter is very complex. Even though you read number of times, you will not understand. So this is one of the very severe chapter, very tough chapter in the CA Intro Audit. I can say in CA Intro Audit, there are 2 toughest chapters. One is strategy topic, which is very toughest. Another one, risk assessment. But risk assessment is very lengthy chapter. That's the reason I always tell students to leave it. Don't even touch that. Especially in risk assessment, no internal control part is there. That is very tough. Leave it. Okay, fine. Planning. Anyhow, this planning chapter I'm revising you now thoroughly, where I'm giving you crystal clear clarity what exactly the terms are. Now, so what are the considerations? So when you're planning, no, whether you're developing strategy, plan, program, leave it aside. You want to plan an audit of a client. You want to conduct an audit of a particular company. What are all you should consider when you're planning the audit? Understand the legal environment, regulatory environment applicable to the entity. What is the legal and regulatory framework applicable? Okay. See whether any analytical processes can be applied or not. Determine materiality for that particular client. See whether any expert assistance is required or not, especially when we are doing audit of insurance companies, when we are doing audit of electricity companies, when we do audit of any some oil companies, we generally take the help of experts. Perform risk assessment to identify risk. So these are all the points, these are all the things that you need to consider when you're planning an audit of financial statements. Then tell me, when you're planning, will auditor engage? See, engagement partner is the one who will sign the audit report ultimately. Will he only plan the entire audit, or will he involve some team members also? Will he discuss will he discuss with somebody else? Yes, obviously. You can't develop plan isolatedly. You have to discuss with management. You have to discuss with your team members. Like, your team is not going to do the audit. So, see, ultimate responsibility for planning is with the engagement partner, no doubt. Partner is only ultimately responsible because the client appointed the firm and the partner has to sign the audit report. So partner is only ultimately responsible for planning, sole responsibility. But even though you have 100% responsibility, you should discuss certain points when you are planning the audit. Whether it's a strategy forming, plan development, program development, when you are developing the plan, program, strategy, all that, when you're doing the audit, you should consult various people. So what are they? Involvement of the engagement team. First, I will involve my team members. Like, why? The engagement partner and key team members, important team members must be involved in planning the audit, and discussions must be there among the team members. Their involvement increases effectiveness and efficiency of audit, through their experience and insight. So when I involve my team members, I will know whether they can be able to work on particular matter or not. Accordingly, I can allocate the work according to their competences, experience, all that. That's why I should not develop the plan without discussing with my team members. My team members must be there when I'm planning the audit. Remember, only partner is not doing the audit. Entire team members as well as partner together, they are doing the audit. Then not only that, I should also discuss with management of the client. Client management also I should discuss. I should discuss with them when I'm developing my plan, everything. I should discuss with them also. When I'm planning the audit, I should discuss. Why? You should tell the client when are you going to come for audit. What are all the points that you are going to verify briefly. Remember, you don't have to discuss in depth. The auditor may discuss planning elements with company's management to facilitate. They can facilitate you then only. Suddenly overnight you decided tomorrow you went for audit. The corresponding accountant is absent in the company. What you will do? So ensure that discussions do not compromise effectiveness of audit. Do not compromise. See, how are you going to verify? Purchases, how are you going to verify? Sales, how are you going to verify? Inventory, how are you going to verify? Don't tell them how are you going to do the work. Tell them that I want to do the work on so and so date, so and so time. What you will verify inside that? No need to tell them. Matters related to surprise checks. Matters related to surprise checks should not be included in the discussion. Obviously, when you're discussing with the client, you shouldn't. Now see, you are involving your team member, you're involving client management. just because you're involving them, will they also be responsible for planning? Not at all. They are not responsible for planning. Who is responsible for planning? The auditor is ultimately responsible for strategy, plan, everything. The auditor may discuss elements of planning with the management. However, make sure that audit is not compromised. That's it. So one of the main segment in this topic is covered. Planning means what we understood. Now planning includes three elements. Sorry, planning includes three parts: strategy making, plan development, program development. Now, what do you mean by strategy? Look at this. What do you mean by audit strategy? First of all, audit strategy is something that sets scope of the audit, timing of the audit, direction of the audit, and guides the development of an audit plan. Generally, strategy is in the mind of the auditor. Generally, strategy will not be visible. Strategy will be like a descriptive. Okay, audit strategy covers so many things. So strategy sets scope of the audit. Okay, so look, we are bank branch auditors. For a particular bank, for a particular some 5 or 6 branches only, we are the auditor. Scope, 5 branches. Timing, we need to finish this audit by April 10th, for example. The client appointed us in somewhere in September, October. So we need to finish audit and then give the report by April 10th. So some 20 days time only we have. Direction of the audit, we need to do audit in the context of statutory audit as per RBI guidelines, like that. Overall audit strategy assists the auditor in various ways. Like how strategy will help the auditor. Strategy will help me to identify resources to deploy, use of experienced team members, involvement of experts on complex matter, assigning resources to specific audit areas. Just a minute. Yeah. Review of other auditors' work, allocating audit budget, deciding when the resources are to be deployed. Resources means what? Manpower. In audit, no. For auditors, what is the resources? Manpower. And interim stage, key cutoff stage, all that. Management of resources. Generally, no. In the initial stages of audit, no, I may do audit with 8 or 9 members, for example. But at the cutoff date, as on 31st March, because I need to finalize the audit, I want 15 team members. So timing of resources. Initially, quarterly, initially we will do quarterly audits. That time only 5-6 members are required. But at the time of completion of audit, finalization, every team member, 15 members has to come, like that. Management, see, these are all various benefits, ma. These are all various benefits of strategy. Strategy means what? Briefly, what should I do? Okay, I need to do audit as per Companies Act stat audit. I need to comply with accounting standards. I need to verify whether the financials are prepared as per accounting standard. My objective is to give an opinion. Okay, briefly, I require some 30-40 days of time. And this overall view is called as what? Strategy. Then management of resources. Actually, in our normal class, no, we discuss more in depth with various examples, all that. Okay, but here it's a revision class, since I can't discuss at that level now. So management. So how strategy benefits? Strategy benefits auditor in identifying the resources, in allocating the resources, in deciding the timing of resources, and management of resources. Resources to deploy. What resources are required? Where to deploy? Allocation, when to deploy, and as a whole, management of resources. Okay, so like scheduling meetings, team briefing and debriefing meetings, team meetings will be there. Determining how reviews by partners and managers will occur. So like, our team will be working in the client premises, right? When should I review the work, and whether to complete quality control reviews or not. In SQC, for listed companies, audit engagements, review, quality control reviews compulsory. So when this should happen? All these points I will get to know only when I'm developing a strategy. So strategy making helps the auditor in these many ways. Any 4 sub points, these are all various sub points. Any 4 or 5. Okay, so they may ask you, many times they have asked, what are the how overall audit strategy assist the auditor? How overall audit strategy assist? How it will be beneficial to the auditor? Remember, benefits of planning, that is different. Benefits of audit strategy, the answer is different. Be careful. There is a high possibility that student might write a same answer. Again, we have another question: advantages of program. Later we have another concept called program, audit program. There also we have a discussion called advantage of program. So be careful. Next. So when I'm developing a strategy, what factors I should consider? There are 5 factors that we consider. One, Characteristics of the engagement that define the scope. So when I'm developing a strategy, first I should see the characteristics of the engagement. Is it a stat auditor, internal auditor, stat audit? For example, it's a stat audit. Is it a normal company, a bank, insurance? These are all we call it as characteristics of the engagement. Reporting objectives. Reporting objective is different. Reporting requirement is different. Reporting standards are different. Reporting objectives, this is nothing but communication objectives. This is nothing but communication objectives. Here SA 260 standard will help you. Then, where significant factors in directing. So in every audit, my team will be focusing on certain areas where there are some risks. So significant factors in directing team efforts. In the recent Jan 25, on this one question came, 5 marks question, telecommunication company, digital database, like that one question came in Jan 25. On this only they asked. The question is so practical, so depth. Like only students who understand this topic conceptually can figure out the answer. Fine, anyhow, I'll come back. And results of preliminary engagement. What is preliminary engagement activity? I told acceptance and continuation of client relationship, establishing terms of engagement, compliance with relevant ethical requirements. These are all preliminary. The preliminary engagement activity, when you are performing in a client, you will get to know some information. That also you should consider while developing your audit strategy. So when you're developing an audit strategy, you should consider preliminary engagement activities. You should consider, you should identify where your team efforts has to be directed. And you should also consider reporting objectives. You should consider characteristics of the engagement. Finally, you should consider what is the nature of resources, timing of resources, extent of resources required for the audit. So nature, timing, extent of resources required for audit, that also you should consider. Now look at that. So characteristics of the engagement that define its scope. Characteristics of the engagement means what? What is the financial reporting framework applicable? For banks, financial reporting framework is different. Insurance company, financial reporting framework is different, like that. And specialized knowledge. See the nature of business, what business client is involved in, whether do you require to have a specialized knowledge. What are the industry specific reporting requirements? Whether can you use evidence obtained from previous audits or not. Reporting engagements. Reporting objectives. What is reporting objectives? Plan timing of procedures and communication. When you should, for example, physical verification of inventory, you should generally plan on 31st March. Okay, timing of procedures. And communications, you should frequently update the client what is the status of the audit. So what is the entity's reporting timetable? For example, for a listed company, if I'm auditor, I should give quarterly review reports. Then I should give annually one audit report. So entity's reporting timetable, get it. And organize meetings for discussing nature and timing extent of audit work with management. Discussions with management on type of the reports and timing of the reports. For example, if you're doing a bank audit, in bank audit also you have one question. What are various reports? A bank auditor will give various reports. Ask the management. Communications with management about status of the work. Nature and timing of communication among team members. My team is performing work right, audit right. I should check their work right. When should I check? How should I check? Nature and timing of communication among the team members, including meetings and reviews. These are all called as reporting objectives. Further, I will identify MCOT, SCOT or MCOT, significant class of transaction SCOT, MCOT, material class of transactions, both are same. Material class of transaction ABs, account balances and disclosures. Identify what are all the material transactions in this company, material balances and material disclosures, and direct team efforts to significant matters. Those significant transactions, significant balance are there, right? Give your team attention to those matters. Like what are significant class of transaction? Look at the transaction volume. Look at the transaction volume affecting reliance on internal control, significant industry development, changes in financial reporting framework, changes in legal environment, significant industry development, changes in legal environment. This is what they tested in the Jan 2025 as a practical question. Some telecom regulatory has given some instructions to telecom companies where they need to maintain digital database of some customers or something like that. They gave a question. So practical question. That's it. Next, preliminary. Results of past audit, emphasis of the team, all that. This is a normal thing. So in this, these 3 points are very important. First 3. This itself can be asked as a 4 marks question. This itself can be asked as a 4 marks question, or this third point itself can be asked as a 4 marks question. Anyway, they can ask. Be careful. Next. Once you develop a strategy, what do you mean by planning? We understood. What is a strategy? We understood. How to develop the strategy? We understood. What are the advantages of strategy? We understood. Now plan. Now you need to develop the plan. What is a plan? I'll tell you how a plan looks like. Okay, generally I use ChatGPT all that in the class, but here I don't have time. So plan means what? Serial number, audit area. Okay, for example, risk assessment procedure, team member Mr. A, who is an engagement partner, timing, some 2 days required, instructions, extent, nature, timing, extent, like this. We will list out opening balance verification, purchases, sales, fixed assets, depreciation, like that we will list out. We will allocate the work like this. We will develop some document. This document is called as an audit plan. Okay, audit. So SA 300, what 300 standard says, the audit plan should include risk assessment procedure. The audit plan should include further audit procedure. So not only risk assessment, further audit. Just a minute. Yeah, I think yeah, it is smooth. Perfect. Yeah, no problem. So nature, timing and extent of risk assessment, nature, timing, extent of further audit procedure at assertion level, other planned procedures, okay, to ensure compliance with standards on auditing, and plans for type, timing, scope of audit, including sampling and work allocation, everything has to be considered. Audit plan should include description of this itself, 4 marks question. The audit plan must contain description of the following. What audit plan should contain? What description audit plan should contain? Audit plan should contain risk assessment, audit plan should contain further audit plan should contain any other planned procedures, and not only that, you should plan type, timing, scope of audit. What type of audit procedure you need to do, when you should do, scope, including whether it should be done on a sampling basis, how work allocation must be done, everything will be covered here. That's it. I hope everyone, it's cool, it's smooth, I hope. Yeah, perfect. So the audit plan is more detailed than strategy. Remember, MCQs is important. Focusing on specific procedures to be performed by team members. In audit plan, specifically what we need to do, that only will be major point. Planning occurs over the course of audit with specific stages. In planning, first we do risk assessment, then we do further audit procedures. Sometimes further audit procedures will do immediately for some transactions, whereas for some other transactions planning only we will do. So simultaneously we will do actual audit for some transaction, for some class of transaction we will not even start the audit. For them, planning might be going on simultaneously. Next, what is the relationship between overall audit strategy and audit plan? Audit strategy sets broad overall approach to audit, what exactly overall we need to do, whereas plan talks about specific matters, specific issues, how to do audit of purchases, how to do audit of sales, how to do audit of that. So that is what planning. So audit strategy determines the scope of audit, timing of the audit, direction, whereas audit plan describes how strategy is implemented. There is another word called program. Program is even more detailed. For example, in strategy I understood that I should cover purchase. When should I cover purchase? On purchases I should do risk assessment, further audit, all that is plan. In purchases, what points I should verify, each and every point I will list it out. That is program. Next, audit plan is more detailed than strategy, which includes nature, timing, extent of procedures. Development of an audit plan. Planning of an audit occurs throughout the audit as plan develops and adapts to the engagement. Obviously, planning itself is a continuous activity. Therefore, plan development is also continuous. Plan is not developed overnight. Once audit strategy is established, audit plan is developed. Establishing audit strategy and development of audit plan are not separate but are interrelated process, where changes in one will automatically affect the changes in others. So audit strategy and plan may not be a separate process. They can be one and same. That's why in reality you don't find strategy separately. Plan itself is a strategy document, plan itself is a plan. That's it. Changes to planning. Obviously, the auditor shall update and change overall audit strategy, audit plan as and when necessary. Why you need to change? Unexpected events. Suddenly, when we go to the client warehouse, we found some new inventory. That new inventory we don't have in our plan, so we will have to add it. Changes in condition. New information discovered. Changes in strategy and plan ensures that audit remains effective and revised. Audit plan should be dynamic and flexible. Therefore, modifications can be made. Example, audit evidence from detailed checking may contradict evidence from testing internal control, prompting changes to the plan. So when I'm doing transaction actual checking, substantive procedure, I may find so many mistakes. Originally, I thought internal controls are very effective. Now, when I find so many transactions where controls are failed, so I may have to change my control assumptions. Okay, fine. Let me not discuss so in depth again here. Fine. Now, planning, supervision, review of work of team members. Remember, audit strategy plan planning activities means what? How to do this audit, when to do this audit, when to so and so process, when to perform, all that, right? How to allocate resources, all that, right? Now, I should not only plan how to do the work, I should also plan, so I should also plan to review my team members' work also. My team members will be working, right, in audit. I should also plan when should I review this. Suppose you might have remember engagement quality control review, UQCR, engagement quality control review. When that review should happen, that also I should plan. Yes, the auditor shall plan. The auditor shall plan nature, timing, extent of direction, supervision, and review of the team members. To what extent direction, supervision, and review will happen? It depends upon size and complexity of the entity. It depends upon what audit area. It depends upon assessed risk. It depends upon capability of the team members. If my team members are very capable and competent, I rarely review. I will review at the end of the audit. If my team members are new, they don't have any idea, I will review them very frequently. So nature, direction, supervision, review of the engagement partner. The direction by the partner, supervision by the partner, review by the partner depends upon these factors. This itself can be asked as a 4 marks question. Be careful. And most important, documentation. In the recent exam, this also they have asked for 5 marks question. Documentation part, in Jan 25 exam, they have asked this. You know why you need to document? It's a record of key decisions regarding planning. Facilitates communication with the team member on important issues. Records planned nature, timing, extent of risk assessment, and here it is further. Here it is further audit procedure. Then documentation includes overall strategy, audit plan, and changes to the plan. And remember, it's a record of significant changes. Explains why changes were made. Like why? What is the reason? Originally you thought of 10 days, right? Why you increased it to 15 days? Reflects the final strategy and plan adopted. Oh, you know, changes and all you record, right? So automatically the audit plan, whatever you're documenting, is the final version. Shows appropriate response to changes during the audit. So originally how we planned, later how we changed it. So all that information will be there. That's it. So this is documentation of the audit plan. This itself has been asked as a 5 marks question. Remember, I need to cover in a revision class, I need to cover in a shortest time. So I can't give so many logics and all. Okay, in our actual class, we'll be discussing very in depth this particular chapter, where we'll discuss so many issues. We will be repeating all this. But remember that this is a revision video. So if any of you feel like you're not able to understand some points, remember that this is a revision video. I'm trying my level best. It's very stressful for me to compress the entire content in shortest amount of time so that your time will be saved, so that you will focus on reading it again and again. Then the next topic in this chapter is program. What is an audit program? Audit program is a detailed plan. Plan is a detailed strategy. Program is a detailed plan. Simple. And all these 3 are called as planning activities. Now, so audit program is a detailed plan comprising series of verification steps to be applied, okay, to gather sufficient appropriate evidence so that you can form an opinion. So audit plan, it gives you, program will give you instructions. Purchases, verify purchase order, verify GRN, verify so and so, verify receipt, verify vendor master. Like that, so many points you need to verify each team member. That's a program. Okay. Now, can one program be there for all the clients, for all the businesses? Not possible, because every business has different processes. So evolving one audit program is not practicable for all businesses. Nature, size, and composition of business vary. Obviously every business size will vary, nature will vary. Yes or no? Internal controls are different in every business. Nature of services rendered by auditors varies from one assignment to another assignment. So necessary of tailored program. So for each business you need to have a tailored, you need to customize the program. You can have one standard program, but you need to customize it as per the requirements of each client. So tailored program will prevent time wastage on irrelevant matters. So tailored program means what? For each client, specific program has to be developed. Address special situations. Ensure audit program is aligned to specific circumstance. So you should align the program as per the specific circumstance of the client. So assistance, I should tell my team members, my articles and all, keep an open mind. Program, I told you 10 points to verifying purchase. Suppose when you're verifying purchases, you found some 11th point, immediately please come and tell me. So the auditor frames a standard program considering nature of the company, size of the company, composition of the business, and dependability of the intern. So after studying a particular company, for that company I will develop one program, so that my team member will follow the program, so that quality of work can be enhanced. At the same time, I should tell my team member, don't only blindly follow the program. If you find some changes are required, please immediately come back and tell me. This program gives you a minimum work only. Audit program is only giving a minimum guidance. That is not exhaustive. Alterations. As experience is gained, the program may be altered. some work which may be irrelevant may be deleted. So assistants must be encouraged to keep an open mind beyond the given program, note and report significant matters to seniors and partners of the firm. So program has to be reviewed periodically. Audit program should undergo regular review to ensure that it is adequate. Changes in the client business policy may render sometimes original at the beginning of the audit. I might have thinking the client is so and so, but as we started the audit, the client would have changed some businesses, he would have added some new products, so program also shall be changed accordingly. So an obsolete program lead to negligent audit work and lead to legal consequences. And contents of the program. Besides listing tasks to be performed, the program shall include instructions. What is the extent of checking, sampling plan, all that. Until officially updated by principal, the team members and all strictly has to follow the program. Concerns about rigidity are not true. Obviously, since program will list out what are all you need to do, each and every step will be listed in program. Obviously, people will feel that it is rigid. Rigidity will be there, but periodic review will be conducted to ensure that it is up to date. So keeping the program up to date ensures it is flexibility and relevance. So when you're developing a program, what points you should keep in mind? So what points you should keep in mind when you're developing the program? Audit planning starts after previous year audit. We already saw this point. Audit plan will be reviewed and modified during the audit based on the internal controls, preliminary evaluation, compliance with the compliance and substantive internal controls and substantive procedure. Timing and coordination. When you're developing a program, timing of the procedure you should consider. Coordination of client assistance. See whether assistants are available. See experts requirement is there. Other auditor requirement is there. On certain processes, auditor do not have discretion on timing. For example, on certain procedures, no, you don't have discretion. For example, physical verification of inventory, you generally will do on 31st March only. So what are the key points in program construction? 3 marks. Stay within the scope of the assignment. Don't check something which is not relevant in your audit. Prepare a written audit program to implement the plan. Identify best evidence reasonably available. Include any one relevant step. For example, identify best evidence. For debtors and creditors, best evidence is third party confirmation. For bank loans and balances, best evidence is banker confirmation. So identify for each audit procedure what is the best evidence. That's it. And specify the audit objectives and detail instructions for assistants. Try to identify what kind of errors are possible. Accordingly develop the program. Coordinate procedures for various interrelated items. And what are various broad types of evidences available? Documentary evidence. Physically you will get an evidence. Arithmetical calculations is one way of getting an evidence. Internal controls and checks. Minutes books is one way of evidence. Statements from third parties is one way of evidence. Explanations from management's officials. This is what we call it as written representations as per 580. That's it. Cash in hand. What is the best evidence? Physical count. Investments pledged with the bank. What is the best evidence? Banker's certificate. Debtors, what is the best evidence? There are so many. Client's ledger, invoice, credit note, all that, balance confirmation, many evidences are possible. Then advantages of the program. Here you will find some benefits of planning. Same benefits of planning points you will find. A clear set of instructions. Program will give you a clear set of instructions. It gives a total perspective for major audit. Selection of assistants based on capabilities becomes easier. Reduces risk of ignoring records, reduces. Assistants accept responsibility by signing the program. And monitoring progress, assist the auditor in monitoring the audit. It will help you to audit subsequent years. It acts as an evidence of due diligence. Okay, in case auditor was complained, that client complained on the auditor that auditor did not perform the work carefully, so auditor can prove, see, this is a program, this is how we worked, like that. Then disadvantages. Since program is rigid, no, inefficient people, like for example, work may become mechanical. Program sometimes may become rigid and inflexible. Continued use of outdated program may overlook changes in the business. So program has to be updated. That is the reason we have to update the program. Especially inefficient articles, they might defend their work deficiencies. They will say, I will ask my article, why you did not verify so and so point. He will say, that is not covered in program, no. So like that. So rigid program kill the initiative among the team members. So that's why you need to take certain precautions. Supervise the work to ensure that they understand the program objectives and avoid blind following. Foster receptive environment. Encourage assistants to observe objectively and report. So that's why you need to tell the team, look, this is a program for purchases. You have to do exactly audit as per this program. At the same time, I should also tell him, also see whether in reality in the client, do you find any 11th or 12th point? If so, please report me. Now, extract of sample audit program pertaining to sales of an entity. So, vouch a few sales invoices, see, this is how sales, how to extent of check, what is the sample, who has done the work, who will review, all that, this is a program example. This is how a program looks like. Now in exceptional questions, we have some questions on program chapter. So let me go to the program chapter, exceptional questions. So audit strategy program, I think I think in this there are no exceptional questions. I think all were covered as part of this. In this chapter there is no exceptional questions as such. That's it. In Jan 25 2 questions were there, both are exceptional questions in Jan 25. That alone you read. Okay, that's it. Actually not required. Here itself I already covered. This is more than sufficient. So I hope I have given you a detail, at least a decent clarity through this 45 minutes revision. In our actual class we'll be discussing this chapter for 2.5 to 3 hours, where it will be much more exhaustive. So but since considering it's a revision class, I can't give much in depth because I have to save your time. With the very reason why many students watch revision is come up with another chapter later. That's it. I hope you're clear with audit strategy, plan and program. I think that main clarity you got right at the beginning itself. I gave you clarity. Planning means everything. Planning activity means everything. So in this chapter, planning means what, strategy means what, plan means what, program means what. Like that 4 parts the chapter is divided mainly. That's it. Okay, I hope you thoroughly got a decent clarity on this chapter. Something that you don't have earlier, I hope you have got clarity now on this particular topic. That's it. Okay, now you understood, even though the chapter is very small, why the weightage is very high. It's very small, but it's very tough. It's not that easy chapter at all, very tough. But if you continuously read thoroughly, revise thoroughly with a proper clarity, there is a high possibility that you will write very right answer. That's it. That's it. Okay, take care guys. Thank you. Yes, just guys, just check out once. Some issue. Yeah, got it. It's solved. Yes, perfect. Perfect. Yes, I'm proceeding now. So let's discuss now about SQC and 220. There are 2 standards, standard on quality control and 220. So both let us discuss now both. This is actually part of quality control topic. This is actually part of quality control topic. I hope every one of you are aware of quality control topic, which is there in your ICA book as a part of 11th chapter. 11th chapter is ethics and terms of engagement. Inside that, ethics discussion is there, terms of engagement, which is nothing but SA 210 discussion is there, then SQC and 220, 2 standards were discussed. This is third part, nothing but quality control part in that chapter. Now this ethics and terms of engagement is already covered, immediately after nature, objective and scope of audit discussion, ethics and terms of engagement. Then only we discussed audit report topic, which is already covered as part of part 1 audit marathon. Now this SQC and 220 now we will discuss. Now, so what are the 2 standards? Both are dealing with quality control. Both are dealing with quality control. SQC is also a quality control standard. SA 220 is also a quality control standard. SQC is applicable for firms, audit firms. It is not applicable for auditor, or no, it is not dependent upon engagement. It is applicable for the firm. Where the firm is providing audit services, assurance, related services, review, anything. The firm might be providing audit, review, other assurance and related, doesn't matter. It is applicable for the firms. So SQC is applicable for all types of engagements, whereas 220 is only applicable for audit engagements. We know very well, even in the nature, objective and scope of audit revision, I clearly spoke about, whatever works that we provide are broadly classified into 2 types, assurance engagement, non-assurance engagement. We provide again assurance on historical financial information other than historical financial information. On historical financial information, we provide reasonable assurance, limited assurance. Reasonable assurance, if at all we are providing on historical, then that is addressed by standards on auditing, whereas limited assurance is addressed by standards on review. Other than historical financial information is addressed by standards on assurance engagement, and non-assurance is nothing but related services, standards on related services. Remember, at CA interlevel we only have discussion about standards on auditing. We don't have standards on review, we don't have standards on assurance, we don't have standards on related services. Just 1 minute. Yeah, so we don't have standards on related services in our syllabus. Getting it? We only have standards on auditing. That within standards on auditing, some 6 to 7 standards we don't have syllabus at all in CA Inter. We only have it in CA Final. So anyhow, at final level, we'll be discussing the pending standards. Now, what is this SQC? SQC is applicable for entire firm. SA 220 is applicable for a specific audit engagement. So I'm performing audit of one company for a particular financial year, statutory audit, general purpose financial statements audit. SA 220 is applicable for that. Actually, SQC talks about firm shall establish policies and procedures. SQC talks about every firm, every CA firm, whether it's a proprietary concern, partnership firm, whether it's an LLP, okay, so whether a CA is practicing individually or practicing as a partnership firm, doesn't matter. They both are considered as they both are considered as firms, audit firms. Audit firms must have quality control policies and procedures. Audit firms must have system of quality control. So that rule is prescribed under SQC. SA 220 says, whatever quality control system is developed, right, the firm shall develop quality control system, right? The firm shall develop the quality control system. That fact is mentioned under SQC. The firm should implement it in audit. The firm should implement quality control system in audit. Implementation part is covered under 220. That's the basic difference between SQC and 220. SQC talks about establishing the policies and procedures, establishing the quality control system, whereas 220 talks about implementing that quality control system in the audit engagement. That's the basic difference between SQC and 220. I hope you're clear now. Now, what do you mean by quality control? You see the heading of SQC. SQC is what? Quality control for firms. What the firm is doing? It is performing audit, review of historical financial information and other assurance they are providing, and they are also providing related services engagement. So the firm is providing audit, the firm is providing review, the firm is providing other assurance service, and the firm is also providing related services. So whether the firm is providing any of this doesn't matter. Quality control standard is applicable. Now what SQC is saying, you know, SQC simply says one thing: establish quality control system. And what is exactly a quality control system? Very simple. You remember Domino's, you remember KFC, you remember any McDonald's. You see Domino's pizza, whether you have it in India, whether you have it outside India, everywhere the menu is same, everywhere the pizza is same, everywhere the making process is same. So that is why wherever you go and have a Domino's pizza, the taste is same. Why? That's a quality control, because Domino's has standardized the way how to make a pizza. Pizza making process is standardized. Why the standardized? To give same taste, same experience to the customer at any place in the world. Yeah, whenever you come and buy the pizza, it will taste exactly the same. 95% accuracy they will achieve. That's a quality control, nothing but. Same way, we chartered accountants, whenever we are performing audit, whenever we perform the audit, wherever we perform the audit, whatever the client, doesn't matter, we must achieve quality in the audit. So the audit that we are performing must be qualitative. For that reason, we have to establish certain policies and procedures, standard operating practices, standard operating policies, system of quality control we should establish. Okay, where and all we should establish system of quality control? The standard identified totally 6 areas. The standard identifies totally 6 areas where quality control policies has to be established. Leadership responsibility, one element of quality control. Ethical requirements, another element of quality control. Acceptance and continuation of client relationship. Human resources. Performing the engagement. You see, they are not using the word audit. They are using the word engagement. In entire SQC, they don't use the word audit, review like that. They use only the word engagement mostly. And monitoring. So there are totally 6 elements of quality control. 1, leadership. The firm top management should accept the responsibility for overall audit. 2, the ethical requirements. The firm shall establish policies so that the firm and the team members will comply with ethics. Whatever work they are doing, they should comply with ethics. Acceptance and continuation. You know how to accept a client, which client should be accepted, which client should not be accepted. There must be a policy on which client will be accepted, which client will not be accepted. The firm should establish policies and procedures. And human resources, how many staff the firm shall have, all that. Engagement, performance monitoring. Let's discuss one by one. So what is the objective of this standard? Very simple. The objective is very simple. The firm shall establish a quality control system. Quality control system is also called as policies and procedures. Why you need to establish? So that to ensure that compliance with standards, compliance with law and regulation, and reports that the firm issuing is appropriate, where engagement risk is low. The reports issued by the firm for various kinds of works which they are accepting, the reports given must be right, the reports given must be appropriate, which means engagement risk must be low. The quality control system, the quality control system consists of policies and procedures to achieve these objectives. So automatically the policies and procedures nothing but consist of these what are all rules and regulations the firm and the staff, everybody shall follow to achieve these objectives. That's it. Next, 1 minute. Yeah, perfect. See, if at all any of you who are watching this in the live, if at all in between if some issue comes, don't worry, just refresh it, it will work. Okay, that's it. Now, and remember, these quality control systems policies must be documented, and it must be communicated by the firm to all its staff, partners, articles, paid assistants, to everybody. Now let's discuss each and every element. Now let us discuss each and every element. What are the elements of quality control? Most important element in quality control is acceptance and continuation of client relationship. This point you will once again see in audit engagement, audit strategy, audit planning, audit program topic. Just a minute. I think everything is proper. Just 1 minute. Be online. Streaming bitrate is proper. Everything is proper. Yeah, I think it is good. It's proper, right? Just 1 minute. Let can somebody confirm me whether you're able to, I mean, is it smooth? Okay, fine as a whole. Yeah. So very occasionally in the live, very rare it lag, but again it will saturate immediately. So kindly just follow that. Fine. Okay. So the most important element in quality control is acceptance and continuation of client relations. So when a client comes, new client, what points the firm shall consider? Suppose if main partner is not there, another partner has to confirm the client whether the client is accepted or not. So what points they should check? This point is once again covered as part of preliminary engagement activities. This point is once again covered in preliminary engagement activity in one of the chapter audit strategy planning program. So acceptance and preliminary engagement activities will consist of one of the activity, that is nothing but this acceptance. So what firm has to do before accepting a client or before you continue an existing client, the firm must gather important information. What information? First one, integrity of the client. So check whether the client is honest or not. What do you mean by integrity? Integrity of the client. What matters you will consider in integrity? This itself can be asked as a 4 marks question. Straight away, integrity of the client matters to be considered, like integrity of client principal owners, key management, top management, those charged with governance, client business practices and operations, how are they? What is the attitude of the client towards accounting standard? Are there any pressures on the firm to reduce the fee? Is there any scope limitation? Involvement in money laundering activities. Why are they changing the auditor? Why previous auditor is not reappointed? These are all points you should consider. You should ask the client. You should get that information before you accept him or before you give consent for continuation. Remember, acceptance and continuation of client relationship means what? Acceptance means what? Acceptance means a new client. Continuation means we are talking about existing client. That's it. Now, so integrity of the client you need to consider. Second one, you should consider your competence. See, many clients will approach you tomorrow, but you can't accept them just for the sake of money. You should know whether you can do that work or not also. You must check your competence levels, your capability, your time and resources. Do you have enough time so that you can deliver that work? Do you have enough staff members so to perform the engagement? And compliance with ethical requirements. Before you accept, whether are you ethically fit or not. Because for example, a company client want to appoint you as a statutory auditor. See whether are you eligible, qualified and not disqualified or not. You should only check. And what are all various ethical requirements we will discuss in CA final? We have something called professional ethics in CA final. There is something called CA Act is there we will be discussing. And the firm shall document how these issues are resolved while accepting or continuing a client relationship. So when you are accepting and continuing, when you are doing this entire, you are gathering information about the client, you are checking the competence capability, if any issues arises in this, okay, how did you resolve it? That also firm has to document. Then now remember, if any conflict is there between the firm and client, suppose no, my relative has some shares in the company, that's a conflict. It must be resolved before accepting the engagement. If firm gets any information after accepting the engagement, I accepted now, we started audit, now we got to know some information that could have affected the decision regarding acceptance. If at all I know this information earlier itself, I would have declined this work. Then what the firm has to do? The firm should assess legal and professional responsibilities, including reporting to relevant authorities and possibility of withdrawal from the engagement or from the client relationship. So if at all firm no, we gave acceptance to the client, yes sir, we are ready. Now we started auditing also. Now we got to know that one of the partner has shares in the company. If at all we know this information earlier, we would have not accepted this client itself. Now what firm has to do? Consider legal obligations right now. Consider professional obligations right now. See whether you have to report it to anybody or not. See whether withdrawal is withdrawal required or not. Is it from the engagement you withdraw or from client itself you withdraw? Check out. So this itself was asked for 3 or 4 marks question many a times. Okay, so that's it. Integrity of the client, this itself can be asked. Acceptance and continuation of client relationship, this itself can be asked as a 4 marks question. Very important. Then human resources. So what is human resources? Every firm, tomorrow your opening practice, you have to establish policies and procedures so that you will have a reasonable assurance that firm has sufficient persons with the capability, competence, ethical principles to perform engagements in accordance with standard. You must establish policies and procedures in your organization in such a way that you have staff member who are competent, who are capable, so that whatever works your firm is accepting, no, they can perform it competently. And you must develop an HR policy. The HR policy shall address recruitment, how to recruit articles, how to compensate them, how to train them, how to develop their career, and performance evaluation, how to evaluate their performance. You must have HR policies like that. And you must focus, the firm policies and procedures relating to HR must focus on continuous development of the personnel. Like some firms, no, they'll have a policy. Every Saturday, full day, seminars will be conducted, updates will be discussed, like that. So one day they will dedicate for training of their staff, like that. So that's a policy for them. So the firm shall establish policies and procedures for HR. HR policy shall address 3 issues like this. That's it. I hope you're clear. And engagement performance of the work, like you accepted audit, you accepted review, you accepted some related service, whatever the work you accepted, to perform that work you must have some policies and procedures. So you remember, consistency in engagement can be achieved by briefing the teams on objectives, what are the standards applicable, supervising them, training them, and performance review methods. Like whenever your team member is working, no, you need to review them, how are they working, all that. Consultation must take place. Remember, whenever we are working, no, like a team member is working in a firm, so many teams will be there. I am part of one of the team member, and I was given some audit work in one of the client. So when I'm doing this audit, I got some doubts. Whom should I consult? I should consult either a senior, I should consult partner. If at all even still my doubt is not resolved, I should consult somebody within the firm. Even if my doubt is not resolved, I should consult externally somebody. Such a kind of consultation facilities must be there. So consultation must take place for resolving difficult or complex matters with individuals inside the firm or outside the firm. External consultation may be required from others, other firms, professional bodies for advisory services. So when you are performing the work, no, policies and procedures must be implemented in such a way that, you know, policies and processes must address various issues like briefing the team members, engagement standards, supervision, training, all that. And consultation must take place on difficult matters, all that. External consultation may be sought for any complex matters and all. And remember, engagement quality control review, this is most important in this. In engagement performance, most important point is this 8th point, engagement quality control review. What is engagement quality control review? See, whenever we are doing any works, you know, significant judgments will be there. Wherever in any work that you are doing, especially in audit, if any significant assumptions, significant judgments have been taken by the partners, by the auditor, the significant judgments must be reviewed by a quality control reviewer, okay, before issuing the report. Remember, quality control review, engagement quality control review must happen before the report is issued. Now, to what extent reviewer will review, it depends upon complexity involved, risk involved in that engagement. In that audit engagement or in that engagement, what is the complexity? What is the risk? Depending upon that, the review will be happening. If the risk is very low, complexity is very low, review might be happening within 2 days. If the risk is high, complexity, the review might increase. Next step. Now remember, if the review does not reduce partner's responsibility, remember I am the one who is signing the audit report ultimately. Just because a reviewer is coming and reviewing, my responsibility will not reduce. This is just like a a precaution. Before I give my report, I will ask reviewer. So what is engagement quality control review? In audit, I will tell you. Very simple. I am the partner and I have some team members. We have conducted some audit of a company for 40 days. Over, where I concluded that unqualified opinion shall be given. But before I give my report, no, I will ask my another partner of the firm. I have partner, another partner is there. He is not my team member. He's just another partner. I appointed for my audit as a quality control reviewer. I appointed him as a quality control reviewer. What he need to do? He will check my documentation working paper. He will go through entire work what I am doing. He will check whether anywhere I am taking wrong decision and all. He will verify all my important decisions and all. And he will also see. He will ask me, Harsha, what you decided? I tell him, sir, I decided to give unqualified opinion. Then he will also check my working papers and tell me whether my opinion of unqualified, which I concluded, is it correct or not? He will discuss and then tell me. He will just review and then tell me. Once he gives, okay, Harsha, you can proceed. Your conclusions, your work, your everything, your report, everything is proper. He told me. Then I will proceed and give unqualified opinion. So before I give a report to a client and third party, my entire work will be reviewed by somebody. So this is for a better quality control. Now, and remember, engagement quality control review is mandatory for audit of listed entities. Which engagement audit? That for which clients? Listed clients. For listed clients, if a firm is doing audit, then the partner shall not issue audit report without completing engagement quality control review. So EQCR is must for all audits of listed entities. For other engagements, sir, non-listed company audit, sir, it's a review engagement, sir, not audit, sir. For them, whether a quality control review is there, it will be firm's choice. Firm will develop the quality control review criteria. Now, sir, okay, sir, the partner quality control reviewer came, sir. He reviewed entire work, sir. The quality control reviewer told my audit report is not correct. I should not give unqualified opinion. Whereas I am feeling unqualified, sir. He is saying qualified opinion. Now there is a difference between us. What to do? Any disagreement between the team members, between the reviewer and partner, it shall be resolved before issuing the report. Suppose if reviewer, he recommending qualified opinion for me, whereas I decided unqualified is correct. If his recommendations are not accepted by partner, as a partner I am not okay with his recommendation, then the matter shall be resolved by policies and procedures, by consulting another practitioner or by consulting another firm or professional body. So see, if there is a conflict between the partner and reviewer, if there is a conflict, whose decision will prevail? Both of you will not fight. Firm quality control policies will be there. Inside that, what they are saying, what rule is there, follow that rule. That's it. Then the most important, documentation. The firm must establish policies for documentation also. Remember, so the firm must establish policies and procedures for timely assembly of final engagement file. You see here they are not using the word audit. In audit documentation chapter, you will see the word final audit file. Here you will see the word final engagement file. This engagement may be audit, this engagement may be review, this engagement may be related service, anything. Correct? Especially assembly of audit file. For audit cases, assembly must be completed within 60 days after issuing the audit report. Sir, what is assembly? I already covered in audit documentation revision. And remember, the firm must establish policies for maintaining the working papers, documentation, confidentiality, integrity, accessibility, retrievability, and ownership. Remember, the engagement documentation is property of the firm because they are the one who is working upon. So the documentation, whatever they are gathering, is property of the firm. The firm, if they want, at their discretion, may disclose documentation to clients, provided that disclosure does not affect confidentiality, validity of the work performed, all that. And not only that, the documentation, you work so many, you provided so many engagements, right? You worked on some audit, review, all that, right? So some documentation is there, right? How long you should retain it? You should retain it for such a period which is important. The documentation should be retained long enough to perform monitoring. What is monitoring? Monitoring means, I'll tell you very simple. We complete our work, right? Once all the works are completed in this year, at the end of the year, generally what happens, this partner will check all the other partners' works. Other partner will check my works. So this is called monitoring. So until monitoring is completed, documentation must be retained. For audits, the retention must be for 7 years. For audit engagements, typically audit documentation, for audit engagements, the documentation must be written minimum for 7 years from the date of auditor's report, or if later, group auditor's report. So either the audit report date or group audit report date. Group audit report means consolidated financial statements will be the right from that audit report date, whichever is later. Monitoring. The firm shall establish policies and procedures for monitoring. So why we need to monitor? Monitoring is important to evaluate whether quality control policies are relevant, adequate, and operating effectively. How do we monitor? By doing periodic inspection. Perform inspections of completed engagements. Already some completed works are there, right? Go back, open the works, open the documentation, see whether the work is properly performed or not. See the report issued is properly or not. Once again check it. See, inspection is nothing but, for listed companies, inspection will happen indirectly through engagement quality control review. Once audit report is also given, after that once again they will open and check. That is called inspection as part of monitoring. After the report, if at all review is happening, review of audit documentation is conducted after the report is issued as a part of monitoring, then it's a monitoring. If review of audit report, review of audit documentation is happening before audit report is issued, that's an engagement quality control review. That's it. So perform inspections of completed works to check whether the work is in compliance with quality control system or not. And finally, the first element, leadership responsibility and ethical requirements. Ethical requirements first I will finish. The firm shall establish policies and procedures so that the firm will comply with code of ethics. What is code of ethics? Integrity, objectivity, competence, confidentiality, behavior, independence, all that. Now, the firm shall establish policies so that the firm will maintain independence wherever required. So the policy and procedures shall ensure that the firm shall communicate independence requirement to personnel. So the firm shall have a procedures where they are communicating independence requirements to people. And the firm shall identify and address threats to independence. Withdraw if the threats cannot be eliminated. So there must be a policy on how to address the threat. There must be policy on how to withdraw. For withdrawal also some procedures will be there. That and all in depth will be discussed in CA final. Then engagement partners should report any threats of independence to the firm promptly. So who should do this ethical requirements check everywhere? Engagement partner shall check mainly. So he is the one, he should check whether any ethical requirements are conflicting. If there is a conflict, he must immediately report it to the firm. He must check quality control policies and decide whether to accept or not. Then prompt notification of breaches. If any ethical requirement of breach, immediately the concerned partner, the concerned team member should report to the top management of the firm and obtain written confirmation of compliance with independent policies from all personnel. Every firm shall take a declaration they are engaged in. They complied with ethical requirements. Annually once they should get a written confirmation of compliance with the firm's policies and procedures with independence. Its independence policies. With respect to independence policies, annually one letter has to be obtained. Remember, very important for MCQs and all. Then leadership. SQC1 requires policies and procedures to promote a culture that values high quality. The CEO of the firm, the top partner, managing partner, he must take ultimate responsibility for the quality control system. Leadership should set an example that promotes high quality audit work. The persons responsible for operational quality control must have experience. What is meant by operational quality control? The people inside the firm, one or two partners will be given this responsibility of developing policies and procedures. Developing policies and procedures responsibility will be given for some people, some partners. Those people are called as operations personnel. Those people are called as the firm's persons responsible for operational quality control. They must have sufficient experience, sufficient ability, sufficient authority so that they can develop policies and procedures in light of various standards on auditing, all that. That's it. So this is also a bit advanced standard. It's not that easy because this requires a discussion of so in-depth basically, but since it's a revision, we can't cover all that. Basically whatever is required I covered. Now 220, quality control for an audit of financial statements. Quality control for an audit of financial statements. So what is the scope and objective? 220 says what? Engagement partner is responsible for quality control procedures at audit engagement level to comply with the firm's SQC. You see here they are using the word to comply with SQC. So the partner has to ensure that whatever the audit work he is taking responsibility, he must ensure that that is complied as per SQC. So what is the objective of 220? Implementation. SQC objective, establish. SA 220 objective, implementation. Implement quality control policies at engagement level to ensure that audit complies as per standards, audit report is appropriate. So what are the responsibilities of partner? SA 220 outlines responsibilities of the partner. What are the responsibilities? Leadership for quality. What is that? The engagement partner must take responsibility for overall quality. MCQ. The actions of engagement partner in taking responsibility shall emphasize. This itself was asked as 4 marks question many times. The actions of engagement partner when taking responsibility for quality shall emphasize. Engagement partner should behave in such a way where he will demonstrate performing the work that comply with the standards, comply with the firm's quality control policies, ensure that report is appropriate, encourage the team to raise concerns. As a partner, I should tell my team members, please raise any queries and all freely without any fear of reprimand, all that. Getting it? Then ethical requirements. Partner is responsible to identify threats to independence. Whether are there any threats in this audit, independence related threats, and the partner has to eliminate them. If they cannot be eliminated or if safeguards cannot be implemented, the partner has to report it. Reporting by partner to appropriate firm for appropriate actions. What appropriate action? Either eliminate the threat or withdraw from the engagement. Partner is responsible before accepting a client, audit client, ensure the partner has to check whether information we obtained regarding integrity, competence, ethical requirements, significant issues from previous audit, and performance of the work. The engagement partner is the one who will direct the team, who will supervise the team, and he will ensure that the work, the audit complies with the standards. The partner is responsible for performance of an audit as per standards, all that. Review of documentation. What is this review of documentation? There is one question actually. For example, one firm is there, one partner who he's completed entire work, he has to sign the audit report, but while he's coming to office next day to sign the audit report, only audit report signing is pending, he decided to sign on the next day because it's a good day. For example, he died. Another partner, since this partner has already completed the work, he signed the audit report and gave. Is there anything wrong? Yes. Before you sign the audit report, the one whoever is signing the audit report, right, he must review documentation before you sign. Review documentation. Why you should review documentation? Ensure that sufficient appropriate evidence has been obtained to support conclusions so that you can issue the audit report. So before audit report is issued, I must review once again entire documentation we gathered. See whether the documentation gathered, see sufficient appropriate evidence is there, conclusions are they appropriate, everything once again you should ensure, and then only you sign the audit report. And see that consultation takes place on difficult issues within the firm or outside the firm. And for audit of listed entities, engagement partner shall ensure that engagement quality control reviewer is appointed, and the partner shall discuss all significant matters with him, not to date the audit report until the review is completed. If difference of opinion arises between the team members, among the team members, between the team members and consulted people, between the partners and reviewer, they shall be resolved as per policies and procedures. Documentation. The engagement partner should document ethical issues identified. What are the ethical issues if any ethical issues are identified, how are they resolved? Independence related conclusions reached on acceptance and continuation, consultation related details including scope of consultation, all that. These are all various things that he should document. They may ask you this itself as a 4 marks question, SA 220. Okay, documentation requirement as per 220, that itself they can ask. Write about engagement performance, a 5 marks question they might ask, okay, under 220. Acceptance and continuation, generally they will ask is as part of SQC. In SQC matter is the same matter that they will ask generally. That's it. So this second point in this leadership responsibility, actions of engagement partner, this itself can be asked as a 4 marks question. Very important. See, this matter, this SQC topic, quality control topic seems very simple, but this is very complex. It's not that easy to comprehend. Okay, so but since it's a revision session, I tried my level best to bring it in a shortest time where every point is covered in depth. That's it. Okay, so I'm not giving too much of explanation because I assume that you have already been aware of it. So that is the reason initially I took an example of Domino's Pizza, all that. That's it. So with this quality control topic is completed, guys. Pakka, I'm telling you 5 marks possibility is there. Pakka 5 marks possibility is there. Right now, whatever I discussed in the last half an hour, pakka mark my word, 5 marks possibility is there. That's it. Once I'm doing paper analysis video, I will once again connect to this particular video. That's it. Okay, so continue with this quality control topic is over.